But really what they are doing is statistics at an extraordinary scale. So large language models that led to chatbots are about training these systems on human language so that they can build statistical estimates of answers to your prompts. When you're thinking about something like weather, that's another very, very, very complex system. Think about how huge the atmosphere is that surrounds the world. Think about how complex the calculations are when we run simulations to try to estimate how the weather will progress in the short term. And then think about how hard that problem is when we're thinking about climate effects over many years and many decades. That is the complexity that AI helps wrangle because of this new approach of training a computer on a lot of data so that it can build better estimates of what could happen in the future. And harnessing that power is going to lead to some very practical advances, we think, in both understanding weather better, but also understanding long-term climate effects. That's what's going to help us be more prepared and more able to deal with what's coming.
And obviously the US is a huge key driver in developing AI technologies, but I'm curious, as a non-US citizen, who do you see elsewhere in the world doing interesting things?
Well, this is a global technology. First of all, again, AI, it seems like magic, but it really is human beings and corporations that are building compute, that are training it on data. They're using algorithms that are developed in research communities and widely shared. And so the ability to build AI of various sorts, it happens around the world. And in fact, I think that's good because there's so many applications globally that we'll want to pursue. But of course, it does mean that it really comes back to the question of what kind of a future we're going to build. And, if you think about it, it's such a powerful force right now. Every country around the world is using AI to build a future that expresses their own values. And I think this is why it is so important that like-minded countries with democratic values and norms come together and agree about how we're going to build the rules of the road for AI.
You're advising President Biden on this new age of artificial intelligence. How is the Biden-Harris administration thinking about AI?
The starting point for this administration is what the president talks about every time he talks about AI. He sees its power and its potential. And every time he talks about it, you can hear his optimism about all the things that it's going to bring. And he's very clear-eyed that that doesn't come for free and that managing its risks has to go hand in hand with it. President Biden frequently talks about the fact that we're at a pivotal moment in history in which the choices that we make in the next few years are going to shape many, many decades ahead. AI for him is very much part of this moment. And that's why you've seen this administration move out so actively with urgency, starting by listening to all kinds of communities. We talked about the work that we've done with industry, but also we've had very active engagement with civil society.
Dr. Prabhakar, thank you so much for joining us.
It was a pleasure. Thanks for having me.
everyone. And Kumar, thank you so much for joining us. So you're a professor at Caltech and you're senior director of AI research at NVIDIA.
Which actually makes you the perfect person to answer a question that we've had, which is really broadly, how is AI changing, or has it been changing the scientific process over the last couple of years? Let's begin with that.
Yeah, this is such an exciting time. Thank you for having me on this show. And, the world has seen ChatGPT and the power of AI when it comes to language models. But to me, that's just the beginning, because beyond language, we can think of all kinds of scientific processes. And by understanding that through AI, we can do everything better, faster, cheaper, more accurate, and really be able to come up with new inventions and discoveries.
Let's dig into that. What does an AI-enabled lab look like?
Yeah, to me, like AI will completely transform the scientific workflow the way we know it. Ever since the 17th century or even earlier, the way we came up with new inventions or discoveries was somebody has some intuitions, right? They went to the lab, they tinkered, they're like, oh no, this doesn't work. And okay, this works, let's move ahead.
Trial and error.
Right? Exactly. And now think about AI being able to do that in the virtual domain, like being able to accurately simulate many of the processes or learn from data, right? The observations directly. And with that, be able to come up with better design, better discoveries than what would have taken really long in the real world.
What's changing the most right now? When you look at the landscape, is there any particular field that you see evolving much more quickly than any other field?
One thing that we're working on heavily is the Earth-2 project at NVIDIA, where our goal is to build very accurate digital twins of this planet. Be able to predict not only short-term weather, but also long-term climate change eventually.
The digital twin of the Earth, what is being twinned?
Yeah, all the processes on this planet. Think of like the atmospheric processes of convection currents, storms, right? Even really like fine scale features of cloud turbulence, what's responsible for hurricanes, for instance, how would this hurricane paths change, and can we come up with the right risk assessment? Because these are chaotic systems. These hurricanes can go in so many different ways. Can we really hone in on what is the risk to different human populations based on what we see today? So these cheaper and faster weather forecasts with AI will also enable us to create better probabilistic assessment of extreme weather events.
Let's talk about some of the other fields that AI is making transformations in the scientific process. For example, genomics or even drug discovery. What's going on there?
Oh, it's such an exciting time there because, the same kind of generative AI that we see for language, you can replace the letters of the English alphabet instead with nucleotides. ATGC, if you recall what makes up our DNA, right? And with that letters, you can now ask the language of the genome and have a model learn that.
So if there are tasks that artificial intelligence can make more efficient or even replace humans in a lab, what's kind of the vibe in the scientific community? Is there as much fear as there is in other industries that AI could take their jobs?
I don't think it'll happen anytime soon, and maybe never, because humans are such creative beings, right? We're always thinking of the, next unknown question, right? There's so many deep mysteries of the universe. There's so much we still need to understand. And AI is a tool. This will enable lab scientists to rule out a lot in simulation before they can go and do their experiments. So they only need to do a few. But then I feel like there'll be always things that'll be still unknown and to be conquered.
There's a lot of, I don't want to use an unpleasant word, but there are a lot of people who don't believe in things like climate change. And there are a lot of skeptics who believe that science is out to get them, or that, we're all just sitting here lying. Is there work being done that you think could actually win over some of these skeptics? Is there a way to demonstrably show them?
Yeah. I do think all the work we're doing will help towards this because, this is not some model that's in some supercomputing facility, right? Not available to the public. I mean, you can download this and go try some of this yourself. Just like a video game, you can play the game of climate change one day, right?
Quantum physics.
So everything becomes accessible. At least my hope is, chunk of the community that is curious will have resources online that is much more open so they feel like they can participate in that.
If you think about the scientific journey that humanity's been on over the last 300 years, it's been quite good. Just take us 10 years from now. Like, how different will things be?
I think the whole process of scientific research and development will be accelerated many, many times, right? Even orders of magnitude in some areas. And that'll just mean that we can quickly rule out things that don't work and hone in on things that work. Certainly, drugs designed by AI, they're already coming into trials, and that'll just increase fully. Personalized medicine for cancer and all of these where we really haven't been able to understand, right, for various different targets, how to quickly design drugs. This can make it much faster and also cheaper because right now so many of these treatments are too expensive to be done at scale. So it'll make this democratized and cheaper. And yeah, I think this will hit every area. I don't think any area is immune to this.
I think it will be interesting, won't it? 10 years' time, if it takes the average drug 10 years to come to market, and if AI systems right now are coming up with some of the potential candidates for a future successful drug, then in 10 years' time, are we going to see a waterfall of new drugs?
I mean, it may not be a huge number, right? Because you can't test all of them. It'll be more targeted. It will be personalized. It will
actually work.
Exactly, effective.
Thanks so much for joining us.
Thank you.
Thank
it's been
you, Maud.
fascinating. Yeah. Thank you for taking the time.
Yeah.
Over the past decade, China has gone from a Silicon Valley copycat to a top contender in technology on the world stage.
Its ascent is peaking at a time when geopolitical tensions with the US and Europe are intensifying, and the rise of artificial intelligence has sparked a new arms race.
The US is rushing to curb China's influence in AI while balancing the need to regulate the powerful technology within its own borders.
How America manages these competing priorities will have implications for where the balance of power in tech will shift to next.
On this episode of AI IRL, we'll explore how China's playbook went from imitation to innovation and discuss what's at stake in the competition between these two superpowers.
Mustafa Suleiman, thanks so much for coming in. Now, you are the co-founder and CEO of Inflection AI and a venture partner at Greylock. Some people will know you as one of the co-founders of DeepMind, now owned by Google. Tell us, what made you want to start fresh with Inflection?
Well, now is really the moment. I mean, it was very clear to me during 2020, 2021 at Google when I was working on Lambda, the conversational AI that now powers Bard, that these large language models were truly going to be the future. And I wanted to start a company to build personal AIs, an intelligence that is completely aligned to your interests on your team and really functions as a personal assistant or a chief of staff, one that knows you intimately and over time can actually help you with practical tasks like scheduling, prioritizing, planning, and those kinds of things.
And that's what you're working with Pi.
Exactly, yeah. Pi stands for personal intelligence, and we see it as your personal assistant, essentially.
How do you feel about the concentration of power in technology right now among the big companies coming out with their own AI models? Microsoft, Google, Meta.
Well, I mean, I think you're right to point out that the big companies have the resources and the people and the compute infrastructure to be able to adapt and compete faster than ever, right? And that is a very impressive, reality of how technology works these days. It requires a huge amount of compute. And at my own company, Inflection, we've managed to raise a lot of money and build one of the largest supercomputers in the world. But on the flip side, the other trend that's taking place is that the open source movement is now almost at cutting edge. I mean, it's probably about 12 months behind the very largest models built at the big tech companies. And so that's kind of a contradictory trend. Like the big companies are getting bigger and better faster, but also everybody is now going to be able to get access to these same capabilities in open source.
Let's fast forward a little bit into the present day where the world order has changed since you first entered the tech industry. How did China go from being a copycat culture to a contender when it comes to digital innovation and specifically AI?
Yeah, I mean, China is more than a contender. I think in many respects, it's one of the leading players now. I mean, they've always been incredibly creative. And I think that we may have, sort of overstated the extent to which they were simply copying, what we were doing. And I think it's important to remain humble about the fact that, these ideas are going to be widely available to millions and millions of people. And, in many respects, all of our cultures are equally creative, and they've been able to take, tools and ideas that are available both in open source and the academic literature and move them forward, innovate at the cutting edge. They've produced a lot of very good papers, contributions to the academic conferences that have been peer reviewed. So, I just think overall it's better to take an approach of humility, acknowledging that, they're also going to be a really significant player in this field over the next few decades.
How would you rank the United States in terms of technological prowess in that world order?
Well, I mean, there's no question that we, in the US and in the West more generally, are currently in the lead. I mean, we have the very best, most innovative technology companies and technology hubs. Without doubt, Silicon Valley is leading the pack. And I think we'll continue to. I think we worry too much that we're going to sort of be dislodged from our podium position.
For how long do you think?
Well, I think the question is, what does it look like to be dislodged? And is that really the right framing in the first place? Like, what is the difference between first and third? And, people talk about there being a race for AI, and it's very unclear what that looks like to come second or third in that race. I think it's sort of the wrong metaphor.
Are we talking about superpowers, Clash of the Titans sort of stuff? It reminds me of back when the previous US administration banned companies from doing a lot of business with Huawei and Huawei ended up basically having to get a lot better very quickly at making its own chip designs and all that kind of stuff. And it feels like it backfired a little bit.
Yeah, you've also advocated for the US restricting sales of some NVIDIA chips, which are crucial in training AI systems, to buyers who don't agree or who refuse to use them ethically and safely. So what do you think is the best way the US can actually flex its power? Is it through the technological innovation or by stifling effectively some of its adversaries through regulation?
The first thing I should say about that is I don't think now is the time to do that. I mean, I think in theory, when the time comes, if the time comes for us to adopt a kind of global anti-proliferation strategy, we're worried about technologies being so powerful that we have to stop their spread. If that moment arises, and I think we're quite a long way from experiencing that, then technically that would be an appropriate containment strategy. Because much as this technology is manifested in software, it lives on the internet, it still sits on chips, whether you're training a model or serving a model. So in order to ask a model a query, you have to have access to one of those NVIDIA GPUs. And, for what it's worth, there are really only like one major company in the world that produces those high-end GPUs, NVIDIA, and they manufacture the vast majority of their chips at TSMC in Taiwan that use one single company, ASML, a Dutch company that manufactures the core chip that produces the chips, and they sit in the Netherlands. So it's actually a very narrow supply chain. And so I think the point I was sort of trying to make is that if you wanted to adopt a containment strategy, there is a supply chain where you can impose chokeholds on it.
And in 10 years from now, which country do you think will be leading the world in AI? Is it going to be the US? Will it be China? Will it be Europe?
It's going to be the US, I'm pretty sure of that. I mean, the fundamentals in the US innovation ecosystem are unquestionably the best in the world. I mean,
what could flip that balance of power?
Well, I mean, I think it's hard to say. I mean, I really do think that the US is in the strongest possible position. At the end of the day, it's talent that drives, this innovation. And talent still concentrates around a small number of physical places. Despite everything that we've experienced in the pandemic and people wanting to work remotely, it's still really important to be physically proximate to other people who, are working with you in the office. I mean, I think that trend isn't going to change. I do think China is going to catch up. I think they're going to develop their own AI chips, their own fabrication facilities. But that is going to take 5 years or so. The export controls that the US has implemented, are real, and they really will prevent China from getting access to the next frontier of models, so the GPT-5 onwards. Right now, I don't really see how China could train those kinds of models.
Is there any downside, any unintended consequences that could come from this containment strategy the US is employing?
Yes, I think it is a very aggressive strategy. The counterattacks have already started, right? China restricted gallium, which is a raw material used in chip manufacturing. And I expect them to have their own reactions in time. We're very dependent on their supply chain. And so the idea that we could completely decouple, I think, is misguided.
I'm going to just put you on the spot really briefly and wonder, can you tell, because we're all friends here.
Sure, go for it.
Like, do you have a major regret about your work in AI? And do you also have a major single goal?
Yeah, my major single goal is to show that it is possible to create safe and ethical artificial intelligences which are accountable to humans. There is a possible trajectory where some groups may recklessly experiment with algorithms that can self-improve. And if in 10 to 15 or 20 years' time, those kinds of AIs are set loose on the open web in a reckless way, then I can imagine that possibly causing serious harm. And so for as long as I can remember, almost 15 years that I've been involved in AI, I've been trying to raise awareness and concern about the possible ways in which it can go wrong. And part of doing that is to show a bunch of practical ways that it can go right, both with writing my book and laying out a series of containment strategies and things that we have to do in politics to improve our governance and regulation, but also in actually building and making Pi, which I think is hopefully going to continue to remain a very safe and controllable personal AI that can work for you.
Mustafa, thanks so much for coming in. Been a pleasure.
Thanks very much for having me. It's been great.
Toner, thank you so much for joining us. You're a director at Georgetown Center for Security and Emerging Technology, and you're also an OpenAI board member. Dan Wang, thank you so much for joining us. You're a visiting scholar at the Tsai China Center at Yale Law School, and you've been studying technology and China for many years now.
And we've just heard from Mustafa Suleyman, and he thinks that China's emerged as one of the biggest contenders in AI. So Helen, I'm just curious to start with, do you think we're overestimating China's capabilities?
It's certainly true that they're a big player. And it's also true that we shouldn't underestimate them and that we have a bit of a history of underestimating China's ability to innovate. I mean, I think 10, 15 years ago, the story, at least in Washington, D.C., where I'm based, was, yeah, China can't innovate. If they're producing things that look like new technology, it's because they've stolen them. I think that's clearly no longer true. At the same time, I think it's also very possible to overestimate them. And sometimes I think I see that as well. So are they a serious competitor? Yes. Are they eating our lunch? No.
So that copycat culture, it's fair to say that most people are thinking, we're past that stage. Dan, what do you think of that?
Well, I think it's certainly the case that China focuses on different things. So President Xi Jinping is, I think, a little bit less enamored with the internet platforms, with a lot of the cryptocurrencies, with a lot of the AI businesses that Silicon Valley specializes. He's also a little bit less enamored of Wall Street and financialization and hedge funds. And if I had to think about what Xi's broad views are, it would be much closer to being something like capitalism with German characteristics, which is much more about building cars, building hydraulic pumps, building heavy machinery, the heavier the better, about all sorts of these major industrial projects. And I think China is very much a leader in things that include electric vehicle batteries now, solar photovoltaics. It is making a lot of electronics products, and it is innovating on a huge sort of a lot of the automotive supply chain. But I think they have a little bit less of a focus on AI, and therefore there is not so much political direction anymore to really push forward these consumer applications.
I think it's fair, though, some of those areas, the US is also innovating very, very strongly. So are there any areas where China is innovating significantly better than the US?
Well, I would say something like electric vehicle batteries, where China has something like the 70% of all global expansion, all global capacity of electric vehicle batteries is now mostly in China. When it comes to the clean technology supply chain, again, these very industrial projects, these pieces of heavy machinery, that is a little bit more the focus. I think the US is really strong in things that include semiconductors, artificial intelligence, biotechnology. These are things, the smaller things, where China is not so good, but there are big areas in which China is way outbuilding the US.
I mean, the semiconductors is getting significantly better in China. I mean, partly maybe as a result of the Huawei issue. Helen, what's your view on the semiconductor side of this?
So China's definitely been investing for decades in trying to have their own independent semiconductor supply chain, and they've been making some progress. The thing to know about semiconductors is there's a huge range of sophistication, from the really basic semiconductors, computer chips that go in basic devices, your smart fridge, your car, up to the kind of more advanced chips that might go in a brand new iPhone, up to very advanced chips that go in kind of the data centers, gigantic warehouses full of computing, which is what you're training advanced AI systems on. So China has made a lot of progress on the more basic end of the semiconductor sort of scale, and is still really struggling to hit the most advanced end. And that's where, it's not even, you can't even say the US is, alone able to create those advanced semiconductors, but what you have is an incredibly advanced global supply chain.
Many describe artificial intelligence and its development across these two superpowers as an arms race. Is that framework misguided, do you think?
I think it's a bit misguided. I think you really want to look at what kind of AI are we talking about, and in what way might it be a race. I think the place where it's clearest that it makes sense to think in a competitive framework is in kind of military domains. So, it's just true that the US military really wants to make sure that it is keeping pace with, and ideally a little ahead of, the Chinese, or a lot ahead of the Chinese military in terms of what technology they have.
Dan, Washington has taken some steps to curtail some of China's ability to get their hands on the cutting edge chips that really power these AI platforms. What's your take on that? Is that an effective strategy, or will China just find a way to build their own?
I think that China is going to try to figure out a lot of the way to build their own. A lot of the chip makers now have been under very significant stress from US sanctions dating back to about a year ago now, released by the Biden administration, that is really stopping their ability to access not just the high-end chips, but also the semiconductor production equipment as well.
And I think in general, it's really difficult to distinguish between what kinds of technologies should the US really not want China to be able to develop, and where is it fine. So, you mentioned, clean technologies before, where China, if you're looking at, manufacturing solar panels, as you mentioned, EV batteries, a lot of other areas, China is doing amazingly at that. And what you're starting to hear in some, US policymaking circles is that maybe that's a bad thing, that China is making a lot of kind of clean technology stuff. And I find that a little sort of tricky to reckon with, is at what point do we want to really shut them out or prevent them from being, able to manufacture anything if it's something good, useful that we can use. Of course, if it's technologies that we think have really significant military value, I understand, but then it starts, the lines between those categories start to get very, very blurred.
It seems like these tensions are just ratcheting it up even higher as time goes on. With each administration, they're intensifying. So to your point, if we do need these other technologies, solar technology for this transition into a greener future, what kind of happens next? How much do we place on kind of the AI arms race that could then potentially work against us in climate change? Is that a concern, or is that too far in the future still?
Well, a few months ago, Beijing did announce some export controls on certain solar technologies involved in making production wafers.
So it's already happening.
It is already happening, that there are some threats out there that, relatively speaking, Beijing has been pretty restrained against retaliating against American companies of the likes of Intel, of the likes of Tesla so far, but these things could escalate more.
How does the relationship between, the ruling party in China play out against the kind of the development of companies?
I think the Chinese system is definitely more top-down when it comes to AI development. You see less kind of individual tech companies like OpenAI or Google taking the lead, and more these kind of multi-institution partnerships, or maybe you have a university and a tech company and a government, department all collaborating on big AI projects. That's much more common in China. At the same time, China is a huge country, so there's a limit to how much the government can achieve from the top. So a lot of what you see is sort of Beijing providing direction, providing ideas, providing sort of signaling of this is what we in the central government would be excited about.
Dan, how would you compare how the Chinese government is handling AI with its people versus how they handled social media?
Well, I think President Xi Jinping doesn't necessarily view AI right now, a lot of these ChatGPT-like applications, as some of the most economically productive things that are coming into our society. So I think that President Xi looks much more at AI like, he would at Facebook or Twitter, now known as X or whatever it is. These are platforms like TikTok that, if you're asking me, is something like TikTok or Facebook really increasing my personal productivity? Well, I would say actually it is really horribly detracting from my productivity. And so I think that a lot of these AI platforms right now create speech issues. When an ordinary Chinese person sitting in Beijing or Shanghai asks AI, well, what happened in 1989? Well, what do you think of socialism? What do you think of President Xi's performance? These AI tools are having a lot of challenges actually answering socialist correct values that are in line with the government's ideas. And so these are major speech platforms, first and foremost, and perhaps not really the economically miraculous thing that raises our productivity growth at the very moment. Now, it might happen later on. Right now, I think the party views it as somewhere between economically not that useful and potentially very socially destabilizing.
So from a consumer standpoint, AI is it can potentially create more problems for the Chinese Communist Party. But then if you look at it from like a surveillance standpoint or military type of AI applications, that's kind of in a different camp. Is that right?
Yeah, that's right. And I think they're definitely, one area where China is, I would say, leading in AI is on surveillance. They really have leaned hard into facial recognition, voice recognition, even gait recognition. So how you walk in a crowd, can they pick you out by that? I think in the West, there's been some development of these technologies, but with a lot of criticism from civil society, a lot of hesitation, sort of, I would say, like very yellow light. And in China, it's been blaring green light.
On the topic of WeChat, when we spoke ahead of this, I think we touched on the fact that there are some generalized misunderstandings about China's approach to social media and data and AI. AI relying on huge amounts of data, and the perception is that because of things like WeChat and similar things in China, that there's this huge pool of data that the population in China is very happy giving over and is used to giving over, and therefore is just sitting around waiting to be exploited by AI. And I remember that you made a pretty significant point. It's like, that's probably not really the case. And people think that's the case, but it isn't. So I wonder if you could touch on that.
Yeah, I think people have this perception that because the Chinese government is very controlling and has a lot of access to what's going on in Chinese citizens' private lives, that means that there's these beautifully curated, extremely complete, large databases of information that can be used to train AI systems or to do other things. But for anyone who's ever worked with data, you know that cleaning data, structuring data, making sure that the right information is flowing in the right places is incredibly challenging. So it's both true that the Chinese government can get very detailed information on the private lives of its citizens if it chooses to, and also true that it's incredibly messy the way that works, and incredibly difficult for any given actor to get access to something. So, for instance, a company trying to train some AI model using data is actually subject to a pretty significant data governance setup in China, data governance regulations that make it really challenging to use customers' data for things it wasn't already designed for, or that you didn't already get consent for.
Which we learned from Cambridge Analytica scandal just as one case, and there are many others. That is not the case in the US. It's
That's
not
right.
the case in Europe. There's a lot going on. The EU's AI Act is pretty widely praised by some people, not everybody, but it's quite broad and far-reaching. But that's not the case in China. in terms of what you're saying?
So China's setup is now more similar to the GDPR that exists in Europe. So around kind of protecting consumer data and giving people the right to, opt in to different uses. Of course, in China, there's always the exception, unless the security services, think that you might be a dissident, and then they're going to get whatever they want on you. But in terms of kind of companies, they're certainly relatively restricted in what they can do.
Switching gears a little bit, Dan, I'm curious about how China's sluggish economic growth recently weighs into the government's calculus and how they're thinking about AI's potential to spark social unrest.
I think that the Communist Party is very much involved in trying to think about, how to control possible social unrest. I was in Shanghai in November 2022 when there were protests in the streets denouncing zero COVID, denouncing the Communist Party by name, that these were things that were erupting. And so I very much sign on to Helen's description of AI, that China is leading in the AI of censorship. It is leading in the AI of facial recognition. That right now it looks very much like the US is a place where ordinary consumers can tinker with and play around on a lot of these AI tools, whereas in China is mostly reserving these very powerful tools for its own use, potentially to control society. That right now China is in a moment of economic weakness. This might deteriorate further, this might get a little bit better, but there is always this presence hovering over there that the state security might ramp up its technology really to make sure that there are no socially destabilizing incidents.
Well, Helen, Dan, thank you so much for being here. It's been great to learn from the both of you.
Thanks so much.
Thank you very much.
Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. Holding steady, the BOJ keeps its policy settings unchanged and nudges its economic growth forecast higher. Officials stop short of confirming an intervention that drove the yen sharply higher. President Trump claims a breakthrough in Gaza, saying the US-led Board of Peace has reached an agreement for Hamas to disarm, though questions still linger. And Apple shares slide in aftermarket trading as component shortages weigh on the company's sales forecast. It's just gone 8 a.m. across the Emirates. I'm Abir Abu Omar in Dubai. A lot to get through in this show. Happy Friday. Before we get into the geopolitics of the region and the yen, a big story after that BOJ decision just about an hour ago. Let's take a quick look at where markets are sitting. U.S. futures 0.3% higher. Now that follows a positive close for the S&P 500, about 1.7% higher, led by gains after earnings. We saw Apple and we also saw Amazon. Now Apple dropped about 6% in after-hour trading, and this is because of the supply shortages. Amazon, though, was a contrast to that performance, about 9% gain, and that is on cloud computing revenue that was higher for a fifth straight quarter. We also saw gains in the SOX index, the biggest in a while, and that is as the AI story returns front and focus. And speaking of that, Asian equities 3.6% higher this morning, led by, no surprise, the Kospi, which earlier in the session had its best intraday performance, 15% higher, led by gains in its two biggest constituents, Samsung and SK Hynix. In Asia, we're also keeping an eye on the yen. It's roaming around the 160 level against the US dollar. We'll talk more in depth about that. And then Brent crude prices $88 on the barrel, 1% lower. Escalations in the Middle East continue, albeit a little bit calmer than over the past couple of days. But we have another geopolitical story out of Gaza. We'll talk a little bit more about that in just a few minutes. And then the yield on the 10-year notes, 4.65% lower, 2 basis points lower today. We're keeping an eye on the long-term yields, though, that are touching fresh multi-year highs. But we had solid U.S. consumer spending data, and we're keeping an eye out on that, and continuously the hawkish tilt by the Federal Reserve. Now, for a look or a deeper dive into what is happening in Asian markets this morning, we've got Avril Hong in our Singapore studio for us. Avril, what do you have for us?
Well, it's that powerful tech rebound underway in Asia today, Abir. I mean, you're looking at the Kospi. At one point, its climb was the most on record, and it's underpinned by 20% rally in the chip giants. And investors may be betting that we're done with the unwind in momentum. Momentum is soaring today. It's coming back in a big way. And this is also supported by some domestic developments, with the Sovereign Wealth Fund planning investments strategically into AI, which would, for the first time, include domestic assets. So that's what you're seeing in stocks. And that's also spreading to Japan, where the tech rebound is also underway. But to your point on the BOJ, we of course saw it leaving the overnight call rate unchanged at 1%. And to some, this was a missed opportunity to follow through on the yen gains overnight, where we did see dollar yen dipping below the 160 handle, in the form of perhaps some expectations in market participants that there would be a surprise rate hike. So in the absence of that, the focus, the onus now is really shifting to Ueda-san to follow through with some hawkish messaging to support the Japanese currency.
All right, and we'll be keeping a close eye on that, of course. Avril Hong in our Singapore studio. Now, sticking with that story, the Bank of Japan kept its policy settings unchanged and nudged its economic growth forecast higher, signaling confidence that the economy remains on track for further policy normalization. Bloomberg's Sherry-Ann is in Tokyo and joins us now. Sherry-Ann, good to have you on. A timely time to have you on this morning. The BOJ kept rates unchanged. Now, that was widely expected. Avril was just speaking about how that was a missed opportunity, perhaps. Can you talk to us a little bit more about what exactly did the decision entail and some of the details there?
Amir, I'm not surprised that it could be taken that way, right? Because there was a lot of excitement going into this BOJ meeting, just because we had that suspected intervention overnight. Coming into this meeting, all 52 economists surveyed by Bloomberg expected no change, especially since they hiked in June, and we have now the rate at the highest level since 1995 at 1%. But then overnight, we actually saw sources confirming that Japanese officials had actually officially intervened in order to support the currency. We also heard that U.S. authorities had carried out rate checks. So then we came into this morning thinking, well, we thought it was going to be a routine meeting, but could it mean that potentially the BOJ is ready to act? In fact, T.S. Lombard had said that before, when we have seen these interventions, the BOJ has hiked rates, and we have seen that just recently, mid-2024 as well. But the expectations were a little bit perhaps too high for a very cautious Bank of Japan, because it was as expected, left at 1%, and there was only one dissent that wanted to hike rates. That was also a key number that we're looking at. In June, we actually had a dissent for cutting rates. That was a reflectionist board member, Asada, who was appointed by the Takaichi government. This time around, the vote was 8-1. And the risks, though, when it came to the statement, all pointing to potentially more upside to inflation. So that is perhaps where you could take a little bit of more hawkish commentary away. They're saying that the risks are skewed to upside for inflation. The underlying inflation could be overshooting its 2% target. Also, they upgraded their forecast for fiscal year 2026 for growth to 0.6% from 0.5% previously, and they're attributing that to global AI demand, among other factors. So that's interesting, where they're seeing the strength and resilience of this economy.
Sherian, I'm just looking at the yen, and it's currently sitting at 160.6 against the dollar. A possible intervention that we reported yesterday. Further interventions, what is the consensus on that? Is it going to be meaningful to boost the currency more, or do you think we will need further rate hikes by the BOJ?
There are many things that are difficult to overcome for the Japanese yen at this point. We saw the intervention last night, suspected and confirmed by sources speaking to Bloomberg. So we saw that spike of 3.3%, which took us to the highest levels in over 2 years or so. But at the same time, or the best day for the yen against the dollar in about 2 years or so. But the fact is that rate differentials are still there, right? I mean, this was a good opportunity for Japanese authorities to try to do something, because we saw the FOMC holding rates steady, so the dollar was a little bit exposed. But then they had a three FOMC board members dissent towards the hawkish side. And right now, the perception is that the BOJ might be falling behind the curve. So you have the rate differentials that you have to contend with. Not to mention credibility issues for Japanese authorities. How many times have we heard from finance ministry officials, from every official in the government, that they are carefully watching with a sense of urgency, that they're ready to take bold actions when it comes to the yen, and nothing necessarily has happened. We've been stuck at this 160 level for the longest time. And of course, we continue to see the weakness at a 40-year low against the US dollar. And now $70 billion spent already earlier this year, which was record intervention. And the yen continues to weaken. And the fiscal concerns are not helping, because we continue to see that the government might be pulling the other direction from the Bank of Japan. We have just seen Prime Minister announce a sales tax cut on food and soft drinks temporarily for 2 years, but still that could mean some more expansionary moves.
All right. Bloomberg's Sherian with that excellent analysis, of course, our co-anchor of the Asia trade. Now, moving on to a regional story, President Trump says his U.S.-led Board of Peace has reached a deal to disarm Hamas and other armed groups in Gaza and establish a new Palestinian government. So to discuss this story, let's bring in Stuart Livingstone-Wallace, Bloomberg's executive editor for the Middle East, North Africa, and Russia. So what exactly do we know about this deal, and dare I ask, how possible is it to actually achieve this?
Yeah, so I mean, we don't know that much. We have the broad contours of it, but the information is coming out in patches. So broadly speaking, what the idea is that you will get some sort of semi-simultaneous withdrawal of Israeli troops from Gaza and a disarmament of Hamas, and then a new Palestinian government comes in. That's the idea. I think in practice, those of us that have been looking at this story for some time are going to be cautious. Clearly, is to be welcome that there appears to be any progress whatsoever, but you've got a couple of problems. One is the time frame is, I think, 200 to 350 days for implementation. That's a pretty wide margin for things to go wrong. Secondly, some of the comments coming out of Hamas overnight seem to suggest that they're anticipating an Israeli withdrawal before they disarm, which may be problematic. And thirdly, we've yet to hear from Israel. So once all of that comes out, then I think we'll have a better assessment of the chances of success.
Yeah, and just moving on to the same story we've been covering since early March at this point, but let's focus in on oil. We understand that Saudi Arabia is trying this new multinational alliance to protect the Red Sea. We're also seeing Brent crude prices at around $88 on the barrel, down today, but still a fifth up for this month on these new escalations. What do we know about this protection mechanism in the Red Sea?
Yeah, so, I mean, it's interesting. I mean, there are existing maritime task forces out there that do similar things. For instance, we saw it off the Horn of Africa when you had the big issue with piracy, and there are others. So they can work. The issue here is which countries are going to be prepared to put forward resources, and do they have the resources that can be effective in this instance? Because ultimately what they're facing is missile and drone attacks, potentially from the Houthis. And not everyone necessarily has a navy capable of dealing with those threats. So it's absolutely to be welcomed. It's a great idea. It goes in the right direction. Can it be effective? Again, remains to be seen.
Remains to be seen on both fronts then, Stuart. Thank you as always for your time. Stuart Livingstone Wallace, our executive editor for the Middle East, North Africa and Russia. Now, still ahead, Al-Dhabi Capital joins us with their market outlook as chip stocks rebound on the back of robust earnings from the likes of Amazon and Microsoft. This is Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Tyler Kendall in Geneva, Switzerland, and this is Bloomberg.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe. I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie. This is your opening trade.
Only on Bloomberg.
Welcome back to Horizons Middle East and Africa. Asian stocks are rallying on the last trading day of the month. This is as investors renew bets on AI trading following this week's rout. For more on these market moves, Senior Portfolio Manager at Al-Dhabi Capital, Rashmi Garg, is with us now. Rashmi, good to have you on. We were just talking about the positive performance that we're seeing, or the outperformance that we're really seeing in Asian equities, but also in the futures picture. So let me focus in on everything that's happening in this green across the screen that we're really seeing. Investors have focused in on CapEx for the past couple of quarters. Looking forward when it comes to the AI trade, to hyperscalers, what comes next? What do investors start looking at now?
Yes, good morning, Abir. And yes, it's a good day to be back on the screen. I mean, finally, we see some green. AI trade has been our preferred trade, the picks and shovels part of it. So it's good to see the shares bouncing back today. Now, going forward, what are they going to focus on? So what we saw in these past couple of earnings season was that CAPEX was being punished. If you are incurring higher CAPEX, then investors did not necessarily like it because what they demanded was an answer to how this is going to be monetized. Now, what we saw, especially if we focus on the earnings of, let's say, Amazon and Microsoft, we saw that the higher capex necessarily does not mean that it is impacting the profitability of these companies or it is impacting the ability to monetize these expenses. I mean, we did see very strong growth, whether we look at Microsoft or whether we look at Amazon in the cloud divisions. Amazon also mentioned that the AI chips business is doing very well. The advertising business does well, which also gets helped by AI, the AI suggestions that the consumers get. So I think overall there is the ability to monetize AI, and AI is a huge force. I mean, if you look at our lives today, compare it to 2 years ago, I'm sure all of us have been using some form of AI in our daily lives, in our work. So definitely this is a force to contend with, and we are strong believers.
Okay, so Rashmi, moving on from just AI and equities, central banks, a big week for central banks, starting with the Federal Reserve, BOE, and just this morning, the BOJ. And I want to focus in on the BOJ for a second. Another cautious step, it seems, towards policy normalization, especially after that yen intervention that was reported. But do you think that Japan can essentially keep on tightening without causing any meaningful disruption to the global bond market or that carry trade?
Yeah, so that's a very important question, Abir. But, where are we right now in the global balance, global, let's say, fixed income scenario, or let's talk about the central bank scenario? We have Japan, the Japanese central bank, who have not tightened today, but whatever the signals the market is giving, a tightening is required. Whether we look at the inflation picture in Japan, whether we look at the Japanese yen, or if we even, look at the, the US picture for that matter. I mean, if you look at US, the communication from Chairman Walsh wasn't very clear, and clearly investors were saying, okay, you are saying that you're going to combat inflation, but you're not doing anything, and you are sort of giving us explanations that you're not fully answering our questions. So I think the Bank of Japan has to continue tightening, but this is what is demanded by the economic backdrop, and I think the Fed will also need to tighten. And I think that in itself, in that sense, I mean, what is very important is the relationship between the BOJ and the Fed. And I think that will put both of them sort of in balance with each other. So I think this is what is needed. And if something less than that is done, then I think we will see huge imbalances in the global fixed income market.
So speaking of the Fed, Rashmi, you brought up Kevin Warsh's remarks essentially in the path forward. And we don't understand a lot about what the path forward looks like. He does say he wants to tame inflation still at a 5-year high. But going forward, what do you think will impact the Fed's decision making? What data point is going to have an impact on the decision making, whether it's a cut or a hike?
Yeah, so I think the data points that have always been important for the Fed when we talk about the Fed under Chairman Powell, the inflation, of course, the unemployment data, the economic growth, I think these have been the important data points. Now, under Powell, it was very clear that it is data dependency, which is guiding the path forward. But under Warsh, it seems that Warsh, in his desire to be different from Powell, is actually maybe sometimes not making that much sense, in the sense that he's not being able to give a very clear direction to the market. And he is touting that as strength, but I'm not sure if it is such a huge strength when the markets are actually, they feel that the credibility of the Fed is is getting impacted as a result of that. If we look at the bond market, if we look at the 30-year yields. So I think, no, it is not like a Fed cannot say that, let the market do our job. I think the Fed needs to do their job. And I think going forward, the same data points are going to be important, but they need to be taken in totality by the chairman. And I think saying that we can change the measure of inflation is not going to satiate this market.
All right, Rashmi, we're going to have to leave it there. Rashmi Garg, Senior Portfolio Manager at Al Dhabi Capital. Now, coming up, Apple falls in late trade after some warnings in its latest earnings. We'll have the details on that story next. This is Bloomberg.
Up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jennifer Zabasaja in the Lesotho Highlands, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Welcome back to Horizons Middle East and Africa. Apple shares stumbled in late trade after a lower than expected sales forecast from the iPhone maker. Bloomberg tech anchor Ed Ludlow has more from San Francisco.
No sentimentality on Tim Cook's final Apple earnings call as CEO. The shares really fell in after hours as Apple explained that the September quarter, things are going to get more tough. Not just because of higher memory prices, but tighter supply. They underestimated demand, which means that there is a shortage of leading edge processors. It is multifaceted. And that outlook where they see revenue growth of 9% to 11% in the September quarter, below the street's estimate of above 12%, it really overshadowed what was a strong June quarter. They beat expectations on the top line. iPhone came in strong with growth. Mac, a particular bright spot, although services missed estimates. Greater China missed estimates. It was a lot for the street to pass. Tim Cook said that Apple underestimated demand and went on to say that they will therefore be scrambling on the supply side, quote, as shortages of those lead edge processors and rising memory costs then go to iPhone, Mac, and particularly iPad in the quarter to come. Cook did use the opportunity to thank those participating in Apple's call, that he could not be more confident in his successor as CEO, John Ternus, but the market was focused on a tougher message. After years of Tim Cook mastering the supply chain is getting difficult for Apple, and Apple's entering a period where even it can't get all the chips that it wants. This is Ed Ludlow for Bloomberg News in San Francisco.
Meanwhile, Amazon jumped in late trade after reporting a 5th straight quarter of cloud revenue growth. The results ease investor concerns that the company will not produce a return on its AI spending. Amazon Web Services revenue jumped 37% to more than $42 billion, and the unit generates about a fifth of the company's revenue and most of its operating profit. And Anthropic says its AI models breached 3 organizations during recent cybersecurity tests. It comes a little more than a week after its chief rival OpenAI disclosed a similar incident. In a blog post, Anthropic says it found 3 instances in which its Claude AI tool accessed the internet and then hacked into external organizations. The affected organizations are not named in the post. Now, before we head to the break, just a quick look at where equity benchmarks are sitting. Green across the screen, U.S. futures 0.4 higher, NASDAQ 100 futures 1% higher after a positive close yesterday following 6 straight sessions of declines. We're also seeing Dow Jones and Eurostoxx 50 futures in the green as well. And then we take a look at where Brent is sitting, as well as NY Crude, and they're dropping 1.4% and 1.7% respectively. Escalations in the Middle East continue, albeit at a slower pace over on Friday. Now, coming up, we will cross live to Tokyo to speak to Amundi as the Bank of Japan kept rates unchanged. That is despite the yen intervention. That is coming up next. This is Bloomberg.
Western countries, all of them are cutting funding to Africa. And some of these programs were supported by funding coming from Western countries, like for human resources, for testing, for transportation of samples. And suddenly, African countries have to think how to fund money and to cover this gap. But it takes some time. And I think the combination of all of these factors are fueling this mistrust that we see at community level. We value the support we got and we are still getting from the US. And we think that if we continue to work together, and there is no reason for the US not to work with Africa CDC, Africa CDC is the leader in terms of public health in Africa.
Welcome to Bloomberg This Weekend. I'm David Burr.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars, Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech.
Every weekday, only on Bloomberg Television.
Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. Holding steady, the BOJ keeps its policy settings unchanged and nudges its economic growth forecast higher. Officials stop short of a confirmation that an intervention that drove the yen sharply higher. President Trump claims a breakthrough in Gaza, saying the U.S.-led Board of Peace has reached an agreement for Hamas to disarm, though questions still linger. And Apple shares slide in aftermarket trading as component shortages weigh on the company's sales forecast. It has just gone 8:30 a.m. across the Emirates. I'm Abir Abu Omar in Dubai. We still have a lot to unpack for the remainder of the show. But before we get to that, a quick look at where equity gauges are sitting. U.S. futures tilting higher by the second 0.4 at this point. A positive close in the S&P 500 yesterday. A positive close in NASDAQ 100 yesterday. Over 3% higher following 6 straight sessions of declines. We also saw it entering a correction mode earlier in the week. Asian equities about 4% higher, led by the Kospi. We're seeing Samsung and SK Hynix at least 25% higher. The AI trade is alive and well. The return is palpable there, and that's why we're seeing Asian equities 3.9% higher as of this point. The Kospi 15% higher, its best intraday performance. Brent crude 1.4% lower. We're keeping an eye out on developments in the Middle East, albeit a little bit calmer today. We'll monitor the situation over the weekend and what developments happen there. And then the yield on the 10-year notes, 4.65%, dropping 2 or 3 basis points this morning. We're keeping an eye also on the longer-term yields that were touching fresh multi-year highs earlier. But for a look at what is happening in Asian markets, a very positive performance this morning. We've got Avril Hong in Singapore for us. Avril?
Yeah, Pierre, we're seeing tech rebounding hard today, tracking what we saw on Wall Street, where chips rallied by the most in more than a year, thanks to Microsoft, and then more recently, Amazon earnings also giving that positive sentiment. You're seeing the Kospi, as you said, rising by the most on record intraday, underpinned by 20+% gains in Samsung, SK Hynix, and it's also some domestic developments related to the sovereign wealth fund planning investments strategically into AI, which would for the first time include domestic assets that are also lifting tech stocks. It's not just what we're seeing in South Korea, of course. Japan tech stock rebound is well underway as well, and this is coming on a day where as the yen gained past 160 to the dollar overnight, following suspected reported intervention, the export-related names are coming under pressure. So that's the flip side of things. But also when it comes to the BOJ and how it left rates unchanged, this was the consensus. In the statement, there wasn't much as well in the way of surprises. So the focus now shifts to Ueda's presser. There's a lot of pressure for him to follow through on hawkish messaging to help support the Japanese currency, as you can see how it has paired gains in the Asia session. Abir?
All right, Avril, thank you as always for those updates. Avril Hong in Singapore. Now let's get more on this BOJ decision with Hiromi Ishihara, head of equity investment at Amundi Japan. Hiromi, thank you for your time this morning. We were just talking about how timely it is for us to have you on with us this morning. A possible intervention, the BOJ decision earlier, and we're awaiting that presser that Avril was talking about. So simply to start with, what do you expect the messaging to be out of the presser?
So if whether actually could give us any indication of the next interest rate hike timing would be a key, because very interesting timing that we saw the FX intervention the last night. So it's certainly the pressure over the yen is getting higher. So September or October are sort of the consensus right now, but September meeting could be live meeting, then yen could be strengthened a little bit. So it's all the eyes on the indication for next hike.
Hiromi, I'm also taking a look at the levels the yen is sitting at right now at about 160.7 on the dollar. Now, it was stronger yesterday following that reported intervention. The consensus on further intervention, what is that for you? What does that look like? And would it be enough for the Japanese government to continue intervening, or are we ultimately going to need to be looking at higher rates?
So what the market is suggesting is definitely BOJ is the behind the curve right now, and they need to take action more quickly than right now. So the pressure is really high, but the government is also, adding the extra pressure of the BOJ. So even though we have seen like a 165, it could be another intervention level, but the yen itself structurally weak against dollars, so any intervention actually have the very short-term impact rather than structural impact.
And Hiromi, what would that mean for equities? Would that be a possible headwind or a healthy development for Japanese equities? And then what sectors do you see benefiting and which ones stand to lose from a possible hike?
So weak yen generally is positive for export-oriented. And as you could see, for example, the mega caps names in the topics or Nikkei 225 are mostly exposed to the export-oriented business. So they are the beneficiary for weak yen. However, what we are really concerned over here is the impact over the inflation and also the sustainability of JGBE level. So we are really in the level that we feel uncomfortable, to be honest, at the FX level right now.
And I'm just taking a look at the Nikkei, Hiromi, and it's rebounded sharply, especially when compared to what some moves we've been seeing in regional peers, including the Kospi. So do you think that despite, and this is also despite the ongoing volatility that we've seen in the yen, so do you think that foreign investors are still structurally bullish on Japanese equities, or is this easy money out of these governance reforms that we've been seeing?
So I think it's actually obviously that investors are bullish on Japan, and then I think it's overall the constructive view on Japan equity itself. Just looking at the index constituents, of course, Nikkei is exposed to AI-related names and has a sensitivity to all the semiconductor AI-related rally. However, looking at how the performance has been driven, we have a lot of broader universe, broader sector actually contributing to the positive performance in Nikkei, which means that the Japan equity actually can offer broader investment opportunity outside of AI. Of course, the AI is a big theme, but at the same time, that we have the corporate governance story, but also, the positive macro environment, which should support the domestic-oriented side. So I think, compared to U.S. equities or other Asian equities, Japan equity actually is an interesting diversifier, providing a different, broader investment opportunity. So all in all, a constructive view remains.
All right, Hiromi, we're going to have to leave it there. Hiromi Ishihara, Head of Equity Investment at Amundi Japan. Thank you for your time this morning. Now, from central bank decisions to geopolitics, our top story this morning, President Trump says his U.S.-led Board of Peace has reached a deal to disarm Hamas and other armed groups in Gaza and establish a new Palestinian government. Meanwhile, there was an unusual calm between the United States and Iran after re-escalation between the sides for the past 2 weeks. Joining us now to discuss all of this is Ian Parmiter, former Australian ambassador to Lebanon and research scholar at the Australian National University Centre for Arab and Islamic Studies. Ambassador, good to have you on this morning. Lots of developments, albeit a little bit of calmness between the United States and Iran, given the latest escalations. I want to start with the Board of Peace in Gaza and the plans there. President Trump taking this as a win, essentially, before any details emerge. How likely is it, do you think, that we see both parties, Israel and Hamas, come to the table and actually agree to have Hamas disarm weapons?
I think with anything to do with Israel and Hamas, a degree of caution is warranted. There's zero trust between the two parties. The degree of hatred between them is really quite extraordinary. The other aspect is that President Trump has made major statements in the past that have indicated that he's actually been able to bring peace to Gaza, and they haven't quite worked out. As we have it at the moment, Israel occupies nearly 70% of Gaza and is it would be most unlikely to start withdrawing from that unless it really did feel that Hamas was completely under control. Now, Hamas has been prepared to make this statement that it will give up its weapons and that also give up political control of Gaza, but the extent to which it will do it in full is very uncertain. You can give up some weapons, but not all of them. And the other aspect that I should mention, of course, is that Prime Minister Netanyahu is facing an election in 3 months' time, and he won't want to go into an election with his opponents being able to say that he's agreed to a deal which doesn't absolutely guarantee Israel's security.
Yeah, of course. And, that is something that is happening very soon. But ahead of all of this, let's just assume that they get through those disagreements. And there's a huge layer of complexity, as you've mentioned, with Hamas disarming and Israel agreeing to pulling out. But let's just theoretically assume the deal does go forward. They go through all these layers of approvals. And then we start seeing countries in the region get involved, the Gulf countries, Egypt, Turkey. Does that mean a new regional architecture, or is it just going to be continuously Israel and Hamas with third-party players?
I think the most important aspect would be the international stabilization force, which is referred to in President Trump's 20-point plan that he announced last year. And that includes Indonesia, among other countries. But we don't know at this stage anything about the contribution that they would make and just how exactly they would work. Gaza is not a large area, but it has a huge population. And the international stabilization force contributors would want to be quite clear that the danger to their troops who are going into Gaza would be minimal. So it's we don't have any indications of that at this stage as to just how that can be guaranteed. But we do have as well, though, a Palestinian Technocratic Committee, a 13-person technocratic committee that is prepared to run the administration of Gaza. And we also have an overall coordinator, the Romanian diplomat, Mr. Mladov. And so all of the technical aspects are in place. The technical security aspects are in place. It's a question of just whether they can operate.
Just quickly on this is all happening in the midst of a wider war in the region, Iran and the United States. Why do you think President Trump made this announcement now? Do you think it's a win in the midst of all the losses that the U.S. is facing right now between itself and Iran?
Well, there's no doubt that President Trump is looking for wins at this point. The war against Iran is going very badly. President Trump keeps making optimistic statements, but the war is the most unpopular in American history, he's losing popularity himself as a result of it. So being able to announce a win in Gaza, first of all, it changes the conversation, but it does actually potentially give him something to be able to say that he has achieved in the Middle East.
All right, Ambassador, thank you so much for your time this morning. Ian Parmiter, former Australian ambassador to Lebanon and research scholar at the Australian National University Centre for Arab and Islamic Studies. Now, coming up, Saudi Arabia posts its deepest quarterly contraction since the pandemic. We'll have the details on those numbers next. This is Bloomberg.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
You're watching Bloomberg Deals. Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
Bringing you up-to-the-minute space news whenever and wherever it happens. I'm Ed Ludlow at NASA's Kennedy Space Center in Florida, and this is Bloomberg.
Shell is looking for alternative routes to offset the disruption in energy supply caused by the war in the Middle East. Speaking to Bloomberg TV, CEO Wael Sawan says the company remains confident. This is despite the disruption, especially in their business in Qatar. Take a listen.
Of course, we had some real challenges there. A missile hit one of our facilities. Thankfully, no one was hurt, and we are well on our way to repairing the damage that was incurred there. What I would say is at the moment we keep a very close eye on what's happening in the Straits because at the end of the day, the facilities are offline pending our ability to evacuate product, as of course is the majority of the oil and gas resources that are needing to traverse the Straits. And so no guesses on how long it's going to take, but suffice it to say we continue to focus on first and foremost the safety of our people and then finding alternative supplies to meet our customers' demands.
Well, is your willingness or enthusiasm for investment in the Middle East, is it being challenged at this point by what we've seen over the last 3 months?
The Middle East will always be a core region for energy. And when we look at any investments, we are, of course, always looking much, much longer term. So while, of course, the short-term disruptions are concerning and we need to be able to sort of grapple with what they mean at the right points in the cycle, longer term, we continue to have high confidence and look to continue to have a diversified portfolio of supplies. Of course, we saw the impact of us pulling out of Russia. If we had concentrated on one region or one country, it doesn't play to our model of being a global, diversified energy supplier and one that is able to optimize those supplies to meet our customers' demands. And therefore, I wouldn't rule it out or double down. I think at the moment, we continue to have that long-term view of fundamentals and will operate accordingly.
That was Wael Sawan, Shell CEO, speaking to Bloomberg yesterday. Saudi Arabia's economy has recorded its deepest quarterly contraction since the COVID-19 pandemic. The decline was driven by a sharp downturn in its critical oil industry as a result of the war in the Middle East. So to discuss all of this, we're now bringing in Chief Emerging Market Economist for Bloomberg Economics, Ziad Dawood. Ziad, about a 5% contraction in the GDP numbers that came out yesterday. What does it essentially say about the impact of the Iran war on the kingdom?
Well, it says a few things, but the headline is the impact is deep. Now, there's an aspect of it which is basically the oil sector, how much oil or barrels does Saudi Arabia produce, and there was no surprise there. There's a big contraction because of the shutdown of the Strait of Hormuz. But the Iran war is also filtering into the non-oil sectors, stuff like construction and tourism and all these sectors. There is weakness there. It's not as deep, nowhere near as deep as the contraction in oil, but there is weakness that is filtering through there. Now, what's going to happen going forward? If we get a gradual reopening of the Strait of Hormuz, you mentioned COVID, we'll get a V-shaped recovery, the stuff that we're talking about during COVID. That assumption, which we currently hold, is being challenged by the recent geopolitical events. We're seeing escalation between the US and Iran, we're seeing escalation between Saudi Arabia and the Houthis, and we've seen an exchange of strikes from Saudi Arabia to Iraq and from Iraq to Saudi Arabia. Our underlying assumption is some gradual reopening, but obviously the geopolitics is challenging that.
That V-shaped recovery just gave me a little bit of PTSD about COVID times. But then about the general consensus or what we can extrapolate when it comes to regional economies out of Saudi Arabia as a story, Ziad, what can you tell us about how regional economies are going to suffer?
So the good thing about Saudi Arabia is that they publish data early and we can see what is happening there. And I think if we try to infer what's happening to the broader region from the Saudi numbers, it is basically that with the exception of Oman, Saudi Arabia might be faring better than the rest. So if you think the Saudi numbers are bad, they're going to be worse in other places. Let's break it down. Again, oil and non-oil. Despite the war, Saudi Arabia was still able to get a lot of its oil out during the war. Kuwait didn't benefit from this, Bahrain has not benefited from this, and Qatar has not benefited from this. Saudi also faced fewer attacks on its soil, which means that the non-oil sectors have been impacted less by Iran than in countries like Kuwait or the UAE. So with the exception of Oman, I think Saudi numbers will probably be better than the rest of the region.
All right, Ziad, thank you as always for your analysis on the region. Chief Emerging Markets Economist for Bloomberg Economics, Ziad Dawood. Now, coming up, a surge in illegal immigrants prompts Spain to order an emergency military deployment. We'll have more on that story next. This is Bloomberg.
The global economic playbook is being rewritten and the levers of power are moving in real time.
To see where the world is headed, you have to look where the action is.
I'm Haslinda Amin in Singapore.
I'm Menika Doshi in Mumbai.
Welcome to Emerging, the New Economy podcast.
Each month, we dive deep into how the world's most exciting rising economies are shaping the global future.
Join the conversation. Subscribe to Emerging on your favorite podcast platform today.
When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg. It's It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Welcome back to Horizons Middle East and Africa. Egypt has unlocked around $1.8 billion in financing after clearing the 7th and cumulative review of its expanded IMF program. The IMF board said Egypt faced a fallout of the Middle East conflict in a strong macroeconomic position and made sufficient progress on selling state assets. Completion of the reviews immediately makes the $1.5 billion available to Egypt. The Spanish government has ordered troops to one of its 2 North African enclaves after a recent surge in illegal immigrants. Local media reporting thousands of illegal immigrants have crossed into Ceuta in recent days, one of the only land connections between Africa and Europe. Spain's defense minister says he is sending soldiers to help reinforce the border, plus boats and divers. And Ethiopian Airlines expects the pace of its revenue growth to reduce by half due to the Iran war's impact on oil prices. Africa's biggest carrier sees a 10% increase in sales this financial year. That is down from 20% growth in forecast. The airline CEO says operating costs increased by a quarter, mostly due to fuel, and expects expenses to rise further. Now, before we send you off to the weekend, a quick look at where equity benchmarks are sitting. Green across the screen. When it comes to U.S. futures, we're expecting a positive session later today, another positive session after yesterday's close in the green. So 0.5 higher for S&P futures, 1% higher for NASDAQ, 0.5% higher for Dow Jones, and European stocks also higher at the open is the expectation. Brent crude prices are in the red as escalations in the Middle East calm down slightly today. We're also seeing NY crude a little bit lower, 2% lower this morning. Now that is it for Horizons Middle East and Africa. Stay with us for Daybreak Europe. This is Bloomberg.
Everybody has a moment where they put into action all they've practiced, where they step up to a challenge and either succeed or fail. But what are those moments for some of the world's most influential leaders?
It was a rough and tumble world, and I thought, okay, I can rise up, I can play this game, and I did play the game.
It was great, and it was depressing, and it was disappointing.
My chair at the time sat down with me and said, "Succession starts now."
I'm Francine Lacroix, an award-winning journalist. For the last 25 years, I've interviewed world leaders, bank bosses, even fashion icons. I'm often asking about the news of the moment. But I've always been curious, who are these people as leaders? Join me for the podcast version of Leaders with Francine Lacroix. I'll start your week with conversations that explore what drives the world's most influential people, how today's leaders got to where they are, where they're going next, and how they've transformed their organization in the process.
Make decisions. A poor decision is always better than no decision.
You have to have truth tellers around you, and you have to be willing to listen.
You don't want to be setting strategy in the middle of a transaction, that's for sure.
Do it for the right reasons. Don't do it because of FOMO.
We'll also learn lessons which we can apply to our work and daily lives. Tune into the podcast version of Leaders with Francine Lacroix. Listen and watch on Bloomberg Television or wherever you get your podcasts.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Live from London, this is Bloomberg Daybreak Europe. I'm Lizzie Burden with your top stories. Korea's Kospi on track for its biggest ever gain as investors dive back into the AI trade. Aggressive spending forecast from Amazon helping drive a powerful rally in global chip stocks. Meanwhile, the Bank of Japan raises its growth outlook as rates remain on hold, a day after the country's government stepped in to support its currency. And President Trump says the US-led Board of Peace has reached a deal for Hamas to disarm. But questions remain over the extent of any agreement. Well, a very good morning. Happy Friday. Here is where we end the week and the month in markets. Korean stocks, as you can see, surging by a record after that huge drop earlier in the week and all those circuit breakers. The Kospi up more than 16%, and analysts saying that this is more fundamental than bargain hunting, more of a genuine relief rally. It follows that bounce in US tech stocks yesterday, helped by upbeat earnings, as I say, from Amazon, and a report that Citadel bought a big chunk of the AI stocks held by hedge funds Situational Awareness. And you can see we have futures higher again on both sides of the Atlantic. Eurostoxx 50 futures up 0.8%. Nasdaq futures up more than 1% this morning. So a positive note to end the month. Now flip the board cross asset. We have oil down nearly 2% on Brent at $87 the barrel. Nonetheless, Brent heading for a 21% monthly gain on the Iran war escalation. The yen holding on to its losses after the Bank of Japan held rates as expected. The yen having advanced yesterday after Japanese authorities reportedly intervened to boost the currency. But those gains trimmed now. The yen trading at 160 per dollar. Still, we are looking at the 10-year here at 464. So currently down 3 basis points. Now, let's take a look at the risk events on the agenda for today. Apart from Governor Ueda's presser, we are also looking at 7:45 a.m. London time at French preliminary inflation numbers, expected to stay at 2% in July, kept there by pump prices and airfares. Then at 8:55 a.m. it's German unemployment data, and at 3 p.m. London time it's the University of Michigan sentiment numbers, expected to show consumers still concerned about the inflation outlook and borrowing costs as well. Plenty ahead. Let's set you up for your Friday. We begin with Korean stocks having jumped by a record, rebounding from this week's rout. And we can go straight to Avril Hong in Singapore for a look at Asian markets. Avril, what are you watching?
It's a crazy day, Lizzie. I mean, you look at how powerful this rebound is in AI trades, led by Korea, of course, against the backdrop from the U.S. chip stocks revival overnight. And thanks to these solid earnings from Microsoft, from Amazon more recently as well, you're seeing the Kospi rising, as you say, by the most on record, underpinned by 20+% gains from Samsung and SK Hynix. And this is also helped along by some domestic developments. related to the sovereign wealth fund planning investments strategically into artificial intelligence, which would for the first time include domestic assets. And then you also had yesterday flows data, which showed foreigners buying stocks. So you get the sense that maybe there is an end to this unwind in momentum. Momentum is really soaring and coming back in a big way today. Now, flip the board. It's not just a tech rebound in Korea, it's also in Japan as well, not to be left behind. This is the bounce that you're seeing on the Nikkei, and this is thanks also to the likes of Tokyo Electron, which had its half-year profit outlook beating the street's estimates. In the next hour, we will have earnings from Kioxia, which of course has been a big winner in the memory trade. But look as well at what we're seeing in the Japanese currency. Some of that pressure is coming for the export-related names, and this is coming after the yen gained by the most in more than 2 years, following on from reported intervention. Of course, we did get reporting that some of this was from Japanese officials buying the yen, and then a follow-through from the New York Fed on the rate check. That being said, given how the BOJ left rates unchanged, despite that being consensus, and not much in the way of surprises in the BOJ statement, the onus really is on Ueda-san now to deliver hawkish messaging, especially when you look at the options market and the skepticism there, the dollar-yen risk reversals. The further out the time horizon you go, the less confidence there is of the yen gaining. So we'll watch to see what the BOJ governor says. Lizzie?
Avril, we're going to dive back into the Japan story in just a moment, but for now, Bloomberg's Avril Hong, thank you very much. I want to pick up on that tech theme that Avril raised, because we saw Amazon jumping in late trade after reporting a fifth straight quarter of cloud revenue growth. Amazon Web Services sales jumping 37% to more than $42 billion. The company also boosted its full-year capex forecast. CEO Andy Jassy saying most of that will go towards spending on AI.
We now believe we will spend approximately $220 billion in cash capex in 2026. The higher cost of memory pushing this number up from our prior estimate of about $200 billion. But even at that amount, we will still not have enough capacity to meet all the demand we have in 2026. And I believe this dynamic will also be true in 2027 too.
But it was a different story for Apple, forecasting lower than expected revenue growth of 9 to 11% in the coming quarter, with the iPhone maker's outlook hit by supply shortages, which CEO Tim Cook warned will affect more of the company's products in the months ahead. Cook described the memory shortage as a, quote, 100-year flood, while adding that the issues were fueled by stronger than forecast demand for the iPhone and Mac. Well, that's tech. Turning back to Japan now. The Bank of Japan, as Avril says, holding rates and upgrading its economic growth forecast as investors await comments from Governor Ueda later on this morning. The central bank's rate decision comes a day after Japan intervened to support the yen, triggering the biggest intraday move higher for the currency since 2023. Now, the US is said to have played a role in the intervention, and Treasury Secretary Scott Bessent gave his views on the yen in an interview with Fox Business.
Japanese yen seems very undervalued to me. The currency is very cheap. The economy is doing well. The prime minister is very popular and enacting very strong policies. And I think we're going to see the fundamentals come through. At a point that the market will realize the yen is undervalued and should strengthen.
Bloomberg's Sherry Ann has more for us from Tokyo. Good morning to you. Lots of questions here. I mean, how significant is it that the US got involved? Could we see another round of yen intervention after Governor Ueda's presser? And really, what are you going to be listening out for when Governor Ueda speaks after this decision?
The intervention suspected overnight and confirmed by sources to Bloomberg that Japanese authorities had actually stepped into the markets to support the currency was what made this BOJ meeting more exciting, because it was supposed to be a routine meeting where 52 economists surveyed by Bloomberg were expecting a hold by the BOJ. Well, we saw now them carry out that hold. Only one dissent by one member that wanted to hike rates. But it's still the question of, will intervention continue? I mean, we have foreign finance minister officials in the past quote the rules from the IMF, stating that 3 days of intervention only count as one single operation, and that 3 interventions within 6 months are consistent with a free free floating exchange rate regime. So could we see more done in order to support the currency, especially given that, yes, when there was action last night, we saw that spike of about 3.3% to see the best day in over 2 years. Right now, we're still under pressure, given that perhaps the markets did not get that hawkishness coming from this BOJ decision as well. We saw a little bit more downside pressure on the Japanese yen, despite the fact that in the statement, BOJ officials had talked about how risks were skewed to the upside for inflation. They had also upgraded their growth forecast for this year, which means that potentially we could see more tightening in the months ahead.
Okay, thank you very much for that. That's Sherry-Ann out of Tokyo as we look ahead to that press conference. Well, turning to the Middle East now, and President Trump says that his US-led Board of Peace has reached a deal for Hamas to disarm. But there are still questions about the extent of the agreement and when it will take effect. Let's go straight to our Bloomberg Horizons Middle East and Africa anchor Abir Abu Omar for more. Abir, what do we know about this deal and what have we heard, crucially, from Hamas as well?
Good morning, Lizzie. Well, I mean, you just said it in your intro. A lot of questions still linger around what exactly is in this deal. And that is exactly what we're looking for. We don't have a lot of clarity about this, but just some caveats around this Board of Peace deal and President Trump's remarks. Lizzie, we heard from Hamas officials overnight that essentially they will not disarm until Israel pulls out. We don't have a lot of clarity from the Israeli side on exactly how possible that is. History, suggests to us if there is evidence that Israel is not going to be very prone to pulling out before Hamas actually disarms its weapons. President Trump did say that this is a monumental step towards peace and security in his post. And then he said that it would pave the way for a Palestinian government that would work closely with the Board of Peace. What I can say is, again, we don't have a lot of details about just exactly what this entails. We know that Israel and Hamas had reached a deal to end the war that started on October 7th in October of 2025. But then again, Israel was or is still in Gaza or the strip of Gaza. And then what it would take for Israel to leave is this situation of them asking Hamas to disarm, Hamas saying no until Israel does that. No details in the blueprint itself, and it would take multiple weeks and months to implement, according to our understanding. And so this is the preliminary version of what we understand is this deal. In the midst of all of this, Lizzie, and the announcement of this deal by President Trump, we're still seeing a wider war, of course, taking place between the United States and Iran. And so a lot of analysts are pointing to President Trump desperately needing a win. And so this announcement comes at a time where escalations in the region between Iran and the United States are taking place, and ahead, of course, of his midterm elections in November. And then analysts are also bringing about Benjamin Netanyahu's own re-elections in Israel also looming this year. And so a lot of questions still unanswered about just exactly what this would entail, what this Board of Peace would entail for the Gaza Strip, and what Hamas and Israel decide to do next. But those are the very few details that we have at the moment, Lizzie. A story that is obviously evolving, just like the wider war between Iran and the United States in the Middle East.
And of course, on the latter front, we shall keep an eye closely over the weekend because it's obviously when a lot of developments often happen. Abir, thank you for the update. Have a great weekend. Bloomberg's Abir Abu Omar. Well, still ahead, Ken Griffin's Citadel comes to the rescue of situational awareness, the hedge fund led by a man who was once described as the Nostradamus of AI. But first, the French insurer AXA reports first half profit higher than the same period a year ago as it assesses the impact of European wildfires. We'll speak to the CEO next. This is Bloomberg.
bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Bersecci in El Ola, Saudi Arabia, and this is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe. I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie. This is your opening trade.
Only on Bloomberg.
Welcome back to Bloomberg Daybreak Europe, 6:15 a.m. here in London. Well, first half profit at the French insurer AXA was 2% higher than a year ago, in line with expectations. Continuing our focus on earnings this week, I'm pleased to say the CEO, Thomas Buberl, joins us now. Good morning to you. Thank you so much for making time. Let's just start with your message to shareholders this quarter, because it seems to have gone quite well for you.
Yes, good morning, Lizzie. Yes, the numbers are very good. We are very happy about a good development of our growth numbers and of our earnings numbers, which shows that in a difficult environment, we are well diversified and on a solid track to deliver good results.
Yeah, one of your management committee members has said that the firm doesn't currently consider the wildfires as a threat to your outlook. I do wonder how much they are going to cost AXA, if you could put a number on it for us.
Look, first of all, these wildfires are always very tragic events, and when I think about them, my thoughts first go to the victims of these wildfires, in particular two firefighters who have lost their life, and it is always a very tragic event. And in these moments, we don't think about numbers, we think about how can we help the victims, and we've put a lot of measures in place in order to help the people with fast claims payments, with relocations, and simplification of the procedures. Obviously, the question will come, how much will this all cost? But this is far too early because, these have just happened. The fires are still happening, and there is always a little delay in the claims notification. But be assured that we have a clear policy of high diversification. And if you go back over the last 3-4 years, we have had many of these events, and all of these events, yes, have touched us, but have touched us in a way that we have always well managed and absorbed these events in our numbers without creating any volatility or disturbance.
OK, I appreciate that it is very early to put numbers on things, but you mentioned diversification. Do you think that some regions could end up uninsurable because of the fires?
Look, this is the big question. I mean, we have to live with the fact that these fires are happening more and more. This is part of climate change. This is part of our daily reality now. And the question is always, what can you do against it? And I do not believe that risks are not insurable. Every risk is insurable if under the condition that you work a lot on prevention, because claims can be prevented. Since those wildfires and many other natural catastrophes are at the origin of human behavior, if we are together able to change human behavior and adapt human behavior while exercising more prevention, we will be able to better manage these claims and the costs, and also obviously the tragic consequences for all of the victims.
Well, yeah, in terms of how you handle this, in California, you now have catastrophe bonds, cat bonds, tied specifically to fire risk. Is that something that European insurers and reinsurers need to start considering, Thomas?
Look, I mean, this is a good idea to bring in more capital into the market. It's not a new idea because we have had cat bonds for many, many years, and investors like to take cat bonds because they diversify from financial market risks. Nevertheless, this doesn't reduce the actual exposure. And what I'm trying to say is we need to work on prevention. We need to make sure that the actual exposure to fires, to wildfires is reduced. And that doesn't work with cat bonds. That works very much with changing behavior and working on the fact that these fires that often are caused by human incidents are being reduced. And that's why we are very much pushing on how can we help governments, how can we help companies, how can we help private individuals to behave differently and prevent these events from happening. It's better to not have these events than to have them covered in a different way.
Completely, and I take your point that prevention is better than cure, and of course you would say that of all risks that could be insured against. But in terms of how this impacts your business, I was looking at a 2025 report from the French Insurance Federation saying that fires account for only 4% of claims but generate the second highest cost for home insurance, representing 25% of the total. Does that logic apply to your business at AXA?
Yeah, look, I mean, these numbers are also, you can find them in our numbers as well. But what is important is that we look exactly where those claims occur, which we do because we have a very large database, and then make sure that we use this data to help our customers to prevent further claims. Because again, we need to bring the cost of claims down. We live in an environment in which risks are increasing, cost of risk are increasing, and in order to ensure insurability, the only way is to help our customers and society at large to better manage and reduce these risks going forward.
Thank you so much for giving us your perspective on those wildfires. Of course, a pertinent issue at the moment, but really great to hear about your results as well. Thomas Buberl, CEO of AXA, thank you for your time this morning. Well, coming up on Daybreak Europe, a hedge fund started by a 20-something former OpenAI researcher gets hit by this month's AI sell-off. We'll bring you that story next. This is Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Gurr.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Welcome back to Bloomberg Daybreak Europe. Now, Bloomberg has learned that Ken Griffin's Citadel has bought a big chunk of the AI stocks held by Situational Awareness. If you hadn't heard of it, it's the hedge fund led by a former OpenAI researcher, once known as the Nostradamus of AI. Now, Leonard Aschenbrenner came to prominence in 2024 after writing a viral essay about the future of artificial intelligence. And he started the hedge fund 2 years ago, despite having zero investment experience. We're told, however, its assets have plunged over the course of this month. And we can get more now with Bloomberg's Anthony Stevens, because, Anthony, this sounds like a niche story, but actually it's important for sentiment today in markets.
Yeah, he's a really prominent AI investor. So retail, he is very heavily followed. You know, you have one of his YouTube podcasts has over 500,000 views. His X account has over 200,000 views. And this is despite him putting out some pretty terse AI content. He is a domain specialist. He's grown his fund from around $225 million to over $20 billion at the peak, with concentrated bets on AI, whether it's in the energy space, in the chip space, in the computational space, in private markets. So he's an AI specialist, but unfortunately, he's been caught out by a combination of leverage and volatility. And in the insane volatility that we've seen the last month, he was on the wrong side of things. And it looks like the prime brokers who lent him this money have come asking for some of their margin back. To raise this money, he looked like he was trying to sell some of those private stakes, but in the end, what's happened is Citadel has bid him at a discount for that portfolio. Now, that trade being completed has driven some of the reversion as some of that selling pressure from his fund eases in the AI names. So you see the portfolio that he holds being up around 15 to 20% across the United States. This includes a pretty large holding in SK Hynix ADRs. If you remember, Situational Awareness was also prominent in being a cornerstone investor in the Hynix ADR. So it is very important that that selling pressure is now relieved. And you can see the almost celebratory reaction in SK Hynix ADRs, which went to a 56% premium in the US and are now trading anywhere from 25 to 30% up in Korea.
Okay. Anthony, thanks for tying all that together for us. Bloomberg's Anthony Stevens there. Now, to some other top stories we're following for you around this morning. Staying in tech, Anthropic says that its AI models breached 3 organizations during recent cybersecurity tests. It comes a little more than a week after its chief rival OpenAI disclosed a similar incident. In a blog post, Anthropic says it found 3 instances in which its Claude AI tool accessed the internet and then hacked into external organizations. Elsewhere, turning back to earnings, Crédit Agricole has reported better than expected second quarter numbers as income rose at its French retail business and its asset management arm reported a record profit. The bank's CFO joins the opening trade for an interview at 7:30 a.m. London time. Turning to football, FIFA says that it'll proceed with a consultation on its controversial plans to bring private investment into the World Cup and other football tournaments. Europe's football governing body UEFA says that its members will boycott all FIFA tournaments, while North America's CONCACAF has also rejected that proposal. Well, coming up on Bloomberg Daybreak Europe, we'll dig into a busy week of central bank action with Lauren Van Bouillon from Allspring Global Investments. Plenty to discuss, from all those central bank action moves this week, or lack of, to the impact on the bond market. So stay with us. This is Bloomberg.
bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Tyler Kendall in Geneva, Switzerland, and this is Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers, and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech.
Every weekday, only on Bloomberg Television.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jennifer Zabasaja in the Lesotho Highlands, and this is Bloomberg.
Live from London, this is Bloomberg Daybreak Europe. I'm Lizzie Burden with your top stories. Korea's Kospi on track for its biggest ever gain as investors dive back into the AI trade. Aggressive spending forecasts from Amazon helping to drive a powerful rally in global chip stocks. Meanwhile, the Bank of Japan raises its growth outlook as rates remain on hold, a day after the country's government stepped in to support its currency. And President Trump says the US-led Board of Peace has reached a deal for Hamas to disarm, but questions remain over the extent of any agreement. Well, a very good morning. Happy Friday if you are just joining us. 6:30 a.m. here in London. This is where we end the month in markets. Korean stocks, as I say, surging by a record after that huge drop earlier on in the week and all of those circuit breakers. The Kospi currently up 18% in Seoul. Analysts saying that this is more fundamental than bargain hunting. It's more of a genuine relief rally that we're seeing right now, and it follows a bounce in US tech stocks yesterday, so helped by those upbeat earnings from Amazon and by that report, as we were just discussing with Anthony Stevens, that Citadel bought a big chunk of the AI stocks held by the hedge fund Situational Awareness. So you can see the mood is positive across the world. European stocks 50 futures up 0.8%, and Nasdaq futures pointing to even more gains, up more than 1% this morning. A positive note to end the month. Now, flipping the board cross asset, and we've got Brent down more than 2% now at $87 a barrel. Brent, though, nonetheless heading for a 21% monthly gain on the Iran war escalation. The yen is there at 160 per dollar. Of course, we've had the Bank of Japan holding as expected this morning, but it's still weak at 0.7%, despite that yen intervention yesterday. More on that in just a moment. But there in the middle, we've got the 10-year Treasury yield after the Fed decision this week. Lots of questions about credibility at the Fed. The 10-year now down 3 basis points at 4.64. Now, let's turn to our front pages this morning, kicking off with the Financial Times. It says that US President Donald Trump is now not sure about whether he will allow Ukraine to make its own Patriot missiles. The paper had a telephone interview with the president in which he said that the US needs to be careful about whom it grants licenses to. Turning to the Wall Street Journal, it leads on the US-led deal for Hamas to disarm, describing it as a multi-phase process that would see Palestinian militant groups lose power in Gaza. And here in Europe, the headline on El País in Spain reads, collapse at the Ceuta border. It says authorities are on high alert after thousands of migrants stormed the border with Morocco. And you can get a roundup of all the stories that you need to know to get your day going in today's edition of Daybreak, which, as ever, terminal subscribers can find by going to DAYB Go. Now, let's turn to the week that was in central banks. The Bank of England keeping interest rates here in the UK steady at 3.75%, with Governor Andrew Bailey insisting that his committee is not getting closer to a hike, despite 3 members of the Monetary Policy Committee voting for tighter policy. While the MPC said that it remained alert to the inflation issue, the Governor told us he was also concerned about rising youth unemployment.
I think we're seeing a slow
softening of the labour market. We're seeing a slow disinflation in underlying inflation. I think when I talk to firms, we've got this, what was it called, sort of, low hire, low fire economy going on. And the UK is not alone in this by any means. This is a market where sort of turnover's dropping. I think it's therefore, and you see this is a bit of the youth unemployment story. That's really, I think, hard for people trying to get into the labour market. There's low hire, low fire.
Well, with me for analysis this morning is Lauren Van Billion, Senior Portfolio Manager for Rates and FX at Allspring Global Investments. Great to have you back, Lauren. Thanks for
good morning.
Joining me. I know you were listening intently to that press conference from Andrew Bailey yesterday, and what a line. Frankly, there's nothing in what I said or in anything that I've said along those lines talking about do not leave this room thinking the Bank of England is edging towards a hike. So that was a dovish message in the presser, despite the seemingly hawkish vote split. I wonder, when you look at the market reaction, you had front-end gilts rallying in response more to the presser, and you've written that market pricing on 2026 tightening looks too aggressive. Should we be more focused on the dovish votes yesterday and what we heard in the commentary from Ramsden and Taylor? Because they're talking openly of cuts if the Iran war ends.
Yeah, forward guidance seems to be going out of fashion in most central banks.
Yeah.
So it was quite a statement from Bailey, but perhaps just an insight into what's really driving his thinking. Obviously, the Bank of England doesn't target, labour or output gaps, but we know that's a sort of forefront of their minds at the moment. And if wages continue to come in sort of fairly well behaved, and we talk about that low hire, low fire environment. There was a lot of comfort around the domestic inflation picture.
Yeah, second round effects.
Absolutely, right. We've heard that from a lot of central banks. They're not seeing the second round effects. Yes, they're alert to them, but they're not. It's not a concern right now. It's difficult to imagine rate cuts with oil, like you say, up 20% on the month.
Yeah.
That's certainly a supply shock. But it does suggest then that on hold is that more natural sort of position.
But of course, there's also the fiscal story. It wasn't the main emphasis of the Bank of England yesterday, but maybe that's because it's coming down the track. We'll have Burnham's budget in the autumn. To what extent does that worry you about the long end of the gilt curve?
Well, and as you say, we saw that curve steepening very dramatically. I think for us, very long end gilts have been a difficult buy for a while. It's something.
But they didn't go crazy when Burnham arrived, right?
No, they didn't go crazy, but that was a very well telegraphed arrival.
Yes.
They'd gone crazy sort of in anticipation of perhaps. But I just looking at the risk reward there, still to me it's towards the front end of that UK curve. And yes, that long end then has to worry about the budget to come, this swirling talk of won't they go for early elections. There's plenty there to keep that long end busy.
I also want to talk about the Fed. Do you think it's got a credibility problem under Kevin Walsh?
I don't. I think that's too hard an assessment too early, at least.
Even without a hike.
Even without a hike. I think it came off obviously June where inflation numbers surprised to the downside, and not just headline but core. Looking ahead, we've got some disinflation still coming through from things like housing. It does depend on oil coming back down. For me, looking sort of into the tail end of 2026. But I think this is a market that's trying to adjust to a Fed that tells them less about what they're going to do and how they're going to do it.
Yeah.
And I think we're seeing that again with that yield curve move and that post-Fed, that really, that incredibly steepening curve.
I also just want to show you a chart, though, if we can bring it up, of US yields in comparison to peers since Walsh became chairman. They've risen more, basically, than elsewhere in the world. Did Wednesday make other markets even more attractive than Treasuries? You can see that's not quite the one I was after. We'll show it later on in the programme, perhaps. But
still going up.
Yeah,
still going
exactly.
up.
Are you looking more at, for example, Australia or even the UK?
For us, the ex-US has been attractive. And Europe and UK got hit so much harder than the US sort of in the immediate start of the war in Iran. So that was when actually we were adding exposure ex-US, mainly in that 2 to 5 year area of the curve, but we were adding risk there. And yes, because yields have moved a lot higher in the last 5 months, but you have had these bouts of strong rallies within that. So it's been sort of you've had the opportunities to add risk and then take profits in quite quick succession. I mean, Australia, to me, I think is very attractive because the central bank was more aggressive in its hiking cycle. I think they're done. And I think that softening economy suggests they could be one of the first to have to pivot to outright cuts in 2027.
OK, just finally, why should the market see these hawkish vote splits at the BOE and the Fed, these family fights, as Kevin Waters put it, as different, you know?
No, it's a good question, and I'm not sure. You know, the MPC needs to be having a robust discussion. We want to see them having well-reasoned arguments and all making their point. I suppose the issue is the Fed feels slightly more politicized, doesn't it? Given all the events of the year, whether it's around Fed spending, whether it's around investigations, whether it's around the pick for the chair. So I think the US just feels more politicized, and that's why it sort of takes a different tack.
OK, really interesting. Lauren, thank you so much for coming in this Friday morning. Lauren Van Billion, Senior Portfolio Manager for Rates and FX at Allspring Global Investments. Well, coming up, the French car parts maker Forvia reports better than expected first half profit, and the CEO, Martin Fisher, will join us next. This is Bloomberg.
My old mentor, Roger Staubach, who told me when I transitioned, football will never leave you, but you need to leave it.
Wow.
Everyone has a dream, and a lot of dreams are, you know, my dream is to play football and play professional football, and you get the dream comes true, but it is going to end. And the day it ends, the day before it ends, you're one of the best in the world. Great. The next day you wake up, that's gone. What are you great at? And the truth is, nothing, right? I'm not great at anything else.
I talk about it all the time, Steve, is this whole idea of it's not from penthouse to penthouse. And what I mean by that is you played for 15, 20 years and you're in the penthouse. That doesn't mean that you come to the business world and you're going to be in the penthouse. You don't start on the third floor or the lobby. You actually have to start in the basement.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend.
This is Bloomberg Television. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Welcome back to Bloomberg Daybreak Europe, 6:42 a.m. here in London. Well, turning back to results now, the French car parts maker Forvia has reaffirmed its guidance for the year after reporting better than expected first half operating profit. Let's welcome the CEO, Martin Fisher, to the programme now. Martin, great to have you with us on the show. I wonder what gives you confidence that you can deliver on your guidance when we've seen the likes of Stellantis' profits really hit by tough competition and recall costs as well. How are you so optimistic?
Yeah, good morning, Lizzie. No, in fact, we are presenting today first half results, and it's a third consecutive semester that we improve year over year. And it has a lot to do with the discipline in which we approach a market that in general is weak. So we have seen auto supply go down, but in these circumstances, we managed to improve our operating margin by 30 basis points to 6%. Cash is up to 430 million, and we managed to further deleverage the company to 1.6 times. And all that, also order intake was good with 15% up over prior year. So we have a strong start into the year. And the capability of our teams dealing with inflation, with uncertainty in the economy, gives us that confidence for second half year. We are cautiously looking at the market, but we are confident in our actions.
But how do you feel about Chinese competition in Europe? What are the risks and opportunities there?
Yeah, China is definitely the predominant market for us right now. Being a little weaker at home, but as you say, pushing strongly into the European market. So what is very good for us is that already 20% of our revenues are in China, and half of it with Chinese OEMs, and that's only growing. So when we look at our global order intake, which was pretty strong in the first half, 17% of that intake is with Chinese customers. We typically start with them on the home turf, but then when they go and venture out into Europe, into South America, and so on, we can be their trusted partners to bring them into these regions and also drive our sales together with the Chinese customers.
Have you ever had an offer from a Chinese manufacturer, Martin?
Please say that again. It didn't come across quite well.
Have you ever had an offer from a Chinese manufacturer?
Yeah. Sorry, it didn't come through. But I mean, I thought it was about Chinese manufacturers. And yes, we have a diversity of them. So our very traditional partner is BYD. So we have been strong with them over the past years. And since we have been extending our portfolio. So we also deal with others like Chery, Shangan, a new tech player that has entered the auto market very successfully. So we try to grasp the breadth of that market to be as robust as we can be. And again, when these car makers go global, we are their trusted partners.
OK, sounds like perhaps not a takeover suggestion. But also, how confident are you about this new Made in Europe set of rules that's being discussed, of course, in Brussels to try and save the European continent's auto industry?
Yeah, that's certainly a very hot ongoing discussion, and we'll see what the European Commission, the European Parliament make out of it. Us as a car parts supplier, for us, it has always been important to be local for local. That's the most robust supply we can offer to our customers, and that's why we are strong in Europe, but equally strong in Asia or North America. So we are robust against that kind of legislation. As a European citizen, I think we deserve well a bit of political support for our businesses and for our economies. And I think local content can be one of these levers that other regions like North America already apply.
Well, yeah, because you've got this new decree in China making clear that there's no real desire to share Chinese EV tech know-how with the Europeans. So I wonder how that can be squared with, you know, the kind of Chinese partnerships that the likes of Stellantis are trying to do.
Yeah, I think the European OEMs are very well inventing and reinventing themselves. And I have no doubt in my mind that when it comes to electrification, electronics technology, they are catching up. So that is pretty clear to me. At the same time, what our customers see is just an incredible speed in the Chinese marketplace in the development of new technology and vehicles. And I think customers like Stellantis of ours, Renault and so on, they want to tap into that potential. As we do, so also our presence in China is pretty strong. And we develop part of our product portfolio, part of our innovation also in that ecosystem that is very fast and very strong in China.
Just finally, Martin, I'm really interested to hear how you're building your footprint when it comes to defence. I'm thinking about AI-powered air defence and counter-drone systems. What are you doing there?
Yeah, in general, I mean, where the automotive market is somewhat stable but not growing, we have looked for ways to diversify. And we do that both in the auto sector, where we regionally diversify, and then also go into new product technologies, into the commercial vehicle segment, but we do it also in adjacencies. And defense is one of those for us, where we have been active for a longer time, but now we boost that up. So we have this week announced our first contract to produce drones, and that gets us into this space. The way we conquer is basically on two fronts. We have good industrialization capabilities and capacities. And on the other hand, we have products and technologies that qualify. So now, based on that first contract we have also established a dedicated team, and we are gonna very seriously explore that space and add business after business.
Okay, really interesting, Martin. Thank you so much for making time for us this morning. Martin Fisher, CEO of Forvia. Well, let's turn back to the wildfires that we were discussing with AXA earlier on in the programme. A group of scientists warning that climate change made the weather that fuelled Europe's recent wildfires at least twice as likely in France and at least 20 times as likely in Spain. The alert from the World Weather Attribution Group comes after fires consumed hundreds of square miles near the cities of Bordeaux and Madrid. Fire crews are also tackling sizable blazes in England and in Greece. And we can bring in our Bloomberg climate reporter, Joe Wirtz, for more now. Joe, thank you for joining us. Just give us some context here. You know, we're kind of in the thick of things at the moment, but how severe have the blazes been across Europe this summer compared to history?
Yeah, they've been remarkably, severe. These are, rapidly moving, quickly developing wildfires, that have spread quickly through the undergrowth and the wildland areas near Bordeaux and Madrid. And in some cases, there's been reports on the ground from firefighters that these are the types of wildfires that have created fire storms. They're capable of producing really their own weather systems, these big clouds and powerful downdrafts that can further spread the flames. So this is really a new era of wildfires. We've seen these in other places in the world, but in some cases, particularly in France, these are the first time we've seen these types of storms, firestorms and wildfires. These outbreaks of these really dangerous fire conditions.
So it is a case where we can actually use the word unprecedented.
Yeah.
I was talking to AXA earlier on in the programme, who, of course, have a perspective on this from the insurance side. And the AXA CEO is saying, it's really all about prevention.
That's right.
I do think we have to talk about whether it's changed the policy perspective.
Yeah.
Have we actually seen policymakers really changing their views? Does it look like we'll get proper action on this?
That's a good question. I mean, fire scientists are pretty clear. We are now in this era, and these fires are happening and they're starting. They're dangerous and they move quickly and are extremely dangerous. And now that they're here, it's really a matter of responding to them, not just extinguishing them when they ignite, using these very expensive, aircraft regimes to dump water or fire retardant on these things from the air. It's just forced a huge mobilization of both of firefighters and resources. We've seen a record number of EU firefighters deployed across the continent to battle these blazes. And like you said, really a lot of conversation now about how to manage the land, manage communities now that these fires are here. A lot of this work is extremely expensive and cumbersome, time-consuming. We're talking about, manually managing land, thinning brush and trees, and really getting on the ground in these communities where this land is managed. And in some cases, this is abandoned agricultural land, former farms, and a complicated structure of which authorities in charge of these lands. Is it privately owned? Is it under a local department or prefect? And really the nitty gritty of having to manage this on the ground is where a lot of the prevention solutions, I think, are going to lie.
Yeah, so many angles to this story. Joe, thank you for bringing us that reporting. Bloomberg's Joe Wirtz. Well, plenty more coming up on the programme. Don't go anywhere. This is Bloomberg.
bringing you up-to-the-minute space news whenever and wherever it happens. I'm Ed Ludlow at NASA's Kennedy Space Center in Florida, and this is Bloomberg.
When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
Every weekday, Bloomberg puts a spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
He'll do what the data say he should do, and he'll be independent. And the fact is that the data right now are taking the pressure off the Fed, and I think that the markets will get around to seeing that. Maybe they need another couple of prints like the one we saw today from PCE. But we should also talk about the GDP numbers today a little bit, because I think that they've been miscovered quite a bit.
White House National Economic Council Director Kevin Hassett there in defence of Fed Chairman Kevin Warsh, referring to that 0.1% drop in PCE last month shown in yesterday's data. And I promised you this chart earlier with Lauren Van Billion. It does show us how you've got global bond investors looking away from treasuries for other opportunities around the world, as we have that theme of Fed credibility rearing its head this week, given the vagueness in Fed communications under Warsh, as well as the lack of a hike this week. Now, the other theme of the week, of course, has been the roller coaster ride on the Kospi. So flip the board. Korean stocks surging by a record today after that huge drop earlier in the week. All those circuit breakers as well. Analysts saying that this is more than just bargain hunting. This really is a relief rally, and you can see foreigners coming back to the Kospi. Just flip the board one more time. To end the week, we've seen drama out of Japan as well, not when it comes to the BOJ decision, but in the terms of the yen intervention that we saw yesterday. The US getting involved now, but the yen having dropped, giving back some of those yen intervention-induced gains. Now, earnings has been another theme of the week, and the earnings conversations will continue throughout the morning here on Bloomberg. We'll be speaking to executives from NatWest, Crédit Agricole, and also Clarion. So, the opening trade coming up next. Anna and Guy will take you all the way to the European cash open. This is Bloomberg.
Is there anything that humans today can do?
Yes.
That will change the lives of the humans currently on the Earth?
Well, first of all, people who switch over are getting the benefit right away. But coming back to the point about the fossil fuel industry and our debt to them, there's an old saying that came from the King of Saudi Arabia years ago. The Stone Age didn't end because of a shortage of stones. It ended because something better came along. Something better has come along now to replace fossil fuels, which are dirty and polluting and threatening humanity's future. The cheapest electricity in the history of the world is solar energy. Second cheapest is wind energy. And now batteries, the only thing that's come down in price faster than solar is utility scale batteries, doubling every single.
Why are we ending the wind farms that are now being built off the coast of the United States? We're ending them.
Because Trump is insane.
On another subject,
you don't want to explore that, but let me add one point on the solar. If you look at all of the new electricity generation installed worldwide last year, I often ask people what percentage of it was renewable, and people say, they're looking for a high number, say maybe 30%, 35%. Correct answer is 93%. Because it is taking over the electricity generation industry.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Good morning, everybody. It is Friday, July the 31st, and here's what is on our agenda. Amazon results confirm a strong quarter for cloud companies. The Kospi ends July on a high after a furiously volatile month, leaving hedge fund situational awareness counting the losses. And surprise yen intervention sets the stage for a not-so-surprising BOJ hold.
Yeah, I'm going to get to the press conference very, very shortly. We'll talk about that in just a moment. Let's talk about that volatility that you mentioned, Anna, and show some examples of it. The Kospi. This is an index, right? I know it's not an index, it's two stocks, but it's an index in theory. Kospi is up by 18%. 18%. That's an index. It's up by 18%. Yes, it has the whiff of an ex-cat about it, but nevertheless, it is up by 18%. We'll talk about the impact of that. Dollar yen is up by 0.6 and 0.7%. What was all that intervention about? What was the market check coming out of the United States all about? We'll talk about that when we get to the press conference of the BOJ. Euro Stoxx 50 futures actually quite positive coming into the end of the month. We're up by 0.8%. Earnings a big factor in that narrative, and we'll deal with the details of that as we work our way through the morning. The countdown to the opening trade starts right now.
Welcome to the programme, everybody. Oh, we're nearly at the end of July, Friday the 31st of July. I know there are 31 days, but always 31 days, but this feels like longer than the average July for some reason. It's just gone 7 o'clock here in London. It is Friday, and we are taking stock of what has been an incredible week for technology in a number of ways. We've learned a lot about the types of AI that the market wants to see CapEx spent on and the types of AI it doesn't. And broadly speaking, Guy, it seems that cloud is in favour, and it seems that if you can prove you've got some revenue coming in, that's in favour as well. Those are the types of AI spending that the market seems to be able to tolerate, and I offer you Amazon as the example.
We should just call it AWS, because that's really what we're talking about here. AWS. Revenue, fantastic. The revenue line is sensational, plus 37%. That's a really great number. The problem is, though, compare and contrast the cash flow out of AWS and Apple. Apple got dinged last night. Amazing free cash flow. Amazon, not so amazing free cash flow. In fact, a huge drop in free cash flow. But the top line is moving, and the market, that's all the market needs right now. So at the moment, it's not focusing on the cost of that top line. It's just focusing on that top line.
Yeah, they're getting the revenues in. And to your point about it being just AWS, most of the profits at Amazon now come from AWS, which is also an incredible fact when you think about where that business started and what it meant for high streets all over the world. In terms of the Apple story, then, of course, this is an example of the other tech theme, which has been higher memory costs, and that's pushing up prices for Apple. That meant that they had to push up prices, of course. They do report that demand is better than expected for some of those products, but they also report that there will be further delays to some of the deliveries going out into the future. And this is the last quarter for Tim Cook as he hands over. I do think it's worth, as we're talking about technology, worth marking what happened with Microsoft yesterday. We talked about the details of the earnings report in session or in our show yesterday, but it made history. This stock made history, up 16% in session, which in itself is not a historic percentage, but adding $450 billion in market.
See, I was going to include that in the next segment, which is insane volatility.
Yes.
And in some ways that
also valid there.
Precisely, it fits. So I think it fits with that narrative. You're just getting these uber swings. Microsoft is still down quite significantly over the last few months, but you get this massive pop in its stock price because actually its cloud division Azure has done better. There are many more examples. There are many more extreme examples. Look at the Cosby. Cosby's up 18%.
In a day.
In a day. In a day, it's up by 18%. If you take a look at the week, though, we're still down on the week, which tells you an awful lot. You can be up 18% today, and I think on the week it is either, actually, when I checked this morning, it was down, but I think we were only up by 15, 16% at that point, so maybe actually we're flat. But nevertheless, it has been a wild week for the Cosby, and it is absolutely extreme. There are other examples. You just go on and on and on and look at the examples of some of these wild swings at the moment. This is not a normal market. This has not been a normal month by any stretch of the imagination. And you can see that in terms of the chart. You can see there, look at the right-hand side of it. Take a look at just in terms of the performance of other markets as well and the extremes that we've seen there. And that takes us on to the situational awareness story. And Leopold, what a great name. Leopold Aschenbrenner, the boss of that business, who basically has had to sell huge chunks of his business because this was effectively an AI fund. It's made massive gains, but some of the drops that we've seen recently have caused it effectively to see some of those positions go significantly underwater. These are the kind of blow-ups. It's not a complete blow-up because it might actually end up as a going concern, but it had to sell huge chunks of the portfolio to Ken Griffin. These are the kind of moments that cause funds like this, glittering funds like this, to go completely the wrong way. And it's just an example of leverage. The amount of leverage that is in the system is massive.
He's a fascinating character, isn't he? Because an AI researcher turned hedge fund manager. But it just also goes to show it's not only retail investors who get in here, it's new entrants to the hedge fund industry who are getting sort of blown up to some degree here. So I'll offer you a counter argument for all our sort of doubts and scepticism about whether the positivity around AI continues, which seems to be filtering through this morning. This comes from Hebe Chen in one of our stories over at Vantage. And he's giving a different gloss, I suppose, to what we've seen in the Cosby today. He says, stripping away the speculative foam, we are allowing the market's real contours to surface, which I just thought was so poetic. It deserved to be referenced today. So we don't know whether the real story around the Cosby is the drop of a third that we've seen since the peak in June, or the rally of 18%, which we see today. But we'll be here for it next week.
We are still down on the week.
We're down on
1%.
We're down since the highs in June.
But on the week, we've got an 18% rally, and we're still down on the week.
Yeah. It tells you a lot about the extent of the volatility. We don't have volatility in the BOJ decision today. That went pretty much as expected. No change from the BOJ, but a lot of volatility in the yen, as we know. They did vote 8-1, and that one dissent was interesting because if they'd gone for a hike today, that would have been a vote for a back-to-back hike because they went for a hike last time. So that would have been a quite punchy call, but that's not what they did. They decided to hold interest rates. Interesting on their real assessments of what's going on in the risks in the economy. They're talking about them being balanced and not necessarily tilted to the downside anymore on the Middle East, which does tell a story about resilience, about the Japanese economy, as we've talked about in the European context as well. But maybe I'm burying the lead because the real story was around intervention in the yen, which came in US time, and the finance ministry saying we are getting more than just moral help from the United States. And Scott Besson now with some very positive lines about what the Japanese are up to.
So, Scott Besson's been talking about the fact that he thinks the yen is undervalued. We understand that the New York Fed, at the behest of the Treasury, may have done a market check. Now, that's not intervention. That's just ringing people up and going, so what do you want to buy this stuff at? Or what would you sell this stuff at? So, but nevertheless, it implies that there is the US backing. But why?
Yeah.
What was the point? I don't understand what the point of that was, given the fact that we are now effectively in a world where the market's signalling and saying, if you want to stabilise the situation, you've got to start raising rates. And the BOJ didn't do that.
And a lot of the guests we talked to, say that the BOJ is the thing that is holding back the currency, and that's what needs to happen. Interesting that 60% of BOJ watchers are telling Bloomberg News that the Prime Minister Takaichi could be the blocker here, could be the barrier here, the reason that rates aren't going higher. So we'll see what the UAIDA press conference delivers, because that's going to be important, and that looms on the agenda.
20 minutes' time, just over 20 minutes' time. What else is coming up? NatWest is just out with numbers. Q2 pre-tax operating profit looks like it's beaten. It looks like the bank has boosted its full-year outlook. We are going to find out all the details. Paul Thwaite, the CEO of NatWest, is going to be joining us shortly. Clotilde Langevin is the Credit Agricole CFO. Many things to talk about there. What is going on with the French economy? What is going on with the politics? What is going on with the wildfires? What is going on with equity trading? Eleanor Taylor, your leader and co-head of Global and Swiss Equities, is going to be joining us. We'll look forward to seeing her a little bit later on. And Victoria Clark, Santander CIB UK Chief Economist, joining us a little bit later too.
Let's look ahead to some of the other things that we're watching out for today. At 9 a.m. UK time, we get Italian consumer confidence. We get Euro area CPI at 10 a.m. UK time. 12:15 UK, we get to hear from the chief economist, Hugh Pill, who speaks at the National MPC Agency briefing. Now, one of the hawks, of course, on the MPC and not on that panel talking at the Bank of England yesterday. So it'll be interesting to get his perspective. We also get US earnings from Chevron, Exxon, and ExxonMobil. So an interesting moment to mention what we've seen on oil then, Guy. We've got oil logging a 20% jump in the month of July as war, of course, festers is the word used by our colleagues at Bloomberg News, and that does seem to be perhaps appropriate because we had the MOU, which brought about some kind of peace agreement in the short term, paving the way for a longer-term peace deal. But then we saw tit-for-tat attacks taking place and then a pause in that and a return to that. Anyway, where are we? It seems that we've got a trickle of vessels still going through the Strait of Hormuz, and the Saudis discussing forming an alliance to try and protect navigation in the Red Sea. So we're still worrying about a couple of different geographies here.
But it goes back to volatility. It goes back to two things. It goes back to volatility, extreme volatility, up, was it 21% in the month?
20%.
20%.
Oil, yeah.
OK. That's quite volatile. And inflation. This is inflationary. I was listening to Paul Sankey, actually, yesterday on US TV talking about we're looking at the wrong thing when we look at the Brent price. And it takes us back to the conversation we had with Shell yesterday, talking about what refining is looking like at the moment. They're running at 100% plus in terms of their refinery capacity at the moment. Getting product to market, petrol, diesel, jet fuel, etc. That's where the real bottleneck lies right now, particularly as we take out more and more Russian capacity.
And as we work our way towards those US earnings in the oil space, interesting to bear in mind the question you asked Wael Sawan, which was about, well, okay, if you're refining to that degree right now, what does that mean for maintenance and refining ability in the future?
At some point, you're going to have to fix these things. He says, I know my plants quite well. We're going to be able to manage them quite well. Therefore, actually, don't worry about it too much. Anyway, let's return to the AI theme next. Models going rogue. Anthropic says its models breached 3 organizations during a cybersecurity test, which went a little awry. This is becoming a theme, isn't it? Remember that rival OpenAI disclosed a similar incident. We will discuss next. Plus, we're going to return to the airline theme, IAG, and British Airways, Iberia, etc. Missing estimates. The British Airways co-owner continues to be tested by that rising fuel cost story we've just been discussing. More insight on that story. Plus, we're going to come back to the NatWest story. NatWest earnings crossing the wire this morning. Paul Thwaite is the CEO. Looks like the numbers are pretty good. We'll come back to that. You want to join in any of these conversations? Honestly, join us around the table this morning. IB Plus, BBTV Go is the function. We'll see you in a moment. This is Bloomberg.
The global economic playbook is being rewritten and the levers of power are moving in real time.
To see where the world is headed, you have to look where the action is.
I'm Haslinda Amin in Singapore.
I'm Menika Doshi in Mumbai.
Welcome to Emerging the New Economy podcast.
Each month, we dive deep into how the world's most exciting rising economies are shaping the global future.
Join the conversation. Subscribe to Emerging on your favorite podcast platform today.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
Earnings season is here.
There are earnings galore.
Some areas have done well. Equity trading has been an area of resilience.
Bloomberg is first to break the numbers.
Diving through the details of these earnings.
That is the weakest growth in more than 3 years.
With the smartest insights.
Are we seeing dislocations that point to something a little bit more severe?
If you look at where global growth expectations are, compare them to the start of the year, they're actually pretty similar.
But there is this uncertainty, and we haven't seen it in the results.
Continuing coverage on Bloomberg.
Not only is it a record second quarter, but it's also a record first half for us. But what's extremely pleasing is you mentioned the significant beat on investment banking, but actually we had record flows from asset management, almost 9% growth from our private bank. Our corporate bank is continuing to show signs of progress, which we assumed.
What we did within the investment bank, we also shifted some capital from the fixed income businesses to the equity business to help them. But our focus is really, which I also believe that the numbers are very strong because they are mainly driven by intermediation activities. And rather than deploying capital in prime brokerage.
You know, our top line income of £8.1 billion is up over £1 billion on the same number last year. Profits of £3.3 billion are up 30% over the previous year. And the investment bank, as you say, has done extremely well, including my colleagues on the equity trading floor behind me.
Senior executives from Europe's biggest banks speaking to Bloomberg about a strong quarter of earnings. And we continue to watch the banking sector then, guys, this morning.
We do. NatWest is out with numbers. Pre-tax operating profit, $2.29 billion. The estimate there was 2.01. I would call that a significant beat. In terms of the return on capital employed, full-year ROTE target, now seeing the bank sees that at plus 19%. Previously, 17%. The market was kind of all the way there. The estimate was 18.8. So basically, this is a bank that is strengthening its guidance for 2026. Joining us now, Paul Thwaite is the CEO of NatWest. Paul, great to have you on the programme. What gives you the confidence to raise that guidance?
Hey, good morning. Yeah, a very pleasing set of H1 numbers today. The numbers show that we're delivering for customers and for shareholders. As you alluded to, strong returns, profits are up 20%, and we've announced an increased dividend by 26%. What gives us the confidence to strengthen the guidance really is the strong performance of our 3 businesses. I'm delighted that all 3 of our businesses, retail banking, private banking and our corporate bank, are performing and growing really well. They're also becoming more efficient. So that's a virtuous cycle. You know, we're driving a lot of capital and that's driving great returns. I think we're very well positioned in terms of the structural growth drivers in the economy. And that's really what's given us the confidence to talk to, I guess, a better set of 26 numbers than we originally anticipated at the start of the year.
Why does that momentum stop there, Paul? Is all the good news in now? Is this as good as it gets?
I don't believe so. I'm delighted with the momentum that we've got. You can see that all 3 businesses and their balance sheets are growing. We see really good demand in the economy. You can see our lending performance in terms of our corporate bank. Significant increase in the first half of the year. We've got good line of sight with the biggest corporate banks. We've got good line of sight on the pipeline. So we can see that continuing out through 26 and into 27. Likewise, in our retail business, we've got good line of sight on pipelines. So I think as we continue to drive growth and structurally higher returns and make the business more efficient, that will support earnings, not just during 26, but out through 27 and 28. So I feel confident in where we're positioned as a business, not just for the short-term performance, but also for the medium-term performance, looking out for several years.
Paul, good morning. You've talked in your release today, or there's a note here that says that operating expenses of £300 million relate to the Evelyn deal. What is that cost related to, and how has that deal been progressing for you?
Yeah, good morning. Yeah, you can see in the results today, the private bank and wealth management business is performing really well organically. Record net inflows, 45,000 customers investing with us for the first time. And as you referenced, we completed our acquisition of Evelyn Partners last month. That gives us unmatched scale and capabilities. So we're very pleased to combine that with our existing private bank. The cost numbers, it's very simple. It's just in effect incorporating the run rate costs of Evelyn into our guidance. We've done the same on the revenue side. We're a month in. The integration is going well. I'm very excited actually about the scale and capabilities we now have. We have the largest employed advisor network in the UK. We have very deep client relationships. We have a digital investing platform. And I do think as we look out over the next 3, 5, 10 years, it's going to be a defining decade for financial advice. So to have the capabilities to support customers as they plan and invest for the future is really important to us. It also creates a bank that's growing at a faster rate, but also growing at structurally higher returns.
So you say it's going to be a defining decade for advice, Paul. Yesterday we spoke to Charlie Nunn over at Lloyd's, and he was telling us about the AI Invest agent that they have launched, which will be able to give advice to all UK customers around investments. Where is NatWest on that push?
Yeah, I think that's going to be an important or an incredibly important feature of both financial advice and wealth management going forward. We have an AI financial assistance. Personally, I think that AI will be a real accelerator for savings and customers. I think it will bring a lot of value to customers. It'll allow them to do research. It'll allow us to provide great insights to customers and actually free up a lot more time for financial planners and wealth advisors to do what they like to do, which is to spend time and really get a great understanding of what customers want to do, whether it's planning for their retirement, whether it's planning to pass on their wealth to their children. So I see AI as a real accelerator of the wealth management business, and we're excited about the opportunities it presents.
OK, can I take that, Paul, put it together with some of the other things you said as well? You like where the business is. You like the medium-term momentum that you have. You like the kind of the profit profile that you're looking at over the next few years. You think AI is going to do some heavy lifting. You've bought Evelyn. So now what? Are you now in the position where... And I'm going to bring the kind of the buyback and the dividend and all that sort of stuff into this as well. Are you now at the point where you think you've done enough on the M&A front in that space? Could you see yourself doing more? The Evelyn Partners, kind of the initial reaction was actually fairly negative in terms of the share price. Are you now in return money to shareholders mode and return in investment and put money to work in the business mode rather than acquisition mode?
Yeah, I think it's a good question. I think what we've done is put the business in a great position. What we've created with the leadership team is 3 businesses that are growing and are scale and are really well diversified. All our focus at this time is on integrating Evelyn Partners. As I said to the previous question, we see great opportunity there. We're committed to the ordinary dividend at 50% of profits. And what I've said today is we're also committed, as we have done for the last couple of years, to returning surplus capital to shareholders. So I think we've given a very clear steer about where we see our priorities, which is 1, integrate Evelyn, and 2, return surplus capital to shareholders. So I think we've given a very clear steer about where we see our priorities, which is 1, integrate Evelyn, and 2, return surplus capital to shareholders. So I think we've given a very clear steer about where we see our priorities, which is 1, integrate Evelyn, and 2, return surplus capital to shareholders. So I think we've given a very clear steer about where we see our priorities, which is 1, integrate Evelyn, and 2, return surplus capital to shareholders. So I think we've given a very clear steer about where we see our priorities, which is 1, integrate Evelyn, and 2, return surplus capital to shareholders. So I think we've given a very clear steer about where we see our priorities, which is 1, integrate Evelyn, and 2, return surplus capital to shareholders. So I think we've given a very clear steer about where we see our priorities, which is 1, integrate Evelyn, and 2, return surpl make sure that we return surplus capital to shareholders. And we think that has been previously well received and will continue to be well received.
OK, so that's the strategy. The context politically is changing a little in the UK, Paul, and I wonder if you are, I'm sure you're quite excited about the prospect of growth in every postcode, which is the catchphrase the new Prime Minister likes to use. Are you also apprehensive about the possibility of higher taxes on banks?
Well, first of all, we wish the new Prime Minister and the new government success, both domestically and internationally. I think that's really important for the UK. I have been encouraged by the early messages on growth about every region and every postcode. I've also been encouraged by what the Chancellor has talked about and the role he sees for financial services in supporting that growth. I won't comment on or speculate on different policies. What I have said consistently over the course of the last couple of years is that strong economies need strong banks and vice versa. And it's really important we have policy certainty and stability so businesses and investors can plan on a sensible basis. My role and the bank's role is basically to partner with government. So whether that's building and subfinancing infrastructure, whether it's helping SMEs or whether it's helping people get on the housing ladder, that's, in my view, where we should be using our capital.
Thank you very much. Thanks for joining us, Paul. Really appreciate it. The CEO of NatWest, Paul Thwaite. Thanks so much for being with us. Let's just go to another UK corporate where we're getting some breaking news coming through. BP out with some announcement at the top of the hour saying they are going to market their North Sea business for potential sale. The North Sea business is better positioned as part of another company. This pretty big action from the new CEO over at BP and ahead of the earnings which are coming next week, and all about getting the balance sheet back in shape, I suppose.
But also about the politics of the UK, you could argue, in some way, because this has been a very controversial point in terms of where this new government is going to sit in terms of drill, baby, drill, effectively, in the North Sea. OK, let's talk about what else you need to know this Friday morning. Anthropic says its AI models breached the security of 3 organisations during a recent cyber security test. It comes a little more than a week after its chief rival, OpenAI, disclosed a similar incident. In a blog post, Anthropic says it found 3 instances in which its Claude model accessed the internet and then hacked into external organisations. President Trump says his US-led Board of Peace has reached a deal for Hamas to disarm. But there are questions about the extent of the agreement and when it will take effect. Officials said details of the deal would have to be refined over the next couple of weeks, with progress expected in the coming month or 2. And the Spanish government has ordered an emergency military deployment to one of the country's 2 North African enclaves. This after thousands of illegal immigrants entered over recent days. Spanish media have reported that thousands crossed into Ceuta on Thursday, many by sea. Ceuta and another Spanish enclave, Melilla, serve as the only direct land connections between Africa and Europe. The border crisis has drawn scrutiny across Europe, including a threat by the Italian Prime Minister, Giorgia Meloni, to suspend the EU's freedom of movement agreement with Spain. Spain takes a very different tack when it comes to immigration at the moment, recently allowing, effectively legalising around 1 million illegal immigrants, effectively codifying them into the system. And you can see it in the economic data. The demand curve has shifted right, the supply curve has shifted right, everything is moving, and the Spanish economy is benefiting, at least at a top line level, maybe politically a different story.
Yes, from migration and from money from the EU. Coming back, we will get back into the bank earnings story, and Credit Agricole is going to be in focus. We will speak to the Deputy General Manager and CFO. This is Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Burr.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
What's the skill set that you would advise every aspiring CFO to develop?
Psychology.
I think analytical skills are important. Obviously, you need to like the numbers. If you don't like numbers, then don't go into finance. It's sort of like a recipe for disaster if you don't like numbers.
Not only for the CFO, but also the company's management. That's a communication and the collaboration.
I spent a lot of time figuring out how to take the complex and make it simple, and then finding a way to be able to communicate that both internally and externally.
I think it's relationships, whether it's working with investors, bankers, with the senior management team, with the board. Having your head down is one thing as a finance person, but keeping your ears open is super important as well. And I think that all of that is what kind of builds out being a successful CFO.
Watch Chief Future Officer only on Bloomberg.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers, and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech.
Every weekday, only on Bloomberg Television.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Bersecci in El Ola, Saudi Arabia, and this is Bloomberg.
Welcome back. Let's take a quick look at the markets, just figure out exactly what is going on this morning. This is what the futures picture looks like. We have a generally positive picture across much of Europe. The Euro Stoxx 50 in particular, as you can see, and we'll dig into the details in a few minutes, is rising quite sharply this morning. We're up by, let's call it nearly 1%, 0.9%. The bond market is just beginning to open up here in Europe in terms of the picture that we see there after the significant volatility of the last few days. I see yields going lower just once again. It's interesting that the UK yield dropped sharply yesterday, particularly at the front end, and we'll come back to the Bank of England a little bit later on. But this morning, little moves at the in the European bond market.
We are watching live pictures coming to us from Japan. The BOJ Governor Ueda delivering his opening remarks ahead of the press conference. So for the next hour, Guy, we'll be keeping one eye on this, won't we? And to listen out for if he gives any suggestion of the cadence of rate hikes that are going to come, because we had that story. Was it earlier this week? It's been a very long week. But earlier this week, I think, that said that the BOJ is prepared to move faster than the market expected. But the market expectation is still only one hike every 6 months. Is that fast enough to stem the drop in the yen, which intervention doesn't seem to be able to stem?
This is the problem. And it was... I'm still trying to work out the sequencing. Why do intervention just before this event takes place?
Maximum surprise is the only argument I've seen that, to answer that question.
Oh, and why get the US involved? Why expend that firepower now? What were they trying to achieve? Maybe we'll get some answers out of this press conference.
Yeah, absolutely. So no doubt he'll be asked about the growth picture in Japan, the extent to which the weakness in the yen is making the inflation story more challenging as well. That's an interesting dynamic that we need to watch. Also, so we're watching that. I mean, whether he'll comment on what the Americans are doing with regard to currency, I don't know.
But why do it? What was the purpose of that? I don't know. Maybe you just try and maybe you're just trying to manage expectations. Well, even if you're trying to manage expectations into the event and into the press conference, why would you do it why would you go so hard? I'm really scratching my head.
We will see if we get any answers. So that's the BOJ. That's one thing we are keeping an eye on. We're also watching, of course, the bank earnings story. We've already talked to NatWest this morning. Let's talk about the French banking sector. Crédit Agricole has reported better than expected results for the second quarter. Income rose at its French retail business, while its asset management arm reported a record profit. We're joined now by Crédit Agricole's Deputy General Manager and CFO, Clotilde Langevin. Clotilde, very nice to have you with us. Thank you for being with us on the programme. So one thing that has got a lot of headlines, a lot of attention over the last quarter for banks on both sides of the Atlantic has been trading revenue. What can you tell us about how Crédit Agricole has performed there and how it stands up to its peers?
Well, we've performed very well in the CIB more generally, and indeed in investment banking, where the growth has been more than 60% this quarter. Fixed income and commodities were stable. But what's interesting is that we have a very balanced mix in our CIB between capital markets and investment banking and structured finance and financing, which was also very strong. And so, in fact, we had a very strong set of results overall, thanks to very dynamic activity everywhere. I just talked about equity and trading, but we had record inflows in insurance, record levels of assets under management in Amundi. And in France, we had a very strong loan production and very high net interest income. And so, all in all, we reached record revenues, 7.4 billion euros for Crédit Agricole SA, growing by 7.7%. And this allowed us to post very strong gross operating income growth of 11.4%. But we're also very profitable because our cost-to-income ratio decreased and is now below the target that we had set in our medium-term plan, which is 55%. And the return on tangible equity is at 14.3%. And this allows us to pay an interim dividend on the 15th of October of 57 cents per share.
OK, Clotilde, that's a nice introduction to the performance over the last quarter. Can I ask you about mergers and acquisitions across Europe? Because this is a really interesting period for consolidation in the banking sector, in particular cross-border. So you have a stake in Banco BPM, 29.3%. And we know that there's an attempt, of course, there's press reports, actually, that Monte dei Paschi and Banco BPM are trying to explore a possible merger. And we already know that Intesa Sanpaolo has a takeover bid on the table for Monte Paschi. So I wonder what it is that you're looking for in terms of consolidation within the Italian banking sector. Are you backing a merger of Monte Paschi and Banco BPM?
So Italy is really a strategic market for us. It's our second domestic market, and it represents 20% of our net income for Crédit Agricole SA. So it's very strong, and we want to continue growing organically through our retail bank, but all of our other businesses also are present, growing through partnerships. And also we have a strong and long-term partnership with Banco BPM. And so that's also why we increased our stake to 29.3%, which are fully acquired shares. So we have a strong position. So there's lots of scenarios on the table, all of the scenarios that you're talking about. So we are key to the setup, thanks to our 29.3% position. We're not necessarily going to be the ones who are going to decide, but nothing can be done without us, and nothing can be done against us. And for us, the priority
so do you not have a preference,
is to remain
so does the business have a preference?
We, as of today, have not received any concrete proposal regarding, for example, the scenario of MPS and Banco BPM that you talked about. For us, what's really important is to continue to develop in the long term in Italy, which is a strategic market for us.
Clotilde, just one more follow-up on this. So why don't you just buy it? Why don't you just buy the rest of it? That's the bit that I'm curious about here. If it's so important to you, why doesn't Crédit Agricole just step up?
What's important for us is the whole setup that we have in Italy. We don't only have this participation in Banco BPM, we also have Crédit Agricole Italia. We have more than 6 million customers in Italy, and we have all of our businesses. So we also want to grow organically. Now, as of today, we have not asked the ECB for the authorization to take control. So our situation here is a strong, stable situation, which allows us to be a key player in this setup on which we're not going to decide upon everything.
Can I just ask a question which kind of is related to what is in the news at the moment? Is it possible, at this point, given the fires are still raging, for Crédit Agricole to get a number, a vague number in terms of what this is likely to cost the business? How and I'm wondering through which channels you think the effect will be greatest?
You're talking to me about the wildfires, right, in France? Is that what you're talking about? Sorry, I didn't get that. Yeah, okay. Right.
Yes.
So, in fact, today, our main priority is just supporting the victims and the communities and our employees. So what we're putting in place today is a certain number of support measures, loan payment holidays, zero interest emergency solutions, support plans for businesses, and a 2 million solidarity fund. So that's what we're working on right now. Now, down the line, what's going to be the impact? It's probably going to be lower for us than the impact of the first quarter storms, but that's the direct impact. And there will probably be an indirect impact, which will probably have a more important impact on the regional bank that is locally present. But today, our priority, which is always in fact our priority, is to continue to support our customers in the good times and the bad times. So our priority today is to provide them this very short-term emergency support.
Clotilde, what bearing does the presidential election in 2027 have on the business? Clearly, it will possibly continue to impact French assets. But in terms of the structure of your business, the vulnerabilities of your business, how are you thinking about the election next year?
Right. So the election creates uncertainty, undoubtedly, in France. Now, we have a group that is very present in France. Crédit Agricole SA has more than half of its revenues outside of France, but we are naturally, for example, exposed to French debt, naturally. So France has strong fundamentals, a diversified economy, strong fundamentals in terms of energy, of tech, etc. And we know how to support our customers in uncertain times. This is what we have been doing for years. And we know how to support our individual customers, providing them with solutions in terms, for example, of savings. We know how to support our corporate customers, helping them diversify, helping them hedge, for example, against uncertainty. And more specifically, our exposure to French debt is large, naturally, because we're a natural French player, but the exposure to volatility is very limited due to the accounting that we put in place for our banking exposure and our insurance exposure. So we have the solidity needed to maintain strong growth. We have strong drivers of performance down the line within this uncertain environment.
France is trading 78 over Germany at the moment. We'll certainly keep an eye on that number. Clotilde, thank you very much indeed. Always appreciate you bringing us the details of the numbers and the outlook. Clotilde Laugerin, the Crédit Agricole Deputy General Manager and, of course, CFO. What have we got coming up for you? We're going to come back to the volatility story. Hedge funds start.
you're going to see disruption in certain job functions. I don't see how that's not possible. And I don't see how anybody can look people in the eye and say that's not possible.
What percentage of customer service gets displaced?
It can be a large percentage of customer service. I think that function, I forgot my password, what's my billing amount? Those are all simple and easy things for an agent to go do. Like what we're seeing in our customer service right now is the rote stuff can be done by agents. More complex is a combination of an agent and a human working hand in hand to be able to satisfy that customer much better than either of them could do alone. And so I think you'll see all of those things happen, but I'm going to lean heavy, as I think all of my colleagues will, all the Fortune 100 will lean heavy on AI. You cannot be a part of this age without understanding the technological revolution. We have a responsibility to put serious money, resource, and effort into training not just our employees, not just people that are impacted, but the communities we serve as well, because that's the age we live in.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
"15 minutes ago until the opening trade here in Europe. Broadly, we look positive. We are being bombarded, though, by news this morning, particularly on the tech front. We'll come back to some of it a little bit later. One story that is kind of adjacent and related is what, of course, is happening with situational awareness, the fund that has captured so much attention over the last 24 hours. Ken Griffin's Citadel, the giant, has swooped in to buy the bulk of the AI stocks held by situational awareness. So this, remember, was a fund, a hedge fund, opened not that long ago by a former OpenAI researcher. I've seen various descriptions of it this morning, one of which is the Nostradamus of AI, which always ends well. Leopold Aschenbrenner started the hedge fund 2 years ago, despite having no investment experience. Now its assets have plunged in the course of a month, obviously because of the massive AI sell-off that we have seen. It may end up still as a going concern. We don't know what's the ultimate kind of endpoint for this fund, if there is one. Anthony Stevens joins us now to talk us about what this means. Anthony, I don't want to get into the details of the fund and what has happened here and what's happened with Ken Griffin. What is the takeaway? What is the big picture takeaway that I should look at from this story? Huge volatility, lots of leverage. Is it just inevitable that we are going to see funds like this getting into trouble?
It teaches you that even a bona fide AI investment genius cannot mix leverage and volatility to this extent. That is the lesson. This man created a hedge fund worth 10 to 20 yards from a 225 million start. He's under 30 years of age. He's written a seminal paper on AI. He has the intellectual chops as ranking with anybody else on this trade. Unfortunately, at the very top, he had a lot of leverage. He had a lot of complicated positions, a lot of options positions. And into the pace of technology change, he got hurt very badly and margins were called. That is the takeaway here. The pace of change in the AI trade, the volatility you're seeing on both the pure flow side and the technology side, and this rotation between hyperscalers and semiconductors is catching even the best off guard. And now we're seeing volatility to the upside. You're seeing Korea have a record pop here, up 18% on the close. So this kind of volatility, as we've been speaking on multiple hits, determines the size of your positioning. You cannot have huge positions into this kind of volatility. So until things calm down, we are more in a tactical trading market with regards to the AI trade, as opposed to the absolutely structural bullishness we were having before. That is something investors will need to adjust to, given the popularity and prevalence of the AI trade in everyone's portfolio globally.
Anthony, thank you very much. Bloomberg's Anthony Stevens bringing us this story around an AI-related blow-up. We will certainly be on the lookout for more. Turning to tech more broadly now, and quarterly results from Amazon and Apple have capped off a big week of earnings. Apple tumbled more than 6% in extended trading as supply shortages hurt its sales forecast. Meanwhile, Amazon jumped in late trading after reporting a fifth straight quarter of cloud revenue growth. So there's the contrast between the two, and you can see the contrasting moves after hours between the two on your screens now. Let's bring in Bloomberg's Neil Campling, who tracks technology stocks often for us here on the opening trade. And Neil, what were the key takeaways for you then from these results? We'll come to Microsoft perhaps in a moment, but a real contrast. If you're in cloud, you were rewarded, it seems, this earnings season.
It was, if we look at the replayer, I suppose, really, with Amazon compared to Microsoft the day before, because the cloud business, clearly the most important metric for growth, came in above expectations. AWS grew 37%, the fastest growth year-on-year growth quarter since 2021. So that kind of validates, if you like, some of the massive CapEx spending which is going on, and they raised that CapEx guide last night. And that, if you like, has overshadowed any concerns around free cash flow, which was negative in the quarter, over $8 billion of negative free cash flow. And is also the price action probably reflects, if you like, where we are year to date, because Amazon was only up 2% year to date, whereas Apple was up 22% year to date going into the print last night, with no concerns over that AI CapEx spend. Investors have been hiding out in that particular stock. But again, similar to the supply chain companies like Qualcomm and ARM talking about smartphone volumes being lower, Apple, who have the best purchasing power of any company really on the planet for the components and the memory, did talk again last night about memory pricing being higher, and that they're going to go higher still, and the supplies were tough to get. They're going to have to start depleting some of their inventories they have.
Kioxia, out of Japan, the chip company, just out with some numbers. NAND unit prices rose by 70% in the first quarter versus the previous. 70%, extraordinary numbers. Volatility is everywhere, Neil. What did you make of the Microsoft move yesterday? We're getting vol on kind of both sides. Today, you see it in Korea, obviously massive upside vol. Microsoft was an example of that yesterday. What do you make of this kind of volatility?
A lot of it probably comes back to, as you've been mentioning already on the program, about positioning around single stock volatility and dispersion, which you're not necessarily seeing in the headline index moves, but you're seeing it at the stock level. You're seeing in thematics as well. There's a high beta momentum index in the US that had a 14% move yesterday. So it's positioning. You're talking about this hedge fund, that, in terms of those positions have probably been unwound already. So pockets there that have been covered. So I suspect that the volatility is going to continue at the stock level whilst people are looking into different areas of the market. One really good thing is that valuations in the US have, the US stock premium has come down significantly versus Europe. And that's despite the fact that 85% of companies are beating estimates this quarter. So the fundamentals are still strong in that respect. The only concern on the AI trade, I think, primarily is just how big that CapEx is going when you have, as you say, things like memory pricing being so significant in terms of a cost.
Yeah, it's just the inflationary impact of that is extraordinary. Neil, thanks for the update. Neil Campling joining us on some of the aspects of this tech trade. There are so many. We're being bombarded. Mark Cudmore's here from the MLive team. He's the boss over there. What does he and the team make of all this volatility? Let's find out. What do you think, Mark? The Kospi's up 18%. What's going on?
It's insane, isn't it? On Wednesday, it was down 21.3% for the week. Then it had a 26% rally between Wednesday's lows and Friday's highs. This is one of the world's largest stock markets. Through the GFC, we saw some wild moves. In the dot-com era, we saw some wild moves. This is pretty insane for one of the world's largest stock markets. So a couple of takeaways. I think, first of all, Korea stock market, I think this is the long-term bottom. Look, this is high beta to the AI capex bubble. We've discussed for a while that we're in the volatile end game of the AI capex bubble, with the base case that we're not we're not at the end yet. We think it's when the capex turns. And the earnings this week said capex is still going to increase. So you've now got to go out probably to the next earnings season, and it might be the one after that. But it's always the next earnings season you look to. So the AI capex bubble inflates. We'll see global stocks reach a fresh record high. But the volatility that we've seen in July is going to become a feature, not a bug, for the coming months. I think we're in that kind of multi-month end game of the AI capex inflation, but it's in the end game when we get the most crazy moves. But for Korea itself, I think a bottom is in. This stock market is now good value again. We've seen a capitulation from local retail. We've seen the situational awareness capitulation. So therefore, it's much fresher positioning wise, and it fundamentally is a good story.
OK, yeah, we seem to be on some massive price discovery adventure when it comes to everything to do with AI, Mark, right now, and that's a volatile place to be. Let me ask you about the BOJ. Just a couple of lines that I thought sounded maybe hawkish from Ueda, saying we need to be more aware of upside price risks than before, and saying we'll have firm discussions from next meeting on. Is the market's thinking around the cadence of hikes going to change, do you think, from anything you've heard so far from the BOJ?
No, I think the BOJ is actually a side story of this week, not just because of all the other news, but also because we had the intervention. And I think, as a couple of people outlined, it's likely that we'll probably have another couple of follow-through episodes in intervention. If we don't, the yen's in trouble. So there's a chance they can really follow through. I think the changes in the BOJ are very marginal here, incremental. But I think that there could be more intervention in the days ahead, and that is still low down in the stories of markets this week.
Mark, somebody just written to me about this, actually. Is the BOJ's problem, are all these central banks' problems actually the Fed right now and the market questioning the Fed? And that's the real issue that they're all having to deal with. And that obviously has implications for the dollar, the yen, etc.
I think that's absolutely right. But it's weird because ultimately the Fed was very disappointing this week. It took a big blow to credibility. That should be bad for the dollar. But I'm not sure we're quite ready to start the big dollar downtrade yet. And I'm somebody who's structurally bearish the dollar. I think still has US more upside on rates, and that will support the dollar a bit more in the short term.
OK, Mark, thank you very much. Bloomberg Markets Live Executive Editor Mark Caldmore. Remember, you can get up-to-date analysis from Mark and all of the Markets Live team. MLIV Go is the function to use on your Bloomberg terminal. Yeah, we certainly see that lingering effect of Walsh and what we did and didn't hear from him in the markets, don't we? It was yesterday's story in fixed income, if not in FX. And I've read lots of copy talking about, did we really understand what he was saying? Is the market really able to speak Walsh just yet?
But the problem is, though, that if they're not, then we've got a problem.
Yeah.
And that miscommunication is maybe something of a factor that I think the market is still grappling with. And it's a big issue. OK, 5 minutes to go. The opening trade is almost upon us. Futures are higher here in Europe. There's lots of single stocks. We'll talk about them in a moment. This is Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Tyler Kendall in Geneva, Switzerland, and this is Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
Good morning,
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia trade.
This is Wall Street Week.
Welcome to Balance of Power.
You're watching Bloomberg Deals. Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
The global economic playbook is being rewritten and the levers of power are moving in real time.
To see where the world is headed, you have to look where the action is.
I'm Haslinda Amin in Singapore.
I'm Menika Doshi in Mumbai.
Welcome to Emerging the New Economy podcast.
Each month, we dive deep into how the world's most exciting rising economies are shaping the global future.
Join the conversation. Subscribe to Emerging on your favorite podcast platform today.
You up to the minute geopolitical news whenever and wherever it happens. I'm Jennifer Zabasaja in the Lesotho Highlands, and this is Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Couple of minutes to go until the opening trade. I'll show you futures in a moment for Europe, but let me give you a sneak preview. They're higher, and one of the reasons they're higher is because of this chart here. Europe went out here in terms of the close yesterday. The US finished over there. You just got to price that in terms of what we're going to be seeing in terms of the equity market open here in Europe, and it gives us a nice kind of some wind in the sails, let's put it that way, in terms of which direction we're heading in, and that is definitely higher this morning. There's a bunch of stock stories as well that are going to be quite positive as well, and are going to lend some helping hands to that narrative. But nevertheless, European stocks futures, the 50's up by 0.6%. The FTSE's a little bit of a laggard this morning. We're only up by 0.2%. DAX is up by 0.5%. Some of the other markets are up actually quite significantly this morning. So there are some single stock kind of impact variations that you're going to see in terms of the narrative this morning, but broadly, nice tailwind coming out of the Asian session, nice tailwind coming out of the US session. All of that helping Europe this morning, Anna.
Yes, indeed. So we look ahead to a positive start for European trade, and let's think about some of the individual stocks and sectors that could be in focus. We'll start first with the banking sector. We've got NatWest numbers out delivering a lift to guidance, signalling buybacks after a beat on the earnings front, so all good there. It seems at the top line. Credit Agricole, profits boosted by Amundi and the French retail bank. So that's the story in the banking sector here in Europe today. On the technology front, we look at anything that's connected to Apple. We sometimes see some of those suppliers to Apple move on the day after those Apple numbers. And the Apple numbers didn't go down all that well, but for reasons to do with supply chain. So we'll see if that has an impact. And Leonardo in the defense space, orders strong, the full year outlook raised. So maybe that's one to watch this morning.
I spoke to the CEO a couple of days ago at Farnborough. Very positive momentum he certainly sees with that business going forward. OK, let's talk about this market open this morning. As we've already indicated, we are expecting a positive performance. The FTSE is likely to be a laggard. We're certainly seeing that early doors. Stock 600 is expected to be up around 0.6%. I don't have a number for you yet. We're broadly expecting Europe to go higher at a kind of top-down macro level. We've also got some single stocks that are going to add into that narrative as well. So the stock 600 is up by 0.2%. The FTSE is not quite delivering the 0.2 move we expected and we saw in futures. We're getting basically a flat open. The stock 600 is up, though, by 0.2%. The IBEX is up. The IBEX is only just up. The CAC's only just up. So where are we going to see this? Actually, I think we were expecting a little bit more outperformance initially. So there's a few key stocks that feel like they're not open yet. So it's going to be interesting to see what they are and what the drivers are first thing this morning. The DAX is yet to go. The AEX is yet to go. We were expecting maybe 0.5%. We're not getting that yet out of Europe, Anna.
Yes, indeed. We do seem to have more sectors in negative territory than in positive, which the futures picture is sort of inconsistent with. So let's dive into a bit of the detail as to why that is the case. We do have to the upside basic resources, so that sector going up by 1.3%. Antofagasta, Fresnillo, Anglo-American, the usual cast of characters moving that sector higher. I know that iron ore prices have been very much in focus of late, but we'll leave the upside there and look at the downside, because maybe we've got a bit more downside downside than we'd anticipated. I can see that IAG, which you have had numbers out, it's been such a busy morning, I haven't had time to mention much, but that company, that stock is down by 4.5% on the back of its numbers. We have Accor in the hotel space and others in the hotel space, and airlines and catering companies and gaming companies all a little bit weaker. Personal consumer discretionary, grocery stores also an area of weakness. Not a standout performer to the downside, but Unilever and Tesco's are both in the mix there. So, yes, it's just not a day that's not as positive as maybe expected, although we are seeing a bit more upside in basic resources now.
Yeah.
But we kind of split 50-50 then in terms of the sector moves.
Points. So it's Unilever. So we're getting a little bit of a mover. So what you get, there's quite a positive tech performance in Europe this morning. So ASML is up quite nicely, 2.35. Schneider's up quite nicely. Asia Brand Baveri is up quite nicely as well. All of these are kind of adjacent AI stories, AI data center stories. You've got Unilever and Nestle as the two biggest drags on the market. Are we getting basically a rotation within the space? You're getting money coming out of the staples, the safer end of the market, and we're rotating back into maybe some of the sort of AI adjacent trades. ASML, Siemens Energy, Infineon is up quite nicely this morning. Schneider's up, ABB's up this morning. So that's the kind of trade. It's back into tech. It's out of safety.
Yeah, indeed. And we've got something like Soitec in the technology space up by 8%. So there are some pretty standout movers in the tech space. And, of course, it's been such a volatile landscape recently. Let's widen our focus and talk to Eleanor Taylor-Jolly-Dunn, who's co-head of Global and Swiss Equity over at Union Bancaire Privé and joins us now. Eleanor, good morning to you. Nice to have you with us. So oil prices have been creating a lot of volatility recently. The tech trade has been creating a lot of volatility. And July has been marked by a lot of that equity market volatility, certainly. Are you assuming that that carries on for the rest of the year, over the next few months, or, you know, we're at the last day of July, is it behind us?
I think what we've seen over the reporting season so far has been very strong earnings results, which probably the market was not entirely expecting when you see to what extent companies have been able to beat expectations. So for a fundamental investor like myself, it's particularly encouraging to see that when you base your decisions on earnings as opposed to optimism, that is being paid off at the moment. Having said that, yes, there was a lot of hope going into July, a lot of growing questions against that hope as regards the monetization, the success story of AI going through. And there was what I think one can expect when there is a completely transformative technology, a very, very high expenditure behind that technology, a pause for thought in markets, which happened. And there may be perhaps a more critical, a more informed look going forward, which is again more based on earnings than has perhaps been the case in the more recent months, quarters.
And so where does that take us on that AI trade into the rest of the year, Eleanor? To what extent do you want to get exposure, continue to have exposure, or to avoid? And if you want to avoid, where do you look to be instead?
Well, certainly if you are a portfolio manager, what you're looking for more than anything else is balance in some way. So having exposure to names which have a decent value creative opportunity, be that expressed in earnings or what we prefer to consider the cash flow return on investment growth or stability of those companies. Now, we want to find pockets of that growth in different themes. There is a very dominant theme at the moment and a concentration of the market, which has been much discussed over this year, which is around AI. But I would argue that there are other opportunities in the market, other trades to play alongside an AI trade. And one also has to be thoughtful about who really benefits at what time and how from these different themes. So we have within our portfolios at the moment exposure, obviously, to AI thematics, but we also look for companies which can play into the infrastructure spend that we're still expecting coming out of Europe. We have companies which have exposure to what unfortunately is truth, which is that demographics, certainly in the Western world, are probably moving more to an older generation rather than a younger generation. And that means that there are going to be health costs associated with that, and a willingness of us all to try and combat that in an effective way with an interest in healthcare and improving healthcare metrics.
But I don't know, how do I invest in this? Day to day, we are seeing such volatility. Do I just have to take less risk in a portfolio given that volatility? Is that just the nature of the market we find ourselves in? Can you take the kind of positions that you once wanted to? The danger of getting stopped out of them at the moment looks pretty extreme. How do you invest in a world where this kind of volatility is there every single day?
I see that the markets change in their behavior every single day, and the sources of volatility can be very different. What is different about the markets at the moment compared to perhaps other periods of volatility that we have known is the very high concentration in a few names when it is the United States, indeed a concentration that we've seen also on the US, and a willingness also to pay perhaps slightly higher valuations than one would necessarily in usual circumstances feel comfortable with in order to gain exposure to that particular thematic, which is technology, artificial intelligence. But then as a portfolio manager, we always have to be aware that things can change, and things do change very rapidly, as we saw during the month of July. Fortunately, you could say it's so far, at least it's only been a month of change. But I don't have a crystal ball exactly for the future, and what has happened over the July does give me also an indication or a reminder of what is likely to happen or could happen in the future. So maintaining exposure to themes which have genuine underlying earnings potential makes sense, but at the same time being sure that we're always balanced, that should something suddenly come out of favor, we have other areas of growth which are present in the portfolio. It isn't perfect every day, obviously, but hopefully that gives us some protection on reversal trades like we saw during the month of July.
But do you worry that investors ultimately, and at the moment it feels like we're repositioning around some of this stuff, but I was talking to the CEO of UBS about this earlier this week. His view is that ultimately investors, kind of the people that put money into wealth funds, don't like this kind of volatility. So ultimately, is it, while it's a short-term kind of, we're seeing a lot of movement, ultimately people will get much more cautious if we see this persist?
We've certainly seen people become more cautious in the past around volatile equity markets. But when you look at the valuation which people are prepared to pay for equities at the moment, when you see the performance of equity markets globally, and notably perhaps again in the United States, which is the most exposed market to technology, you could argue, then you do seem to see that a number of people continue to wish to be exposed to this market. Indeed, we've seen a pretty attractive picture in terms of flows onto equity markets. But yes, there is a flexibility around those flows. And there have also been interesting periods where we've seen quite interesting flows back into Europe, which was something which was missing perhaps over some of the more recent years, as people felt that Europe wasn't able to re-find a dynamic in terms of growth. But when you see some of the numbers and also the macro numbers which were published yesterday, you can see that there are shoots of growth in Europe. There are areas of opportunity in Europe, and also, for example, in Switzerland, which is a market that we continue to consider as very value creative and interesting. And as such, you see that there is interest for investment in equity. Whether that interest and whether the levels of equity markets are reflecting perfectly what is happening in the general economy and reflecting perfectly some of the considerations and concerns that people have around the cost of living is another debate. But clearly there is a willingness to be involved in equity markets if we look at the level of equity markets today.
And Eleanor, do you, I know equity markets is your focus, so within equities, are you interested in commodity-related equities at this point, given we have an oil price that sort of refuses to go down? I mean, it went down, but then bounced up again, because, of course, we see a persistence to the activity in the Middle East.
Well, one of the main areas of my focus is Swiss equity, and the Swiss equity market does not have a terribly high exposure, in fact, has no exposure really to commodities. So that answers part of your question. As regards our global equities, we do look certainly at companies which would be serving the commodity area. We're also aware of the importance that a lot of our investors still attach towards ESG considerations that may hold us away from some more direct exposure to commodities, but where we see an end market which has a growth potential, which is as a result of higher commodity prices, we do gain exposure to that both through our Swiss equity and through our global equity.
Eleanor, thank you very much indeed. Always appreciate the time. Thank you for joining us on a Friday. Eleanor Taylor, you're leading the co-head of Global and Swiss Equities at UBP. Let's take a quick look at the Call 6. This is what we are seeing this morning in terms of the big moves that we are watching. There's quite a comparison. Basically, tech is up. Look at ASML, up by over 3%. Nestle is down, so let's take that as being emblematic of the more staples trade, and that is under pressure. So we're rotating back towards tech, I think, is the narrative that we are watching. Banks also firmly in focus, as they have been all week. Let's start there with Alex.
Yeah, guys, look to Credit Agricole this morning. Of course, got that beat on earnings, boosted by Amundi. And looking at this, out of the gate, up around 5% in the green this morning, climbing up. Let's turn, though, to tech. And this really is an interesting one. It's been a bit of a week of whiplash, I think it's fair to say, when we're looking at tech stocks. But European tech stocks opening up. You can see particularly those in the semiconductor space. And this is interesting because there was that question whether Apple's disappointing sales forecast were going to cast a shadow over Europe. But in between, of course, we had the rebound of the Kospi and the tech trade in Asia. We'll be seeing European tech stocks, particularly those in the semiconductor space, opening very much in the green, climbing this morning. Let's turn then to Siemens Healthineers, and this was a mixed picture in their earnings this morning. They are in the red, down around 5%. On the one hand, you had this windfall brought by tariff refunds, which did lift their earnings. On the other hand, there was a drag in the diagnostic space, and that was contrasting with other areas which are looking promising, like imaging and cancer treatments. But you can see this morning that mixed picture. That is pulling Siemens down, Siemens Healthineers down into the red around 5%. Let's just turn the board over finally. We can look to, we've got Siemens Healthineers there. Sorry, Dan, flipping that over. Yes, to Taylor Wimpey. Here we go. Now, there was a cut to the dividend here, and this is dragging them down around 5%. The broader picture this is pointing to is to a slump that Taylor Wimpey is still confronting, but that is taking them down around 5% now. So that's some in the green. European tech very much in the green. Credit Agricole in the green as well after that beat on their earnings. Taylor Wimpey, Siemens Healthineers, some of those in the red this morning.
Alex, thank you. Alex Morgan with an update, a rundown of some of those stocks on the move. Coming up, profit beats from both NatWest and Credit Agricole. We'll dive into the results from the European banking sector next. This
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's
a really compelling story.
This is where your trading day begins.
And this is open interest.
Only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything. When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo. And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech.
Every weekday, only on Bloomberg Television.
Bringing you up-to-the-minute space news whenever and wherever it happens. I'm Ed Ludlow at NASA's Kennedy Space Center in Florida, and this is Bloomberg.
We had a very strong set of results overall, thanks to very dynamic activity everywhere. I just talked about equity and trading, but we had record inflows in insurance, record levels of assets under management in Amundi. But we're also very profitable because our cost-to-income ratio decreased and is now below the target that we had set in our medium-term plan.
What gives us the confidence to strengthen the guidance really is the strong performance of our three businesses, retail banking, private banking, and our corporate bank are performing and growing really well. They're also becoming more efficient, so that's a virtuous cycle.
That was the NatWest CEO and Credit Agricole CFO speaking to us earlier after their earnings reports. So NatWest raised its guidance for the year and says it will consider buybacks sooner than planned after beating second quarter earnings estimates. Credit Agricole, for its part, also reported better than expected numbers. Income rose at its French retail business and it saw record profit in its asset management arm. Let's put together what we've learned then from the banking sector this week. Philip Richards joins us from Bloomberg Intelligence, who leads the global capital market banking team. Philip, good morning to you. Let's start with NatWest then. How did NatWest stack up against the competition? Telling a pretty positive story this morning.
Yeah, good morning. Yeah, as you say, I mean, there's been a very strong 2Q round for the European banks overall. Two-thirds of banks almost beating on revenue, every bank almost beating on cost of risk, EPS line, almost every bank outperforming. And not really any bank suffering on that front. And we've seen exactly the same today. Credit Agricole, NatWest, up in guidance, beating quite strongly, 10%, 11% PBT beats for both.
We just talk about trading and why there is this big gap between what Wall Street has produced, particularly on the equity front, and what Europe has produced this week. And it's been notable, like Barclays, into UBS, into a whole range of other banks. We have seen good performances, but not relative to the United States. Is that because all the great deals are in the United States, or is it simply just we are not going to give these businesses the same level of capital, they can't take the same amount of risk, and therefore they don't deliver the performances?
Yeah, I think you hit the nail on the head there, exactly. We're all talking about the beats versus consensus, but the fact is consensus is far too low for these European banks. And as you say, the Europeans are doing a far lower growth rates than the US banks are. And you say all the activity, the M&A deals, all the technology investments, IPOs are all coming through in the US. So unsurprisingly, the US are winning on their home turf.
Philip, we've been asking a lot of CEOs in lots of different sectors, to be fair, but including the banks, about return on investment from AI. And both NatWest and Lloyds talked to us this week about their wealth management tools, basically, ultimately that are going to be fueled by a lot of AI. Is this going to be a huge step change in the retail banking landscape, do we think, in terms of the products available, the access that people have to wealth management products?
Oh, it definitely is across the board in terms of the whole AI rollout. But it's also a case of not everyone's going to benefit on a relative basis. So it's about controlling how much you spend, and that's the concern sometimes. Maybe the banks are spending too much and maybe not actually getting the full return on that. So there's a combination of the two. Yes, you've got to spend to grow, but actually, are you getting the returns on that?
Yeah, tokens aren't free. No. Price is dropping. Not free.
Still not free. Still not free. Token maxing is definitely out. Philip, thank you very much indeed. Philip Richards joining us from Bloomberg Intelligence. Let's get into another story that we're watching. Actually, probably haven't paid attention enough to this morning, but we are definitely paying attention to now. IAG is down 2.5%. Remember, this is the parent company of British Airways, Iberia, Aer Lingus, etc. Let's find out why we are down. The stock was down more than this earlier on. We've rebounded a little bit, but why we are seeing this drop. Benny Campbell joins us now, Bloomberg's managing editor for space and aviation. Benny, good morning. Is this just a fuel issue that IAG is facing?
Yeah, so fuel is the big sort of story here, has been really across the industry for a number of months now, and it's hitting hard at IAG, as it is indeed with all the other airlines. Why is the stock down? It's down because the company is more pessimistic about its growth prospects. In February, when they reported for the first quarter, they said that capacity, which is sort of a key metric for the industry, would rise about 3% this year, and then this morning, the new word that was used was flat, so no growth. So essentially, the company has abandoned its growth prospects for the year, and they're doing that because they are less optimistic about adding routes, growing the business, and really it's about retrenching, and that sort of sends a signal that this is a generally slightly more pessimistic outlook into the latter part of the year, and that is why the stock is down.
Yeah, Benny, you might have thought in terms of the competitive landscape, that the fact that there might be reticence still to travel through Dubai, travel through Abu Dhabi, might mean that there's something to play for some of the other for the European carriers in terms of taking people to Asia. But I guess you can't turn that kind of growth plan around very, very quickly, can you? What's been the competitive landscape? What does that look like at this point?
Well, it's been very, very dynamic. You're absolutely right that there was a window of opportunity for the established airlines, say BA, Lufthansa, Air France, to push more into these routes that over the years they had really lost to the Middle East carriers. That's parts of Asia, parts of Africa, parts of India, and so on. But that pendulum has started swinging back as the likes of Emirates, Qatar, Etihad sort of regain their strength. Now, obviously, in the last couple of weeks, the conflict has flared up again, so it's really unclear how that dynamic will play out. But this was a bit of a flash in the pan, to be honest, in terms of those gains that they had. They haven't really stuck, it seems. So that's on the long-haul side. On the short-haul side, the likes of Ryanair and EasyJet are still making life difficult for a lot of the carriers over here. They are gobbling up more capacity. A lot of people are flying shorter routes, thinking about those long-haul trips. So it remains a fiercely competitive landscape. We're going to hear more from the company at the bottom of the hour. That's when the analysts get their time with management, and they'll ask about what's going on the crucial transatlantic route in particular.
It's been interesting. Up until this point, it's felt like the long-haul carriers have had an advantage. There's been some premium in the market. People have been prepared to pay for premium seats, and that has insulated them. Can we now say, basically, that period has come to an end, Benny?
Well, it depends a little bit where you look. In the US, that still seems to be a strong theme. So if you talk to United, Delta, even American, who've struggled a little bit on the premium side, they all tell you that the premium is where the growth is, the front of the cabin. That's where people are still spending. Over here, it's a little bit more diverse. As I said, the low-cost segment remains very strong. The customer is opting for shorter routes. So that sort of creates a slightly more difficult picture for the carriers over here in terms of long haul, and they had that brief moment in the sun pushing more capacity into Asia, but that seems to have disappeared again now.
Thanks very much, Benny. Thanks for bringing us the story. Benny Camel there on IAG. Let's check in on what's happening with Universal Music Group. They reported the stock is down really substantially today after they reported numbers late yesterday. Universal Music Group then reporting subscription revenue that actually beat analyst estimates because of price increases from streaming platforms and a busy music release schedule. But the EBIT numbers seem to miss estimates, and so that seems to be something weighing on the business.
Adidas had a pretty tough... Was it yesterday or the day before? I've lost track this week. It seems to have been one of those weeks. That takes us into Puma, which this morning is down by, let's call it 5%, on the back of the numbers that we've seen from the company this morning. What you're basically getting here, I think, is probably, as one of the analysts puts it, a clean-up operation. This is a business that is kind of going through a little bit of a reset right now, and it'll be interesting to look forward to see what it delivers going further down the road. But the market this morning is reacting fairly negatively after what has been a very tough week for the footwear industry.
It has been. Let us talk about the macro a little bit. Coming up on the programme, the Bank of England keeps rates on hold. We will discuss the decision with Santander UK's chief economist, Victoria Clark. There's a lot of change from number 10 in terms of the economic landscape. Well, that change is intended at
Hello there. Just wanted to say, Primer is back. We've been scouring the frontiers of science and technology to help explain the difference between the next gold rush and whatever this thing is. And in season 2, we're upping the stakes. More danger.
Now that is some high-grade uranium mineralization.
We used to have a stable climate on this Earth. Right now, we do not.
More science.
We're pushing the envelope of technology in multiple directions. Software, hardware, chemistry, physics.
The cable is, very cold.
And more CEOs that can nail the photo shoot.
Hundreds and hundreds of billions of dollars are at stake.
While the problems are economic, the solutions are too.
And yes, we will be talking about AI.
There is a lot of humanoid hype out there.
But our future doesn't run on hype. It runs on innovation. Watch season 2 on all these lovely channels.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
The global economic playbook is being rewritten and the levers of power are moving in real time.
To see where the world is headed, you have to look where the action is.
I'm Haslinda Amin in Singapore.
I'm Menika Doshi in Mumbai.
Welcome to Emerging the New Economy podcast.
Each month, we dive deep into how the world's most exciting rising economies are shaping the global future.
Join the conversation. Subscribe to Emerging on your favorite podcast platform today.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
This is the opening trade, 30 minutes into today's session, and it's turning out to be a pretty positive session, actually, for Europe. Took a little bit of time to get going, but we are participating in, for what it's worth, the rebound in technology stocks that we're seeing in the Asia session, because technology is the best performing sector here in Europe today. That is playing out well for the DAX, as you can see, and to some degree the CAC 40 as well. The FTSE 100 not left behind. Basic resources not doing too badly, and that plays well for the FTSE. So we do see a bit of positivity then coming through from the Asia session ahead of what could be another positive day over in the US, Guy. A bit of a rebound here for tech stocks, but it's quite a divided story across Europe. We've got some real standout individual stocks moving quite a lot in either direction.
And we have a fresh record high on the Stock 600 this morning, which is also probably worth mentioning as well. In terms of the internals, it's kind of 2-to-1 basically in terms of the upside versus the downside. What is the standout story this morning, though, is the volume. You are getting, you got a kind of end of the month factor and all that kind of stuff to throw into the market as well, but you have got quite a big chunky move, big rotation being signalled by what we're getting in terms of the volume numbers. Let's talk about Polish convenience stores to start with. Why not? Zabka is being bought by Couche-Tard. That stock is up very nicely. NatWest on the back of the numbers that we talked to the CEO a little bit earlier on, up very nicely on the back of the numbers. You want to talk about the tech trade? I give you ASML. It's up by 3.22%. When you get ASML moving that kind of distance, you are going to get some fairly decent upside on this market. So that's basically the narrative that we're getting. Decent earnings, a bit of M&A, and a tech trade that is working. There are some negative stocks this morning, believe you me. Universal Music, that miss that it's delivered is being punished, and really punished. 22% to the downside. Hensoldt is out with a miss this morning. It is being punished. It's down by 3%. Taylor Wimpey has basically kind of said that the market's really flat in terms of the housing story here in the UK. We're not going to be able to do for you as much as we thought we were going to be able to do for you investors, and that's the reaction. Taylor Wimpey down by 5% on the back of that story. So a mixed market, Anna, but certainly a market that is being driven by tech and earnings this morning.
Yes.
The upside.
Yes, absolutely. Let's get an update on some of the stories that are driving the tech narrative this morning. Amazon shares jumped in late trade after reporting a fifth straight quarter of cloud revenue growth. The company also boosted its full-year capex forecast. The CEO, Andy Jassy, saying most of that spending will go towards AI. Meanwhile, Apple forecasts lower than expected revenue growth in the coming quarter, with the iPhone maker's outlook hit by supply shortages, which CEO Tim Cook warned will affect more of the company's products in the months ahead. President Donald Trump says the US-led Board of Peace has reached an agreement for Hamas to disarm. US and Board of Peace officials said details of the deal would have to be refined over the next couple of weeks, with progress expected in the coming month or two. The Bank of Japan kept its policy settings unchanged while signalling less caution about economic growth, pointing to confidence that the economy remains on track for further policy normalisation after it lifted its benchmark rate last month to the highest since 1995. And the decision came after Bloomberg learned that authorities intervened in the currency market overnight to support the yen. Guy.
Let's talk about what's been happening with the Bank of England. Yesterday we had a very nice special. We listened to the press conference. I actually thought it was quite interesting. So let's come back to it and talk a little bit more about what we've seen. The governor downplaying a future rate hike, this after the bank held rates steady. There were 3 dissents, though, to the upside. The committee said it remained alert to the inflationary impact of the ongoing conflict in the Middle East.
Please do not leave this room thinking that the Bank of England is edging towards a hike, because, frankly, there's nothing in what I said, and I think any of us have said along those lines. We took a decision today to leave bank rate unchanged, and that is the relevant conclusion.
Please don't leave this room thinking we're going to hike rates. I wonder if he actually meant to say that. That was a very strongly worded statement, a very strongly dovishly worded statement that came through from the governor. And I have to say, the front end moved aggressively on it. I can't remember, we were kind of down 2 or 3, 4 basis points kind of for the bulk of the press conference, and then we dropped quite sharply towards the back end of it. Santander's CIB UK chief economist is Victoria Clark and joins us around the table. What did you make of that?
I think he got carried away. I don't think the intention was to be quite as forceful in that message that, that we were edging towards rate hikes, because, of course, that remains a possibility, as their analysis yesterday showed. But I think, he was frustrated that perhaps that person hadn't quite understood that there's full optionality there. And I think that optionality was still the message he wanted to give. So I think, I think it probably gave too much of a dovish steer to the markets. And
so rate hikes are still possible here?
I think they are, yeah. I mean, looking at the Middle East crisis, they've clearly got a scenario which shows that if there's episodic Middle East energy shocks coming through, that you might need to raise hike rates in that scenario. But look, I mean, at the moment, they're not particularly keen to do that, but it's there, and it's certainly something that he shouldn't be discounting.
Yes, it's quite interesting, isn't it? Because another of the journalists made this point listening to the press conference yesterday, that the people at the table yesterday were all people who'd voted to keep rates on hold, but there were these 3 dissenters. Was there anything that you heard from the dissenters that made you think, or indeed from those who held, was there anything that made you think we won't get 6-3 next time, we'll get more dissent, or we'll get more push for a hike next time? I wasn't sure, looking at the detail, whether that kind of messaging was there.
So I think that the dissenters are quite on their own at the moment. The one that would be closest to joining them would probably be Claire Lombardelli, one of the other deputy governors. But she said yesterday that, it wasn't a close call for her. And I think at the moment that the bank are really pretty happy with the way that the data's gone, that there's disinflation, that the signals on inflation expectations look good, that everything that they have to hand at the moment tells them that maybe that risk of second-round inflation isn't that big. But the hawks are saying, well, that may be so now, but, this stuff comes later. Isn't this all a bit complacent?
And what's your assessment on second-round effects, then? Because he also added in that companies they hear from, they're not considering putting up prices anything more than just recouping costs. I mean, what do you think the second-round effects will amount to?
I think that they will be quite contained this time, but I also have a lot of sympathy with the hawks who are saying, look, let's not get carried away. Those are risks there. It depends where inflation peaks out. I have inflation at the top, nearly 4%. The bank has it down at 3.2%, so that's quite a big difference. And the consequences of that for inflation expectations could be quite meaningful. So I think that there's risks there. I am pretty reassured by the data of the last month. I think that the fact we haven't seen a lot of pricing power in anything in recent inflation prints, the signals for the year ahead are good. But I also, I do have that sympathy there with the hawks that there are some risks, and it's too early to judge on those. So, look, to the question at the opening, I think the governor does need to keep all those options in play.
Presumably the labour market is the critical factor there.
Yes.
The labour market looks like it's got quite a lot of slack in it. What power does Labour have right now in terms of its ability to say we want higher wages, or are there other factors here, like government spending, the shifting of government spending, that is likely to maybe drive that inflation?
Yeah, so I think that the labour market is absolutely central, and I don't think this is an employees' labour market at the moment. You're just not seeing that in the surveys of pay setting, pay expectations. So that's the thing that would make you reassured on that, certainly. But look, we don't know precisely where the economy will be 6 months from now. I mean, there's some hints in data that there's a little bit of a bounce coming through. That's worth bearing in mind. I mean, look, my feeling is it's, this isn't going to be a big thing. Second round effects aren't going to be a major thing this time. I don't have an enormous amount in the forecast. But,
you get to 4%. You are way off target, though.
It is, and it is a temporary jump, and it is largely energy and food and those things. But when you get towards that point, those risks come front and centre. So the labour market's important. There's other things that are important too. I mean, obviously we're talking about private sector pay. There's a lot of public sector employees. Public sector pay settlements will be important too, and that will determine cash into household pockets. So I think all these things need watching.
We've seen that as crucial, haven't we, that the public sector pay awards in the past. Let me ask you about things that the government is doing, and we have heard from Andy Burnham a story overnight that we've got saying that he's going to give mayors in England a share of the income tax generated in their regions as part of the new drive for more economic and political power to be pushed out of Whitehall, sort of, devolving some of these powers out to the regions, out to city mayors. Now, we don't know a lot of detail, do we, about any of this right now, but I wonder what difference can that kind of policy make? Do you have any expectation? Has work been done on what difference this can make? Because he clearly is counting on this kind of devolution policy to move the dial.
Well, look, I mean, the details are absent, as you say, and it feels as if this, well, we know this is not for now or even for next year. This is, into the future. So I think, for the immediate, Bank of England horizon, it's, it's not something for them to dwell on too much at this point. I think, politically it's obviously very important. I mean, we know from polling how big the cost of living issue is and, across the UK, the kind of sense of inequity that may be there. So it's, I think it's more probably about the political narrative than necessarily the economics.
OK, so that's about the politics. I mean, Victoria, and not to step too much into the politics, but just thinking about what change we can expect in the economy as a result of the politics. We've heard from Andy Burnham say a few times that he thinks that the model for the UK has been broken over the last 40 years and he wants to change that, but we don't know a huge amount of what he wants to change it to. Are you anticipating that kind of, he has the latitude to make big changes to the UK's economic model, or will they just be tweaks?
I think it's difficult because every chancellor over recent years has had a very tough set of constraints. And, I mean, I come back to this all the time, which is just the difficulty of the fiscal position. That constrains them very much on the kind of tax and spending levers. Obviously, Rachel Reeves had a big go at regulation, deregulation. They've made some progress. There's other things to do there. I think it's very difficult. I think that you're more likely to see things that are perhaps more meaningful for the narrative, but in terms of where that shifts the economic conditions, perhaps that's more incremental.
Nice to see you. Thanks for stopping by to see us.
Thank you.
24 hours for UK policy. Victoria Clark, Chief Economist, joining us from Santander's CIB UK. Coming up, we're going to turn to the geopolitical picture. The US President, Donald Trump, says Hamas will now
Do you mind being called an ideological lunatic or a bunch of left-wing nut jobs?
I've been called worse things than that.
Oh! You'd think she owned the place.
23andMe, I think, is so incredibly valuable. We're coming back.
It had that kind of detective story feel to it. When you're hot on the trail of something, you know that it's very exciting.
What magazines were you reading as a kid?
I don't think I was reading magazines until I was in them.
You are on the cover of all of these.
Oh, and there's many, many more, but we just don't have time.
Why should people trust you?
I don't think anybody should trust any company or entity completely with any of this.
It's very uncomfortable. Artificial intelligence is this force that is far bigger than we are.
I want to build better businesses around these brands.
The shock will never wear off.
So you're a brother and sister running one of the most powerful companies in the world. When you argue, who wins?
No one. The way I could see AI being banned or blocked is if something really went wrong. And if something really went wrong, then maybe it deserves to be.
So is it paradise ahead or Gattaca?
Maybe somewhere in the middle.
Trading day
day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Welcome back to the opening trade, 8:45 here in London this Friday morning. And we have actually a positive picture for the European equity markets, picking up on the positivity on technology. Media stocks underperforming, but that's sort of stock specific to Universal Media Group. Technology outperforming on the back of, well, today's more positive vibes, shall we say, around the tech trade.
Love some positive vibes going into the weekend. Let's talk about what's happening with the geopolitical story. President Trump says his US-led border peace has reached a deal for Hamas to disarm. There are quite a lot of questions, though, about the extent of the agreement and when it will actually take effect. Let's try and find out some of the key questions that we need to be asking. Abu Omar, Bloomberg Horizons, the Middle East Africa anchor, joins us now. So the headline is Hamas is going to give up its arms. How does that actually happen? What do we know about the details of the deal?
Good morning, Guy. Not much is the short answer about this deal. We don't yet have a lot of clarity on what exactly it entails or how Hamas disarms. It's obviously filled with caveats given the history between Hamas and Israel. Now, two things that we know so far is that Hamas did come out through delegates in Al Jazeera and said that it will not disarm as long as Israel is in the Gaza Strip. And so Israel, from Benjamin Netanyahu's government, we haven't heard anything, but it isn't. We're not really clear on whether Israel will agree to pull out of Gaza unless Hamas disarms. And then when it comes to the details of this deal per se, Guy, what we know is that nothing is final, that the discussions can go on for a couple of more weeks, and that the implementation could take up to 350 days. So there's a lot of time for a margin of error to happen there. And then the Board of Peace obviously will include countries in the region. We don't know what shape or what form those countries will take in securing this deal. So in a nutshell, there's a lot of unknowns. President Trump did come out on a post and said that he will require the complete disarmament of Hamas, that this deal will pave the way for a Palestinian Authority to come in Gaza and govern it and give people a better future. And he said that it will be a step towards lasting peace and security. But then when it comes to the response from Israel, we still don't have that yet. We'll obviously follow it and see what the far right part of that government decides to say about it. And then, as I said, Hamas will not agree unless Israel pulls out, and then it can decide whether to disarm or not.
And Abir, it's been a volatile week for oil prices, of course. We're watching, of course, everything to do with, well, the Red Sea now, but also the Strait of Hormuz, where I see reports that things are slowly picking up. I mean, this can be unwound again, but what's the state of play right now?
Yeah, slowly picking up is the right way to describe it, Anna. And again, the Gaza deal is in the midst of this Iran-U.S. tensions that are happening in the region, that are re-escalating. And the heart of all of this, of course, is the Strait of Hormuz, but not just the Strait of Hormuz, because we're also seeing the Red Sea getting affected or at risk of the Yemeni Houthis attacking it. But as you said, the movement in the Strait of Hormuz is slightly picking up. We reported yesterday that a Qatar LNG ship was able to make its way through the Strait of Hormuz. It was idling around for about 3 weeks, but was able to pass through with its lights turned on. So we're seeing slight movement there, obviously a fraction of what it was before the war, and then over the past 2 weeks since the escalations restarted. And then we also reported that Saudi ships, Anna, which have been able to make their way through the Red Sea, Saudi Arabia was resorting to the Red Sea as an ulterior pathway throughout the war, is now going through other pathways in Africa. So you're seeing two waterways at risk now, and we're still monitoring that movement. Again, a little bit more movement, but nothing compared to what it used to be.
Abir, thank you. Bloomberg's Abir Abu Omar. Now, the Spanish government has ordered troops to one of its 2 North African enclaves after a recent surge in illegal immigrants. The migration crisis risks a flare-up in tensions with leaders across Europe, with Italy's Prime Minister, Giorgia Meloni, threatening to impose travel restrictions on Spain. Let's bring in Bloomberg's chief Europe correspondent, Oliver Crook. Some of the pictures are quite dramatic here, Ollie. How did this enclave, well, remind us of the geography first, and how did this enclave become the centre, the latest centre for the border crisis?
So absolutely. So this is Ceuta, which is Ceuta, I should say, which is right off of the southern tip of Gibraltar, basically just across the border there, basically attached to Morocco. And this is actually only one of 2 areas of the European Union, both Spanish, that actually border the African continent. And what we've seen over the last week or so is a real increase in illegal crossings into the area by migrants that you can see there on those photos that are actually really very breathtaking, and that really exploded yesterday with effectively them completely losing control of the border. And this is obviously a major concern for the Spanish. We understand that they're going to deploy the military, the army, some of the civil guard, more in police to try to regain control of the area. And we're going to get a visit there, we also expect, from the Prime Minister, Pedro Sanchez, who will be going down to the region, we understand, a little bit later today. Now, this is significant, obviously, for the Spanish. This is something that they're now having to deal with. The reason that why this is happening now, according to the foreign minister, this all comes down to a court ruling in Spain, which effectively blocked the ability for the Spanish authorities to intercept and send back people immediately. So effectively now, if you do get to Spanish soil from the sea after this court ruling, you sort of suddenly come under all of these sort of protections for human rights and effectively cannot be sent back, which is the reason, at least for now, that the foreign minister has given for the reason that they've seen this massive influx over the couple of days. So for the Spanish, #1 priority is going to be regain control of the border, try to figure out what to do with these people. But of course, it sparked some controversy within the European Union. We should say that this is not, the European continent. There is still a good deal of sea between this enclave of Spain and the rest of the continent. So it's really majorly an issue for the Spanish. But of course, this is turning into a political conversation here in Europe.
The Spanish have taken a very different approach to immigration to the rest of Europe, you could argue. And these pictures have been flashed across Europe. They are everywhere, as far as I can tell. You've seen the Italian reaction. Meloni is clearly not happy. What else are we hearing? Is there going to be a change in the kind of the free movement principle that underpins the European Union as a result of this?
Yeah, so what's really interesting here, Guy, is that obviously you have the socialists from Spain, Pedro Sanchez, and then the right-wing government of Giorgia Meloni that really came into power in a very anti-immigration sort of platform. The Spanish, as you mentioned there, on the other hand, have been very welcoming and trying to increase the numbers of immigrants within Spain. And they've touted that this actually has been a very massive economic success for Spain. And you've seen it in the numbers. They're trying to mostly attract people from Latin America. That being said, the largest proportion within Spain are actually from Morocco. But of course, this turns into the domestic debate internally here within Europe, where you basically have the Italians saying that this is the massive problem, this is sort of the migration crisis that we're talking about, and you have Meloni coming out on Twitter saying that the images coming from Ceuta demonstrate the uncontrollable illegal immigration poses the real threat to the security of European borders. We are prepared to take extraordinary measures to defend our borders, ensure safety for our citizens, including the suspension of the Schengen Agreement with Spain. Now, it's not very clear what she's referring to here, so effectively what European nations can do is they can kind of retake control of their borders really at any time and basically impose border checks. This happens very, very routinely. You have the Germans do it, the French do it. The French have basically the ability to do with every bordering country until October because of the concerns that they have over extremism. That is not something terribly new. What it seems like she is trying to imply is that somehow Schengen would get together and basically put Spain on pause. Not really clear if that's something that she would be able to do or there really is any precedent for. But obviously, this is a moment for Meloni to sort of score some political points. Obviously, this doesn't really pose an imminent threat in terms of immigrants to Italy. It does cause, however, Guy, a really big problem for the Spanish, particularly with this court ruling, to figure out how they're going to deal with these thousands of people in the next weeks and months.
Ollie, thank you very much indeed. Oliver Crook, our chief Europe correspondent, updating us on the immigration story. Let's talk about another challenge that Europe faces right now, and a big one. A group of scientists now warning that the risk of extreme fires is growing. the climate is warming, seems to be the sense, and you are going to, no more normal summers. You're going to see a lot of extreme weather, and that seems to be the narrative that is emerging very, very quickly. The World Weather Attribution Group says climate change is making fires twice as likely in France, and get this, 20 times as likely in Spain. The alert comes after flames consumed obviously hundreds of square miles near Bordeaux and Madrid over the last few days. Joe Wirtz is our climate reporter and joins us now. For context, how extreme is what we're seeing in places like Spain and France right now relative to recent history?
Yeah, this is really a new era of wildfires. We're seeing intense, fast-moving mega fires. In some cases, these are fires that are so intense they're warping the weather around them, creating their own weather systems. These are firestorms, the dangerous, extreme fire behavior where the fire's moving and spreading rapidly. These firestorms create these powerful downdrafts that can spread the flames further and also hamper the response. Right now, we're seeing strong winds in Greece and Crete that both spreads the flames, fans the flames, and hampers the wildfire fighting effort. You can't take up planes or helicopters or do these aerial drops that we've seen. It's really hard to do when the winds are gusting this strong.
And the climate is having another impact on our ability to create energy, and that is around river levels.
Yes.
So the heat has seen water levels drop in the Danube and the Rhine, and that means in some parts of Europe, that creates problems for generating electricity from some sources. Run us through how significant that is.
Sure, yeah, we've seen record low river levels in the Danube and critically low levels in the Rhine. Hungary has had to take emergency measures to shore up its only nuclear plant there. It uses these rivers for cooling, and the river levels drop too low. It threatens that cooling supply. They've had to roll out these special floating pumps to secure the water that they need to keep those plants cool. It's also affected the amount of energy fuel that they can transport on the rivers. When the river levels get low, you can't move as much cargo on those ships. And so we've seen a real bottleneck of shipping through those rivers there.
Joe, thank you very much. Bloomberg climate reporter Joe Wirtz bringing us, ahead of the weekend. There we go, some sobering messages.
You'd be delighted to know the football starts again this weekend.
Excellent, good.
Just because obviously the World Cup wasn't enough.
Yes, we need more football in our lives.
OK, that's what's happening this weekend. What's happening next is the
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Burr.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
A global rally in tech stocks gather momentum as South Korean equities jump by the most on record. Now, Asians' gains follow the biggest rally in Wall Street chip stocks in more than a year. Amazon jumps on strong earnings, but Apple falls on supply shortages. Plus, President Trump says the U.S.-led Board of Peace has reached a deal for Hamas to disarm, but questions remain over the extent of the agreement. So we've made it to Happy Friday, everyone. It's been a long week because we've had a lot of earnings. There's been quite a lot going on. Also on treasuries, I know we're following South Korea very, very closely because of the volatility that we saw there in certain asset classes. Now, we've seen a global rebound in chip makers carrying into Friday. That is giving a little bit of a lift to stocks to end a month that saw a steep G rating in this year's most popular trade on a positive note. I'm, of course, speaking about AI, and then we'll talk about the Fed and Kevin Warsh and maybe concerns over his credibility. And, of course, we look at the Middle East, Brent crude 87.78. So let's also look at the European markets map. If you look at the week that we've had, they've really tracked a lot of the U.S. moves, which is why we're seeing a positive note for the DAX, the CAC, and the FTSE. This is a picture for some of the big corporates we're watching for. So Amazon gaining in pre-market trading after reporting second quarter results that actually beat expectations on key metrics, including revenue at its Amazon Web Services business. Apple sliding after component shortages are weighing on the company's sales forecast, and pre-market Apple down 6.7%. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. This, of course, we're in London, and this is the final day of a big week when we had a lot of earnings. Now, quarterly results from Amazon and Apple have capped off a big week of earnings. Apple tumbled more than 6% in extended trading, and supply shortages hurt its sales forecast. Meanwhile, Amazon jumped in late trading after reporting a fifth straight quarter of cloud revenue growth. For more, let's bring in Bloomberg's Neil Campling. Neil, there's a lot going on, and then in a second we'll also speak to Yari Sten about the overall impact this has on the economy. But Amazon had some pretty strong revenue and CapEx. So how well positioned are they to get through the AI build out and build on that in the future?
I think, Fran, the main thing is that there's comfort for investors in that the investments that they're making are paying off through the growth rates you're seeing in AWS. So AWS grew 37% year on year, the fastest year on year growth rate in 5 years. So it's delivering on that side. Clearly, it comes at a cost in terms of a significant amount of CapEx. But to put it in context on one of the measures, if we look at CapEx to sales as a measure, then they actually are at the lowest end relative to the other hyperscalers. 26% of CapEx to sales is their ratio. And by comparison, Alphabet is at 50%, Meta is at 60%, and Oracle is at 97%. So in that respect, they have the balance sheet, if you like, or the investments to pay off with that growth coming through.
So, Neil, news of supply shortages are really hitting Apple's results as Tim Cook departs. So what does this tell us about how the firm is actually adapting to this AI era?
They've actually built up a lot of memory, which they're now actually having to use their internal inventory. That's going to impact in terms of pricing. It may impact volumes down the line. One of their suppliers, Qualcomm, had similar caution the previous evening. But I suppose for their positioning, they're waiting to see which of the AI models, if you like, win out in the battle. And then I suspect they will then sign a deal to lease, if you like, the capacity and that compute down the line. But in the meantime, clearly, us as consumers, I think, are likely to wear higher pricing of the products when Apple can get those to market. But it was a surprise to hear that the company with the greatest purchasing power of components in the world is struggling for supplies and is unable to get as much memory and components as it needs.
Neil, thank you so much. Neil Camping there with the very latest, of course, on AI. And it has been quite a week. Also, Ken Griffin's Citadel has swooped in to buy the bulk of AI stocks held by Situational Awareness, the hedge fund led by former OpenAI researcher, once described as the Nostradamus of AI. Now, Leopold Aschenbrenner started the hedge fund 2 years ago, despite having no investment experience. Now its assets have plunged over the course of this month after a sharp decline in AI-related stocks. It's a story that's one of our most read on the Bloomberg terminal. Let's get straight to Nishant Kumar, Bloomberg's hedge fund reporter. Nishant, I mean, this is a fascinating story. It's a complicated one, but what actually happened here? How did, a fund go from 45 to 10 billion in a month?
So I would say in days, actually. So at the core of this is really the leverage story, the money that hedge funds borrow from banks to supercharge their returns. Banks were lending this fund like 4 to 5 times its capital. And this fund built a massive position in AI that became even larger with this leverage. Then the tech share started to slide and lenders wanted more collateral. And the fund had to sell into a falling market to meet those calls. And the rest, as we say, is history. One thing I would like to highlight here really is that despite all this thing, and this took just days, for all that, the fund lost about 67%, but it's still up 80% on the year. So that goes on to tell you how massive the rally in AI stocks has been this year.
So is this a one-off? I mean, we're also really interested because, of course, Citadel had to step in. But is this a one-off or is it a warning sign about something uglier brewing?
Well, it's what's separating the two things. One, prime brokers were already differentiating on single sector concentration. Barclays, for example, turned the fund away on exactly that. Two, the fund is still standing and still one of the largest equity hedge funds in the world focused on AI. It still holds more than $5 billion worth of Anthropic stake. So this is really a leverage story more than a verdict on the AI trade, I would say.
So why did Citadel step in? What did Ken Griffin get out of it?
Well, I mean, Citadel ends up with stake in major AI companies at a price that was not on the table, just a week earlier. So that shows how powerful even these large multi-strats have become in the market. There is a very short list of firms that can absorb billions of dollars of stock in days. And calls went out to several of his peers, like Millennium looked at it. So did Gen Street, the powerful prop trading shops, which is also one of the investors in Situational Awareness. Citadel heard about it. They negotiated a deal. It got a discount and bought the portfolio. And it seems the AI trade is back up today.
Nishant, thanks so much. As ever, Nishant Kumar, there, our hedge fund reporter, on this very, very readable story to try and understand what's coming up next. Now, earlier this morning, the Bank of Japan held its policy rate steady after officials took the rare step of wading back into the currency market with apparent help from the U.S. Here in Europe, the BOE kept UK interest rates steady, with the governor, Andrew Bailey, insisting his committee is not getting close to a hike. Well, with us this morning, Yari Sten, Chief European Economist at Goldman Sachs. Yari, as always, thank you so much for joining us.
Morning.
There's just a lot of data to get through with central banks that are going in very different positions. I mean, let's start with Japan and just in general what we're seeing in Asia. Is this, where does this end up?
Yeah, we think it ends up with higher rates in Japan. I think that's pretty clear. We didn't get an awful lot of news, I would say, overnight. Yeah. There was emphasis that there's upside risk to inflation, but I think there's also a little bit of caution not to overdo the speed of the rate hikes, because you want to make sure that demand can recover and you can get back to 2% sustainably. And so we think the BOJ is still on a semi-annual hiking pace. We expect the next one early 27, another one mid-27. Of course, this can shift around depending what happens with energy prices. But we think it's a pretty sort of inline, steady pace type of message.
Yeah, what did you make of the Fed? I mean, this was the big one where you saw Kevin Warsh. I mean, people are now saying, well, maybe he's not as credible as we thought. And I don't know whether there's, this is a correction course or whether it was on purpose, whether it was just like teething problems.
I think the main thing is very little guidance. So no hike, no guidance, no change to the statement. I think that was the broad takeaway, that we are in a different era now of Fed communication where you get much less guidance coming into the meetings. There's sort of bigger surprises on the day, more information revealed through the decisions. That said, we think he did lean dovish on some of the things he did say. That wasn't an awful lot, but the things that he did say, we think leaned a little more dovish. For example, he downplayed some of the inflation pressures from AI. He mentioned a couple of times that the market is actually doing some of the tightening for the Fed. And so, yeah, we read all of this as there not being urgency for them to raise rates. Now, what happens in the end obviously depends on what happens with inflation. And here we have a more dovish view. We think that inflation is being propped up by a number of things that are more likely to drop out in coming months, including still pass-through from the tariffs, some effects from AI, some energy pass-through, and so on. And so we have them on hold through the rest of the year.
So, but is there a danger that actually if they're too slow, then they'll have to hike by 50, which is quite a lot?
I'm not sure I would worry about that so much. I mean, again, it depends what happens with energy prices. We obviously have lots of risks still out there. But when we look at wage growth, for example, when we look at the labor market, when we look at underlying inflation dynamics in the US, it looks more benign than concerning to us. And of course, rates are still restrictive in the US. And as a result of that, we don't think there's an awful lot of urgency.
Yeah, what's your take on the Bank of England? So I was in the press conference, then I had an interview with Governor Bailey, and he was really pushing back. I mean, it was almost like he was at making sure that nothing was being priced in the market.
Yeah, I mean, at first sight, the vote split was more hawkish, so most people had not expected Catherine Mann to descend. But then the rest of it, we think, was more dovish. I mean, they emphasized a few times that the underlying inflation trend has been softer in the UK. I mean, we very much agree with that, but I think the way they emphasized it, it also turned up in the inflation projections, of course, that were lowered. He then, pushed back against the idea that the Bank of England is getting ready to hike. I think he said pretty clearly that the sort of modal view is for rates to be unchanged. And then I also thought in some of the paragraphs, for example, Lombardelli kind of indicated that the decision was not close for her. There had been some questions about her maybe shifting. And then Dave Ramsden talked about, yes, potentially having to hike if there are upward pressures, but he also talked about potentially having to cut. So we thought that the broader communication was on the dovish side and consistent with the idea that they're not hiking. And our forecast continues to be that they're on hold.
But Yari, how difficult or how complicated it is for the Bank of England to also deal with the fiscal? I mean, we're going to have a big budget event, right, at some point in the fall because of the new government. And this is something that, we know from the Bank of England governor that he met with the Chancellor, but of course he wouldn't give us any indication of what they talked about. Yeah. I mean, could that complicate things significantly for them?
It might. I mean, obviously, for now, all they can do is wait. So there's a lot of time left. We don't, a lot of sort of moving pieces in the fiscal story, and they will obviously see what is announced, then kind of run the numbers and then respond to it. The risk ultimately is probably in the direction of more spending and slightly higher deficits. So the way we think about it is that this is something that could support demand more than expected over the next year or two. But I think the hurdle for that to push the bank into hiking, we actually think is pretty high, because if you were to deliver more spending as part of the budget, gilt yields would probably also rise. They wouldn't probably like that. And so you would already get a tightening of financial conditions. And for the bank then to hike on top doesn't seem all that plausible to me. So I could see how it could push back the eventual cuts. So we do actually think that next year the bank is going to resume the cuts. So that could get pushed back. But I think the hikes are really much more related to the energy risks, second round effects on inflation. And so far, we're not seeing any of that.
Yeah, I mean, it was striking for me this week that actually the difference between the German, and bonds and actually gilts was quite watchable. I mean, you kind of saw, are gilts being punished because the UK is not getting a handle on inflation?
I mean, gilts have carried an excess risk premium, term premium for some time, right? So when you just look at, even if you just look at 10-year yields, you see that the UK is carrying a much higher premium. Now, some of that is probably related to remaining inflation uncertainties, also the bank having restrictive rates relative to the ECB, so that's probably some of it. But there are also more worries around the fiscal situation, the pressures that the budget is under. We ultimately think in the near term this will probably remain. Certainly as we sort of run into the budget, we learn more about the burn and fiscal policies. But ultimately that risk premium in the UK relative to other countries like France to us looks too high.
Because of the French elections, or just because of the situation in Europe?
Both. I mean, it's on both sides. I would say on the UK side, the sort of fiscal outlook, is challenging, but I don't think is as bad as the markets are pricing it, because potential growth, we think in the UK, for example, is higher than in Europe. There are also some positives that people don't talk so much about, like AI. The UK, I think, will be able to benefit from that quite a lot.
More than Europe?
Probably, yes. I mean, it's more services-oriented, has a strong innovation R&D base, life sciences. So I think there are a few things that should actually play in the UK's favour relative to a sort of a more traditional manufacturing base like in Germany. But then also on the European side and the French side, there are obviously fiscal risks and concerns there. And so I think, relative to that, we think gilt sort of over the sort of next year or so should look more attractive.
Jari, what do you think the ECB does next? I mean, there's always these rumors that come up also about Christine Lagarde, whether she stays and she doesn't. I don't know whether that actually would be a market event.
I'm not so sure. I think that's a little bit of a distraction for me from the main issue, which is how much does the ECB need to raise rates to contain the inflation pressures. That, I think, is really the focus. I think it looks very likely that they will hike again in September. When we look at the renewed spike in energy prices, when we look at the resilience of growth, and then also the commentary. Again, Lagarde didn't say much last week, but there were a few hints here and there that... So I think September is very likely, unless something changes fundamentally. But beyond that, we're more skeptical that more rate hikes are really needed, because the incoming inflation data to us looks reasonably benign. You're not seeing pressures on the wage side, for example. And I think taking rates restrictive into the adverse energy shock, I think, will not have a huge amount of support on the Governing Council unless something changes. And so our view is the hike in September to 2.5%. They keep a hawkish stance, but then wait and ultimately stop there. And so relative to what's priced, because we're pricing 2 more, that seems like quite a lot to me.
Okay, thank you so much, Jari, as ever, for joining us. Jari Slender, Chief Economist for Europe at Goldman Sachs. Now, coming up, President Trump says Hamas will disarm. More on the details of that next potential deal. This is Bloomberg.
bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Bersecci in El Ola, Saudi Arabia, and this is Bloomberg.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers, and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech.
Every weekday, only on Bloomberg Television.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
President Trump says his U.S.-led Board of Peace has reached a deal for Hamas to disarm, but there are questions about the extent of the agreement and when it will take effect. Now let's get more with Abir Abu Amar in Dubai. Abir, good morning. And what do we know about this deal?
Good morning, Francine. Not much is the short answer. What we know so far is that, as you have just mentioned, President Trump said that Hamas has agreed to disarm if Israel pulls out of the Gaza Strip. Hamas came out overnight telling Al Jazeera that it will only disarm, as a matter of fact, if Israel pulls out its troops. Now, we haven't heard back from Prime Minister Benjamin Netanyahu's government or whether that will actually happen, just bearing in mind that he has an election year ahead of him, and it will be quite questionable on his party, from his party, if he does not get a deal that actually is in the interest of Israel. This is what a lot of analysts are saying. But when it comes to this deal, or this potential deal, the exact details of it are not yet clear. What we understand from our sources is that it still needs a couple of weeks or so for the final details there to be finalized. It could take, Francine, up to 350 days to actually be implemented. So there's a lot of margin of error there to potentially happen. President Trump does say in his post that this will pave the way for a Palestinian government to rule the Gazan people and pave the way for a better future there. He also says that it paves the way for more security and peace in the Gaza Strip. Let's just bear in mind that this deal announcement, according to President Trump, is happening in the midst of a wider war that is taking place in the Middle East, of course, the Iran-US war. And so for President Trump, this is a small win, or this is what a lot of those political analysts are saying. He's in a desperate need for those wins, especially as the U.S.-Iran war drags on in the region with no clear end in sight. So short answer, again, is we still don't have a lot of details on what exactly this deal entails. We have a little bit of opposition from Hamas on disarming, as a matter of fact. They only say that they will do that if Israel pulls out of the Strip. And if history proves a lesson, Francine, that will be a difficult feat to actually accomplish.
And Abir, it's been a volatile week for oil.
Yeah, so another thing that we're watching very closely, oil, it's roaming at around $88 on the barrel now. We're seeing Brent down today, but for the whole month, it's actually up about 20%. And that is obviously as these escalations in the Middle East continue to happen, albeit a little bit calmer today. Francine, we're watching two straits now. We're watching the Strait of Hormuz, but also Bab el-Mandab in the Red Sea that's been prone or has been at risk of those attacks by the Yemeni Houthis. We're actually reporting on stories that Saudi Arabia is having to reroute some ships through African routes, Francine. It's obviously been using the Red Sea throughout the course of this war as a secondary route to the Strait of Hormuz. In the Strait of Hormuz, movement is picking up only slightly. We reported yesterday that an LNG ship flagged to Qatar was able to make its way through the Strait of Hormuz for the first time in 3 weeks. So slight movement there, but nothing really compared to the levels that those shipments were at pre-war.
Abir, thanks so much. Abir Abu Ammar there in Dubai. Now, the Spanish government has ordered troops to one of its 2 North African enclaves after a recent surge in illegal immigrants. Now, the migration crisis risks a flare-up in tensions with Europe across Europe, with Italy's Prime Minister Giorgia Meloni threatening to impose travel restrictions on Spain. Let's bring in Oliver Crook, our chief Europe correspondent. Ollie, how did the enclave find itself at the center of this real border crisis?
Yeah, Francine, really very interesting. So this part of Spanish territory, which is effectively attached to Morocco just across the Strait of Gibraltar, Ceuta, is where this is all happening and has been really developing over the last week, where you've had a surge of immigrants coming in illegally, swimming, climbing over the fence. And effectively, as you saw from those very dramatic pictures there, Francine, we should say a number of people have died in the attempt to do this, have basically totally lost control of the border. And there are thousands of people now, they don't have a really precise figure, that have streamed into this sovereign Spanish territory. This obviously is a massive concern for the Spanish government. We understand that Prime Minister Pedro Sanchez will go down to Ceuta today in order to visit and to inspect the situation. They will deploy the military, the civil guard, additional police forces, and their number one priority right now is to try to retake control of the border. And then they have a much bigger question, which is how to deal with this influx of thousands of people and where to send them. And the reason, Francine, that this is happening now, at least according to the foreign minister, is a court ruling that we got out of Spain over the last couple of days, which effectively barred Spanish authorities from blocking people from coming and sending them back on humanitarian concerns and those sorts of things. So as a consequence of that, now if you cross into Spain from the sea and you manage to end up on that territory, you get a lot more protections than had historically been the case, which is why this is now happening. This, of course, is causing some issues for Spain, some broader issues across Europe.
Yeah, I mean, the pictures are pretty incredible. I think 50,000 migrants, according to press reports, entered that Spanish enclave. So what kind of consequences could we see in European politics as a result?
Yeah, well, we're already hearing the sort of rhetoric. You know, obviously the context for this is that you have a socialist Prime Minister, Pedro Sanchez, who has been very pro-immigration. He's been trying to actually attract people mostly from Latin America, but actually in the end, most of them that go into Spain are actually from Morocco. And Giorgia Meloni, who was obviously on the right wing, was elected on a very anti-immigrant platform, now taking to Twitter and talking about potentially suspending Spain from Schengen. Now, it's not clear exactly what she means. There is prerogative for every individual nation within Schengen to basically instill border checks on their own borders. This happens fairly routinely. The Italians do it, the French do it, the Germans do it. It happens all over the place. But really, I think it's for Meloni a place for her to win some political points. Obviously, with those pictures, which are very dramatic, are going to sort of instigate a lot of anger among the far right around Europe. So really, Meloni is sort of an opportunity there for her to sort of potentially grandstand a little bit on that, though it does not pose a direct or immediate threat. We should still say this is still several miles off of the European continent.
Ollie, thank you so much. Oliver Crook there, our chief Europe correspondent. Coming up, an earnings beat for Clariant. We'll speak to the chief executive shortly. This is Bloomberg.
Western countries, all of them are cutting funding to Africa. And some of these programs were supported by funding coming from Western countries, like for human resources, for testing, for transportation of samples. And suddenly, African countries have to think how to fund money and to cover this gap. But it takes some time. And I think the combination of all of these factors are fueling this mistrust that we see at community level. We value the support we got and we are still getting from the US. And we think that if we continue to work together, and there is no reason for the US not to work with Africa CDC, Africa CDC is the leader in terms of public health in Africa.
The global economic playbook is being rewritten and the levers of power are moving in real time.
To see where the world is headed, you have to look where the action is.
I'm Haslinda Amin in Singapore.
I'm Menika Doshi in Mumbai.
Welcome to Emerging the New Economy podcast.
Each month, we dive deep into how the world's most exciting rising economies are shaping the global future.
Join the conversation. Subscribe to Emerging on your favorite podcast platform today.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend.
This is Bloomberg Television. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacroix here in London, and these are your top stories. A global rally in tech stocks gather momentum as South Korean equities jump by the most on record. Asia's gains follow the biggest rally in Wall Street chip stocks in more than a year. Amazon jumps on strong earnings. Apple falls on supply shortages. Plus, President Trump says the U.S.-led Board of Peace has reached a deal for Hamas to disarm, but questions remain over the extent of an agreement. Now, Swiss chemical company Clariant has beaten profit expectations for the second quarter. Guidance for flat sales in 2026 remain unchanged as the company navigates a challenging geopolitical and economic backdrop. Well, we're delighted to be joined by Conrad Kaiser, the Clariant chief executive. Thank you for joining us this morning. When you look at the backdrop for a lot of the chemical companies, it hasn't changed. I know you've had a good, sound results. The Strait of Hormuz is still closed. So how much do you worry about costs going up in the next couple of quarters?
Yeah, what we see, good morning, Francine, regarding the Strait of Hormuz is we now are expecting a prolonged period of turmoil. The strait is not fully open yet, as you're well aware. What is different from a few months ago is that industry experts were expecting very high oil prices, $150 per barrel or even higher. That has not materialized. So global oil and gas markets have proven to be much more resilient than people thought. So we are expecting prolonged turmoil in the Strait of Hormuz. But in terms of impact on oil and gas prices, we basically no longer have scenarios with oil pricing well above $100 per barrel. We are seeing, though, continued elevated prices in downstream products from refineries, from crackers. Keep in mind, Strait of Hormuz, not only 20% of global oil and gas export, but also when you look at base chemicals, petrochemicals, roughly 20% of global production came from the Middle East, and there is not that resilience, that spare capacity in those markets.
But give us a sense of how much energy prices, but also shipping and logistics costs have impacted you.
Yeah, they have obviously impacted us, but what is very positive is that we have been able to more than price through year to date the impact of increased raw materials, increased energy, increased freight prices. If you look at it in the quarter, we saw actually elevated raw material costs, 7.4% compared to the same quarter last year, but we have actually fully priced that through to our customers. We are truly specialty chemicals. We are generating significant value to our customers, and it allows us to pass on these raw material cost inflation.
There's also extra tariffs that we heard from the U.S. last week. I think Switzerland is now 12.5% compared to Europe at 10%. First of all, is that frustrating, being a Swiss company? And again, what kind of impact would it have on your return longer, from here until the end of the year?
Yeah, the impact is very modest because we have actually 68 sites globally. We typically produce in a region for a region. It is somewhat surprising that we're facing tariffs in the context of forced labor. I mean, there obviously is no forced labor, not in any of our sites, but also not in our supply chain. The difference between the 12.5% is that apparently the judgment of the United States is that Switzerland is not enforcing enough these forced labor law in its imports. I can assure you that both Clariant as well as our peers here in Switzerland were obviously free of forced labor.
But does it again? Is a change from 10 to 12.5% impactful? Regardless on whether there's a basis for it. It means that there's a higher franc to contend with. It just how much does it complicate it, that 2.5%?
Sure. Yeah, well, for Clariant, it is not material. We have basically 68 sites, manufacturing sites globally. Only one of them is in Switzerland. For some colleagues here in Switzerland who have their manufacturing predominantly in Switzerland, this is obviously a bigger impact. But for us, it's not material.
So yesterday, there was a big ruling, of course, in your favor. What does that mean going forward? Does it make you're expecting also other rulings that you're waiting for? Are you more positive on the outcomes for those results coming?
Yeah, a big step forward yesterday. The courts in the Netherlands, actually a very positive ruling for us. The claim from Shell, more than €1 billion, has been dismissed on all aspects in the Dutch court. This is actually a very positive development for us. It related to a legacy topic, an ethylene cartel. It's very positive that the judge in the Netherlands has assessed that there had not been an impact by the cartel behavior on ethylene pricing.
I mean, your share price flew yesterday. Are you worried that it makes you more of a takeover target? It must be great relief, but how does it change, the proposition of Clariant going forward?
Yeah, it is very positive to see the reaction yesterday, the share price up 16%. It basically tells the story that there was a significant overhang from these ethylene claims in our share price, which we have said all along. And we're very glad to see that actually moving out now.
And so you don't think it makes you more of a takeover target now that the overhang is gone?
No, we think in terms of the whole situation with the overhang from ethylene on our share price, it has never impacted us, neither from an operational point of view. We always basically had very strong liquidity. We basically have a strong investment grade. It never has impacted the company, neither operationally nor from a strategic perspective. We've always been able to do bolt-on M&A. It has not been constrained by this overhang in the share price from these ethylene claims.
Okay, thank you so much for spending a bit of time with us today. That was the Clariant Chief Executive, Conrad Keijzer. Now, France's Crédit Agricole and British lender NatWest posted results ahead of expectations for the second quarter. NatWest raised its guidance, citing its takeover of wealth manager Evelyn Partners, while Crédit Agricole reported a record results in its asset management arm and income growth in its French retail business. Let's bring in Philip Richards, senior analyst at Bloomberg Intelligence. Thank you for joining us. What actually have we learned from these two banking reports this morning?
Yeah, good morning. All week has been dominated by the investment banks and how strong the trading has been. And what we've seen today from more retail focus, corporate as well, but mainly retail focus, that these banks are actually doing very well as well. The revenue line is coming through very strongly. Credit risks are very low. So actually, it's not just the investment bank focus, it's across the board in banking.
And so through this earnings season so far, how is Europe doing compared to Wall Street?
Yeah, well, Overall, it's doing very well. I mean, if you look on revenues and cost of risk, almost every bank is beating, essentially. In the bottom line, EPS, every bank has beaten consensus. So they're doing very strongly. How are they doing versus the US banks? I think it's a different story, because of the US are doing so well, particularly on the trading side. So if you look at equities trading or fixed income trading, then actually in both cases, the US banks are doing a lot better than the Europeans. So there they are losing share, and that's a concern.
Philip, thank you so much. Philip Richards, their senior analyst at Bloomberg Intelligence. Now, the Bank of England has kept UK interest rates steady at 3.75%, with Governor Andrew Bailey insisting his committee is not getting closer to a hike, despite 3 members voting for tighter policy. Well, I spoke to Governor Bailey about how policymakers are navigating uncertainty.
There are 2 things, I think, that shape my thinking, certainly. One is obviously is the one that's shrouded in so much uncertainty. It's where are these events in the Gulf going to go to? And then the second question is, for any sort of given set of events, how are they going to feed through into domestic inflation? Now, we start in a position where it's come in lower than we thought it would. We're below where we thought we would be if you go back to April. But you can't take too strong a message from that in terms of second-round effects going forwards, because, frankly, this is a very unprecedented situation.
Governor, if you look at market bets, they reduced bets on a hike in September. We're now at around 33% chance. Yeah. Are you content with that?
I think the market pricing is sort of sensible.
So that's where you would lean towards.
The reason I say that is because when we survey the market, what the market tells us is that their sort of, if you like, their central expectation is for no change. But then they say, yeah, but there's a risk on the upside. And you can see that built into market pricing. And I think that, as I said in the press conference earlier, I think that fits with the fact that we've got 3 scenarios. We've got less probability attached to any one of them, frankly, than we probably normally would. But the adverse scenario is further away from the centre than the lower scenario. And the adverse scenario basically is a scenario which says if this breakdown of the ceasefire continues as a permanent thing, then we're going to have higher energy prices, and that will have an effect.
But, Governor, we've also seen some new language, right? So the 6 members who held rates said the policy strategy could change if upside risks to inflation were to subside. So can you tell us a little bit more about that?
Yes. So I think if, however, we were in a position which we were when we started the meetings for this round, where the Memorandum of Understanding and the ceasefire was holding, and we had crude oil price, I think, briefly down to somewhere not much above $70 a barrel. It's a bit higher than it was before the conflict, but not a lot higher. Then, yes, I think we're looking at a different situation. Now, sadly, of course, that hasn't held.
But that's very unpredictable at the moment, or
yes.
Are you expecting, so it could flip? And what happens if it flips from one to the other?
Well, I think there's two things going on. So if we got into a situation where the ceasefire is in place again, I don't think it's unreasonable to think that when they come down as much, we'll see, but they come down again. But then the problem we've got is the sheer unpredictability of this, because this is what we've learned again in the last week, 2 weeks, 3 weeks.
Governor, your central projection shows unemployment peaking around 5.5% in 2027, a rate that we hadn't seen since 2015. A weaker labor market is helping, of course, to contain the second-round inflation. Yeah. But at what point does it cost in terms of jobs?
Well, I think we are seeing softness in the labour market. We are seeing something of an output gap opening up, and that is reflected in the labour market. So I think it's exactly consistent with what you say is in the projections. Obviously, we don't want to see that happening. And one of the things I would say is that we don't have a dual mandate, and I like our mandate. What our mandate has in it, though, is what we call trade-off language, which is we've had another negative supply shock. Pushes prices up, activity down. Our job is to return inflation to target, but that language, that trade-off language, gives us some flexibility as over what period we return it to. We obviously have to look very carefully at things like inflation expectations, but it is in our mandate, and I think we must use that where we think it's appropriate to.
You've met with the new Chancellor. Do you think your mandate could change under this Prime Minister?
I've had no discussions on that at all, so I don't think that's anything that we should speculate about. I've not had that discussion.
I know you don't like talking about fiscal policy, but what does the uncertainty of the budget in autumn mean for the next couple of months?
Look, honestly, I don't go into this autumn in any different position than I normally do. I know there's going to be a budget towards the end of the autumn. because that's the way the UK cycle works. And so we condition our monetary policy decisions on announced fiscal policy. We'll do the same again.
Well, that was the Bank of England Governor Andrew Bailey. Coming up, as FIFA vows to press ahead with controversial plans to seek private investments, we speak to former England international and Mercury 13 investor Enia Luco. That's coming up shortly, and this is Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need,
there's going to be now tons of tariff headlines until midterm election.
Hear it first on Bloomberg.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
We've put a lot of measures in place in order to help the people with fast claims payments, with relocations, and simplification of the procedures. Obviously, the question will come, how much will this all cost? But this is far too early because, these have just happened. If you go back over the last 3-4 years, we have had many of these events, and all of these events, yes, have touched us, but have touched us in a way that we have always well managed and absorbed.
Well, that was Thomas Buberl, the AXA chief executive, on the impact of wildfires in Europe. Now, a group of scientists has warned that climate change made the weather that fueled Europe's recent wildfires significantly more likely in France and Spain. Well, the alert from the World Weather Attribution Group comes as fire crews are tackling blazes in England and Greece. We can bring Joe Wirtz, our climate reporter. Joe, thank you for joining us. So how severe have the blazes been across Europe this summer?
They've been very severe. The fire season in Europe started early and ramped up quickly. The fires have been big and fast moving. They have also erupted near major population centers, which is worrying people on the ground there. And the fire behavior has really changed this year. Firefighters on the ground reporting, they're seeing fire activity like they just have never seen before. And in some cases, this is so intense and so strong that these fires are actually warping the weather around them. These are creating, firestorms on the ground that just really haven't been seen in Europe before.
So, Joe, the heat, has seen water levels also in the Danube and some of the Rhine River drop to an unprecedented low. What kind of impact is this having?
These are our key transit hubs for commodities, grain, and energy. They're also used to cool nuclear plants. Hungary's had to take emergency measures to shore up pumping stations and emergency pumping stations to keep water flowing through its only nuclear reactor there. And it's led to, limits on the amount of cargo that you can push in those rivers and real navigation problems because the levels are getting so low.
Joe, it's such an important story. Thank you so much for joining us.
Thank
and
you.
Of course, we'll push this out on social media. Our climate reporter, Joe Wirtz. Now, FIFA says it will proceed with a consultation on its controversial plans to bring private investments into the World Cup and other football tournaments. Well, Europe's football governing body, UEFA, says its members will boycott all FIFA tournaments, while federations for Asia and North America have also signaled their opposition to the proposal. Well, I'm very delighted to be joined by Eni Aluko, investor in Mercury 13, former England international football player. She's also on the CAF Women's Task Force. Eni, such a great pleasure, first of all, to have you here. I mean, this UEFA-FIFA standoff is a big one. If this continues, it's likely that women's events will be the first real testing battleground for it. I mean, how do you feel about that? Does it prove the importance of the women's game, or does it just bring unwanted pressure?
Well, yeah, I think the women's game is an integral part of global football now, you know, whether that's the World Cup or the European Championship. So that includes UEFA. But I think UEFA's stance, I think, really shows the lack of consultation, the completely, the diametrically opposed positions for UEFA and for FIFA, and the fact that Infantino seems to be doing things and making decisions without the consultation of major member associations like UEFA. And frankly, I think that once UEFA's not on board, the value of the World Cup diminishes anyway. Out of the last 4 teams at the World Cup, 3 were European. So I think UEFA's protest means that these proposals cannot go forward, unfortunately.
I mean, did you have concerns from the start? What kind of impact does this have on competitions if the Infantino plan, if we're to call it that, goes through?
Well, look, I think the privatization and commercialization of football has been happening for a long time. And the proposal in of itself to sell the World Cup to private investors, I think is a continuation of what we've already seen. I think where there's a big problem is the affiliation with politics and the fact that it's, Trump's associates that might benefit, who might be the private investors. That's where I think the integrity of football becomes questioned. There are rules around fit and proper persons test. There's rules around who can own in football. And I think that's where, you really question the integrity of the sport. Fans are becoming much more isolated from any of the decisions that FIFA are making. I think from a PR perspective, FIFA should really start thinking about the fans. If they came out and said, right, we're going to generate $4 billion from this commercial proposal and we can subsidize tickets for the next World Cup, it gets received in a much different way because you're centering the fans. I think what we're having is a conversation about a billionaire class taking over football, and the stakeholder fans and some of the member associations get completely isolated.
I mean, if you look at the commercialization, do you worry about, is it ticket prices we should worry about the how often these competitions, like there's a whole ecosystem that we have now that could potentially change?
Well, if you look at the last World Cup, fans were outpriced. I was there in the US, and a lot of people could not afford to even go to the games. So that needs to be taken into consideration. Whenever there is a proposal to generate more money, how does that impact the fans who are the center of the sport, right? So I would like to see that, for the next World Cup, okay, generate money commercially. That's fine. That's what football has done for many, many years. But how can that benefit the fan? How can that subsidize tickets for the fans so that everybody becomes more on board and there's more of a collective approach, rather than it feels as if it's benefiting, the sort of billionaire class and politicians, and it feels very isolated. I think that's where Infantino has gone wrong. There has to be more of a consultation around the fans, but also around, the member associations, important member associations like UEFA.
Do you think CAF, which is the African UEFA, will vote the same or have similar feelings to UEFA?
Well, I think the proposal is that, if the member associations get on board, 40 million will be distributed from this proposed plan. 40 million to African member associations is very, very important for the sort of development of football and the infrastructure. 40 million to the African member associations is very different to 40 million to UEFA. So it's all relative, and so I'm not surprised to see CAF hold back a little bit and say, actually, let's have a conversation, because I think the money that's proposed actually could really be beneficial for African nations. But ultimately, if UEFA are not on board, the World Cup diminishes anyway. I think the value, and so I would like to see a different iteration of this idea. All member associations get back to the table, come up with a different proposal that feels a lot more collective in its approach.
Do you think FIFA and Gianni Infantino will back down?
I think they have to. I think if UEFA have taken such a strong stance, and as I said, UEFA are very, very important to the overall value and position of global football. I think they have to change. The proposal has to change, and they have to sort of come together and come up with a different proposal. I would like to see the fans considered much more in whatever the new proposal is. We saw a few years ago with the Super League proposals, it got widely rejected, same sort of outrage. But there was a different iteration that came with the Champions League a few years later. Champions League changed, then the Club World Cup changed. So I think from this position, you can come up with something better that feels more of a collective approach. And I hope that, you know, the fan as a stakeholder is considered within that.
And you've been such an icon, right, on this field, but also what you've done for women's sports and investing in it. How do you see, where's the money coming from now? I mean, away from what FIFA is trying to do you see more, you know, big sports investments in women specifically coming from the US or Asia, or how's that dynamic changing?
Well, you mentioned obviously that I'm part of Mercury 13, a global women's investment group, multi-club investment group. Private investment is coming into the women's game, which is very, very exciting. It hasn't always been that way. Lots of multi-club investment, lots of new investors coming into the sport, lots of brands, commercial activity. So it's in a really healthy place. It's very exciting to be part of. Great leagues like the US, obviously the WSL in the UK are really growing rapidly. There's development in Africa as well. The women's AFCON is currently playing now. So there's lots of growth on the women's side that is now part of the wider, football ecosystem globally as well.
I mean, I know there's concerns about, the players just playing too many games and risking injury. If you look at the ecosystem, what's your main concern about how we're playing football right now?
Yeah, that always has to be a consideration. The player welfare. The amount of load on players with the new competitions coming in, that has to always be balanced with, the desire to generate more revenue and build more competition. Women's World Cup is next year, which is going to be very exciting in Brazil. But the players always have to, we always have to keep an eye on the fact that the players play so many games now, particularly players at the highest level who are playing in the Champions League as well.
I mean, a couple of years ago, everyone was talking about the Super League, and there was a real uproar from fans. Do you think something like that could ever come back in a different iteration?
No, I don't think so. I think the idea that sort of you can have breakaway leagues, I just don't think it works within an ecosystem that's so historic. Football is such tradition. And so I think whenever there's new ideas, there has to be a collective approach. You cannot have, one president doing something over here and someone doing something over here. It has to be more of collective consultation. I think that's where Infantino has gone wrong on this occasion, lack of consultation. But it does allow you to come back to the table and have a different conversation and say, okay, how do we get to this outcome of more commercial revenue for the World Cup? And how does that benefit all of us, including the fans?
Thank you so much for coming on with us today. That was Eni Aluko, investor in Mercury 13, former England international football player, and a member of the CAF Women's Task Force. Up next, it's Bloomberg Brief, and this is Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Everybody has a moment where they put into action all they've practiced, where they step up to a challenge and either succeed or fail. But what are those moments for some of the world's most influential leaders?
It was a rough and tumble world, and I thought, okay, I can rise up, I can play this game, and I did play the game.
It was great, and it was depressing, and it was disappointing.
My chair at the time sat down with me and said, succession starts now.
I'm Francine Lacqua, an award-winning journalist. For the last 25 years, I've interviewed world leaders, bank bosses, even fashion icons. I'm often asking about the news of the moment. But I've always been curious, who are these people as leaders? Join me for the podcast version of Leaders with Francine Lacqua. I'll start your week with conversations that explore what drives the world's most influential people, how today's leaders got to where they are, where they're going next, and how they've transformed their organization in the process.
Make decisions. A poor decision is always better than no decision.
You have to have truth tellers around you, and you have to be willing to listen.
You don't want to be setting strategy in the middle of a transaction, that's for sure.
Do it for the right reasons. Don't do it because of FOMO.
We'll also learn lessons which we can apply to our work and daily lives. Tune into the podcast version of Leaders with Francine Lacqua. Listen and watch on Bloomberg Television or wherever you get your podcasts.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo. And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling the deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
It's 5 a.m. in New York City, 10 a.m. in London. Good morning, I'm Vonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. Tech earnings diverge. Amazon results bolstering the AI investment narrative. Apple dips on disappointing guidance. Stock futures gain as South Korean chip makers rebound and European equities head for an all-time high. And the yen rallies on intervention just hours before the Bank of Japan decides to keep interest rates unchanged. Tech stocks surging across Asia. We have to get the latest details from Winnie Su in Hong Kong. Winnie.
Good morning, Vonnie. Well, happy Friday. What a significant rebound in Asia, especially with gains being led by South Korea's Kospi Index, which saw an unprecedented jump of 18% in a day. Now, that's being mainly led by SK Hynix and Samsung Electronics, which both saw a surge by more than 25%. Overall, the sentiment is being boosted by the solid earnings from Amazon and Microsoft that reassured investors of the AI monetization, but also the authorities from South Korea stepping in to curb the volatility, as well as how traders pointed to the rescue by Citadel of situational awareness that is putting a floor to the recent sell-off driven by these leverage bets. Now, flip the board, we take a look at the Japanese yen because, yes, we saw that big spike overnight driven by the authorities' intervention and also the U.S. rate check, but we did see these gains started to fade after the Bank of Japan kept rates steady with the Bank of Japan's Governor Ueda, in fact, striking a bit of a hawkish tone, still citing the upside risks of price outlook. However, it seems like at the moment, markets are demanding more.
It does, although, Winnie, you may not have seen this, but we're at 158 now, so a massive strengthening again just in the last few minutes. That is Winnie Su in Hong Kong. Now, let's get a look at what's happening in Europe. Over to Britain and Justina Lee.
Good morning, Vonnie. Now, in Europe, we don't often get to crow about our equity performance, but today is one of those days because the Stoxx Europe 600, outperforming the world this month probably, and it's hit another all-time high, rising 0.8% today. Now, of course, a lot of that is led by a lot of the losers from earlier this week, but we kind of have a rotation of that rotation with a lot of tech names rebounding strongly over the past 2 days. Now, when it comes to the bond market, we have a slightly lower oil today, but interestingly, we just had some inflation figures from the euro area in general, and the core numbers slightly exceeded expectations. Also exceeding expectations are French CPI figures coming out today. And so we're seeing here the 2-year German bond yield rising 2 basis points. Now, on the other hand, if we flip the board here, we can see also on the short end bond yields in the UK, a completely different trend after the BOE decision yesterday. Now, it was also a hold just like the Fed. We also got 3 dissenting rate hikes. But Andrew Bailey came out and told everyone, don't think that we're edging toward a hike. And you can see here that the market heard that message loud and clear, Bonnie.
Absolutely, a lot of messages coming to this market this week, Justina. And in fact, yesterday, even though we had a massive spike and a massive rebound in the SOX index, it was up more than 8%, we're still down on the week so far for the Nasdaq 100. Again, we'll see what happens today, but pointing very much to gains in today's session. Obviously, across the indices, we're seeing the same thing, and it's a bleed across from the Asian session, but of course also the situational awareness situation. Let's look at yields, though, because market's still digesting that Fed outcome and, of course, everything that's happening globally as a result. The 2-year yield staying the same, and we have the longer end of the yield curve coming down just a couple of basis points, but we're still very elevated with the 10-year at 464.50 and the 30-year very close to that 520 mark that we hit earlier in the week. Not maybe getting unanchored, though. We are at least holding on to this pricing. Let's take a look at oil, because once again we're down today for sure. We're down to 88 on Brent and 82 and change on WTI. At the same time, still up more than 20% this month. It's been a wild ride for this market this month. Let's get to some individual movers now. Over to London and Chloe Melly.
Good morning, Bonnie. We've got positive and a negative news coming out of those big tech earnings this morning. So we had Apple down after the component shortages really weighed on its sales guidance. Then on the other hand, Amazon has had this cloud computing revenue accelerating once again and reassuring investors around this AI spending. So 2 very different stories this morning there. Moving on to Coinbase, and the crypto exchange is down this morning after missing revenue expectations. It seems that it is really struggling with that weakness in the crypto market. So we're down more than 4%. And finally, let's go over to the Netherlands, where the world's biggest record label, Universal Music Group, is taking a major hit this morning, more than 22% after it reported a miss in subscription revenue. It seems that it's really struggling to hold on to this market share because of this rising competition from other record labels. And so we are seeing that really drive down the shares this morning.
Yeah, it's been a while, several months for Universal as well. Chloe, thank you so much. Chloe Melly there. She'll be back later in the hour. Also coming up this hour, we'll take a closer look at these moves in the yen and the US dollar with Jane Foley of Rabobank. Let's start with tech earnings, though. Amazon jumping double digits in pre-market trading thanks to robust AWS results. Supply shortages, though, taking a bite out of Apple shares. With us now with more is Bloomberg's Mark Bergen. So it's a 5th straight quarterly gain for AWS. Mark, what's Amazon doing right?
What it's doing right is it's growing its cloud business at a pretty impressive clip. I believe it was about 37% for the quarter. You know, the Amazon AWS has been the market leader in cloud for a very long time. The story that this is a repeat of when we built AWS. For a long time, Amazon was famously unprofitable. They were investing that money in this cloud business that soon became this much bigger growth engine than their e-commerce business. And he's sort of saying the same thing with this new version of AI and chips, and we're going to see a repeat. And certainly investors are buying that. We've seen that this morning, yesterday and this morning as well.
Yeah, why haven't they been up until now? Amazon has been lagging stock-wise, and yet it seems to have been doing very well, particularly in its cloud business for the last several quarters.
Yeah, I think obviously there's, they had a big impact around tariffs with their e-commerce business. I think the AI story in general for Amazon has not been a positive one. They were seen as sort of a late mover. They don't have the strategy in place that, say, Microsoft and Google or even Meta do as far as what their game plan is around large language models, around models around robotics and sort of the next generation. That still remains pretty unclear, I think, but they're clearly the biggest beneficiary in the cloud computing market.
Apple, Mark, it's definitely hurting, price hikes and so on. What should we expect from Apple for the next few months?
Yeah, it was pretty fascinating. Tim Cook described this as a 100-year flood, this memory chip shortage. I think this was an indication. I mean, we've certainly seen that from earlier results, and we've been reporting on that for our colleagues in Asia for some time. This is clearly the biggest indicator that this chip shortage is now having a major impact on the world's biggest company. So I think a lot of that was the sluggish sales forecast we saw, I think, is now dependent on those supply chain issues.
What about for the consumer? Should we expect now extended wait times? And what does extended actually mean in this scenario?
Yeah, as far as I know, I don't think they've, Apple and Tim Cook said this was actually a sign of just increased demand for iPhones and iPads and their products. As far as I know, they didn't signal any extended wait time, but that's certainly a possibility.
All right, Mark Bergen, thank you so much. We'll see how these stocks trade today. Turning to Japan, the yen trading now at 159.10. It strengthened very suddenly just a few moments ago. Once again, we know there was intervention earlier. The Bank of Japan also holding its policy rate steady just hours after that, at least first intervention, with apparent help from the United States. Joining us now is Bloomberg's Ven Ram. Do we just get another round of intervention, Ven?
It doesn't look like, because it stopped at 159, but nevertheless, it's an important spike up that obviously will have the market sit up and take notice. Now, the Bank of Japan had a massive opportunity this morning, which I think they squandered, because, after yesterday's overnight intervention, they could have doubled down and said, look, we are going to put up rates, which would have completely caught the markets unawares, because no one was pricing a hike. If they had come out with their guns blazing and fired the next salvo by raising rates, that would have really propped up the yen like much better than what the intervention could have done. We have seen these repeated bouts of intervention that have failed to sustainably pull the yen up. So, and I think that, if they are found wanting in terms of monetary policy, no matter what they do on the currency front, it's not going to help the yen.
Why didn't you sound a little bit more hawkish? So it's been characterized as maybe a modestly hawkish BOJ meeting. But the plan, or at least the reporting coming into this, was that maybe they would up the cadence of any rate hikes beyond just one every 6 months that the market is used to.
Absolutely. I think that, he repeatedly said that, look, there is a threat that inflation could breach 2%. And in fact, if you see the inflation forecast for this fiscal year, it's 2.5% now. And they also think that the economy is going to go much better. And so for them not to be raising rates and keep rates below neutral is inexplicable to bondholders, which is why you see that the bonds have repeatedly come under pressure. They've sold off. And if you look, currency swap the JGB yen holdings into the dollar, you will find that they are trading at a considerable price discount to treasuries. And that is why the markets want to hear a very strongly hawkish message, which they fail to hear.
Then I have to ask you about the situation, obviously in Korea, but in Asia more generally. How much has this to do with the situational awareness unwind? And how much is it just generally that, positions have been flushed out?
I think that it's got to do with the latter thing that you mentioned. Positions have been flushed out. We saw that Korean market go down 20%, and it's come back up by a whole lot this morning, today. So I think that, this is all a positional flushing out of positions. But I think that the longer term questions remain here. The Korean market has been behaving more like a casino than a stock market actually behaves. So I think that, the risks are out there. And I think that the AA story has played out. And I think it's been overpriced. And I think there's more correction to come in the coming weeks and months.
Then thank you so much. That is Bloomberg's Ven Ram in Dubai. Now to other top stories trending on the terminal this morning. South Korean stocks surging a record 18%. In today's trading, largely driven by chip maker stocks, obviously, that had faced 3 days of massive sell-offs. The rebound was fueled by bullish reports on the AI build-out overseas and regulatory support from the South Korean government, among other things. Anthropic says its AI models breached 3 outside organizations during cybersecurity tests that went wrong. 3 Claude models accessed the internet and hacked real-world systems after a testing environment was mistakenly left connected. President Trump says Hamas has agreed to disarm as part of an agreement with the U.S.-led Board of Peace. Questions, though, remain about the extent of the accord. Officials say details will be refined over the next couple of weeks. Hamas officials confirmed they struck a deal that includes provisions on their weapons. Coming up, we'll take a closer look into Ken Griffin's rescue of situational awareness amid the latest AI sell-off. This is Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Durrett.
I'm Lisa Mateo. And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech.
Every weekday, only on Bloomberg Television.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. Leopold Aschenbrenner's hedge fund, Situational Awareness, slumped to about $10 billion in total assets after Citadel's Ken Griffin bought most of its public stock bets. That's down from $45 billion for the fund at the start of the month. Well, for more on this really crazy story, Bloomberg's Nishant Kumar joins us now. So what actually happened here? How does a fund, well, we know partially how a fund goes from $45 billion to $10 billion in a month, but give us the details of what happened here.
Yeah, so this story is really about borrowed money and a lot of it, and how it supercharged a very crowded, hot trade the world has ever seen. Banks were all lending into this, some offering 4 to 5 times the fund's own capital in terms of leverage. So what was already a big bet on AI got multiplied several times because of this leverage. Then the tech trade turned. And some of the banks, they were so willing to support the fund on the way up, decided that, they want to protect themselves. They want more collateral. So they asked the hedge fund for more collateral. And to find it, situational awareness had to start selling into price which were already falling. So we have seen this story repeat time and again. What stands out really here to me is how quickly it happened. We are talking about days. And even after all that, July was down 67% for the fund, but the fund is still up 80% year to date. That shows how ferocious this AI really has been.
Why did Citadel step in? What did Ken Griffin get out of it? And, were there no other positions they could have sold in order to hold on to their assets?
Well, everyone loves a discount, isn't it? If anything is on sale, we all rush to buy it at the right price. But it also reflects how only a handful of firms in today's world can take on like billions of dollars of stocks in one single transaction. And a few of them got calls this week. So Millennium had a look. Jane Street, which is an investor in situational awareness itself, they also had a look. Citadel got a wind of it, and they negotiated a discount and ultimately bought their positions.
Negotiating through the night, according to your reporting. Nishant, you have to wonder what it says about the AI trade that maybe some of these funds pass, like Millennium and Jane Street. Was this a one-off, or is it a warning sign about AI exposure across the market?
I mean, it's hard to say that, but I won't read it too much into whether it's a signal that shows how the AI story is going to unfold. The firm hasn't gone anywhere even now. It's still among the largest equity hedge funds right now. It still holds on to Anthropic bet, which is north of $5 billion. If anything, this is an old lesson resurfacing. While leverage on top of a very concentrated, crowded bets, and this is what it leads to. The AI thesis isn't really what was tested this week. It was the leverage behind that trade.
Nishant, I wonder if you'd seen the conspiracy theories that Citadel had put out a potential Fed rate hike story in order to actually cause this sell-off. That's a little bit of a conspiracy theory that's going around Twitter. Is there any truth to it?
I mean, it's hard to, as you said, it's conspiracy theory. So, as a journalist, it's hard to, unless, we write about it, it's hard to say. Social media is hot these days, and it becomes hotter whenever a story like this unfolds.
Exactly. It's in the ether, at least. Nishant, thank you so much. That is Nishant Kumar there, our hedge fund reporter. Coming up, a look at what else is making headlines in your front page news. This is Bloomberg.
Western countries, all of them are cutting funding to Africa. And some of these programs were supported by funding coming from Western countries, like for human resources, for testing, for transportation of samples. And suddenly, African countries have to think how to fund money and to cover this gap. But it takes some time. And I think the combination of all of these factors are fueling this mistrust that we see at community level. We value the support we got and we are still getting from the US. And we think that if we continue to work together, and there is no reason for the US not to work with Africa CDC, Africa CDC is the leader in terms of public health in Africa.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
The global economic playbook is being rewritten and the levers of power are moving in real time.
To see where the world is headed, you have to look where the action is.
I'm Haslinda Amin in Singapore.
I'm Menika Doshi in Mumbai.
Welcome to Emerging the New Economy podcast.
Each month, we dive deep into how the world's most exciting rising economies are shaping the global future.
Join the conversation. Subscribe to Emerging on your favorite podcast platform today.
This is Bloomberg Brief. I'm Vonnie Quinn in New York. The United States has led the world in building huge technology companies and attracting enormous capital, but Europe showing a strong desire to try and catch up. Here's more from the latest episode of Wall Street Week.
Growth has been slowing down for a long time in Europe, but we've ignored it. And now we cannot ignore it any longer. Now conditions have changed.
We need new tech champions in Europe.
The fact of the matter is 43 of the largest 50 companies in AI are US-based. Europe has one.
The quest for Europe to get into the mega tech game is one of the reasons it's now undertaking the biggest revision to its merger rules in over 20 years. And few people know more about the potential impacts for businesses and consumers than Fiona Scott-Morton, a professor at the Yale School of Management and a former chief economist at the Antitrust Division of the U.S. Department of Justice.
There's been a lot of angst in Europe over growth and the ability of Europe to stay at the technological frontier. And we've had a couple of reports, the Letta report and most recently the Draghi report, that have really hammered on that and pointed out all the issues in Europe that are holding back Europe from more growth.
Scott-Morton says the new guidelines, which were published in April and are now under review, aim to change that.
I think the complaint has been among some parties in Europe that the Commission is not favorable enough toward the mergers they would like to do. So this is explicitly laying out how do you come to us with a story for why your merger is really good, why your merger is going to increase innovation, something like that, and explicitly laying out what those factors would be and how you might go about showing them.
It's a big deal. It's a big deal because it's been 20 years since there was a revision of the guidelines, and it's a good exercise in showing the direction of where competition law is heading.
Ingrid Vandenbora is the head of Skadden Arp's European competition practice in Brussels. It's firms like hers that are navigating the changes on the front lines.
What the guidelines do is they set out also for the difficult deals, also for those that may not be so easily to get through. There's a couple of factors that are more developed. A, the Commission's going to look at efficiencies in a much more robust way. They call it the theory of benefit in the guidelines. So they're not only looking at what will the harm be to the economy of a transaction potentially, but also what will the benefits be. The second element is that they're going to look at markets on a dynamic way. The key term in the guidelines is dynamic competitive potential of a transaction. And so it's going to be forward-looking.
Beyond giving companies explicit leeway to argue for efficiencies or changes in the market to justify their mergers, the new guidelines specifically address the question of startups and provide ways for early investors to reap rewards for taking chances.
We all know that that's what startup companies need. When you invest, you need to know you have an exit route as well, and that's really what the guidelines are trying to do. So those are a couple areas where very concretely the guidelines set out some more robust frameworks for companies.
And you can watch the full episode of Wall Street Week tonight from 6 p.m. Eastern. Coming up, we're going to talk about this yen move. Several moves, in fact, with Jane Foley of Rabobank next.
Everybody has a moment where they put into action all they've practiced, where they step up to a challenge and either succeed or fail. But what are those moments for some of the world's most influential leaders?
It was a rough and tumble world, and I thought, okay, I can rise up, I can play this game, and I did play the game.
It was great, and it was depressing, and it was disappointing.
My chair at the time sat down with me and said, succession starts now.
I'm Francine Lacroix, an award-winning journalist. For the last 25 years, I've interviewed world leaders, bank bosses, even fashion icons. I'm often asking about the news of the moment. But I've always been curious, who are these people as leaders? Join me for the podcast version of Leaders with Francine Lacroix. I'll start your week with conversations that explore what drives the world's most influential people, how today's leaders got to where they are, where they're going next, and how they've transformed their organization in the process.
Make decisions. A poor decision is always better than no decision.
You have to have truth tellers around you, and you have to be willing to listen.
You don't want to be setting strategy in the middle of a transaction, that's for sure.
Do it for the right reasons. Don't do it because of FOMO.
We'll also learn lessons which we can apply to our work and daily lives. Tune into the podcast version of Leaders with Francine Lacroix. Listen and watch on Bloomberg Television or wherever you get your podcasts.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo. And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas.
Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine. Watch, listen, stream. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
It's 5:30 a.m. in New York City, 10:30 a.m. in London. Good morning, I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. Tech earnings diverge. Amazon results bolstering the AI investment narrative. Apple, though, giving disappointing guidance. Stock futures gain as South Korean chip makers rebound. European equities heading for an all-time high. And the yen rallies a couple of times today. Intervention in the early hours, then the Bank of Japan decides to keep interest rates unchanged. So let's take a look at these markets then. Even with what looks to be a nice rebound for the Nasdaq 100 today, it is the worst performer of the indices in July. So far, before today, it's still down 5.7% month to date, even after yesterday's nearly 3.5% gain. The SOX, by the way, yesterday up more than 8%. And I mean, just look at Korea today. The Kospi rallied 18%. What kind of bounce is that? It's literally unprecedented. It has never happened to see an index in such a major developed country rally that hard. Obviously, this is bleeding across to S&P futures and Russell 2000 futures as well. Let's take a look at yields. We're not seeing too much movement. A little bit lower at the longer end, but still holding on to the price that we moved to after the FOMC, so 465.51 and very close to 520 on the 30-year yield. Oil continues to show some respite. At the same time, we're up almost 20% this month nonetheless. We're just below $89 on Brent, just below $83 on WTI. And we have European gas futures rallying once again. We're up to 59.36 now per megawatt hour. All right, let's get to some stocks to watch. Here's Chloe Mele in London.
Good morning, Bonnie. Let's start with big tech this morning. We had Apple down this morning, more than 7%, after giving quite disappointing sales guidance because it's been really dealing with those component shortages, those supply chain disruptions. And then on the other hand, we have a much more positive story coming from Amazon, with the cloud computing business accelerating once again and reassuring investors around this AI spending. And so we have those very two different stories in that big tech sector this morning. Moving on to the crypto exchange Coinbase, which is taking a bit of a hit this morning. We're down more than 4% after the revenue fell short of expectations. It seems that it's really dealing with this continued weakness in the crypto market. And so we're seeing that really drive down the shares this morning. And finally, Universal Music Group, the world's largest record label, is taking a major hit in the Netherlands this morning. We're down more than 24% after it missed expectations on a very key metric, which is subscription revenue. And so it's a company that's been having some trouble over the last year or so already. And so this print this morning has just really not helped its case. And so we're down quite a lot for Universal.
All right, Chloe, thank you so much. Chloe Melly there in London. Massive volatility for the yen today with an intervention earlier and then a BOJ decision to hold rates pat. We also got the news conference afterwards. Rabobank's Jane Foley writing, quote, a rate hike in October would be a first step towards a firmer yen. But for the dollar yen to hold below 160, the market may also have to price out Fed rate hikes this year. She joins us now. She's head of FX strategy at Rabobank. So, Jane, if we just take a look at the chart for the yen, it's been really incredible today and a very strange day, perhaps, for intervention. Most surprising to the market, which maybe is what authorities wanted. But we had the yen strengthen and then it reversed some of those declines. We're going to take a look at it now. As you can see, a massive strengthening there to about 158. Began to reverse those declines and then we got another sudden drop just less than a half hour ago. We were back down to 158.50 and again the market is fighting that. We're at 159.56. What is going on today?
Well, the market, the market is clearly very nervous. I mean, will there be intervention? Did the US check prices yesterday? Certainly, at least one press reporter suggested that they may have done. Will that happen again? Now, I think really the timing of this is really quite clear. I mean, the Fed, for instance, a couple of days ago had the result of pushing the dollar low. And that's because, of course, US short-term interest rates went down. And that provided really a perfect opportunity for the Ministry of Finance to come in and intervene because they haven't intervened since late May, despite the fact that dollar yen has been pushing higher. And of course, that was probably because why would they try and intervene in a period of dollar strength when the dollar was pushing higher? But of course, this week it started to go down. So that really did open up a window for them. But the crucial question is, can it sustain? Can dollar yen sustain, at 160 without pushing higher again? And many people in the market were looking at the Bank of Japan, hoping for something hawkish. I would say they were hawkish, but often in these circumstances with respect to the Bank of Japan, it's almost as if the market has made up its mind and the market, it seems, will only wants to see a faster pace of interest rate hikes. And that, of course, was not on offer today because it only hiked interest rates last month.
Yeah, exactly. Now, Ueda at the news conference sounded a little bit more hawkish than perhaps the market originally thought. What is his position on this? Is he waiting to see? Is he concerned about, overdoing things or about getting off the path so well trodden so quickly?
Well, I would say that Ueda has been hawkish for a very long time. If you read his Christmas Day speech, for instance, and in fact, if you go back the last couple of years, there's been a couple of themes there, and that's an aging population means a declining labour pool, and that is inherently hawkish. But of course, if we look back over the last, since October, there's been a number of sort of one-off shocks. You had the LP leadership election, then you had a new prime minister, and then you had a general election in February, and then you had the start of the war. And I think, to be fair to you, you could say, well, all of these events probably slowed down or the pace of interest rate hikes made them more cautious. And that's probably why they didn't hike for 6 months. Now, going forward, can they hike in October? I think they can. And if we look through at some of the rhetoric in today's statement, they're talking about inflation, core inflation, above 2% in the second half of the current fiscal year. They're talking, quite bullishly about inflation. If you look at wages, they think that there is that in place that real good position where you can see wages continuing to be pushed higher. Yen weakness is part of the reasons for the inflationary pressures. Of course, higher oil prices are another reason too. But look at the strength of the Japanese economy. Yes, there's been a moderation because of oil, but there are some good factors in there too.
But this is just it, Jane. Didn't we learn this week that talk is cheap? And if hawkish commentary isn't followed by action, or at least the promise of action, or some kind of transparency, the market just won't accept the talk alone.
I think that's the rut that the Bank of Japan, have found itself in. Talk alone isn't enough. And the market, I think, is caught up really on two things. The first, it thinks that maybe the Bank of Japan is behind the curve. And last year we had US Treasury Secretary indicating just that. And the second is that the market is looking at what the Prime Minister is doing. Now, the market is quite fearful that the Prime Minister could be leaning on the Bank of Japan not to increase interest rates. So there is that fear that that's been coming through. But also the Prime Minister, we know that she's an expansionary fiscal politician, and the market is quite fearful of what's going on in JGB yields, what's happening there, to what extent is that really impacting market sentiment too. So I think what the market needs to see is not just the hawkishness from the Bank of Japan and maybe that interest rate hike coming through in October rather than December, but I think it does need further reassurances on the fiscal front. There is a concern about JGB issuance. There is a concern about the balance sheet of the Bank of Japan. That's come down about 15% since 2024. And I think that really has changed the constitution of who owns JGBs. And it really has, I think, accelerated the weakness of the yen. And, what I would say to that is that there might be lessons there, for Kevin Walsh, at the Fed if he wants to change the balance sheet in the US.
Jane, we're seeing a little bit of dollar strengthening today. What are the longer-term dynamics, given the backup that we've seen in longer-term yields, and just how the press conference was accepted by the market, and what happens in the next few weeks if we get some dissenters and other people coming out and maybe trying to reverse some of this market action or not?
Well, I think the Fed is very interesting. It was this week. And I think, the word credibility comes to mind. Walsh has only been in that position for a very short period of time. And yes, he said that he was inflation fighting, but the market, of course, was doubting him. And you see that both in the long end of US yields going higher, but you see that in the short end as well. So he's really got to assert his inflation credibility, or, inflation needs to moderate further in the US to sort of let him off the hook. And that's, I think, where we are in the US. Now, with respect to the dollar, we still have obviously got the war on. And I think because of the safe haven demand, I don't think the dollar's going to fall very much. But at the same time, if we look at the euro, yes, the euro's risen this week against a weaker dollar. But I don't think the market really wants to build very large euro positions when the war is going on. It's because of the detrimental impact of that to the terms of trade in the eurozone. So I think we're in this period where we might just see some sort of choppy sideways trading for euro dollar.
All right, Jane, we have to leave it there, but thank you so much, Jane Foley of Rabobank, with a cameo, I should say, from Buzzy. All right, two other top stories trending now on the terminal this morning. Leopold Aschenbrenner's Situational Awareness Fund had tried selling some of its stakes in private companies this week to raise cash and meet margin calls. Sources say Aschenbrenner opted not to go through with any sales after reaching a deal with Citadel to offload the bulk of its public equity portfolio. Ukrainian artillery crews are on track to have access to extended-range shells by the end of the summer. The country's defense ministry said in June that it had purchased 15,000 extended-range shells from Denmark without providing details. The high-tech tool could give Kyiv a drastically expanded frontline kill zone. FIFA will proceed with plans to privatize its commercial business. That's despite spreading threats from regional football organizations in Europe, Asia and North America to boycott the World Cup. FIFA issued a statement earlier today maintaining that it was not, quote, selling football. Coming up, a complete disarmament. The Board of Peace says Hamas has agreed to the next phase of the ceasefire with conditions. More on that next. This is Bloomberg.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker Playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
Hello there. Just wanted to say, Primer is back. We've been scouring the frontiers of science and technology to help explain the difference between the next gold rush and whatever this thing is. And in season 2, we're upping the stakes. more danger.
Now that is some high-grade uranium mineralization.
We used to have a stable climate on this Earth. Right now, we do not.
More science.
We're pushing the envelope of technology in multiple directions. Software, hardware, chemistry, physics.
The cable is like very cold.
And more CEOs that can nail the photo shoot.
Hundreds and hundreds of billions of dollars are at stake.
While the problems are economic, the solutions are too.
And yes, we will be talking about AI.
There is a lot of humanoid hype out there.
But our future doesn't run on hype. It runs on innovation. Watch season 2 on all these lovely channels.
Welcome to Bloomberg This Weekend. I'm David Gurray.
I'm Lisa Mateo. And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
This is Bloomberg Brief. I'm Vonnie Quinn in New York. The war between Israel and Hamas potentially inching closer to a longer peace. President Trump announcing on Truth Social that the Board of Peace had reached an agreement for Hamas to disarm. This does come with conditions. It also comes as the administration faces growing pressure on multiple conflicts in the Middle East ahead of the midterms. Joining us now is Bloomberg Government's Jonathan Tamari in Washington. President Trump obviously continuing with these wars as if the public is behind him, as if Congress is behind him, but they're clearly not, Jonathan, are they?
No, and in fact, the public seems to be turning increasingly against President Trump, in large part because of the wars, the costs that people are seeing, prices at grocery stores, prices at gas stations. There's been a series of polls out this week from a wide range of groups, Fox News, CNN, Associated Press, Quinnipiac University. They all have the president's approval rating either at his all-time low or very close to his all-time low. Deep disapproval on the economy, deep disapproval about the Iran war. AP had, I think, something around 1 in 3 Americans only supporting it. And so it's been a very big drag on the president, and it's a drag on Republicans right now as we get much closer to November's elections.
Jonathan, critical minerals are back in the headlines. Trump signing an order on export curbs. I thought we had this taken care of back some time ago.
I think the U.S. thought they did as well, but there's a deal with China, and there's, as our colleagues have reported, there's been a lot of dispute actually between the U.S. and China about whether China is living up to the deal, whether the U.S. has violated terms of the deal, and it's still a major pressure point that we saw China use against the U.S. to kind of fight back against President Trump's first round of tariffs. The tensions are certainly rising around this, around a number of other issues, including AI, about China's involvement in the Iran war potentially. And this is all coming. We know President Xi is coming to the U.S. in September. They had a very friendly meeting, the two presidents, a few months ago, but the tension is rising ahead of this September meeting between the two here in Washington.
Yeah, I mean, the timing is so interesting, Jonathan. Is it manufactured tension in some ways? Are both sides angling for a little bit of leverage for this meeting?
There certainly could be some of that. Both sides certainly wanting to come in with something to push on, to ask for. But I do think the tensions around the rare earths are significant. The U.S. saw that was a major weakness that China was able to exploit during that initial trade fight. So it's a big concern for the Trump administration. And this deal that they think they had, again, they don't believe China is living up to its terms. And so that could be a point of, I think, real tension and real dispute when the two presidents meet again.
All right, Jonathan, thank you so much. We'll monitor developments. Bloomberg Government's Jonathan Tamari with the roundup from Washington, D.C. Amazon and Apple capping off a big week of tech earnings, a massive week, you have to say. Amazon jumping after reporting a 5th straight quarter of cloud revenue growth. Apple, though, slumping, supply shortages hurting its sales forecast there. For more, let's bring in Bloomberg's Neil Campling. I'm not sure the market was really anticipating this, Neil. It's amazing how these companies continue to surprise us quarter after quarter. Let's start with Amazon. you know, the stock has not been rewarded in the last several quarters. It's definitely getting rewarded today. I mean, we know AWS is a success. Why is the market missing this?
Yeah, I think if we look at the actual growth of AWS, Bonnie, the key is that, you know, 37% growth that came in was above street expectations, around 31%. It's an acceleration of growth, the best since 2021, the best in 5 years. So there's relief there that the capex that they're spending is in some respects paying off. If you look at hyperscaler spending on the capex, which obviously is a big deal for many investors, you know, their ratio is far lower than the other hyperscalers. They're about 25% capex to sales basis, whereas, you know, companies that are out there like Oracle is at nearly 100%. So they've been rewarded today, as you mentioned. Stock is only up 2% year to date, so there's some relief for sure.
Yeah, absolutely. No relief though for Apple, and that also surprised the market. The memory cost issue for Tim Cook, he's likening it to the 100-year flood. I mean, that's terrifying, no?
Yeah, it's pretty exceptional phrasing, but of course they are the company with the greatest purchasing power of any company on the planet. So for them to be struggling tells you just how bad the memory crunch is. Unfortunately for us consumers, we're going to be feeling it, I suspect, in much higher ASPs for the iPhones going forward. But yeah, the guide was slightly soft. Don't forget, out of the Mag 7 stocks, again, this one was the best performing company into earnings, best one year to date. So there's a bit of travel and arrive to a degree with the stock, I think.
Yeah, it was the place where you went to hide if you didn't want to take part potentially in the AI trade. Speaking of which, Korea, I have to ask you, 18% for the Kospi, and that's a gain today. It could have been either way, but I'm just, you know, making it clear that we're up 18% for the Kospi. What's going on? I mean, this is not sustainable, is it?
It's a record move today. Obviously, the regulators talked earlier in the week about putting in curbs. Well, they may have put in curbs today for some of the leveraged products, but not the actual, you know, the single stock products. As you say, the volatility is so vast that it's going to put off professional investors, I think, to have that kind of level of volatility. Something needs to be done to try and reduce that volatility further, because it is just probably, you know, the most volatile market as we've seen as a on this trade of AI, but it's a concern for sure.
Yeah, absolutely. I mean, it's been so whippy. You have to wonder if really anyone has made money in this market in Korea. Situational awareness, did that have repercussions around the world or impacts on markets around the world, or is that, you know, just talk? Was it really too small of a situation to actually have that kind of an impact?
I suppose, look, if this fund itself was being levered and they were unwinding these, you know, clearly the news of the last 24 hours, they've probably been unwinding those positions for the last few days. And then it has a knock-on effect into other kind of levered products and levered positioning. So I suspect it was a contributing factor, and then it sort of would have helped to kind of steamroll some of the other momentum factors, because we saw significant dispersion and stock volatility across many companies.
Neil, thank you so much. We need all of your expertise and context on mornings like this. That is Neil Campling there for us. It's big oil's turn now for earnings, with earnings coming out from Exxon and Chevron this morning. Let's get a preview with Bloomberg's Mitchell Furman. So, Mitch, I mean, with the war restarting in earnest, it can't, I mean, obviously that won't have played into this quarter's results most likely, but it's been a good quarter. Is there anywhere we should look for fragilities?
Well, the U.S. majors, Exxon and Chevron, are expected to post their third highest ever quarterly profits. There are, of course, outages in the Middle East. We should hear particularly from Exxon, which has quite a significant presence in the Middle East, and they've lost a lot of production. So we should be hearing an update from them about their outlook for, you know, this current quarter and the rest of the year, which should be quite market sensitive.
And with those companies being so close to the physical market, Mitchell, will we get a better read on how they anticipate pricing to go? I mean, particularly with inventory so low across the world, not just in the United States, but Europe as well.
Yeah, whether we get price predictions or simply a read of the current market remains to be seen. But so far in earnings from Shell, TotalEnergies, we've heard language about kind of the market being difficult to call through the rest of the year, obviously because the oil prices have been so closely driven to headlines and what's coming out of the Trump administration regarding a potential peace deal, but because it's so volatile and the Strait of Hormuz has experienced kind of this open and closed, off and on nature, and then there's the increasing threats through the Red Sea and the Black Sea and exports from Russia, diesel. There's a lot of moving parts, which gives these big oil executives a little bit of pause to actually predict where oil prices are going to go.
Absolutely. We'll be glued to the conference calls to hear any stray comments whatsoever. Mitchell, thank you so much. That's Bloomberg's Mitch Furman there. Coming up, we'll get you set up for your trading day. This is Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television. Bringing you the latest business news wherever and whenever it happens. I'm Scarlett Fu, reporting from America's biggest military shipyard. This is Bloomberg.
This is Bloomberg Brief. I'm Vonnie Quinn in New York. Now a look at what's ahead today. Well, if you made it to Friday, congratulations. You've got some more earnings. Chevron and Exxon reporting quarterly earnings before the bell. More results as well from AbbVie, Colgate and Moderna. Plus, we get data. University of Michigan sentiment data out at 10 a.m. Eastern. Let's take a look at some pre-market movers. Apple, well, that was a real shock for a lot of people, down more than 7% at the pre-market, talking about supply constraints, talking about FX issues, talking about the memory cost issue being like a 100-year flood situation, and that really caught the market off guard. Amazon also caught the market off guard, a fifth straight quarter of gains for AWS, 37% higher in revenue. Tesla, this is an interesting one. The Wall Street Journal is reporting that it's looking at a potential sale of its China business, or at least a separation of it, to pave the way for a possible merger with SpaceX. And this is your macro picture for the day. Could be an update for equities. That's it for Bloomberg Brief.
Now, some people have written that your bank, Revolut, is worth $75 billion. Have you ever thought of taking your organization public?
Well, the way I think about it, we kind of will be ready probably in 2 years' time. But then again, depends on how good the market is.
Since you don't have an IPO, how do people who work for you make some money? Do you make a market for people to sell their shares internally?
Yeah, so we do secondaries every 1 or 2 years when people can sell certain portion of their stocks to external investors.
So you've done secondary sales for your employees, so employees can then get some liquidity. Do you expect before you go public you'll do any more of those, or are you just going to wait till you go public before you liquefy any more stock?
Yeah, I think so. We might do secondaries as well before we do IPO, because we do it every 1 or 2 years, so we might do secondary as well.
All right, well, if anybody wants to sell their shares to me, let me know. And have any investment bankers told you why they're the best to do the IPO for you?
Yeah, obviously every single one is the best.
Everyone is the best. You're not in a rush to do it. You don't need the money.
So we're a bank, and then for the bank it's super important to have trust, and then public companies are trusted more compared to private companies. So that's the reason.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Bersecci in El Ola, Saudi Arabia, and this is Bloomberg.
There's still lots of demand for equities.
Right now, we're in the middle of a good growth cycle.
What we really need to see is continued strong earnings growth.
Once again, we have these broad-based earnings surprises.
Earnings are opinion, cash flow is fact.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Friday, tech stocks bounce. Equity futures pushing higher heading into the weekend as Ken Griffin's Citadel is stepping in to help out a wiped-out hedge fund. South Korean investors are hoping the washout is very much behind us. The Kospi absolutely surging.
It's just amazing to see Samsung up 19%, to see SK Hynix up almost 25%. The bigger story here is, have we seen the leverage really come out of the system in a massive way, whether it's the retail triple levered ETF buyers in South Korea, or whether it was a once erstwhile $45 billion fund investing in tech that has now been whittled down to $10 billion and at the mercy of Ken Griffin. You put it together, people have more confidence that maybe we have reached some of the near-term bottoms.
Well, let's start with the fun. Let's start with situational awareness, and let's talk about the positioning. Long hardware, short software with tons of leverage. And that's been wiped out, cleaned out, and you've had to unwind all that leverage. South Korea is one half of the trade, right? It's long hardware. That's been really struggling. You've got a bounce this morning. Can you say with confidence we've had the washout of positionings when you see the bounce back that severe in the Kospi? And as Guy Johnson said repeatedly earlier this morning over in London, you've got the biggest one-day gain on record in South Korea, and you're still down on the week. South Korea's been really volatile all week.
When you see moves of this magnitude, it's hard to say this is comforting, because typically you want to see a gradual bleed upward. That said, it gives you a sense of what the feeling is right now on the street. Even Lori Calvasina came out and said, right now, you're getting to the point where value is being unlocked. In other words, the sell-off has gone far enough, and the price-to-equity ratios are starting to make more sense. So you have that fundamental story. As to the technical story, unclear, because when you have someone who is younger than 30 who's running $45 billion and is suddenly forced to face a call with the Grim Reaper and say, okay, you're right, here you go, it gives you a sense that maybe there are others out there.
He's still got some massive private market positions that reportedly he tried to offload as well. We'll spend some time on this throughout the programme. We'll spend some time on this too. Bring up the bond market and look at 2s, 10s and 30s. And let's just isolate the 30-year piece of the curve, and we'll look at this yield together. 520, yields down a single basis point. Do you know what we've done on the week on 30s? Just a bit of perspective. Yields are higher by 4 basis points on a 30-year yield. After a massive freak out at the Federal Reserve, a lack of guidance, a lack of clarity, a credibility test for the Federal Reserve, it's a move of 4 basis points.
Yeah, and I was actually looking back and I was going to say, oh my goodness, this is the biggest widening in yields in 30 years going back to, and it's like a couple months. I mean, it was like much more before. It was only up some 25 basis points in the past month. So to your point, we haven't seen as much of a freak out in the actual numbers as we have among some media commentators who freaked out.
I'm not saying there's space to be concerned. I certainly wouldn't say he did a tremendous job on Wednesday. I'm not going to try and say that.
This market's just sort of
just saying a bit of perspective.
Yeah,
you know,
exactly.
helpful into the weekend, just a bit of calm. 30s right now, 520, 10s at 467. Coming up this hour, we'll catch up with Dan Greenhouse of Solis Alternative Asset Management as equities bounce. Tom Fordy of Maxim Group as investors reward Amazon and punish Apple following quarterly earnings. Plus, we'll catch up with Terry Wiseman of Macquarie as Japan stages a big yen intervention. We begin this hour with tech stocks adding to gains following strong earnings from Amazon, building on Microsoft's record one-day value gain. Dan Greenhouse of Solis writing the following. The economy is doing well and earnings season is going great. It is the macro that seems to be confounding investors. Dan joins us now for more. Dan, welcome to the programme. Every time we get earnings from MasterCard and Visa, I think of you, buddy, and I think of the economy that seems to be doing OK. Dan, is there a decent argument just to sit here going into the weekend and say things are all right?
I think things are definitely all right, and it's thank you for thinking of me. But it's not just MasterCard and Visa; it's Brunswick. It's a whole host of other companies, American Express, another card company. It's Corning and a whole host of companies in the tech space that are talking about demand. It's Hilton and some of the hotels. I'm trying to find some corporate commentary that says things are not great. And the best you can find is that a couple of companies here or there say things are flat. That's pretty good to me. So, yeah, I think going into the weekend, you have to feel pretty good about what earnings season has done, even outside of AI. But as my quote says, the commentary from the Federal Reserve obviously has given a lot of people some indigestion.
We are learning something about price, positioning and leverage. Dan, what have you learned about price, positioning and leverage over the last few weeks?
I don't think I've learned something, but the idea that it's easy to run a $20 billion hedge fund has probably, again, been challenged. Listen, I don't want to comment on the specifics of the situation since obviously I don't know them, but running money is about more than just being levered long something that's in a bull market. It takes patience and diligence, and it's called a hedge fund for a reason. And apparently right now there's a washout. This happens from time to time. We've all seen it in our careers. I don't know whether it's over or not, but the action certainly feels like the worst of it may be behind us.
But there's a larger question here, and what John's getting at is how much leverage is still in the system and needs to get washed out, right? I mean, in other words, is this emblematic of a whole host of other funds or other types of activity that replicate this in a time where some people have gotten used to markets only going in one direction?
Yeah, listen, some of these charts are obnoxiously vertical. You guys talk about it, we've talked about it. And a lot of them have corrected, and I imagine there's a lot of people who run smaller amounts of money, so they don't make it into the journal, let's say, who are being, as we say, scientifically blown up. And I imagine there's a bunch of them on the smaller side of things. I have no way to quantify that. You can bring on someone from the prime desks, from the big banks, and they'll have more color than I do. But it shouldn't be surprising. On the way up, we all talked about that this was unsustainable. We would pull up charts of SanDisk and AMD and Micron, et cetera, et cetera. And I would say you don't need a PhD, you don't need to be a technician to look at these charts and know that it's not going to continue. And obviously that has, to some degree, stopped over the last couple of weeks. I would just say, getting back to my point about corporate commentary, again, when you read through what these companies are actually saying from Google on down, there's no cessation of demand. You haven't really seen anyone talk about any equation between supply and demand. It's all, we're still going full bore here. So I think from a cycle standpoint, you still have to be encouraged by what's going on.
Do you think the pendulum is still squarely on the equity markets for relative value right now, given how much yields have backed up, even in a pretty good time for consumer credit?
Yeah, well, we've talked about this in the past. I think, and to turn this to the Federal Reserve for a second, we're all, including Chair Warsh, are trying to figure out why yields are going up. And obviously there was I think John called it a freak out after the press conference. So I think that we all don't really know why yields are going up, and we're trying to figure it out here. And I think that speaks a lot to what happened the other day.
Do you think it's fair to say he's part of the reason yields are now going up, Dan?
Well, sure, yeah, it's undeniable he's part of the reason that yields are going up. I think to have fun and be a contrarian for a second here, I understand what he's trying to say, maybe to a better degree, or maybe I heard something other people didn't hear. I heard he was too vague at points, fair, but I heard a guy saying we need to make sure that we're measuring this stuff right. We need to make sure that we understand why it's going up and whether or not interest rates are the correct way to combat the rise in inflation if it's going up according to whatever new way we might measure it. And I think I heard a guy just repeatedly ask for patience, and the market obviously does not want to give him any.
Is there some sort of 4D chess going on with what's going on with the press conference, what we saw in yields, and then the New York Fed doing a rate check for the Bank of Japan as there was some intervention over there? I'm just wondering if there's correlation or any kind of relationship between any of these events.
As a general rule, I don't think anyone is ever playing 4D chess. So I would say no to that. I think we're going through a transition here where the new chairman of the Federal Reserve is trying to move away from what he believes is an era where the Fed provided too much information to an era where perhaps the market has decided the Fed is providing not enough information. And that transition is coming with volatility, completely unsurprisingly. That process is going to go on for a little bit. I don't know what the outcome is going to be. I don't know who's going to win that debate, quote unquote. But I think that's really all that's going on here. I don't think there's any new spike in underlying demand that would push up inflation. Obviously, oil prices are volatile, up $4 one day, down $5 the next day. And I think, again, we're just trying to figure out why inflation is going up. And more importantly, again, he said this, are interest rates the best tool, the only tool to combat what's going on? And again, I just heard a guy asking for some patience while he figures it out.
Dan, I had that question too on the balance sheet, which is what you're alluding to. And I think this is important. If you have a Fed chair that is refusing to articulate a reaction function and in some ways communicating he's not in a rush to hike interest rates or use that tool at all, if I'm in the market right now and I'm thinking, where is there flexibility to express a view across the curve right now? The last place I'd do it is the front end of the curve, because that's where the Fed can actually anchor things. So if you've got a guy suffering from inertia, I don't know, describe it, characterize it, however which way you want to, that 2 years going to remain anchored somewhere close to the policy rate. It's about 50 basis points away. The flexibility is further out along the curve, which is how the market expressed the view on Wednesday to push yields higher. So, Dan, I think we can sort of think about the yield curve that way. That's where the flexibility is. That's where I can push this market round just a little bit. So, Dan, we've got to think about, OK, what do higher long-end yields mean to markets cross-asset if front-end rates will remain anchored? Now, one way of expressing that cross-asset is to go short the US dollar. We saw that on Wednesday. I just wonder what it means to you, Dan, if that's just a base case assumption for the next several months.
So getting back, I said a couple of times we're trying to figure out, I kept saying why inflation is going up, but the answer tangentially is why yields are going up. As an investor, in credit, obviously you care about spread, and in equity you care about relative value, among other things. So one thing we've all discussed is how much is the demand for capital from the hyperscalers and from tech in general, and is that pushing up yields, et cetera, et cetera. If something like that is what's going on, then that's more or less a positive. And I think it speaks to, despite the freak out that's happened at the very long end of the curve with the 30-year, let's say, but even the 10-year at 470 is at elevated levels, you still have the S&P basically at highs. It's up 9% for the year, give or take. Half the index is up more than the headline, which is about what you would expect. It's not as if it's top heavy and AMD and Micron are doing all the work. So you have half the index up more. So broadly speaking, the economy thus far and the market thus far is doing kind of what you would hope, even with this backup in yield. So in terms of I as an investor, or we as an investor class, how do we think about it? If what's going on here is the economy is doing fine, earnings are doing fine, and again, virtually every company is bearing that out, then I'm far less concerned about the backup in yields, assuming it's orderly.
Dan, appreciate it, buddy. It's good to see you in the studio next time. Dan Greenhouse there, a Solus Alternative Asset Management. Dan, thank you. It's the recipe for higher long-end rates, isn't it? If you take the emphasis off short rates, As a consequence, you're putting the emphasis on long rates. If you're flirting with balance sheet reduction at the same time against the backdrop of increasing supply absolutely everywhere, that's even more pressure for higher long-end rates.
Yeah, and that's how you're seeing it transmitted through the market. A real question here, though, what is the most effective way to tighten financial conditions? Is it on the long end or is it on the short end? Some people would argue the purest play is on the short end because it takes the leverage out of the system, and it might not be a coincidence that Citadel put out there that they expected the Fed to hike rates this week right before. I mean, well, this is something people have been talking about. Look, I'm not saying that that is actually what happened.
You're just asking.
But I'm just asking.
Of course, many others are too. 425 on twos, 10s around 467, 30s of 520. With an update on news worldwide with your Bloomberg brief, Vonnie Quinn has more. Hey, Vonnie.
Good morning, John. The Kospi surging by a record 18%, driven in large part by the chip makers. SK Hynix rallying by the 30% limit, and Samsung up 27% intraday. Bullish reports on the AI build-out overseas. Regulatory support from the South Korean government among drivers of today's rally. Microsoft soaring 16% in Thursday's trading for its best one-day performance in 18 years following strong earnings. The company adding nearly $500 billion to its cap, the most by any stock in any single day. The Spanish government ordering troops to one of its two North African enclaves after a recent surge in illegal immigrants. The migration crisis risks a flare-up in tensions with leaders across Europe. Italy's Prime Minister, Giorgia Meloni, threatening to impose travel restrictions on Spain. And that is your Bloomberg brief. John.
Vonnie, thank you. Watch this space. That is a major, major point of tension for Europe right now. Up next on the programme, we've got a breakthrough in Gaza.
The war in Gaza, which proceeds at a very low level, it's just about there.
The war in Gaza is over. It's over. There are little flames. Hamas has been, I think they're going to give up their weapons.
Up next, General Robert Walsh of Academy Securities, live from New York City this morning. Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals. Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Mike Worth, Chevron, crushed it. Good morning. Stock is up in the pre-market by 1.7%, higher year to date by more than 20, I think 26 percentage points higher. The earnings come in as follow. The biggest quarterly profit we've seen Bramo, since 22.
Yeah, when you take a look at the overall earnings per share in the second quarter of $6.06 versus an estimate of $5.65. Just taking a look at what they're doing with some of this profitability, they're paying down debt. This is fascinating. They're increasing production. They had about a 20% increase in production over the period of time, and it's running its U.S. refineries almost full out with the utilization rate above 97%. So this is a company that is taking this moment to sort of fortify its balance sheet, be prepared for whatever is coming next, but might not have the conviction to go in and do new exploration and drilling, because ultimately it is a cycle. And typically when you get that kind of cycle, prices can come down pretty significantly if they go to heights that we've seen recently.
We've seen this in energy, we've seen it in mining. After the bust of the last decade or so, in both asset classes, for both the metals and for oil, I think of the shale patch, of course, more recently for the oil majors, it was a focus away from volume to value. Capital returns over investment. It's not to say they don't make massive investments, they do, but certainly the emphasis has shifted since then. And if you're a company like that, are you going to make a long-term call off a short-term volatile move? That's a difficult call to make.
Which is why they're paying down debt and fortifying their balance sheet. Notably, Chevron shares up 23% so far this year. Sounds really good. Up only 3% since the war in the Middle East started. So a lot of investors have been looking through this and saying, okay, what about the other side? How are you going to grow, et cetera? Right now, they're growing just by simply profitability and their balance sheet getting fortified.
Add a few percentage points to that move this morning, up another 2 in the pre-market. Equity futures shaping up as follows, up by 0.5 on the S&P 500, up by 1 percentage point on the Nasdaq yesterday, a 3% plus gain on the Nasdaq 100, biggest one-day gain we've seen for the year so far, going back to March, which is quite a gain for the Nasdaq because it's been very volatile over that period. On the Russell this morning, up by 0.5. In the bond market, 2s, 10s and 30s shaping up as follows. Someone's got a new mug on the desk. 2s at 425, 10s at 467, 30s at 520. You want to share it with the audience,
I walked in to Yield is Destiny.
Yield is
and
Destiny.
It's not just Yield is Destiny on any mug. It's on an inspirational, spiritual mug.
I like the tone as well.
It gives you a sense of being on vacation.
How quickly did our cameraman Marlon move to get that done?
Marlon, you are an absolute champ.
Pretty impressive, isn't it?
I am inspired, and I plan on going for a walk this morning.
Are you going to, produce some and sell them?
Let's see how today goes.
A little bit of Bramo merch.
A little merch.
I'll take some Bramo merch.
All right, well, we'll see if we can make that happen.
See if we can sell some mugs, not just some bonds. 30-year yields, 520, maybe to some mugs. Anyway, let's turn to the commodity market. Brent WTI shaping up as follows. That was a bad dad joke. Brent crude around 90, we're up by 0.6%. WTI 84, up by 0.5. Under surveillance this morning, a breakthrough in Gaza.
We reached a momentous breakthrough in the Middle East, something that people said was never going to be done. The war in Gaza, which proceeds at a very low level, it's just about there. The war in Gaza is over. It's over. There are little flames. Hamas has been, I think they're going to give up their weapons.
So here's the latest this morning. President Donald Trump saying the Board of Peace reached an agreement to disarm Hamas. Questions remain over the details and the implementation of the deal. With the latest, Tyler Kendall has more. Hey, Tyler.
Hey, John, good morning. Well, if this agreement holds up, it would be incredibly significant for that 20-point peace plan to resolve the conflict in Gaza after months of little progress. But you're right. At this point, it's unclear exactly how this will work. The deal does hinge on Hamas giving up its arms, with a senior Israeli official telling Bloomberg News that Israel is demanding the full demilitarization of the Gaza Strip. That will then kick in a phased plan where Israel will withdraw its forces as well. Now, Hamas, a terrorist group designated by the U.S., has said that it did agree to a deal, but leadership from the group told Al Jazeera in an interview overnight that it's not going to take any steps unless Israel withdraws its forces first. So it appears that there may be a sequencing difference here between the two sides. We'll have to see how it goes from here. U.S. officials are saying that they still need time to refine some of the details, and they're going to give a 200 to 350-day period for it to be implemented, also deploying what's being called an international stabilization force in order to ensure everyone's safety. John, very quickly, of course, any potential resolution has broader implications for the region since Hamas
dangers. But I think the last piece that Tyler added, the piece on Gaza, makes it very significant that the larger Middle East peace plan, the Hamas disarmament agreement, which will take some time, is a big step in that. It's another step in isolating Iran. And what we're seeing throughout the Middle East, more and more of these pieces are coming into place that is isolating Iran more and more. This was a case where the IRGC asked Hamas to delay this decision and not continue with it. And in fact, Hamas went against this and agreed to the disarmament. Now, the devil's in the details, and we'll see where it goes. But this is a step in that direction. And now the larger question is the situation with Iran getting more dangerous. It obviously is, in the sense that we've gone from a phase of really deterrence where ceasefire was in place. We've kind of gone back and forth where these attacks between Iran and the U.S. have been occurring. But now what you're seeing is Iran again using their asymmetric capabilities to try to spread the fight and extend this throughout the region by bringing in the Houthis into it, bringing in the Shia Iraq militias into it, attacking the Saudi Arabia oil fields. So a little bit of a widening going on here, and that's Iran's asymmetric approach, is to try to widen the war, put more pressure on the U.S. and the U.S.'s partners in the region.
General, what do you think the next steps will be for the U.S. and its regional partners as the war does broaden out more significantly?
It's a great question, Lisa. I think the president has a lot of options on the table right now. I think the president's desires to get back to getting a deal. He continues to say that over and over. And you saw where we had this 13-day significant escalation by the U.S. And this was now for the first time, instead of a tit-for-tat approach, the U.S. used a disproportionate approach, where if Iran hit us with 3 missiles, we went back and hit them with, hundreds of attacks on targets throughout the Gulf region, or throughout Iran. But with that, now that what we're seeing is that the president again kind of settled things down, stopped those attacks to see if negotiations could continue. And I think the options he's got now is, one that Admiral Cooper has on the plate is to go much larger and really try to increase the number of attacks more along the ways of what we were doing earlier in the war. But again, really trying to isolate the Strait of Hormuz by attacking, command and control facilities, drone and missile capabilities that can strike the Straits of Hormuz. That would probably be a phase 1 approach. See how that goes. And if you can get Iran to kind of back off and try to, push their will to the point where they want to get back to the negotiating table, get to a ceasefire, that would be a step. If that doesn't work, I think another option on the table is to go really big, and that would be to try to isolate the country itself, to really significantly go after, probably bringing in Israel, go after infrastructure targets throughout the region.
We all hope we can make some progress on the diplomatic front, and it doesn't come to that, sir. General, appreciate your time. Thanks for sharing some of your morning with us. That was General Robert Walsh of Academy Securities. Up next on the program, Tom Forley of Maxim Group, as Apple sinks on supply shortages. That stock is down 7%.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
What's the skill set that you would advise every aspiring CFO to develop?
Psychology.
I think analytical skills are important. Obviously, you need to like the numbers. If you don't like numbers, then don't go into finance. It's sort of like a recipe for disaster if you don't like numbers.
Not only for the CFO, but also the company's management. That's a communication and the collaboration.
I spend a lot of time figuring out how to take the complex and make it simple, and then finding a way to be able to communicate that both internally and externally.
I think it's relationships, whether it's working with investors, bankers, with the senior management team, with the board. Having your head down is one thing as a finance person, but keeping your ears open is super important as well. And I think that all of that is what kind of builds out being a successful CFO.
Watch Chief Future Officer only on Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Gurr.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Stocks this morning positive heading into the weekend on a high note, up by 0.5 on the S&P, up by 1.2 on the Nasdaq 100. The Nasdaq 100 bouncing 3% in yesterday's session, best day since March, following the longest slide on the Nasdaq 100 since October 2022. That's the index level story this morning. Flying in South Korea. That stuff is crazy. We'll spend some time on that later this hour. In the bond market, 2s, 10s and 30s. Things have been crazy here as well. It's nuts. Think about the amount of ink that's been spent dissing Kevin Walsh in the last 48 hours. I'm not saying it wasn't well spent. I'm sure it sold a lot of papers. I'm just saying that the 30-year, the yield has barely budged on a week. We've had a move of like mid-low single digits on a 30-year yield. 520. Yeah. 520 this morning.
He triggered a lot of people, but it didn't actually leave a pretty big scar on the market, at least for now. And possibly it's because people are waiting for more information, and after momentarily feeling a very emotional response to this change, and change is tough, and I get that. But, after that, I think people have reset and understood, we still don't know a lot, and I guess we have to be patient.
You're not giving yourself enough credit. This is not about change. I know, and I've worked with you for a decade plus. You're not pro-establishment. You're open to change. You're open-minded about all of this, going through the process. You're certainly not afraid of volatility. I know you welcome it. This isn't about any of that.
No.
This is about the tone. It's about how patronizing the news conference was for people who have followed so many of these issues for a long, long time. He sounded like a man who hasn't worked for 15 years. Stepped into the room and decided that no one else knew anything. That's what the news conference sounded like on Wednesday.
We're going to discuss big issues like what's the cause of inflation? What is the correct measure of some of these metrics? How should we look at it? We've been debating this. I mean, the market's been hashing this out, and frankly, it's been a wonderful family fight, and it's been really enjoyable to cover it. I think that the key question is this a Kevin Walsh that is trying deliberately to mislead or just somehow just gaslight a group of people, or is this somebody who genuinely is exploring these issues and not communicating it properly in a way that actually resonates with people?
Don't know, and we certainly want to give him a chance.
Totally.
Don't know, but that tone's not going to help, that's for sure, on Wednesday. And I think that's what a lot of Wall Street had a problem with. It's not about the market doing the work and the end of the hand-holding. Like, I don't know anyone that's really too bothered about that. In fact, how many people in the market have been sick to death of this Federal Reserve for a long, long time? Yield is destiny.
Yield is destiny, and we have yield. So many bond investors are thrilled.
They've been complaining about it for years.
Financial repression has been death to active managers in the fixed income area. So yes, hallelujah. Do we want the Fed repressing, dynamic markets? Absolutely not. I think it's just a matter of exploring it openly and honestly.
Well said. Okay, let's move on. 3 hours away from the cash open. Let's get you some single names. Some morning movers. Yahara has more. Hey, Yahara.
Hi, John. Apple's safe haven status is taking a hit this morning. Shares down 7.3% after the company issued a disappointing forecast, warning us that the problems we've been talking about repeatedly, higher memory costs, component shortages, will weigh on growth this quarter. Add to that a miss on its high margin services business and China sales, and you get the reaction you're seeing today. Of course, shares had run up more than 20% year to date heading into the report as investors rotated away from those big AI spenders. But this morning, one of those big AI spenders is getting rewarded, and that is Amazon, up nearly 13% in the pre-market because investors got exactly what they wanted, assurance that the company's massive AI investments are paying off, even after it raised CapEx plans from $200 to $220 billion. And that was okay because AWS, the leader in cloud, grew at its fastest pace in nearly 4 years. And we get a bunch of energy earnings out this morning, and the first one is Chevron, which you broke earlier. Shares up 3.25% after the company delivered one of its strongest quarters in years, of course, boosted by higher energy prices. It easily beat expectations, but the story goes beyond that. Chevron also increased production 20%, cut debt by a record $8.4 billion, and boosted share buyback, showing that it's using this period of elevated energy prices to strengthen its business. John?
Yahara, thank you. More from Yahara in the next hour. On our radar this morning, South Korea's Kospi surging, rising by a record 18% in today's session. The rebound fueled by chip heavyweights SK Hynix and Samsung following strong US tech earnings. Elsewhere, Amazon shares soaring, the company reporting a fifth straight quarter of cloud sales growth with a 37% revenue jump for AWS. Apple shares sliding, the tech giant's forecast disappointing as it faces major supply constraints. And finally, Ken Griffin's Citadel snapping up the bulk of hedge funds' situational awareness's AI stock bets. The embattled firm forced to liquidate public equities, selling off a heavy chunk of its portfolio following the recent tech rout.
This is Wall Street cinema. Let's just really play this out. This was at one point reportedly a $45 billion fund led by a 24-year-old AI genius who had graduated college at 19 as valedictorian of Columbia. And he believed that he had the situational awareness of AI and the incredible power that it had. And essentially, they might be right on exactly the direction, but wrong on market activity that takes the experience of one Ken Griffin, who Cliff Astis once said, when he heard him calling to bail him out of something, I heard the Grim Reaper's scythe knocking at my door, and I just kept walking towards the light, and I tried to walk away.
We're learning about the difference between being an impressive thought leader and being a great risk manager. That you can get the trade right, add too much leverage, and things are going great. They're going better, and all of a sudden, and the real lesson here for the hedge fund industry, and Dan Greenhouse was talking about, and he's absolutely right, I couldn't do that job. A lot of people struggle to do that job, and this is an example of struggling to do that job, even though you've got for the year so far, for the bulk of the year, the right trade on. You're long hardware, you're short software, but you added too much leverage and the trade started to go against you, and things have turned really quickly in the space of, what, a month?
Yeah.
That's not much time at all.
So, and I couldn't do it either. I'm here. I mean, honestly, if these people are billionaires and do very well because they are incredibly talented at doing this, it's a perfect analog to this moment. The idea of a 24-year-old idealistic, effective altruism believer coming out, having this gorgeous view, and then having sort of a grizzled pro in the market be able to come out and be like,
this is my turf.
Yeah, no, try again.
I'm not betting against the guy, the 24-year-old.
No, not at all.
I imagine he's still got a great future. He's going to take some big bets and he's going to keep swinging. I have no doubt about that.
Sometimes the people who fail the biggest are the ones who succeed the most.
Yeah, and I think there's some lessons learned from a lot of pain over the years for Ken Griffin and Citadel. We'll turn back to earnings. Let's talk about it. Apple falling in the pre-market as supply shortages cloud the company's forecast. Tom Forey of Maxim Group maintaining a buy rating on the stock with a price target of $350, writing, while the company appears to be managing the situation admirably, it looks like memory inflation is starting to impact margins. Tom joins us now for more. Tom, welcome to the programme. Is that another way of saying we've reached the limits of consumer price tolerance and that they can't put up prices anymore?
Sure. So thank you, Jonathan. So Apple did talk about its willingness to raise price to combat inflation, especially in the cost of memory. And I think that the good news is that the company does have the ability to raise price. I think really what happened here is that, to put it about as positively as we can, for 2/3 of their sales, iPhones, Macs, iPads, demand far exceeded supply. And even with Tim Cook's strength in supply chain, he was not able to manage this excessive demand. And now we've got to a point where their inventory needs to be refreshed at materially higher component costs. And that's what I think you're seeing in the margin outlook for the September quarter. And then when you couple in that 250 basis point drag from unfavorable FX, that's what you see in the weak sales guidance for the September quarter.
Tom, given you believe they retain pricing power, the question I'm trying to ask is how concerned should I be over the long term about margins so long as they retain that pricing power?
Yeah, you should not. So I think that I think what we're seeing here is the hyperscalers leading a massive round of CapEx, which is contributing to supply shortages and inflation in component costs. This will resolve itself over time. Apple is still amazing at managing the supply chain. And I would say that this is a short-term issue, but in this case, short-term could be 12 to 18 months, but it'll eventually take care of itself.
Tim Cook talked about the memory cost issue as a 100-year flood in their inability to prepare for it, the idea that nobody can really prepare for it. I just wonder, though, how concerning it is that you saw underperformance in the China business, considering that that was one area of substantial growth going forward.
So underperformance, yes, to the extent that they had growth that was in line with expectations, Lisa. I think what we're seeing, though, is that Tim is handing off a successful China business to John Ternus, to the extent that you now have had 3 consecutive quarters of 15 to 20% top line growth. And prior to that, you had about 3 years of underperformance. And the company is working on, though I do think this is going to take some time, getting that enhanced Siri approved by China regulators. So I think that directionally, he's handing off a strong China business to his successor, John Ternus, who takes over on September 1st.
What's going to be the main product of Apple in, say, 5 years? The John Ternus Apple going forward. Is it still going to be the iPhone? Is it going to be glasses? Is it going to be the watch? Is there some other device that's going to go in our heads that we aren't aware of yet?
On a percent of sales basis, the iPhone certainly seems like that'll be the one. I like your implanted product. I don't know if we're ready to have even an Apple product directly implanted into our brains. But I do think that you also hit on what I would call the low-hanging fruit. I anticipate that they'll come out with smart glasses. As you know, Jonathan, at least I'm wearing my Amazon Echo frames right now. Meta's done very well in that category, and I think that's an opportunity. Foldable iPhones, I think, is another form factor that makes a lot of sense. But I am hopeful and will be closely watching if John Ternus can, mimic Steve Jobs or, channel his inner Steve Jobs and come up with that device that we don't know about yet or haven't really thought about. That'll be a next great consumer electronics device. And that's something I'll be monitoring closely.
Tom, in the meantime, what are your thoughts about how we pay for that device? If you go to, say, a telecom communications company in this country, you can walk into an AT&T or Verizon, they'll give you a good deal. In some cases, they'll just give you the phone. And you won't really be able to identify how much you've paid for that unit. What about the lease program? What does it mean for the outlook for unit sales growth?
So I was thinking about the lease program. And Jonathan, really, it's already a lease program in some regards, to the extent that you have consumers, as you pointed out, either getting very significant subsidies for their carrier or already paying essentially a monthly bill, in this case to their carrier, to have an iPhone for an extended period of time with the expectation that they'll trade in that iPhone for the next generation one. So I'd say they almost have like a de facto lease program. The difference, I think, that I learned yesterday is at this point in time, it's only in the US. And this point in time, it's only through the retail channel, meaning the Apple stores. So maybe to the extent that this drives incremental revenue iPhone sales through the Apple stores, that could be incrementally beneficial. But I would say that they've had a de facto lease program in place for some time.
That makes sense. Tom, appreciate it. Thank you, sir. Tom Forty there of Maxim Group. On Apple, that stock is down this morning by some 7% in the pre-market. It was up big time into this, largely because it wasn't a hyperscaler, and now you start to think about the growth. He says you shouldn't worry about the margins. They've still got pricing power. We'll work through. What does he call it? A once-in-a-century flood over at Apple?
Yeah, a 100-year flood in terms of just the memory cost issues. You raise a great question, though, about leasing, because you don't notice that you're paying $200, $300 more if you're leasing something. And a lot of people who have the ability to pay and aren't paycheck to paycheck are fine with that, especially for a luxury device. And that's one way to lift margins and keep them there.
Not new, though. It's been a story for a long time with that company, to Tom's point. The Nasdaq this morning up by 1.2% on the Nasdaq 100. With an update on news worldwide with your Bloomberg Brief, Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. Exxon reporting second quarter earnings that just missed analyst estimates. The company saying it had the highest upstream production in more than 2 decades, excluding the Middle East disruptions. China's DeepSeek is planning a massive AI data center in Inner Mongolia. Sources telling us here at Bloomberg the facility will add 1 gigawatt worth of compute. DeepSeek is pushing to bring at least part of its data center's capacity online by the next year or early 2028. Tesla reportedly considering the sale of its China unit. The Wall Street Journal is reporting Elon Musk is weighing that sale ahead of a potential SpaceX merger. Musk saying on X, though, that the report is fake news, while a company representative called it false information. And that is your Bloomberg Brief. John.
Right before it happens. Vonnie, thank you.
Always.
I'm tracking that reporting and, of course, the company's reaction to it as well. Just logically taking a step back, whatever you believe is and isn't happening right now. Let's just take what they're saying as sort of the base case assumption. Tesla's right, I'm listening to that statement, okay. But doesn't it make sense intuitively that that is what you would do if that's what you wanted to do down the road?
If you want to have a company that's integral in artificial intelligence as well as telecommunications and all things satellites, you probably want to isolate it from China as much as possible, especially because the Tesla business is so integral to the Chinese ecosystem of electric vehicles.
Just some of that is going to be very difficult to unpack, I'm sure. Up next on the programme, we'll talk about Japan propping up the Japanese yen.
The Japanese yen seems very undervalued to me. The currency is very cheap. The economy is doing well at a point that the market will realize the yen is undervalued and should strengthen.
Why is it in America's interest to support the Japanese yen? We'll have that conversation next. Terry Wiseman of Macquarie, live from New York City. You're watching Bloomberg Surveillance.
My old mentor, Roger Staubach, who told me when I transitioned, football will never leave you, but you need to leave it.
Wow.
Everyone has a dream, and a lot of dreams are, you know, my dream is to play football and play professional football, and you get the dream comes true, but it is going to end. And the day it ends, the day before it ends, you're one of the best in the world. Great. The next day you wake up, that's gone. What are you great at? And the truth is, nothing, right? I'm not great at anything else.
I talk about it all the time, Steve, is this whole idea of it's not from penthouse to penthouse. And what I mean by that is you played for 15, 20 years and you're in the penthouse. That doesn't mean that you come to the business world and you're going to be in the penthouse. Now, you don't start in the third floor or the lobby. You actually have to start in the basement.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech. Every weekday, only on Bloomberg Television.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Stocks bouncing into the weekend. The bounce continues, adding to yesterday's gains. Futures higher by 0.5% on the S&P. We'll round it up on the Nasdaq, up by 1.2. In the bond market, 2s, 10s and 30s, things have settled down. 2s unchanged around 425. 10s around 467. 30s around 520. Under surveillance this morning, propping up the Japanese yen.
The Japanese yen seemed very undervalued to me. The currency is very cheap. The economy is doing well. The prime minister is very popular and enacting very strong policies. And I think we're going to see the fundamentals come through. At a point that the market will realize the yen is undervalued and should strengthen.
So here's the latest this morning. The Bank of Japan keeping rates on hold after reportedly intervening in the FX market. The Trump administration adding to support the yen. A market participant telling us here at Bloomberg, U.S. officials conducted a rate check ahead of the BOJ's rate decision. Terry Wiseman of Macquarie joins us now for more. Terry, good morning. Good to see you.
Good morning, John.
Can we start here? Why is it in America's interest to support Japan as they face this problem? I won't say crisis, but certainly growing problem.
Yeah, I mean, this is a great question. You would think that a market-oriented White House, a market-oriented government would let the market settle where it wants exchange rates to be. But this is not the White House that we have been dealing with for the last year and a half. This is a White House that sees, I think to some extent, conspiracies around the world. And when it sees a foreign currency depreciating a lot, it feels that the United States is being slighted, or manufacturers are being slighted. We've seen that with China. We've seen it with Korea in the past, and the comments the White House has made. There is this issue and this feeling that weak currencies abroad are detrimental for our workers. To some extent, that is true. And I think this White House has their interest in mind to some extent, for political reasons, mind you, and it has to demonstrate that it's not going to let competitiveness in the U.S. Erode indefinitely. So that's the interest that the U.S., I think, has. It's political, it's domestic, but it's an interest nonetheless.
Japan has a solution. We were talking about it. The BOJ can hike. The BOJ chose not to. I'm trying to understand why they keep choosing not to.
Yeah, well, first of all, the hikes that they've done in the past 2 years have not really helped the yen situation. Let's keep that in mind. They have been hiking, and yet the market has been speculating against the yen, against the yen, against the yen for the last 2 years, to the point that we got to dollar yen at 165. So you could say, yes, they could have hiked as a solution to this. I know they didn't. But it's not clear that that would have helped by itself. I think the proper solution here might have, or at least the solution they fell upon, was to have the MOF, the Ministry of Finance, do the intervention, and then have the BOJ come out, not hike, because I think that would have been too much of a shock to the market. Remember, there are too many traders out there who are short the yen and using that short position to finance other currencies, and you would have caused a lot of volatility by a sudden unwinding, a shock unwinding of those positions. But to at least to prepare the market for a hike that's coming, I think this is proper. So we used to think, you go back a month, the market thought that the BOJ was going to hike in December. And then there was rumors in the last week and a half that said they were going to accelerate that hike. And then people started to think it was going to be October. Now it seems like it's going to be September. And the emergency, if there is one, is that the dollar yen pressed to 165. Importers in Japan were getting hurt. Takaichi's popularity ratings were falling over the last 6 weeks, in part because of the cost of living issue in Japan, which had been highlighted by the press. And at that point, the MOF, which is an arm of the government, decided it needed to do something.
Maybe this is a step too far, but I'm wondering if there's a bigger takeaway from some of the central bank events this week, and that is that a lot of these central bankers are leaning on the long end to do the work, and they seem deeply reluctant to make a move on the front end as quickly as some people are suggesting might be necessary, and allowing yields maybe to go where they naturally would otherwise go. What do you make of this?
Well, so there's definitely a debate in the market as to how to interpret the backup in yields at the long end. Not everyone believes that it has something to do with long-term inflation expectations. A lot of people out there believe that it has to do with the fact that governments around the world, government borrowers, sovereign borrowers, have just a lot of debt, and it's long. It's way about time that we started to price that in properly, and the market is driving yields higher to reflect that sovereign credit issue, that debt sustainability issue. There's another view out there that really talks about inflation as the problem, and the fact that the central banks have not been quick enough to address the inflation issue. I think that probably is more the issue in the U.S. than it is in Japan. Of course, we have a Federal Reserve that has not, in the past week, gotten around to signaling strongly that it wants to address that inflation issue. And as a result, you saw yields back up further on Wednesday. That's a problem too. But at a core of the issue is this debate. Are long yields going up because of government debt, or are they going up because inflation expectations over the long term have been going up?
And where do you stand on that?
It could very well be a combination of both. We don't have to fall on one side or the issue, and it may be country specific. In the U.S., you don't see inflation break-evens rising that much, but you do see survey-based inflation going up, and the Fed has cited that as well. And certainly, a lot of people at the Fed have cited that. I would say that in the U.S., it's clearly more of an inflation issue than it is a debt issue or a debt sustainability issue. In Japan, it might be more of a debt sustainability issue.
Everyone's sharing their movie review. What was your review of the news conference on Wednesday?
Oh, absolutely terrible. I mean, we were giggling on the desk.
Were you really?
Yeah, absolutely. We did not hold back. I certainly did not hold back in the notes that I read.
What was it that made it so terrible?
Look, there were three potential reasons for why it went as badly as it did. I'll review them, really quickly here. One of them is that, Chairman Warsh is really a dove at heart. I mean, he's a structural dove. He got the job for that reason. And all of this is just a veiled way of delaying the rate hike, right? And the way you do it is you just talk and talk and talk until you exasperate everyone or get them, confused enough so that maybe they don't pressure you to hike. That has not worked that well with respect to the other members of the committee. They have coming out before the blackout period and basically telling you that it's time to hike. And you saw that with respect to the dissent. The second theory is that he's just over-intellectualizing the whole thing, right? Sometimes, let's admit, too much brain power is counterproductive, right? It just is. And, but the problem, of course, is that this is the Federal Reserve. And the Federal Reserve has to confront crises from time to time, not just high inflation. You don't want Hamlet at the head of the Fed when there's a crisis, okay? But this is a second theory, that there's just too much brain power at work here. The third theory is he just doesn't trust anyone, right? And that's revealed by the fact that he needs these task forces to tell him what the inflation framework should be and how the Fed should address it. My view is, what the heck are all those 200 economists doing on the staff of the Fed? What is the FOMC supposed to do? Aren't they your task force? And this lack of trust was revealed, I think, in the presser the other day, because he said, when he was asked about who was on this task force, he said, these are people I've known for a long time.
Yeah.
Well, does that mean they're your friends? And what's the point? I mean, isn't the task force supposed to be independent? Isn't it supposed to give you an objective opinion? I would have rather heard him say, these are not my friends. These are people I've never heard of. Right? That makes more sense.
We should have started here and not done
Anyway, those are my three theories. I tend to fall on, along the view that he's a structural dove, and this is the reason why this has happened.
Terry, appreciate it.
My pleasure.
Thank you. Terry Wiseman there of Macquarie. Up next on the programme, Victoria Fernandez of Crossmark, Dilip Singh of PGIM, Lake Chu of AllianceBernstein, and the Ares CEO, Mike Arougheti.
The global economic playbook is being rewritten, and the levers of power are moving in real time.
To see where the world is headed, you have to look where the action is.
I'm Haslinda Amin in Singapore.
I'm Menika Doshi in Mumbai.
Welcome to Emerging the New Economy podcast.
Each month, we dive deep into how the world's most exciting rising economies are shaping the global future.
Join the conversation. Subscribe to Emerging on your favorite podcast platform today.
Do you mind being called an ideological lunatic or a bunch of left-wing nut jobs?
I've been called worse things than that.
Oh! You'd think she owned the place.
23andMe, I think, is so incredibly valuable. We're coming back.
It had that kind of detective story feel to it. When you're hot on the trail of something, you know that it's very exciting.
What magazines were you reading as a kid?
I don't think I was reading magazines until I was in them.
You are on the cover of all of these.
Oh, and there's many, many more, but we just don't have time.
Why should people trust you?
I don't think anybody should trust any company or entity completely with any of this.
It's very uncomfortable. Artificial intelligence is this force that is far bigger than we are.
I want to build better businesses around these brands.
The shock will never wear off.
So you're a brother and sister running one of the most powerful companies in the world. When you argue, who wins?
No one. The way I could see AI being banned or blocked is if something really went wrong. And if something really went wrong, then maybe it deserves to be.
So is it paradise ahead or Gattaca?
Maybe somewhere in the middle.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors.
We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
The rest of the market cannot play the ball without knowing how the Fed might play the ball.
Some real anger at the long end of the curve.
If yields rise too much, it's going to break something.
This has become a lot more about credibility than actually bringing inflation down.
I think we'll get to a good equilibrium eventually.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your price action scores look like this. Equity futures adding to yesterday's gains. We're positive by 0.5 on the S&P. On the Nasdaq, the biggest one-day gain since March. We add to it by 1.2% on the Nasdaq 100. On steroids, that was the rally over in South Korea earlier on today. Check it out. The Kospi, not a typo, up 18% on the session. The session. This is intraday. Not month to date, year to date. Samsung up by 21%, SK Hynix up by 26%. And even with that move on the Kospi, it's just unreal. We're down on the week in South Korea.
So is this enough to give people confidence, or is this just more whipsaw volatility? And I ask this in the frame of reference of some sort of washout of leverage. We're seeing that with respect to Korean officials coming out, cracking down on retail leveraged ETFs. We see this with the unwind of a big levered U.S. fund tied to technology. And there's a question here. Are we seeing some of the bottoms because of the washout here? Or does this just indicate how much is left in the system?
So it's been a thing for us for what? The last month, the last 2 months. We've learned tons about price and positioning. We've talked about it extensively. Learned lots about leverage in South Korea. Talked about that extensively. I don't think you should overlook the fundamentals, though. We should talk about the fundamentals. How sustainable is the spend? Everyone's still ramping CapEx. Some companies are punished for it. I'm thinking of Tesla. I'm thinking of Alphabet. Others rewarded for it because the gains elsewhere are so good. Thinking this week of, say, Microsoft. But you've started to see something you pointed out very early on last week with Alphabet. They've got negative free cash flow. They're becoming increasingly, I'm not going to say dependent, but increasingly dependent on raising capital from elsewhere to fund this CapEx. And the price of that capital is going one way at the moment. It's going up. You've seen spreads widen in credit, and you're seeing yields climb on treasuries. If that's the direction of travel, more questions will be asked about the ROI and how expensive the spending is becoming.
This is why I find the Amazon move so interesting. They also outperformed with their cloud computing service, the AWS, and that's the reason why their shares are absolutely surging in pre-market trading. They raised their capex to $220 billion from $200, and they were negative cash flow. Free negative cash flow, and that wasn't something they were penalized for. So it's unclear how this story is coming together and how much tolerance there is. You can feel that ambiguity when you speak to fund managers and we speak to people in the industry who say this technology is real. There still is a whole host of infrastructure that needs to get built out. The promise is there. It's just about who the winners and losers are going to be.
You've got to communicate the path with tons of clarity and with decisiveness and show the numbers, the hard numbers, the growth. Probably the difference in the last week between the companies that have done well and the companies that haven't. And Meta is one of the companies on the wrong side of the conversation right now. Within that company is a very profitable business. With that, there can be no debate. We know that. But when you're on a call being indecisive about what that capacity is for, you're not conveying confidence that you know where this is going and you know what the end point is. And that's going to be a problem for a lot of people.
We're out of the dreaming phase. We need the tangible phase. We need the return on investment. We need to see the business path going forward. We need the clarity of vision, because right now, clarity of vision, whether you run one of the biggest tech companies in the world or whether you run the most important central bank in the world, is what gets rewarded in markets.
That's exactly where my mind was going. I was just thinking of one guy.
Of course.
I wasn't talking about tech CEO. I was just thinking of this one guy.
I picked up what you were putting
down. At the Federal
down.
Reserve.
Yeah.
2s, 10s and 30s looks like this in the Treasury market this morning. Treasuries were sold. Credibility was sold. Earlier this week, on the week, things have settled down. We've settled down around 520. And the lack of clarity of this institution is a contributing factor, but not the only one, to high yields. There's a lot going on in fixed income worldwide.
Yeah, with respect to what's going on in Japan, with respect to the fact that every single major government is borrowing money and there is a huge deficit issue. What I'm curious about this morning and in the weeks ahead is how much dissent we get, how powerful some of the dissenting voices on the Fed actually are. Do we see the beginnings of a mutiny being staged where suddenly Kevin Warsh ends up in the minority?
I see some pushback on the horizon, let's put it that way. And we're all looking at the schedule as it builds out with all the Fed speaking, waiting for one name to pop up, and that's Chris Waller, Fed governor. Didn't dissent at this meeting. It was notable that we got no governors dissenting at this meeting, that it was just regional Fed presidents. There's nothing original about that. 3's a big number, I know, but it's the governors on the board. Do you start to see some building daylight between them and the man at the top?
Does Chris Waller become essentially a shadow Fed chair? And ultimately, people are watching his voice as the loudest one in the absence of a concrete voice coming from the top.
Yields up this morning by a single basis point, 2s, 425. Coming up, we'll catch up with Victoria Fernandez of Crossmark with tech rebounding, Dilip Singh of PGIM as investors question so-called Fed credibility, and the Ares CEO, Mike Arrighetti, on the depth of capital markets. We begin this hour with tech stocks rising following the biggest one-day gain since March. Victoria Fernandez of Crossmark writing, earnings continue to reach new heights, even if companies are not always rewarded for it. And it's not just the large-cap stocks. Victoria joins us now for more. Victoria, welcome. We're wrapping up mega-cap earnings season. One more still to go. NVIDIA, a long, long way away. We'll get to that later on in the next month or so. But let's talk about the names we have heard from. What's been the differentiating factor between the companies that rewarded and the companies that were punished?
You know, Jonathan, you mentioned it a few moments ago, and I think it's important. It's the communication that we're getting. So we've seen negative free cash flow from multiple companies. We've seen multiple companies up the CapEx spending that they have and get punished for that. But yet we have Amazon come out and their stock is actually up. And I think it comes down to Andy Jassy on their call was very clear and concise about what they're doing, about the return that they anticipate getting through AWS with the growth that they're seeing there, saying that they see it as a $1 trillion business going forward. So I think he set expectations as to, yes, we're spending this money, but look at the returns that we're getting on it. Here's the goals that we're setting that we see. And we didn't necessarily hear that same narrative from some of the other CEOs. And so I think that's what investors are looking for. Show me exactly what is happening here and how this spending is going to improve the business, and then the stock gets rewarded. And I think that's part of the main difference, because really, all in all, earnings were pretty good across the board.
Communication should be easier to fix than a bad business model. Now, Victoria, if you've been punished because of bad communication, is there an opportunity to buy some of those names? Because underlying that is a decent business model.
Absolutely. I think there is. And I'm hoping a lot of people went in and bought Microsoft when it was down. We talked about that before, that's a great long-term holding to have in the portfolio. And I think you can be very tactical right now. There's not a lot of high correlation in sectors once you move outside of energy and utilities. So some of these names that are getting hit for reasons that maybe are something that's simple to fix, I think you can go in, you can be tactical, you can add to some of those positions. You're not maybe doing like a full position in there, but you want to add a little bit here and there as the market moves, because as we know, each day it's either up or down. I think you can go in and do some changes there that can be beneficial to the portfolio.
Victoria, just to sort of underscore what you're saying, is this essentially a market of stocks that all look pretty great and pretty successful, that are probably going to end the year somewhat higher, and that you're just essentially tactically trading within them as they sell off for various reasons?
I think that's part of the story here, especially when you're looking at tech, when you're looking at the semi names, these chip names, when you're looking at some of the memory names. There's so much volatility under the surface. I mean, you look at the VIX and we had an 18 handle yesterday on the VIX, but underneath the surface, there's so much movement going on. I do think you can go in there and have those tactical plays right now. Do they end the year higher than where they are? Probably, as long as we see earnings continue to hold up and that communication gets better, where shareholders feel confident about where that spending is going and what that return is going to be.
Late last year, I was talking to a number of credit investors who said the best way to play tech was to invest in their equity and avoid the credit, because ultimately you are taking down the downside and none of the upside. Has that equation shifted? Possibly as borrowing costs go higher, as yield is destiny and destiny looks a little brighter for all those fixed income investors. Do you see the pendulum shifting in the risk reward to bonds?
I think it depends why you're investing in fixed income. If you are going into fixed income because you just want to have that steady cash flow coming out of there and you feel confident that these companies can meet their principal and their interest payments, then why not go ahead and put some exposure in your portfolio to some of those longer dated tech names in the bond market? That makes perfect sense. But if you're going in and you're trading it more opportunistically, then you have to look at what's happening to CDS spreads. I mean, we went on some of these hyperscaler names, CDS going from around 150, 160 out to like 240, 250, huge changes in CDS spread. So if you're looking day to day at market value on fixed income, then I don't think it's where you want to be. That's going to give you a little bit of indigestion. But if you're just looking to get some cash flow, then these higher yields that you're seeing can be good for your portfolio.
Victoria, good to see you, as always. Thanks for jumping on. Victoria Fernandez there of Crossmark. On this market right now, Torsten's Lock of Apollo just published in moments ago. Higher for longer continues. Why are rates so high, the highest in 20 years? We're talking about the long end of the curve. He offers 3 reasons, and he doesn't mention Kevin Walsh. Inflation, fiscal problems, hyperscaler issuance. The bottom line, we're not going back to the 2010s. It's good news for everyone cutting coupons in high-quality fixed income.
Yield is destiny. And
that was teeing you up for it, I know.
But it's true. If you want to clip coupons, well, this is a great time to do it, because your coupons look pretty darn good, especially for high-quality debt. Key question here, the inflation side of things is mentioning Kevin Walsh without mentioning Kevin Walsh. Is it essentially allowing inflation to run hotter for a longer period of time as a result of avoiding any kind of rate hike? The fiscal problems, everyone keeps mentioning, but no one keeps delving into it. People are worried about the deficit. It's not just me. And the hyperscaler issuance, that is going to be the key, especially as these spending ambitions continue to ramp up.
You need to mass produce those mugs. You know that, right?
Evidently.
I think they would sell. I really do.
I love this. This is absolutely
trading
fantastic.
Floors everywhere.
Yield is destiny.
Without a doubt.
It'll be for all the fixed income investors out there.
Think of a price, all right? Prices are going up. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. $5, $10, $10, 15.
$10?
Bonnie Quinn's got more. Hey, Bonnie.
Hey, guys. Thank you so much. Spanish Prime Minister Pedro Sanchez saying the country suffered a, quote, territorial attack. This after hundreds of migrants breached the border fences from Morocco yesterday. European Commission President Ursula von der Leyen reacting, posting on X, saying, "We cannot allow anyone to come to our union without abiding by our rules." Anthropic says its AI models breached 3 organizations during recent cybersecurity tests. In a blog post, Anthropic said it found 3 instances in which its Claude AI tool accessed the internet and then hacked into external organizations. Momentum building against FIFA's plan to bring private investment into the World Cup and other football tournaments. Sources telling us here at Bloomberg, Real Madrid and Juventus are the latest European clubs to oppose the idea. FIFA maintaining, quote, "Nobody is selling football."
And that is your Bloomberg Brief. John.
Vonnie, thank you. That's the central question in all of this. Who owns the sport and who takes the risks? I was just reading the story from Rodrigo Orihuela, our colleague here at Bloomberg, on why Juventus, Real Madrid and all these clubs are starting to push back. They own the player rights, they fund the salaries, they absorb the risks associated with any injuries when they go to play at these tournaments.
They have a real vested interest in controlling some of this. Also, how much animosity, UEFA and FIFA, given the fact that FIFA has really kind of overplayed its hand in a lot of ways.
It's a sad day for football. Can I tell you why it's actually a sad day for football?
Please.
Will you give me a little bit of space?
Always.
The legendary defence of AC Milan in the late 80s, 1990s, Maldini, Costa Curta, Tassotti were led by a guy called Franco Baresi, the greatest defender that ever lived, and he passed away in the last 24 hours. So we wish him and his family and all of his friends the very best. A sad, sad day for Italian football. When everyone talks about Maldini being the greatest defender of all time, he had a teacher, and that was Franco Baresi. And Baresi, from my childhood, just total legend. Yeah. Total legend.
Thank you for sharing that with us.
Anytime, like, it means something to me and my childhood.
I love experiencing
to Milan
your
fans
through.
To Milan fans around the world. All right. Up next on the programme, the Fed under fire.
The Fed is not the referee in this. The Fed is a player on the field. The rest of the market cannot play the ball without knowing how the Fed might play the ball.
No more football. Up next, the former US Deputy National Security Advisor, Dileep Singh, live from New York City this morning. Good morning.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo. And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas.
Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine. Watch, listen, stream.
Stocks bouncing back. We're positive by 0.4 on the S&P. We're up by 1.2 on the Nasdaq, heading towards the weekend with another day of gains on the cards, following a really, really big day of gains on the Nasdaq yesterday, the best day of gains in some 5 months or so. If you turn to the bond market, 2s, 10s and 30s, yields have been creeping higher through the week, just a little bit, up this morning again by not even a basis point on 10s, around 470. Under surveillance this morning, the Fed under fire.
The Fed is not the referee in this. The referee sets the rules, enforces the rules, is an impartial arbiter, and the referee doesn't care who wins the game. The Fed cares who wins the game. The Fed has goals and objectives in this. The Fed is a player on the field. The rest of the market cannot play the ball without knowing how the Fed might play the ball.
So here's the latest this morning. Investors doubting Fed Chair Kevin Warsh's credibility and commitment to curb inflation as Wall Street puts pressure on the central bank to clarify its direction. Bloomberg's Tyler Kendall has the latest. Hey, Tyler.
Hey, John, good morning. Well, as our analysts at Bloomberg Economics frame, this felt like a warning shot after a press conference that was, quote, poor on operational guidance. And Washington isn't necessarily helping here either after President Trump quickly praised the Fed chair post-decision, claiming that he knows Kevin Warsh would love to see lower rates. Instead, the administration is accusing others on the FOMC of being politically motivated, even as we hear from those more hawkish members that they're focused on the economic fundamentals amid inflation running above target for the past 5 years. NEC Director Kevin Hassett was on Bloomberg Television yesterday and said that he felt that the PCE numbers from this week should make Warsh's job easier, especially amid that downside surprise to the core reading, adding that maybe the markets need, quote, a couple of more prints like it. But John, the issue is that data is particularly stale given the surge in global energy costs due to the tensions in the Middle East. And I'm sure you saw new this morning, a new statement out from the IRGC maintaining that the Strait of Hormuz remains closed.
Tyler Kendall with the latest, that tension building with the Saudis as well. You can see that in the price of crude this morning, back into the 90s on Brent just moments ago. That's contributing to that move in yields. Yields higher by about a basis point now. Let's talk to Dilip Singh, the PGIM Vice Chair and former US Deputy National Security Advisor, writing the following. The market is demonstrably running out of patience. The lasting impact of the July meeting is that it will now cost more to regain credibility than it did before. Dilip joins us now for more. Dilip, welcome. You see this a lot. When you do something so poorly, it takes more to make up for it. Are you suggesting that if they do hike in September, it might not be enough?
No, I think if they move in September and they move big, they'll be back on the right path. And look, I mean, I say this with humility and the utmost respect for the Fed because I've been involved in my share of policy mistakes. But when you spotlight a problem like missing the inflation target for 63 months, you declare your resolve to fix it, and then you spend 8.5 weeks offering neither action nor a strategy to do so, it's not a good look. And you invite a credibility shock that makes your job harder. That's what happened.
Dilip, what was it specifically about the news conference that stood out to you as a mistake that needs fixing?
Well, the problem wasn't the decision itself, okay? It was the absence of a strategy to achieve the mission. Instead of a strategy, we heard a suggestion that the market is doing the Fed's work, that higher nominal yields and real yields can partially substitute for rate hikes. We also heard a comment that, who knows, maybe 2% PCE inflation may no longer be the goalpost after January. And that's why we saw long-end bonds, the dollar, and stocks sell off simultaneously, hard, all at once. That was the problem.
Do you think that they're going to be forced to remedy it? And John asked a question about whether they might be forced to do more in September, the idea of a 50 basis point rate hike being put back on the table possibly, or whether you even get some sort of revolt, mutiny by other Fed officials who vote and you see Kevin Warsh in the minority. How do you see this playing out?
I'd say, Lisa, there are two scenarios from here. One is we get immaculate disinflation. Dovish data validate the Fed's patience, and we're going to get 2 more looks at CPI, 2 jobs reports, 1 PCE. I think that's unlikely, but that's a scenario. The second is that inflation remains high and sticky. That's what I expect to be the case. And in that scenario, either the Fed will have to give forward guidance, maybe at Jackson Hole, that hikes are coming, or it lets the bond vigilantes rage in the streets, and it then restores order belatedly by having to go big in September with 50 bips.
Why do you think, Dilip, that it is better to use the front end of the yield curve to tighten inflation, to bring in inflation, than allowing the long end of the yield curve to do the work?
Well, look, I mean, there is something to the argument. Higher long end yields, they do slow investment. They do dent the wealth effect. So I'm not denying that's the case. But they're not a full substitute. For one, higher long end yields, they may not last. So the 30-year yield can spike by 20 bips and then give it all back on a soft inflation print. A Fed rate hike tends to be more durable. The second problem is long end yields, they just tighten a corner of the economy. Housing, yes. Business investment, yes. Maybe consumer durables. But, as Michael Gapin said, the Fed's policy rate is the entire foundation. It's the risk-free price of overnight money. The entire yield curve is bootstrapped from it. The entire financial system is built on top of it. So it reaches every loan, every funding market, every cash flow producing asset in the economy. And that's why rate policy is considered the more blunt instrument. To borrow from Jeremy Stein, it gets into the cracks in a way that higher long end yields driven by the markets do not.
Lisa, I'd add to it. It's a global market. You're outsourcing monetary policy to Japan, to the BOJ, to Germany, to the bond market, to the hyperscalers, anyone that issues at the long end of the curve. You have so much more control over the short term. You can be intentional about it on short rates. Long end rates, do I want the BOJ or the situation with JGBs on any given day to set monetary policy here in America?
Yeah, although you asked a really good question over the past couple of weeks. Is volatility a feature, not a bug? And how much is the volatility in the short term potentially doing the job of the Fed without them having to raise rates?
I don't mind introducing a bit of two-way risk and volatility. I'm not sure that's even what we're talking about, though, is it? This is about building risk premium for the sake of building risk premium. Like, what are we doing that for? Why are we making it all about the long end of the curve? To your point, it's the right question. They haven't explained that. They've been very vague about that. You need to be intentional about why you're doing these things.
So, Dilip, I would ask you, without that kind of guidance, how confident are you to say yield is destiny, and if my destiny is 520, it looks pretty good?
Well, first of all, I think Robert Titt, my colleague at PGIM, trademarked that phrase a few years ago. He's got it tattooed on his shoulder.
That's true.
But go for it with the mugs. Look, I mean, the long end is the whole ball game right now, and we're having more supply from Washington and sovereigns around the world, more supply from Silicon Valley, less demand from a smaller Fed balance sheet, most likely, and now less faith in the Fed's inflation-fighting resolve. So those are now four tailwinds behind a higher term premium, all blowing the same way. So, I think the Fed is going to be forced. It can either take the easy way and hike on its own and guide that it's going to do so at some point in August, or it'll be forced to do so in September. I think ultimately the Fed will do the right thing. They'll ultimately hike 3 times this year. And my view is that argues for gradually adding in the curve flattener risk over the course of this month.
Dilip, just to come back about the economy, because we haven't talked much about it. This is a market issue. At the moment, do you think there are economic consequences to what's developing?
Developing with the Fed or more generally? I mean,
yields
it's all one
climbing higher
conversation.
because of the Fed. Part of the reason also we're getting the hyperscaler debt we're seeing yields rise at the long end. We're seeing a market that's tolerating that quite well. Risk assets certainly haven't plunged in response to that, and the economy seems to be tolerating it well, at least for now. Do you think there are economic consequences to it?
Always. I mean, higher long end yields are a tightening of financial conditions. They're going to have real economic effects, particularly in housing, particularly in rate-sensitive investment categories, probably not AI CapEx. And it will have a wealth effect. It will slow consumption that's resulting from valuations that depend on lower rates. But I still think if you step back and ask, how is this economy doing? For me, the backdrop is the same. We have hot demand colliding with supply-side constraints. That's what produces high and sticky inflation. And I don't think the move this week changes that story. I mean, we'll look back and see that empirically, demand was acyclical during the AI build-out phase. Hyperscaler CapEx has proven insensitive to the cost of financing. See what Google said earlier this week. And there's a downstream positive wealth effect from the AI ecosystem to consumption. Plus, on top of that, we have loose fiscal policies. We have hot demand. And I think the problem I had with what we heard earlier this week from the Fed is there's a lack of recognition that the supply side shocks, they're not independent, they're not one-offs, they're not mean reverting, they're recurring and compounding.
Yeah.
In the labor market, in the energy sector, in the trade sector, this is all part of a new geoeconomic regime. And all of these forces are net inflationary. The longer it takes for the Fed to recognize that we've had a structural break, the more difficult it will be to regain credibility.
It's the uncomfortable new normal. Dilip, it's good to see you. Dilip Singh there, and our apologies for the trademark infringement as well. I think we got clearance, right?
I was about to say...
Do we have to give them
Robert
royalties
Tip.
now?
What do I have to pay you? Trademark.
10 cents
Robert
a month.
Tip. But still, yield is destiny.
Late Shoe with Lance Bernstein. Up next.
weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Bringing you the most important news and financial information whenever and wherever it happens. I'm Michael McKee on the Mexican border, and this is Bloomberg.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg.
More than what you need to know, it's what you need to think about.
The opening about 2 hours away. Equity futures adding to yesterday's gains. Futures positive by 1/3% on the S&P. Yesterday, the biggest one-day rally since March of this year on the Nasdaq. The Nasdaq snapping a 6-day slide, the longest since October 2022. Microsoft got it done. Wow, what a one-day gain for one of the biggest companies on the planet. The fastest cloud growth in 4 years.
That was rewarded with a $450 billion increase in the market capitalization, a record. When you think about them adding many big companies and the total market cap of those companies in one day, it gives you a sense of how volatile things have been and how much just one day of getting it done can lead to some pretty massive market cap responses.
Things have been pretty volatile in the bond market too, so let's talk about it. The 2-year yield has been down every single day so far this week, with the exception of today. Yields are higher by a single basis point, 426. The 30-year inching higher by just a handful of basis points on the week, despite a massive move on Wednesday, only up just a little bit on the week.
I love Thorsten Slock's note. You were talking about it earlier, saying that it's about inflation. It's about the incredible amount of debt being sold from U.S. and global governments. And it's about the hyperscaler issuance. This is going to be higher for longer. And that's what a lot of people are coming around to. Question is that welcomed or is that a problem for the Federal Reserve? And that question was only widened this week with some of the communication.
Is it by design?
Right.
I think we're all trying to figure that out still. As things stand on the week, yields are higher on the week at the long end of the curve. 5 consecutive weeks of high yields at the long end of the curve. That would be the longest going back to 2023. Let's see. As we count you down to the cash open 2 hours away, let's get you some single names, some morning movers. Yahira has more. Hey, Yahira.
Hi, John. Moderna is out with earnings that were better than expected, yet we are seeing shares sinking 8.3% after results for its norovirus vaccine. Early results for that vaccine were not successful. It marks a big setback for Moderna's most important growth programs as the company looks to build beyond its COVID business. But you can see markets punishing companies that, as you said, not getting it done. But one company that did get it done was Amazon, and you are seeing it being rewarded handsomely this morning, up 11%, because it gave investors exactly what they wanted, proof that its massive AI spending is paying off, even after it raised its capex this year from $200 to $220 billion. But that was okay because AWS, the leader in cloud, delivered, growing at its fastest pace in nearly 4 years. And now that Amazon has joined Microsoft and Alphabet in reinforcing that the AI spending is not slowing down, we are seeing a lift across the chip sector with NVIDIA and Broadcom all higher. The rally is also getting a boost after much of the forced selling tied to Leopold Aschenbrenner's AI-focused hedge fund appears to be over. The fund was heavily invested in chip names and the broader AI sector, so its liquidation created technical selling pressure across the sector, but we are seeing that beginning to ease this morning as well, John.
Such a messy year, Yahara, thank you. Just think about it. They effectively blew up being long hardware and short software. And earlier this year, we had all these worries about private credit because they were all long and private markets because they were all long software. So you've had two blow-ups, essentially, on different sides of the same trade.
Yeah, essentially leverage is a problem if you want to get in on this. The idea that the SaaS led to, what was it, a hardware get-in?
Concentration is the problem, right?
Maybe that's the fair approach.
That's the issue. With leverage on top of that, then you've got a massive problem.
Yeah, and the whipsaw back and forth of what exactly is the correct trade in a time of rapidly changing AI.
Let's get to some of our top stories, shall we? On our radar this morning, Apple disappointing investors after issuing weak guidance tied to surging memory prices and chip shortages. Amazon managing to impress with accelerating cloud sales growth, the company reporting a 37% increase in AWS revenue. Elsewhere, Anthropic announcing its AI models breached 3 unnamed organizations during recent cybersecurity tests. The company discovering the hack after reviewing over 100,000 evaluations. Rival OpenAI making a similar announcement just last week. And finally, Tesla considering a sale of its China business to open the door for a potential merger with SpaceX. The Wall Street Journal reporting some executives have already been told to prepare for the move. Elon Musk, the CEO, denied the report, calling it, quote, fake news.
Either way, and I think you put your finger on this earlier, it is going to be messy for SpaceX to just acquire Tesla without some regulatory safeguards. And this has to do with their huge China presence, which is a significant one for them, one of the largest, second largest market for them, one that has been growing rapidly. They have factories there that produce a lot of parts. That is really the key question. Are they willing to do that? And then how do you get to the valuation that some people have priced in for Tesla as sort of an ancillary unit of SpaceX, which is much larger?
Tesla punished last week for a lot of spending, AI spending remaining intact, with several hyperscalers reaffirming some aggressive capex plans. Amazon, Alphabet, Meta, Microsoft leading the charge, devoting more than $700 billion to spending for this year. Late Chu of AllianceBernstein writing, we have reached an inflection point in AI. Investors should remain selective. Late joins us now for more. Late, good morning. Thanks for being here.
Thank you.
What's changed about this AI trade?
Well, I think, well, where we are is on the exciting front, we've reached an inflection point in inferencing, in adoption. And that's, I think much of the market focus has been on the CapEx side. But let's take a step back and then see what we've seen through this earnings period. What we've also seen is revenue upside, backlog, massive amount of backlog these hyperscalers are delivering. And, a lot of people have been calling the AI being a bubble. In my experience, it's very hard to call something being over when we just reached the rapid adoption phase. So if you ask me what has changed, we've been on the journey and we just reached an inflection point.
Well, let's talk about the companies that are being punished and the ones that are being rewarded. So Alphabet was punished, Microsoft was rewarded. What was the distinction between the two for you?
I suppose it's less so about they're that different as in the timing of it. And this month and this week, we've seen massive volatility in the marketplace. And I think that's one of the issues that we have had. And some of it's technical, some of it is led to, is sort of what you talked about, the leverage in the system at the investor level. And these, in my opinion, when you look at the results, they're fairly similar to some extent. We're seeing revenue acceleration, we're seeing CapEx remain firm, and we're seeing these companies actually really innovatively trying to figure out ways to lower their cost base as well. So I think in general, results were similar. It was just more, which day of the week did they report, and where were we sitting in the middle of a massive sell-off.
So to John's point earlier when he was talking about how it was the SaaScopolis early in the year and then suddenly it was the hardware names, the chip names selling off, how much do you see that narrative kind of continuing to oscillate between the two as people keep investing in the hardware and the infrastructure? That seems to be a feature of this entire cycle that has to keep going.
At this point, I mean, we've seen it even from Apple's results, which has been phenomenal in terms of supply chain management. When they're talking about component shortages and when they're talking about pricing increase at the chips level, at the memory level, you see that, we are having shortages. We are still, I would say, overall in the earlier phase of the build out. And especially when you see revenue accelerating, these hyperscalers, and if you're a business owner, if you see business coming in, you should be building. So I think we will still continue to see really strong spend throughout. But in the meantime, most important thing for us to take away this earnings period is that we see adoption, we see revenue accelerating. That to me is the most important sign. And as long as we see that, I think the ecosystem remains healthy.
As an investor, how important is it for you to hear from the C-suite clarity of vision?
it's particularly important when we are in once-in-a-lifetime massive changes at the infrastructure level. So it's important to understand what they're spending on, how they see the future. And it's more important than ever for us to scrutinize and then to ensure that our vision, our belief is aligned with the companies that we invest in. And furthermore, I would say the one thing that we are talking about is as a whole, CapEx is very strong. But underneath it, even when you look at it, stock selection is extremely important. It's not a rising tide lift all boat. And I think more than ever, because the pace of innovation is so fast, and then because this time it's some of the biggest spenders actively looking at what they're spending on, and they're scrutinizing that spend. So we are likely going to see, even at the spending level, even at the supply chain, you're going to see continued pace of innovation going faster. And as a result, the market is also going to pricing in, like when we think about SaaS or some of the company that we think might be disrupted in the marketplace, the market quickly is pricing in the probability of success at the terminal level. And I think we're going to look at that at the hardware level as well. The architectural change is actually happening at a much faster cadence than we ever imagined, and partly aided by technology. And so I think as an investor, it's very important for investors to remain very prudent and selective and pick the right winners, even though in the overall narrative has constantly been focusing on how big that number is.
This has not been a forgiving market, that's for sure. Leah, appreciate your time this morning. Thanks for being here. Late Chu there of AllianceBernstein. The Nasdaq up this morning by 1% with an update on news worldwide with your Bloomberg Brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. Saudi Arabia holding talks with 43 countries on forming a multinational alliance to protect shipping in the Red Sea. The Saudis proposed leading the coalition. The plan receiving support from 13 countries, including Turkey, Egypt and Qatar. Ken Griffin's Citadel stepping in to rescue a hedge fund. Situational Awareness selling off a heavy chunk of its portfolio. Citadel buying up the bulk of the fund's AI stock bets. Shares of Novo Nordisk are falling in the pre-market. The company giving an update on its Zeus Phase 3 trial, saying it failed to reduce the risk of heart attacks or strokes in a large study. The monthly injection was a key part of Novo's effort to expand beyond its core obesity and diabetes businesses. And that's your Bloomberg Brief. John.
Hey, Vonnie, thank you. Appreciate it. Up next on the programme, dry powder on the sidelines.
There's $4.5 trillion of dry powder across the private markets, which is just an astonishing figure. I almost think about it as a waterfall of capital markets depth.
Up next, we'll catch up with the Ares CEO, Mike Harugetti, from New York City this morning. Good morning. You're watching Bloomberg TV.
Western countries, all of them are cutting funding to Africa. And some of these programs were supported by funding coming from Western countries, like for human resources, for testing, for transportation of samples. And suddenly, African countries have to think how to fund money and to cover this gap. But it takes some time. And I think the combination of all of these factors are fueling this mistrust that we see at community level. We value the support we got and we are still getting from the US. And we think that if we continue to work together, And there is no reason for the US not to work with Africa CDC. Africa CDC is the leader in terms of public health in Africa.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo. And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bringing you up-to-the-minute space news whenever and wherever it happens. I'm Ed Ludlow at NASA's Kennedy Space Center in Florida, and this is Bloomberg.
Equity futures positive here by a third of 1% on the S&P, adding to yesterday's gain, the biggest one-day gain on the Nasdaq we've seen since March, following a 6-day slide, the longest losing streak, going back to October 22 for the Nasdaq. The Nasdaq this morning up by 1%. Into the bond market, 2s, 10s and 30s. Lots of reasons for higher 30-year bond yields on the week this morning. Just sticking at about 520. Lots of people talking about Kevin Walsh and that performance on Wednesday, but there's so much more going into high yields at the long end of the curve.
It has to do with government issuance, and it has to do with hyperscaler issuance, and it has to do with the fact that central banks around the world don't seem to be in a rush to raise rates to counter inflation, and so they're allowing the long end of the yield curve to do the work for them.
30-year yields this morning, just about unchanged at 522. And the Savannah's this morning, dry powder on the sidelines.
There's $4.5 trillion of dry powder across the private markets, which is just an astonishing figure. There's broad demand, and you're already seeing it in the 2026 patterns where some of these companies are actually choosing to issue in the private markets. I almost think about it as a waterfall of capital markets depth.
So here's the latest this morning. Ares reporting an earnings beat, highlighting another record quarter of fundraising with over $36 billion of inflows. The CEO, Mike Arougheti, writing, "Our clients continue to reward us due to our strong and consistent fund performance across our strategies." Mike joins us now in the studio for more. Mike, good morning. Good to see you.
Good morning. Good morning.
I wanted to start with a quote of yours from earlier this year when things were pretty difficult with the software issue. And you said something really important. You said the following: if you're going to underwrite a narrative of AI disruption, you also then have to say, well, what does that mean for the productivity and margin improvement for the rest of your book? I think that's a good place to start. Where are you seeing value being created right now?
I'm glad I said that. So if you look at the way that Ares is playing the AI transformation, it's what are we doing within the data center and digital infrastructure space? What are we doing within our portfolio companies, and what's that productivity uplift? And then what are we doing within Ares proper to either improve our investment outcomes or profitability? So if you start with Ares first, we're obviously deploying AI across the entire enterprise. We're seeing significant efficiency. We had a 100 basis point margin increase in the quarter year over year, and we've guided the street to expect 0 to 150 basis points per annum. A fair amount of that is technology efficiency that's getting created, re-underwriting processes, re-underwriting systems, and we are seeing uplift. That is also translating into increased productivity and margin expansion within the portfolios. So if you were to look across our private equity portfolios, our private credit portfolios, cash flow growth is still plus or minus 10%. If you look at corporate earnings, I think you're going to see that that's generally the theme. And then within the investment space, we are doing our best to stay diversified in the way that we're attacking the digital infrastructure opportunity. Big investors in data center development, but I think our approach has tended to be a little bit more targeted. We're doing 150 to 300 megawatt deals, hyperscaler adjacent in large tier one markets like Tokyo, London, Sao Paulo, pre-leased 12 to 15-year terms with escalators. So we have probably shied away from some of the secondary and tertiary markets and stayed away from some of the frontier model type of opportunities. Two, we're a very large lender in the infrastructure debt space, and you're seeing that rolling through our earnings as well in terms of the fundraising and deployment momentum there. So we are one of the largest institutional lenders to other developers, and that's been a bright spot. Three, we have a large asset-based finance business, and we're squaring off with a lot of the banks on SRTs and portfolio purchases, where we're helping them free up liquidity on their balance sheet to continue to deploy into the opportunity. And then four, we have a very large infrastructure equity business where we're investing all around the digital ecosystem, transmission, fiber, battery storage, et cetera. So we're kind of attacking it from all angles, but our view has been we want to be global, we want to be diversified, and we want to have the full capital structure so that we can move around where we see best relative value.
It's the second word I want to dig into, diversified.
Yeah.
And I'm open to the reality check. I'm just going to say it feels. It feels like a lot of people are in the same trade. They're in asset-backed infrastructure debt on the credit side, and they're taking direct equity investments into, say, software and models. How do you avoid all the crowding that we're starting to see in other places?
In digital specifically?
Within your firm?
Yeah, I think the key, and this goes, if you look at our earnings this quarter, and you put the numbers up on the screen, what screams out to me is just the broad-based nature of the business and the diversification. And so the way that we think about private markets is we want to be up and down the capital structure, debt to equity, so that we can move around and find relative value in response to rates or the economic environment. We want to be horizontally diversified across all the different private market asset classes, secondaries, private equity, real estate, infra. And you'll see investor appetite and our own view of relative value shift. And then within the funds, we want to be highly, highly diversified. So if you look at our credit funds as an example, you may see 900 to 1,000 line items. So we're not going to have any single exposure really drive the long-term performance. And I think that's key. There is a risk in any investment business that you're over-diversified. And I could argue maybe 1,000 loans in one fund is over-diversified, but it's served us well over the 30 years that we've been doing it.
Earlier this year, everyone was saying there's going to be a complete collapse, that the private credit space is going to go down in flames because of the retail investors, et cetera. And your compatriots and yourself are coming out and saying, whoa, not at all. We're seeing actually performance hang in there and people are still interested. Where are we in that in terms of interest from investors in private credit, how much the pendulum has shifted to the infrastructure and some of the other plays instead?
Yeah, look, we've been pioneers in private credit, and people have been saying it's a bad place to be for 30 years, and it's grown pretty consistently and compounded at a very attractive rate of return. So anytime there's a narrative that's that loud, you've got to at least ask yourself, what is it that they're looking at? We don't see it. If you look at our direct lending business, which is kind of where I think people are focused, our non-accruals across the direct lending business right now are inside of 2%. That is well below the historical averages. Our cash flow growth is plus or minus 10%, as I said, and that's been consistent. We are seeing healthy interest coverage, very low loans to value. So the fundamental performance is exactly what was underwritten. A lot of the noise, I don't really know where it's coming from. It could be coming from a competitive set of capital that, doesn't like to see the flows. It could be software related, but there's nothing that we see in the portfolios that would indicate that credit's weakening. And the interesting thing to your question, and you see it this quarter in earnings, the institutional demand for private credit is probably accelerating right now because they're seeing spreads widening and they're seeing capital leave the market and feel like there's an opportunity to come in and take share. So our last two credit funds, both in asset-based finance and opportunistic credit, hit their hard caps, and we had demand well in excess of the hard caps, and we raised those funds quicker than any prior vintage.
It's fascinating to hear you talk about the performance of these loans, and it's something that we've seen from the likes of Capital One and some of these other credit card companies. The credit performance is hanging in there. Yeah. It's actually hanging in there better than people expected. Where are we in this economic cycle based on some of the activity that you're seeing in portfolio companies?
Yeah, if anything, you could say growth is moderating slightly. So if we're growing cash flow portfolio-wide 9 to 10%, a year ago that may have been 11 or 12. But it's not negative. So you are slow growth. I mean, where are we? It's still early. And back to the first question from Jonathan, you're seeing margin improvement, productivity gains, balance sheets are healthy, companies are delevered. So it feels pretty good, and it's just not in corporate. We see it in the real estate market too. We're well leased. We're seeing rent increases and strong demand. So everything feels really good.
Right now, we're talking about leverage coming out of the system in public markets. There was some concern that maybe leverage was building, or there was some frothy types of behavior in private asset management. You talk about $170 billion of dry powder. I'm just wondering how you see some of these structural dynamics in the market in terms of ability to finance some of the huge bills coming and willingness to do so.
Yeah, look, I think 170 billion of dry powder feels like a lot, but it's actually kind of in line with our annual deployment. So if you look at the 36 billion that we raised this quarter, we also deployed 36 billion. That's actually a lot quicker than historical. It used to take us probably 2 to 3 years to deploy our dry powder. We're now almost on an annual raise and deploy. I think with regard to the digital CapEx, obviously there's $750+ billion of CapEx demand coming from the hyperscalers. That is a large amount of capital. It's beginning to, quote unquote, overwhelm the markets, and that's showing up in two ways. One, spreads are widening, which is not necessarily a bad thing, and people want to get paid more for the risk that they're taking. And it's probably slowing the pace of the build. So, when you're thinking about deployment, this is not happening overnight. These are 2 to 4 year projects. You've got energy constraints, you've got community engagement and civic discussions that have to go well. So there's a lot that's actually constraining the coming online of some of this CapEx. So at least as we're sitting here today, those numbers don't concern me. But your point is a good one. And going back to a year ago, people were beginning to ask, where's all this capital going to come from? The CapEx numbers have doubled, and the market is trying to keep pace, but it's going to be a little bit of a constraint, I think.
I thought you were about to ask whether Leopold had given Mike a call. When you talked about a dry powder, I thought maybe.
Maybe you were the one that was the Grim Reaper calling. Did you hear some? I love those quotes. Did he give you a call?
No.
Breaking news. And we've got Crude. Just kidding.
Are there any lessons from that? As you see that story and react to it in real time?
I don't know enough to know. I think, if anything, maybe back to your prior question, is be diversified, number one, which is, don't be fully exposed to one factor or single correlation. I think that's, that might be the lesson. It might be that experience matters, and that, combination of smarts and experience through cycles is ultimately important. And I think, I think about our own 30-year journey and all the lessons that we've learned navigating cycles and
painful ones,
and things, and you'll learn lessons the hard way. And so that might be the moral of the story too.
Mike, appreciate it.
Thank
Good
you.
to see you.
Good
Thank
to
you,
see
buddy.
you
Thanks for being
Appreciate it.
here. Thank you very much. Mike Arugetti there, the Ares CEO. So that's a no. Leopold didn't give him a call.
Well, it's a different asset class, I guess. But it does highlight the role of experience in this. I mean, 24, idiot savant or not idiot, but, that it's sort of an incredible, brilliant guy.
Strong, Bremo.
Well, no, but it's like it's a phrase. He's graduated college at 19. No, that wasn't. No.
Running out of time here to clean this up.
Look at that. The time's got to go. Yield is destiny.
15 seconds to dig out of this hole if you want.
No, he's a brilliant guy. 24.
Okay. From New York City this morning, good morning. The third hour of Bloomberg Surveillance up next.
For greatness that comes with building frontier AI systems, and that's why we're working on them. There's been a lot of talk around the uncertainty, around the downsides, and I agree with a lot of these risks. And perhaps where I might disagree or take a different path is that I think we have a lot of agency. Like this period of time where both humans and AI systems have their hands on the wheel and we can collaborate is very important time to get right. And the more that we can reduce the discontinuity that comes from new capabilities and huge change in capabilities, the better. And this is why we took this approach with Thinking Machines and why the company exists.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers, and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech.
Every weekday, only on Bloomberg Television.
Oh, hello there. Just wanted to say, Primer is back. We've been scouring the frontiers of science and technology to help explain the difference between the next gold rush and whatever this thing is. And in season 2, we're upping the stakes. More danger.
Now that is some high-grade uranium mineralization.
We used to have a stable climate on this Earth. Right now, we do not.
More science.
We're pushing the envelope of technology in multiple directions. Software, hardware, chemistry, physics.
The cable is like very cold.
And more CEOs that can nail the photo shoot.
Hundreds and hundreds of billions of dollars are at stake.
While the problems are economic, the solutions are too.
And yes, we will be talking about AI.
There is a lot of humanoid hype out there.
But our future doesn't run on hype. It runs on innovation. Watch season 2 on all these lovely channels.
The global economic playbook is being rewritten, and the levers of power are moving in real time.
To see where the world is headed, you have to look where the action is.
I'm Haslinda Amin in Singapore.
I'm Menika Doshi in Mumbai.
Welcome to Emerging the New Economy podcast.
Each month, we dive deep into how the world's most exciting rising economies are shaping the global future.
Join the conversation. Subscribe to Emerging on your favorite podcast platform today.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
There's still lots of demand for equities.
Right now, we're in the middle of a good growth cycle.
What we really need to see is continued strong earnings growth.
Once again, we have these broad-based earnings surprises.
Earnings are opinion, cash flow is fact.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Yield is destiny. Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now with equity futures positive by a third, adding some weight to the rally of the last 24 hours on the NASDAQ. The NASDAQ delivering the biggest one-day gain since March, adding another 1% to the NASDAQ 100 this morning. In the bond market, 2s, 10s and 30s, yields shaping up as follows. Yields this morning on 2s up by 2 basis points to 426, on 10s around 468.
Yeah, and the real key question here is what is the relationship with the global trade and what is the relationship with the Federal Reserve? We heard from Kevin Warsh, the Fed chair, a speech that was widely panned on Wall Street, but gave a lack of clarity about what the actual calculus would be when they were deciding whether or not to raise rates. Now we're hearing from some of the other officials about why they dissented, and some of those might suck up a lot of the oxygen.
Mike McKee is going through those dissents. I understand that Mike McKee's available to talk to right now about it. Mike, clarity. We didn't get much from Kevin Warsh. How much clarity are we getting from some of those dissenters this morning?
We're getting a lot more. It's become something of a thing that on the Friday after a Wednesday Fed meeting, the dissenters published statements explaining their votes, and we've got statements from two of them, Beth Hammack and Neil Kashkari. Hammack cites supply shocks, but also says that she sees inflationary pressures on the demand side of the economy as well. Businesses in her district, she says, are telling her that pricing pressures are broadening rather than fading, and she notes consumers are expressing despair over persistently higher prices. Inflation has been too high for too long. In my view, now is the time for the FOMC to act to speed the return of PCE inflation to our 2% objective and deliver on our commitment to price stability for the American people. And she notes that the longer inflation persists, the more challenging and costly it is to bring it back down. She also says that she's not confident it will return to their objective on its own. Kashkari worries about the effects of the series of supply shocks the economy has faced, as well as new demand from AI. He looks to the oil shocks of the 1970s and the ultimate decision of the Volcker Fed to lean against those shocks rather than accommodate them. To manage against the risk that high inflation would become entrenched, Kashkari says, I would rather tighten policy incrementally as we gather more data on the path of inflation and unemployment. If inflation remains elevated, in my view, a potential series of small policy moves would be better than waiting and eventually concluding that even bolder actions were necessary. And of course, on the other hand, if inflation fades, he says moving in slow, small steps would allow the Fed to dial back the stimulus without unnecessary impact on the real economy. We have not heard from Lori Logan, the third dissenter, but we are, since it's a thing now, expecting to get something from her later today.
Looking forward to your coverage of it. Mike McKee there breaking down the dissents of Hammack of Cleveland and Kashkari of Minneapolis. Let's start with Kashkari of Minneapolis. I give him credit for being consistent and slightly early, pushing back against the easing bias in the statement a number of months ago, suggesting that the earlier you move, the less you'll have to do further down the line, and that we could see some tightening of financial conditions. And then now, ultimately making the point again that the earlier we move, the more incremental we can be and the less we might have to do later. But of course, this is dragging on and on. It's the word incremental hikes, those two words that get my attention from Kashkari this morning.
Yeah, saying that a series of small incremental hikes is preferable to acting when you finally allowed inflation to get away from itself, and actually arguing that, yes, monetary policy can have a role in dampening supply-side, supply shock-driven inflation, kind of rebutting the argument that this isn't their battle to fight. Ultimately, if inflation is a choice and it is their choice, he's saying they should do something about it. Here's the question. If Lori Logan comes out with this type of statement, it puts all of the non-speaking Fed members on the hot seat. Where do you stand, given that we haven't heard the rhetoric, the argument for remaining on hold this week at the Fed's meeting?
If you're on the board of governors, let's just park the regional Fed presidents just for a moment. If you're on the board of governors right now, I imagine you feel quite sensitive to the idea that a new guy's just taken the role, and you want to give them some time, which might be, and I stress might be because I don't know and have no inside line on this whatsoever, it might be why Waller did not dissent at this meeting. I would look for clarity on that. It's the governors I'm looking for, because right now, based on this commentary, the Fed chair's running out of time. And you're going to have to see the data do a lot of heavy lifting between now and the September meeting to stop this pressure from building even more.
Just like Dalip Singh said, if you do get a sort of immaculate disinflation, that could take the pressure off in a significant way. But without that, a lot of these voices are going to get a whole lot louder.
Let's get to the view on Wall Street this morning. Phil Camporelli of JP Morgan Wealth Management writing the move in the yield curve after the press conference is something that every Fed chair would want to avoid. They would much rather be transparent heading into the meeting versus the driver of material price action. Phil joins us now for more. Phil, good morning.
Good morning.
Whole new world. How many times have we said that this week?
Yeah.
What's your reaction to Wednesday and your reaction to this morning?
Yeah, bond market freak out. We haven't gotten that in a long time. And it does remind me, there was this Chair Powell press conference from October of 2018. I'm not sure if you guys remember when he said, President Trump was very, very critical of him. And
long way from neutral, that line.
Yeah, good one, John.
I don't remember if it was the presser or if it was an interview or testimony.
We're far away from our neutral rate.
But that was the line.
And the bond market was like, what? How many more tightenings does that imply? It ended up being one more tightening in December, a pause in January, and then they were easing by July. Like, this stuff moves very, very quickly. But more importantly, John, as I wrote, no Fed chair wants to see a reaction like that in the bond market after they talk, because they want to be transparent. I remember when Janet Yellen compared monetary policy to like watching paint dry, right? That's what they want monetary policy to look like. And that could be course corrected. I think that's the bottom line here. When the statement came out, there were 3 dissents. Fine. 3/4 of the committee didn't see enough evidence that the impact of what energy prices would be doing to broader inflation. And the statement was fine. It was the press conference. And I think they can, or Chair Warsh can course correct that. At the end of the day, though, I still go back to the 10-year Treasury rate and the volatility of rates. I think the federal funds rate is priced to move 1 or 1.5 times by the end of the year. And it's kind of interesting because when we have our strategy meetings, you have the bond people on one side and they're like, oh my goodness, look what's happening. And then you have the equity people and they're like 20% equity earnings growth, right? And this is a trade that we still like. And that's really the disconnect here. It's yes, there's a lot of consternation in the bond market this week, but the equity trade continues, we think, to have momentum and legs. And we're going to look back on July, and this month, we're going to have an unchanged month in the S&P 500.
Yep.
But it felt more like the Odyssey than an unchanged month in the S&P 500.
A few points away from all-time highs as well.
Yeah.
You serve wealth management clients.
Yeah.
If they're in the clip and coupon business and they're not too worried about the volatility, the income that fixed income provides now is higher.
Yeah, that's the key.
Is this a buy after the freak out?
Yeah, that's the key. So we are of the view, John, that the 10-year Treasury probably stays at or around these levels through the end of the year, which leads us to believe that, yes, you have the power of carry on your side. If the Federal Reserve is already priced to go 1 to 2 times this year, then you're not really talking about a dramatic move. It's kind of like buy the room, sell the fact, dramatic move in the long end, unless we're really wrong about these next 2 CPI numbers and these next 2 payroll numbers that show significant strength that, Lisa, I think you mentioned earlier this morning, could maybe prompt the Fed to do more. So yes, we do believe that it's a buying opportunity in fixed income to take advantage of these current yields. But, John, we are looking in the front end of the curve because I think there's a little bit more of an opportunity there than in the back end of the curve that could have more duration and volatility just in the near term.
I remember late last year, a lot of people were talking about how the pendulum of risk-reward had really shifted more to equities than potentially from bonds, just based on where spreads were, based on the potential earnings ahead for particularly tech companies. Do you think that pendulum is shifting back, that higher yields means lower returns from equities for a longer period of time?
No, because I do believe it's still the equity side, Lisa, that we're leaning into, because we think that this earnings story is interest rate insensitive. And that sounds kind of blasphemous to say. But again, we have a 24% earnings forecast for 2026. And the only other times that we were 20% in a calendar year were coming out of the 2001 recession, the global financial crisis, and the pandemic. And we're doing this in the middle of a cycle. And I think this month especially, the fundamentals have completely dislocated, right, from the price action of some of the hardest hit sectors, which were, tech, communication services, industrials. And, if you look at the earnings revisions, they're positive. That's usually what drives stocks, but the price action was lower. And I think we're still leaning into that tech trade more than bonds. But bonds, again, at these levels, you really need a Federal Reserve that's going to be super hawkish to get hurt. And legging into a 10-year note at 470, if your high side looks something maybe like 5%, doesn't sound like a bad idea when you're getting paid for that carry.
Where in equities is the best place to go? Because we've heard from Mike Wilson about the broadening trade, and we just heard from Mike Arrighetti of Ares about the incredible efficiency gains and increased profitability that non-tech related companies are experiencing. Is that where ultimately the upside is going to come from?
Yeah, so our favorite sectors are tech still, industrials that are tied to the tech trade, but introducing financials. Financials are also a sector that we like. And I think what's happening, when you see the Mag 7 versus the 493, when you see that valuation at points that we haven't seen in a decade, I actually think it has more to do with the 493 than the 7. And investors buying into and having confidence in that those sectors are going to be more profitable, that there can be non-tech sectors that are profitable, like financials. And financials are one of the biggest deltas or changes in our earnings revisions. Buybacks are really important in financials. And capital market activity. I mean, I'm sure you guys covered the JP Morgan results, the Goldman results, and the way that those CEOs talked about capital market activity. And Lisa, again, that's the disconnect, right? You have the fixed income people freaking out this week. Oh my goodness, we may need to see yield is destiny. You may need to see a rate hike.
You're not letting that go, are you? Hey?
Never.
That's going nowhere.
But this remains a pro-cyclical trade. And again, earnings are driven not just by growth, but by nominal growth. So inflation is bad without growth, but if we have a 2% GDP growth forecast and 3% inflation forecast, 5% nominal growth is a good environment to take risk in.
We found something to blame. Can we finish on situational awareness?
Yes.
The hedge fund's blown up, someone stepped in and picked up the positioning. Do you think that's a sign of a washout, a clearing of positions where we can form a new base and pick up from here?
Yeah, we do. And one of the things that we like to look at are retail flows and ETF flows. And John, the move in the tech ETF and the semi-equipment ETF. Those outflows last week were some of the biggest on record, right? So akin to what you were just talking about outflows, that's what I think kind of makes a floor where you can then get back to the fundamental story. Oh my goodness, these folks are adding to their capital expenditures. There still is a supply-demand imbalance on semiconductor demand versus supply, which I think keeps this thing moving forward.
Good to see you, buddy. As always. Phil Camporelli there, JP Morgan. Private wealth management rather. I just want to get to this statement from HSBC and Max Kettner, because he talks about that in this new note this morning, Bramo. He says, yesterday's news around the unwind of AI hedge fund situational awareness gives markets a welcome narrative to justify the renewed sell-off in chip stocks in the past 2 weeks. Goes on to say that technicals have also become much cleaner now. In our view, this creates a powerful backdrop for a positive reversal of Momo, says we shift EM Asia equities back to overweight, reduce Eurozone equities, remain overweight US and Japanese equities.
Yeah, this max overweight in equities continuing. Interestingly, remain quite aggressively underweight developed market sovereigns to fund or carry an equity overweight position. So this is coming at the expense of yield in terms of yield is destiny, yield is going higher, and the developed world is going to continue to struggle with that. That's not undermining, though, the overweight in some of these momentum sectors.
Interesting note from Max this morning.
Very.
Just interesting. And Phil was talking about the same thing. Maybe just, whether it's the right thing to blame, but something for the people who are in denial to blame, maybe, about the last few weeks.
I think we have more situational awareness about
Yes, maybe we do. Or maybe we don't. Let's get you an update on news elsewhere this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. 2 of the 3 Fed presidents who dissented at Wednesday's meeting are speaking out now. Cleveland's Beth Hammock saying now is the time to speed the return of PCE inflation to 2%. Minneapolis's Neil Kashkari saying he'd rather tighten policy incrementally as the Fed gathers data on inflation and unemployment. Anthropic says its AI models breached 3 organizations during recent cybersecurity tests. In a blog post, Anthropic says it found 3 instances in which its Claude AI tool accessed the internet and then hacked into external organizations. Shares of Jersey Mike's slumping nearly 9% in their trading debut. The company and some of its shareholders raised $1 billion in an IPO that priced at the midpoint of its marketed range. And that is your Bloomberg brief. John.
Vonnie, thank you. More from Vonnie in 30 minutes. Up next, the morning calls, plus Shweta Kajuria of Wolf Research as Amazon soars, capping off hyperscaler earnings on a high note. That conversation up next from New York City this morning. Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
You're watching Bloomberg Deals. Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
The world's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker Playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
What we're seeing here is the hyperscalers leading a massive round of CapEx, which is contributing to supply shortages and inflation in component costs. This will resolve itself over time. This is a short-term issue, but in this case, short-term could be 12 to 18 months. But it'll eventually take care of itself.
That was Tom Forney of Maxim Group weighing in on Apple. Apple struggling in the pre-market. More on that name throughout this morning into the opening bell. The cash open 1 hour and 12 minutes away. Let's talk about the stock market. Equity futures positive by 0.25%. The Nasdaq doing better, higher by 0.8%. There's a fantastic story out there about a hedge fund called Situational Awareness. All the characters involved. It's a great one. You could write a book on it, I'm sure. When Ken Griffin of Citadel's doing the rounds too, there's always extra meat to it. But the essence of it is you had a guy who was running a strategy that was very long hardware, very short software, and was using lots and lots of leverage. That produced fantastic returns for much of the year until it didn't. And things unwound really, really fast. Did that contribute to the weakness that we started to see in, say, chips? Did the unwinding of those trades contribute to some of the big moves we started to see over the past few weeks? Maybe to some extent, possibly, yeah. Do you believe that now sets a base, a cleaner base to rally from here because we've washed out some of this positioning? I think some people believe that this morning. And this came from Max Kettner of HSBC, and it's an important line. Yesterday's news around the unwind of the hedge fund Situational Awareness gives markets a welcome narrative to justify the renewed sell-off in chip stocks in the past few weeks. Technicals have become much cleaner now. In our view, this creates a powerful backdrop for a positive reversal. And this goes to a point that a lot of people have been talking about, which is the technical nature of the market over the past couple of weeks rather than anything having to do with fundamentals. We talked about Samsung, SK Hynix, Samsung more so, coming out with really good earnings and still getting beaten up for it. It's also coming in tandem with the South Korean market stabilizing a bit, with authorities putting some sort of caps on the use of leveraged ETFs. I'll tell you what, Bramwell, I can't keep up with the news flow. You know, I was looking at this headline just crossed on the Bloomberg. I mean, let's bring it up right now. Moonshot's Kimi was built on 20,000 NVIDIA chip cluster through Alibaba.
Oh, dear Lord.
You know?
Yeah, well, this is the whole question of how much of the Chinese technology is being built on smuggled equipment from the United States or things that have been sanctioned in some capacity. There will be a lot of questions.
How export compliant is it all? There could be questions about that. Where's the technology coming from? Is it just US tech dressed up as something else? How much of a threat is this to US markets? Is it another shock like DeepSeek just last year? These are all questions we're trying to answer in real time.
And just how much cheaper is it actually than some of the frontier models? I mean, the big argument is that it's cheaper, it's open source, but it turns out when you dig under the hood, it's using a lot of the same compute, a lot of the same technology, and it costs a very close kind of amount.
This is according to our reporting, but what it underlines still is that on the surface, yes, we're seeing some progress from China, but there's an underlying dependence on US technology. So if you thought that story a few weeks ago was a reason to sell US tech, I think you're rethinking that based on the reports we've seen over the last few weeks.
Yeah, which maybe is also giving some stabilization. It isn't exactly a one-for-one type of disruptor that people had imagined.
I'm running out of time here, so I've got to move on. So let's get to the morning calls. One stock in focus, Amazon. Barclays raising its price target, saying it's, quote, atop the AI hyperscaler pedestal. His second call from JP Morgan hiking its price target, noting a clear line of sight to strong financial returns. And finally, Citi lifting its price target too, citing booming AI demand and calling it a top pick. The tech trade then regaining its footing after a blockbuster week of earnings. Amazon surging on growing cloud strength. Apple facing some headwinds. Ed Ludlow has the news wrap. Hey, Ed.
Yeah, good morning, John. The markets with Apple had no sentimentality for Tim Cook's final call. It came down to a really critical question, which is what does the world look like in 3 months relative to today? And Apple made some pretty stunning concessions that they had misjudged demand on the smartphone side and on other products. And so it wasn't even a case of memory. Yes, memory prices will go up, but even in lead-edge processors, Apple basically didn't ask suppliers enough. They made a misjudgment. And so the September quarter and the outlook of growth of 9 to 11%, trailing the street's expectations, it is pretty amazing to see the stock down almost 8% in the pre-market as a result. Amazon, a completely different story, right? They told the market, our AI investments are already paying off, and quite clearly the market believes them. Capital expenditures rising from $200 billion to $220 billion. Azure growth, 37% growth in the quarter gone, above expectations. But loads of other data points that show they're making money on AI. and the street believes that.
The stock's behind the story. Ed, thank you. The stock is higher by 10% this morning. Shweta Khajuria of Wolfe Research staying bullish on Amazon, writing the second quarter was a clean beat and third quarter guidance came in line with investor expectations. We see a path to 40% full-year growth. Shweta joins us now for more. Shweta, welcome to the programme. What was the difference between them and, say, the likes of Meta, the likes of Alphabet?
Good morning. Thanks for having me again. Well, Amazon, as far as I remember in the recent past, had one of the cleanest prints. And what was different between Amazon and Meta and Google was that Andy Jassy actually talked about the clear line of sight into return on invested capital, how they're seeing demand, how they're laying out data centers in the first 2 years, and then they break even post, a couple years after they put in servers and networking investments. And the life cycle and the length of the life of each is different. And they think that this is just a very similar playbook as how they expanded AWS with just much faster growth that they're seeing in AI. And so that gave investors a lot of comfort that they're spending against a lot of demand. They have concrete demand. They're not going to spend if they don't see it. And there is line of sight to seeing returns. And most importantly, they're doing this from a position of strength. And they've done something like this before. So that is probably the biggest difference between across the three.
Shweta, is Amazon essentially a cloud computing company with a retail arm tacked on?
It's really amazing how things have turned around. I mean, retail is their biggest revenue business, not operating income or profit business. But what is remarkable is that if you really believe in the $1 trillion revenue opportunity at AWS, and let's say that it reaches that in 10 years, at low to mid 30% margins, assuming that's the normalized state of their margin profile, it is amazing that that would be about 2/3 to 70% of their total company level operating income. So vast majority of their enterprise value would be coming from AWS. So yes, I would think so in characterizing it as more of a cloud computing AI company than retail.
Isn't it funny, Lisa, if you ask someone on the street away from Wall Street what they know Amazon for, obviously it's retail. They wouldn't even be talking about the other part of the business. In fact, I would guess that most people on the planet away from Wall Street, when they think of this company, don't even know the other side of the company exists.
Well, at dinner the other night, one of the kids was like, how did they get it so much cheaper than everybody else? And I said, cloud computing. Phew. Mind blown.
Totally.
That's exactly how it gives them a competitive advantage to potentially compete on price in a whole different kind of way.
Almost by accident, they end up with that business.
I know.
It's nuts.
I know. It came from, selling books online, and suddenly now they, are the reason why we
You need quite an imagination to think you'd get from that to this.
And the imagination is what people are buying into.
Shweta, appreciate it. It's good to see you. Shweta Khajuria there of Wolfe Research. The stock is higher by almost 11% in the pre-market. Up next, we'll catch up with the former New York Fed President Bill Dudley, seeing some major red flags in Fed Chair Kevin Walsh's strategy. That conversation is up next.
Welcome to Bloomberg This Weekend. I'm David Burr.
I'm Lisa Mateo.
And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Equity futures this morning positive by 0.25% as a bounce on the Nasdaq, up by 0.9. That bounce continues following yesterday's big gain. In the bond market, 2s, 10s and 30s, some data just seconds away. Yields at the front end of the curve up 3 basis points, around 430 on 2s. Let's call this 427. Yields up a single basis point on 10s, behaving just a little bit on 30s at 521, following the freak out on Wednesday and the news conference with that Federal Reserve. We'll spend some time on that in a moment with the former New York Fed President Bill Dudley. Looking forward to that. Let's get you some economic data. Mike McKee has that data for you. Hey, Mike.
Good morning, John. Well, we've got another inflation indicator. The employment cost index for the second quarter is just out, and it is up 0.9%. That's higher than the 0.8 the prior month, or the 0.8 it was expected prior quarter. Excuse me. We see that wages and salaries were up 0.9%, and business benefit costs increased 1%. So a little bit more inflation on the employment side in terms of compensation. Not sure whether that will influence the Fed a whole lot, since we've got a lot more inflation between now and September 18th, their next meeting. But it does show you that inflation is not dead, and it sort of helps undergird the cases that Beth Hammack and Neil Kashkari were making this morning for their dissents.
Mike McKee, thank you. I just want to pick up on the bond market move and just go to the front end of the yield curve. And I won't make too much of a big deal of this. I'll just talk about it directionally. So we're higher by 3 basis points. And if you look across the curve and just look at 2s, 10s, 30s all at the same time, just look at this. How the markets responded to the data. I think this is actually quite important. And I'll tell you why. So 2-year yields have responded by climbing 3 basis points. The 30 has not moved. So that's a market that still believes on the margin that that kind of data would influence the policy rate at the Fed. And it's not something they would look through. Now, it's just one data point. But if things had really changed after Wednesday, you'd expect to see that leakage at the longer end of the curve in the belief that you don't actually think the Fed's going to do anything and they're just going to let inflation run. So I think still out there, internalized within this market, investors still believe that this Fed is sensitive to incoming information and yields are higher at the front end.
The Fed is composed of individuals, and the individuals have different views, as we're learning this morning, and they're all coming out with some dissents. And what people are looking for, you're going to expect to see more volatility around every single data dump that we get, because ultimately, if you get data that does not cooperate with this immaculate disinflation narrative, there will be a lot more people on this FOMC committee that are going to come out and vote with Logan, Hammack, and Kashkari, and might even put the Fed chair, Kevin Warsh, in the minority.
It's a small move, Brammer, but you're with me? That's kind of how to think about this right now?
Essentially, the market is saying that at a certain point, if the data confirms that inflation is sticky and it really is continuing to move in the wrong direction, that the members of the Fed, regardless of what Kevin Warsh does, are going to be forced to make a move. And the market is forcing that hand and saying they probably will follow through on it.
Yields up 3 basis points this morning on 2s. It's a small move, but the direction, the response, the sensitivity to the data as it comes in is noteworthy. Mike, you've been following those descents. What have we learned so far this morning?
Basically, that both Hammack and Kashkari believe that if you start raising rates in small increments now, you'll have to do less later, because they do think that inflation is going to continue to be above target significantly for quite some time. and that the that inflation rate is not going to come down towards the target on its own. It needs more help. It needs more tightening in the economy. We haven't heard from Logan yet, but she has made that same case before, so I would assume that she's dissented sort of on the same basis.
Stay tuned. Mike, thank you. Michael McKee there. The former New York Fed President, Bill Dudley, with a new op-ed titled "Walsh's Approach to Fed Policy is Deeply Flawed." He writes, outsourcing monetary policy to financial markets is a terrible idea. Walsh missed an opportunity to rebuild the Fed's credibility. Bill joins us now for more. Bill, welcome to the programme. We were all watching that news conference, and it didn't start terribly, and then progressively it just got more and more confusing. What was the point in that news conference where you sat up and said, this is weird?
Well, it's weird when you're not explaining why three people are dissenting, yet the committee is deciding on no change in policy. There really was virtually no information about how the Federal Reserve is thinking about monetary policy, how the Federal Reserve is likely to react to incoming information in terms of how they adjust monetary policy. The silence of Warsh was really quite deafening, and the financial markets, basically said thumbs down. I mean, the fact that the 30-year yield went up, the 10-year yield went up, and 2-year yields dropped really was a sign that, that there was a loss of credibility in from that press conference.
Bill, I want to highlight a distinction because I think it's important, and it's in the body of your op-ed, and I want to say it for you. You're not against reducing forward guidance. This is important. I think that the complaints about the people doing the complaining often are around the idea that somehow we still want our hands being held, that we want to hold on to the post-GFC communication architecture. And Bill, I don't think that's what your criticism is about.
No, I mean, I wrote a group of 30 paper that we published in April, and one of the recommendations was to get rid of forward guidance. The only time you really need forward guidance is when you're at the zero lower bound for interest rates and you're trying to provide additional monetary policy stimulus. But the rest of the time, it really just sort of inhibits the Fed and probably makes the Fed a little bit slower to react to incoming information. But that doesn't mean you don't want to know what the Fed's monetary policy reaction function is. And I think that's the real problem. Warsh in his comments is conflating the two, and they're very, very different. If I don't understand how the Federal Reserve is going to react to incoming information, I can't price financial markets correctly. And it's also creating a lot of uncertainty about what policy is going to be in the future. The market response on Wednesday was really Fed credibility has lessened, and I think this is a really own goal on Kevin Warsh's part. I think one of the problems here, I think, is he's overpromised and underdelivered. He's talked about sea change at the Fed, radical regime change. But then the markets are actually getting very, very little in terms of guidance on how to think about the new Fed.
Bill, we were discussing about whether maybe some of this was by design. There is going to be more volatility. There has been more volatility both at the front end and the long end in response to every economic data point and comment coming from anyone on the Federal Reserve as a result of an absence of some sort of reaction function articulated by the FOMC chair. Do you think that this could be by design to help reduce inflation without hiking rates?
I don't think this is a really great strategy for a couple of reasons. Number one, it's a very inefficient way of tightening financial conditions. Basically, you're driving up risk premium in markets. That's a dead weight loss to the economy. Number two, how well can you actually control the market process to generate the impulse that you want to slow the economy down sufficiently? And lastly, it's a credibility issue. I mean, if to the extent that the markets reacted the way they did on Wednesday, that's telling you that people are more worried about the Fed's resolve to do the job. That means inflation expectations are less well anchored than they were prior to the press conference. That in itself makes the Fed's job harder.
Bill, how high is the bar for there to be, I don't want to say mutiny, but the bulk of the FOMC committee voting against the chair, potentially with the governors joining suit?
I don't think we would get to that. I think at that point, Warsh would throw in the towel and vote with the majority. I can't imagine a situation where the chairman allows himself to be outvoted by the committee, because if you had that result, it basically would be saying that the chairman has lost control of the committee, and that's just not a very good look for any head of any organization.
Bill, he was also vague about the inflation target. That was confusing too. Vague on the inflation target, whether they'd respond to it, and what tool they would use to respond. Can I pick up on that last point, Bill? He's flirting with the idea of using balance sheet instead of short-term policy rates, short rates.
Well, I think
what do you think of that?
I think the problem here is that even if you reduce the balance sheet, you're probably going to be able to reduce it by about a trillion or so if you want to continue to have an ample reserves regime. And I think the commitment of the committee is to maintain the ample reserve regime. And then the question is, how much restraint is shrinking the balance sheet by $1 trillion going to be? It's actually going to be very, very small. So the idea that, you pull on this balance sheet lever and that allows you to not have to tighten monetary policy, I think is very much exaggerated.
It's obvious that for the market, the primary tool is still the policy rate, because you can see that in the reaction this morning to the sensitive economic data that we got moments ago on wages. They came in hotter, labour costs. You saw yields rise at the front end of the curve. Bill, we've talked about this all morning, the credibility hit. You say credibility's been hit. Others agree with you. Let's talk about how you repair it. When you do a job really badly, sometimes you have to do more than you otherwise would have had to do. How much more do they need to do now at this Federal Reserve to regain that credibility?
Well, I think you have to follow up talk with action. So I think that what's happened in financial markets over the last 72 hours or so basically increases the pressure on the Fed to act in September. If it's a jump ball in September, you almost need to tighten now because you have lost credibility over the last couple months.
Do you think that it increases the chance of a larger than expected rate hike?
It's possible, but I don't think that you're so far away from your inflation objective that you need sort of shock therapy. If the Federal Reserve did 50 basis points move, that would be in my mind, a little bit of a sign of desperation. Why didn't you hike in July and then you do 50 basis points in September? I think that's actually is a confusing narrative as well.
What do you think the overall motivation is here? I mean, we've been talking about this, and a lot of people said Kevin Warsh is a 100% respected person by the mainstream of the financial markets, by the establishment. Do you think this is just rookie's error, the classic kind of first press conference of a Fed chair? Or do you think that there is some political motivation here trying to dodge the ire of the president going into the midterm elections?
I can't judge that, but I generally think, no, that he's not trying to do it to sort of mollify the president. I think he really does believe that somehow outsourcing this to financial markets will improve the conduct of monetary policy. But you can't outsource it to financial markets for a very simple reason. Markets don't price to what the Fed should do. They price to what they think the Fed will do. And so if you try to outsource it to markets, all you have is the markets looking at the Fed looking at markets, and the interest rate path is indeterminate.
It's the
so
Spider-Man meme that we were talking about yesterday.
Yeah,
Everyone's pointing at each other.
And I saw a couple versions of that. Fed.
I'm sure you did. But it's good to see you. Thank you, buddy. Bill Dudley there, the former New York Fed president. Thank you very much, sir. Appreciate your time. Employment labour costs. Employment costs coming hotter than expected, and you see the reaction in the bond market. It's notable. 2-year yields are higher by a few basis points. Equity markets pulling back. Lisa, the S&P just about positive.
Yeah, and this is something that Beth Hammack was talking about, that she does see the longer this kind of inflationary backdrop continues, that she does expect it to get more embedded in the market, and that there is not a rate that's sufficiently restrictive to really bring down that inflation. Look, we all want to see wages go up, and at some point, it really speaks to the productivity nirvana that people have been hoping for. Question is, if prices keep going up that much more, it doesn't ease the pain that a lot of households are feeling.
There's one letter that stands out for me this morning. You asked about regaining credibility, we both did, and you asked about whether they'd do a jumbo hike. I don't think they're going to do a jumbo hike, but I think you're in the right frame of mind to ask that question. The letter I'm thinking of is S. When Kashkari elaborated on his dissent, he didn't talk about hike, he talked about hikes. He talked about incremental hikes. That's a guy who's willing to go more than once. And I just wonder how many people look to signal the same thing.
Yeah, the idea of 75 basis points of rate hikes that an increasing number of Wall Street companies are looking for.
Is that the way you would have needed to communicate things if you'd hiked, let's say, early this week on Wednesday? Possibly not.
Yeah, well, and at the same time, we need to have some sort of reference point if they start hiking about what their lodestar is. Is it going to be a series of methodical hikes, or is this going to be something that is sort of a case-by-case basis? I mean, that kind of articulation is required for markets to not get ahead of themselves and possibly price in 150 basis point of rate cuts. This is where the reaction function matters.
Futures this morning positive by about a tenth. Let's get you an update on news worldwide with your Bloomberg brief. Vonnie has more. Hey, Vonnie.
Hey, John. Thank you. China's moonshot continuing to rely on Western semiconductors to fuel its AI development. Sources telling us here at Bloomberg the company has a compute power agreement with Alibaba for the use of around 20,000 NVIDIA chips. New York is suing Kalshi for allegedly running an illegal gambling operation. The suit alleges Kalshi's prediction market exposes residents to, quote, serious personal and financial risk. New York also accusing the company of failing to acquire a gambling license. And an update on situational awareness. The Financial Times reporting the fund's manager, Leopold Aschenbrenner, is vowing to fight another day. In a letter to investors yesterday, he said he took full responsibility for the events, which led to a 67% plunge in assets in July. The fund, though, still up 80% on the year. That's your Bloomberg Brief. John.
Vonnie, thank you. Aschenbrenner adding, according to the FT, that the situational awareness fund would no longer borrow money from banks to magnify its bets.
Lesson learned. Guess what? I think we're going to get out of the leverage business.
Yeah, I'm not sure what that line of credit looks like right now anyway, but
that's fair.
More credit to it. He'll keep swinging, right? I don't know him personally, but those kind of people, they'll keep swinging. This won't send them back.
He's 24 years old, and he has done an incredible amount in his years.
It's impressive.
It is so
really,
impressive.
Really impressive.
I'm sure he learned his lesson. I'm sure that Citadel gave him a schooling, and now he's going to go off
No doubt.
Lay the groundwork for something else.
I'm not in the business of knocking that guy.
No, not
Just
at all.
Not at all.
I mean, honestly, this is what experience is, and he's getting it.
It's a major experience. Up next on the programme, Dan Niles of Niles Investment Management as the tech sector posts a major rebound, plus your Hira. How's your morning movers? A clinical trial setback sends Novo shares lower by close to 9%.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
What's the skill set that you would advise every aspiring CFO to develop?
Psychology.
I think analytical skills are important. Obviously, you need to like the numbers. If you don't like numbers, then don't go into finance. It's sort of like a recipe for disaster if you don't like numbers.
Not only for the CFO, but also the company's management. That's a communication and the collaboration.
I spend a lot of time figuring out how to take the complex and make it simple, and then finding a way to be able to communicate that both internally and externally.
I think it's relationships, whether it's working with investors, bankers, with the senior management team, with the board. Having your head down is one thing as a finance person, but keeping your ears open is super important as well. And I think that all of that is what kind of builds out being a successful CFO.
Watch Chief Future Officer only on Bloomberg.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
Chairman Warsh is really a dove at heart. I mean, he's a structural dove. He got the job for that reason. And all of this is just a veiled way of delaying the rate hike. Sometimes, let's admit, too much brain power is counterproductive. right? It just is. What the heck are all those 200 economists doing on the staff of the Fed? What is the FOMC supposed to do? This lack of trust was revealed, I think, in the presser the other day.
We asked Terry Weissman for his movie review from Wednesday, the news conference with Chair Walsh. Lit up. That was the most excited I've seen Terry in like years.
What do you think, 25% on Rotten Tomatoes? What do you think he was actually giving?
If you ask Wall Street,
yeah,
that rating, Wall Street Economist, that rating was pretty low for Wednesday.
It was one of the, every single one was just that like green kind of.
And you tune
flat.
into it because it's so bad. Like,
Actually,
it's right
true.
on the edge of that.
It was relatively entertaining.
One of those movies. Equity futures this morning positive by a tenth. On the Nasdaq up by 0.75%. The opening bout just around the corner. Let's get you some single names, some morning movers. Yahara has more. Hey, Yahara.
Hi, John. We start with Novo Nordisk, whose shares are plunging in the pre-market, down nearly 8% after a major blow to its pipeline. One of the company's most closely watched experimental drugs failed to reduce the risk of heart attacks and strokes in a late-stage trial. And this is a problem because this is a drug that was supposed to drive the next leg of growth for the company beyond obesity and diabetes drugs. Now let's get to the earnings that we've gotten this morning, because we've gotten some interesting reactions. We are seeing AbbVie, this is the company behind Botox. Shares are down 3.25% despite delivering better than expected earnings. But after a 13% rally this year, investors were looking for even more, but they did not get a clean beat since AbbVie did issue a lower full-year profit outlook than expected. And it was a similar story over at Colgate. Shares are falling nearly 2% despite the toothpaste maker posting solid results, beating on earnings, but it did post weaker than expected sales in North America. It said that it's seeing a slowing consumer demand and tougher competition, but these reactions just underscoring how high the bar is this earnings season, and of course raising the question of what it will take to take this market meaningfully higher from here. John.
Yahara, thank you. Thanks for this morning. As we count you down to the opening bell, your trading diary shaping up as follows into the week ahead. At 10 a.m., we get UMich consumer sentiment. At 11, you'll hear from the president holding a cabinet meeting at Camp David. Looking ahead to next week, ISM data on Monday, Tuesday. We start some results again, some earnings from AMD and SpaceX just around the corner.
Very curious to hear
right?
SpaceX, given how much the shares have declined, and the fact that you're going to have an opening up of the shares to the public float and the ability to sell. Real questions there. Also questions about what it would take to buy Tesla. I'm sure everyone's going to wonder.
Oh, without a doubt. That's like number one question, isn't
100%.
it? Yeah, but the SpaceX call would sound like the Tesla call.
Yeah, exactly. Just tell us. They'll say it's not prudent to talk about it, and then people ask again.
Let's focus on tech. Tech stocks on track for a second straight day of gains. A big move yesterday on chips of something like 8%. The hyperscalers powering the Nasdaq 100 to its best day since March. Dan Niles of Niles Investment Management writing, looking at Mag 7 results, it's mostly come down to return on invested capital. Google remains my favourite play. Dan joins us now for more. Dan, it's good to see you. I expect you to be slightly contrarian, and that is slightly contrarian after the week we've had for the likes of Alphabet. Dan, what is it about Alphabet and Google that's getting it done for you?
Well, there's three stocks, John, that I like. It's Amazon, it's Microsoft, and it's Google. So if you look at Google, the great thing is the stock got hit. Well, part of the reason it got hit is it reported results before you had situational awareness shut down, and you had the forced liquidation that put a bottom in. But if you look at the actual results for the most important piece, which is Google Cloud, you saw an acceleration from 63% year-over-year growth to 82%. It's the fastest acceleration of any of the cloud vendors that actually reported, and you've got a pretty low multiple on it. So they've got the full stack, they've got the chips, they've got search, they've got a huge amount of cash flow, and I think they're going to be the winner ultimately in consumer AI, which is why I like them. For Amazon, you know, you've got a big infrastructure business there for e-commerce. I think robotics and AI will really help that. You saw AWS accelerate to the fastest growth since COVID, and you've got a 23 times PE. And remember, the S&P is at 21 times, so you very rarely get that. Microsoft is more, I'm increasingly coming around to this view of a lot of people in enterprise want a secure way to get onto using AI, and Microsoft's got about 450 million paid seats. They've only got 30 million Copilot paid seats, and I think you're going to see a lot more businesses say, hey, I want security. I already am using Microsoft 365, I might as well pay for the Copilot, and that's how I'm going to get there. And so those are kind of the three I like.
There's a lot to unpack there. You mentioned situational awareness, or you inferred that was part of the reason why Google's shares didn't do better when they reported earnings with some of the similar metrics of the likes of Microsoft and Amazon. How much do you think that's been affecting some of the volatility that we've been seeing over the past couple of weeks?
I mean, that's the main thing. And don't forget, they're not the only ones. There's at least 3 other funds that I know that have got problems. Yesterday probably fixed a lot of that. But situational awareness, because they were running 4 times leverage, and it was long-based leverage. You can run leverage if you're hedged, but if you're not, that's a huge issue. And so that's going to force a lot of problems. You might remember Archegos, what happened there. Go back further to long-term capital management. Obviously, you had the bank failures following the rise in bond yields like Credit Suisse. And so the good news with things like that is it washes out a lot of the excesses in the market. And, that's a positive. I mean, what you saw earlier this year in the rise in semiconductor stocks, that wasn't a good thing. Or the move in the Kospi in Korea, that was not good, because a lot of that is just excesses. And when you've got these vertical moves higher, you're going to get vertical moves lower, especially when you have a fundamental catalyst like token minimization, which, I flagged this back in a June 20th note of why I thought there was a speed bump coming.
Yeah.
You put that on top of a highly levered, visible fund that's going to get crushed. This is what happens.
Well, Dan, just quickly, how do you know that there isn't a lot more of that still has yet to wash out? Because this could have been a lot messier than it was. I mean, it was an orchestrated sale with Citadel. It wasn't exactly some sort of fire sale.
It was a fire sale, Lisa. I mean, they did not want to do that at situational awareness. So the thing is that you're always looking for a forced sale, a forced seller. You got that. Now, by the way, other funds that are highly levered, we're also trying to degross, which is why if you look at, something I think I wrote up on Wednesday, I talked about the different metrics and how much the momentum index had come down, especially if you look at the TMT, Tech, Media, and Telecom Momentum Index. That drawdown was almost 50% in a month, and that's longs minus shorts. And so what you had was your longs are getting crushed, your shorts are going up, and if you have leverage on top of that, that's magnifying the losses. And so we've never, ever seen a move in this short a period of time with that magnitude. And so, human beings, our nature hasn't changed, right? Which is fear and greed. You got a tremendous amount of fear going into Wednesday.
Dan Niles of Niles Investment Management. Dan, thank you. Have a great weekend. To Dan's point, the last point, really important, the speed. The amount of time it took for this to unwind, the speed, because of the leverage that had to be unwound, just accelerating the whole thing.
It's the reason why people thought that it wasn't really healthy to see a vertical increase, a sort of exponential increase to just up and to the left. I guess to my question, up and to the right, my question is, how do you see what we're seeing with SK Hynix and Samsung and the Kospi this morning and say it's all over, considering how big those gains are?
A good reason or a convenient excuse to, say that we've got a nice base to rally from here?
Because people still like the names, and so why not?
A lot of people believe it. You're starting to hear it a little bit more going into the weekend. Coming up on Monday, Sarah Hunt of Alpine Saxton Woods, Frank Lee of HSBC, Neil Dutta of Renmac, Nancy Lazara of Piper Sandler from New York City this morning. Good morning. Thank you for choosing Bloomberg TV. Have a wonderful weekend. This was Bloomberg Surveillance.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg.
More than what you need to know, it's what you need to think about.
Everybody has a moment where they put into action all they've practiced, where they step up to a challenge and either succeed or fail. But what are those moments for some of the world's most influential leaders?
It was a rough and tumble world, and I thought, okay, I can rise up, I can play this game, and I did play the game.
It was great, and it was depressing, and it was disappointing.
My chair at the time sat down with me and said, "Succession starts now."
I'm Francine Lacroix, an award-winning journalist. For the last 25 years, I've interviewed world leaders, bank bosses, even fashion icons. I'm often asking about the news of the moment. But I've always been curious, who are these people as leaders? Join me for the podcast version of Leaders with Francine Lacroix. I'll start your week with conversations that explore what drives the world's most influential people, how today's leaders got to where they are, where they're going next, and how they've transformed their organization in the process.
Make decisions. A poor decision is always better than no decision.
You have to have truth tellers around you, and you have to be willing to listen.
You don't want to be setting strategy in the middle of a transaction, that's for sure.
Do it for the right reasons. Don't do it because of FOMO.
We'll also learn lessons which we can apply to our work and daily lives. Tune into the podcast version of Leaders with Francine Lacroix. Listen and watch on Bloomberg Television or wherever you get your podcasts.
My old mentor, Roger Staubach, who told me when I transitioned, football will never leave you, but you need to leave it.
Wow.
Everyone has a dream. And a lot of dreams are, my dream is to play football and play professional football. And you get the dream comes true, but it is going to end. And the day it ends, the day before it ends, you're one of the best in the world. Great. The next day you wake up, that's gone. What are you great at? And the truth is, nothing, right? I'm not great at anything else.
I talk about it all the time, Steve, is this whole idea of it's not from penthouse to penthouse. And what I mean by that is you played for 15, 20 years and you're in the penthouse. That doesn't mean that you come to the business world and you're going to be in the penthouse. You don't start on the third floor or the lobby. You actually have to start in the basement.
The latest business news wherever and whenever it happens. I'm Scarlett Fu, reporting from America's biggest military shipyard. This is Bloomberg.
Only 2 more bells until you can start your weekend. 30 minutes until the start of your cash equity trade. I'm Danny Berger.
I'm David Gura. Bloomberg Open Interest starts right now.
Coming up, the big tech divide. Amazon gains on robust results while supply shortages hit Apple.
A deal by billionaire Ken Griffin's Citadel with situational awareness caps a dramatic week for the AI trade.
And as markets head into August, earnings season passes the halfway mark while geopolitical risks linger.
Some stocks to watch. That big tech divide that we talked about just a moment ago in stark relief here as we look at the screen. Amazon reporting a 5th straight quarter of cloud sales growth with a 37% revenue jump for AWS. Should say it's a totally different story for Apple. Its shares falling this morning after it announced it has component shortages weighing on its forecast here in the quarters ahead, Danny.
Such big swings after reporting earnings we're seeing from these companies. I'm watching another sector that reported this morning, and that is oil and gas. A little bit less dramatic. Chevron reported second quarter results. Oil prices did surge, drew to war-driven supply disruptions. Exxon, they narrowly missed estimates. You can see they're down 1 1/3% for their profit forecast. That's what they missed on, dragged down by scheduled refinery maintenance. David.
Back to those undulations in the tech sector. I want to start with big tech. Apple sliding on a weaker sales outlook, while Amazon, as I mentioned, rallying after the company raised its AI spending plans. But Amazon's CEO says demand still exceeds capacity.
We now believe we will spend approximately $220 billion in cash CapEx in 2026. The higher cost of memory pushing this number up from our prior estimate of about $200 billion. But even at that amount, we will still not have enough capacity to meet all the demand we have in 2026. And I believe this dynamic will also be true in 2027, too.
Joining us now is Bloomberg Tech host Ed Ludlow. Ed, great to see you. And I wonder if we could kind of start with this contrast that's kind of played out over the course of the week as we've made our way through much of the Magnificent Seven. What did those results tell you yesterday just about the way that Amazon's positioning itself vis-a-vis these other hyperscalers, big tech companies?
Yeah, I mean, look, Amazon completed the set of data points that Wall Street wants, the full flush to reward the stock, right? Which is demand is running ahead of supply. They're committed to spending. CapEx was higher in large part because the cost environment is higher. And then they offered more than just top line growth, more than revenue growth. So AWS 37% in the quarter gone, pretty significantly above expectations. But they said that there's already a return on the existing AI investment, which is the AI business for AWS has a $25 billion run rate. And the business of them renting compute capacity based on their custom silicon, principally their Tranium chip, also is at a $25 billion run rate. And if you are sort of thinking, well, Amazon, I know Amazon as Amazon.com. Well, there's something for you too. They even said that people that have used Alexa Plus are more inclined to join Prime or spend more money on Prime. And they just kept giving additional data points that account for the stock being up more than 11% in pre.
Well, if you care about what the consumer side of the business looks like, maybe we can look to Apple as well, Ed. They reported earnings, a different situation there because they haven't been spending as heavily on AI, a disappointment. Where did Apple miss the mark?
So with Apple, not really, you know, an AI story or a spending story. It was astonishingly a management of the supply chain story. The quarter gone was good, largely a beat across the board, a miss in China, a miss on services. The issue for Apple is that the world is going to get more difficult in the September quarter than it is now. Memory prices will continue to go higher, and the revenue guide of growth of 9 to 11% was below what the street was hoping for, of about 12%. But astonishingly, what Tim Cook said in his final call as CEO is that they had got it wrong. They had misjudged demand, particularly on the iPhone side. And so if you park memory for a moment, they actually did not place orders for enough advanced processing chips, right? They got it wrong. And Tim Cook's, career has been marked by his ability to manage the supply chain. So that's been really interesting. And look, the reaction of the stock being down almost 8% is quite severe.
It's a really good point, Ed. We've seen him, to your point, do things like change from the China supply chain to the India one quite adeptly. Ed, thank you so much. Looking forward to Bloomberg Tech, 11 a.m., Ed Ludlow. Now to a different side of tech, a dramatic unwind, specifically in the AI trade. The hedge fund situational awareness is scrambling after margin calls forced it to sell assets. They plunged from $45 billion to roughly $10 billion before Citadel's Ken Griffin swooped in to buy a bulk of the fund's public portfolio. Let's get more with Bloomberg hedge fund reporter Hema Parmar. Hema, you and the team doing excellent reporting when it comes to situational awareness. And I think a lot of people would look at this and say, okay, this is leverage in the system, and it seems to have come undone. What exactly happened with situational awareness, and where do we stand now?
Yes, this is a story we've seen time and time again. Dramatic couple of days, dramatic 24 hours. And, what happens is, this is what you see what happens when we see these firms which have huge amounts of leverage, concentrated positions in volatile stocks. And situational awareness had 4 to 5 times leverage on these assets. And this is what happens when those see a downward spiral. They need to meet margin calls. They need liquidity fast. They have to find a buyer. And they were seeking to sell their public stock book as well as their private stock book. Ultimately, they found a buyer in Ken Griffin's Citadel.
Talk a bit about the level of panic, so much as it existed here within the fund. So you've got this Wunderkind who studies math at Columbia. He's the valedictorian, goes on to found this fund. From your reporting and others, he was looking at Sand Hill Road maybe as a place that might take on some of this, of what's in the portfolio. Mm-hmm. Was there a lot of panic here? Sort of where was the head of the founder of this firm here as this all happened?
Yes, I mean, they were trying to find any number of buyers. So they were talking to Millennium, to Jane Street, to Citadel. They were in conversations with Green Oaks and Sequoia about the private book. So when you're looking to offload this degree of assets so speedily, it's not a good sign. It's problematic. And so I can imagine there would have been a great deal of concern. He's now reassuring investors to say, look, we made a mistake. We're trying to get back on track.
Leopold Aschenberg getting married this weekend.
This weekend,
as well.
Yes.
It's a tough time.
Talking about a stressful week.
Yeah. Some of his clients are probably in attendance, though, so I think he can get some work done.
Busy reception, no doubt. Hema, thank you very much. Appreciate that reporting. And I want to turn now to another story. A lot of earnings coming through this morning. Oil giants Exxon and Chevron reporting earnings before the bell. Maintenance costs brought down Exxon's profits, while Chevron beat estimates. Joining us now is Bloomberg energy reporter David Wethy. David, great to speak with you. And I think about these two companies and the amount of exposure that they have to the Middle East. It does seem like the story of these two reports, which were blockbuster, really are closely tied to what we've seen over the last 5-6 months in the Middle East. Talk a bit about that connective tissue between the war that continues with Iran and what we saw in the results today.
Yeah, it's baked into the DNA of these companies because it is such a heavy presence for them over there, and it's a constantly changing situation. It's hard for the executives to tell the street what to expect because it's hard for them to even know what the outlook is in the Middle East. And to that point, Exxon said that they expect that if the Strait of Hormuz remains fully closed through the third quarter, they said this in the slides for the call coming up, that they could see as much as 750,000 barrels a day of production offline for them. Right now, it's about 500,000 barrels a day that is offline as a result of the Strait closing. So they definitely like to see that open, and that would affect their production more. But particularly, it was the maintenance on the refineries that hurt Exxon this time around. It prevented them from being able to capitalize on the really high oil prices. But they said in the third quarter, they expect less downtime due to maintenance, so they should be able to capitalize on some of those higher oil prices.
Then what separated them between Chevron, who was able to capitalize on those higher oil prices?
Yeah, probably less maintenance than what Exxon did, or they were able to at least tell it better to the street so that there wasn't a miss. And so it was easier for the street to understand as compared to Exxon.
All right, David, thank you so much for joining us. That's Bloomberg's David Wethy on the latest big oil earnings. A check on markets 20 minutes to go until your trading day, your last of the week. And we're coming in from a huge session on the Kospi. We're rallied nearly 18%, but is still down 2% for the week. So the NASDAQ gets a bid up nearly 1% after closing at its highest level in about 3 months. 10-year yields, those move higher this morning, up 2.5 basis points alongside Brent crude up 1.5%. Some of the individual movers we're looking at this morning. Tesla is reportedly weighing a separation of its China business to pave the way for a possible merger with SpaceX. CEO Elon Musk calling the Wall Street Journal report, quote, fake news.
Shares of Moderna falling after the company said a key trial for its norovirus vaccine did not meet the statistical criteria for early success.
And we're also watching Jersey Mike. Shares fell 6% in their first trading day. The company raised $1 billion in an IPO that priced at the midpoint of its marketed range. And we're going to bring you an interview with the CEO next hour. I spoke to him yesterday, and he said, I promise our lettuce is not making you sick.
Coming up, we'll speak with TD Cowen's John Blackledge on Amazon's bigger AI spending plans and what's next for AWS growth. It's coming up on Bloomberg Open Interest. Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors.
We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Anything we do in Africa is going to be more risky than the U.S. I think the approach we want to take is how are we being compensated for that risk? And one of those is obviously going to be a valuation question. In our minds, valuation was a lot more attractive in Africa, even if we adjust for some of those Africa risks that a lot of Western investors see. So yes, in a lot of ways, you take some of those models that, as I said, might be more asset medium or asset heavy. There might be some more inherent risks. However, if we're saying we're adding some risk because of that kind of model, but we're now solving a core problem as opposed to maybe a nice to have solution in Africa, that might actually offset it. Where if you're solving something that people really absolutely need and can't live without, in a way that then that's a lot less risky. So again, we'd encourage investors to have a less binary view. In other words, the US isn't risky, Africa is risky. That's going to lead to a lot of complications down the road.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend. This is Bloomberg Television.
Now to high interest to look at what's making headlines around the world. President Trump says a U.S.-led board of peace has reached a deal for Hamas to disarm, calling it a major step toward ending the Gaza war. But Hamas says it won't give up weapons until Israeli troops withdraw, leaving key details unresolved and implementation likely months away. Novo Nordisk's push beyond obesity drugs hit a setback. Its experimental anti-inflammatory shot failed to reduce the risk of heart attacks or strokes in a late-stage trial, sending shares down sharply. The drug had targeted a potential $10 billion cardiovascular market. And FIFA's proposed $20 billion commercial spin-off is facing growing resistance from European soccer giants. Real Madrid joined other top European clubs in saying FIFA doesn't have the right to sell part of its commercial business. The dispute could threaten support for FIFA's Club World Cup expansion. We'll have more on that story in the next hour.
And Messi famously does not play in Europe anymore.
That's right, Miami.
He's in Miami. But certainly the other one does. Amazon surging after raising its AI spending plans and accelerating AWS growth. TD Cowen's John Blackledge boosted his price target, saying the results show AI investments are paying off. And he joins us now. John, great to see you. I mean, the fastest growth for AWS since 2021. How did Amazon achieve it?
Yeah, fifth quarter in a row that AWS revenue growth accelerated, and they called out, massive AI demand, so growth in AI revenue. Their AI business exited the quarter at like a $25 billion run rate, and they're also saying that the non-AI revenue growth is very strong. And I would also call out that aside from the revenue growth, which was great, margins expanded meaningfully and crushed consensus estimates. And they've been persistently high for now several quarters as revenue has accelerated. So that was really also great to see.
John, what do we learn about the future here? Management talking about $1 trillion revenue business over time. We know well the success of AWS for Amazon in not just recent quarters, recent years. What are executives thinking as they look at the inroads it seems like Meta and other companies have made kind of trying to get into this space?
Yeah, no, I think CEO Jassy was incredibly bullish and communicated so effectively last night. And you're right, he called out potentially AWS $1 trillion in revenue. If you go back to April to his shareholder letter, he was talking about AWS potentially doing $600 billion in revenue. So if we think about that over 4 months, you have that type of move. He didn't put a year on it, but it was incredible. And the other things that he was talking about were, AWS is going to be capacity constrained this year, 2026 and 2027, and that's on the AI demand. And then he said the AI demand in 2028, right, from what they're seeing right now, is striking, which we're a little over halfway through 2026, and he's talking about the demand in 2028. So it's just incredible. And I would also add that he reiterated that AWS's capacity will double by the end of 2027. So at the same time their capacity is doubling, the demand is so strong that they're going to be constrained through 2027. So all in, it's just off the charts demand. And we ended up materially raising our AWS revenue and operating income forecast next 5 years.
So ultimately, you had Andy Jassy communicating a very clear and strong narrative to this market. There had been this idea that part of the reason that Meta struggled after they reported their earnings is we didn't get that same clear narrative from Mark Zuckerberg. John, is there a contrast to be drawn between these two CEOs, not even just in the business, but their communication style to this market and what they're hoping to achieve?
Yeah, exactly. And I've covered both companies for a long time. And CEO Zuckerberg is a great communicator. Historically, he's been a great communicator. Historically inspires confidence within the investment community. But I feel like they've kind of missed the mark 3 out of the last 4 quarters. What we were looking for from Meta was some clarity on CapEx trajectory, clarity on monetizing excess AI compute, and then just more broadly, like, they're investing a lot in this AI moment. What are the products and services and potential revenue streams out of that? And we didn't get as much as we would like, and it was disappointing. Kind of the stock disappointed after the reporting. But they do have an opportunity, right? Like CEO Zuckerberg was like, we think we can sell our capacity at a significant premium to what we paid for it. And from a CapEx perspective, they were like, we're going to maximize our capacity the next couple of years. So I feel like in the coming months we can hear more, and maybe they will cut some deals on Meta Compute. But to your point, yeah, CEO Jassy was spot on. this quarter with his messaging.
John, let me ask you about prioritization. Our Ed Ludlow just a moment ago talking about how there was something in this report for everybody, even those of us who remember Amazon as a bookseller way back. It still has a very sizable, of course, retail component. What did you learn from Jassy, from the company, just about the way that they're looking at the conglomerate as a whole, the whole business, and how much they're prioritizing one part of it versus the others?
It feels like everything's firing on all cylinders, to be honest with you. We spend time on AWS. I thought they were incredibly bullish on the e-commerce business. I mean, they're at record delivery speeds, and I think they feel like there's meaningful runway for further, kind of improving delivery speeds. And in e-commerce, when you increase the delivery speed, you massively increase the conversion rate. So I thought that was really bullish for the e-commerce business in the coming years. Advertising growth accelerated. I mean, this company is firing on all cylinders, and it's a great question in terms of prioritization. And I think they are prioritizing their biggest bets, which are what we're talking about: AWS, e-commerce, advertising, among other areas.
We're talking about India, Mexico, Australia as well for international expansion. John Blackledge of TD Cowen, thank you very much. Appreciate that update after those earnings. And coming up, we're going to speak with Baird's Will Power on Apple's supply challenges as we look at this contrast over the course of the morning. This is Bloomberg Open Interest.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo. And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas.
Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine. Watch, listen, stream.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Apple slumping after supply shortages weighed on the company's sales forecast. Baird analyst Will Power reiterating his outperform rating on the stock, saying supply constraints pressured guidance, but demand remains strong. And he joins us now. Will, let me just start with what Tim Cook is leaving for John Ternus here as he looks to the exit. I mean, his last day is September the 1st, and we think of Tim Cook as having such prowess, such success managing Apple's supply chain. How much of what we saw in that report yesterday is attributable to kind of mismanagement on his part, or is it just by virtue of the fact that there is such widespread demand now for chips in particular, it's becoming increasingly difficult to manage even for somebody who has been known for so long as somebody who can do it so expertly?
Look, well, good morning. Thanks for having me, David. Look, this is still a strong foundation, right? And I think As you look at the results in the quarter, sure, they were a bit light of, expectations, or at least the upside that we've had, the past couple of quarters, and guidance might have been a bit light. But if you back out, some of the impacts from supply constraints and FX, the numbers actually look, still very good. And so I think, from our perspective, the demand signals continue to be, quite robust. And so I think the business remains on, firm footing as we head into this next 10-year.
So is it fair to say that Apple does not have a supply chain issue, that the shortage of chips and the cost of memory is something they'll be able to get through?
Well, without question, they're facing supply constraints, memory price issues that are, impacting, the broader industry. But I think that's something they'll work through with time. And so, our suggestion is that investors look through that. But sure, is that something that could create some turbulence as it has over the last couple of quarters? Yes. And I think that is something that will continue to impact both supply and memory cost and margins as you look over the next, several quarters. But we're taking the longer term approach. And again, the key for us are the demand signals, which I think remain quite healthy. Look, when you step back, iPhone, which is a mature business, has now grown north of 20% the past, 3 quarters. And you've also now got a, resurgence in Mac as well, to help balance that. A services business, that's a $100 billion business, growing, low double digits. So, we remain comfortable with the overall opportunity moving forward.
So let me play this out here. You mentioned the Mac products, and if Apple's able to kind of wade through this 100-year flood, as Tim Cook put it yesterday, kind of ominously here, it released this MacBook Neo, this low-end product, and I'm curious sort of what your takeaway is from the reception that's seen here over the course of the last quarter. I think that Apple for a long time was kind of pursuing the higher end of the marketplace. There was some resistance, I gather, from our reporting, Mark Gurman's reporting, to kind of going in that direction. But it does seem, from the results we saw yesterday and the demand that you've been talking about here, it is a niche that they are well suited to fill.
Well, I think that's exactly right. I mean, they had basically ceded share, to the Chromebook, market. And so Neo really opens up, a new opportunity for them. And they're going after that, right? And you're seeing that demonstrated in the numbers in the quarter with overall, Mac sales up, 27%. So again, really a nice resurgence there. And that's still facing supply constraints as well. That number probably would have been higher, without those constraints. And so, the combination of, Neo, Mac Mini, and then of course, the broader, Mac portfolio, I think, sets them up well. Certainly, medium term. Again, notwithstanding some of the supply constraints that we just touched on.
Even so, with some of those lower end product offerings, they have raised their prices for their devices, some as much as 20%. Do we have any sense to the price elasticity among consumers, whether they are willing to continue to pay more?
Well, I mean, that is a great question, particularly as we get into the next iPhone cycle. Because I think the expectation is we'll see, probably some higher prices, there as well to help offset, some of those supply and memory cost challenges. Look, our sense is overall demand is going to remain, fairly inelastic. Now, will there be some impact? Sure, there's bound to be, but that is one of the central questions. I think the results again that we're seeing at this point, particularly in iPhone, remain pretty encouraging. I think again the demand signals have been strong, and we're going into a product cycle that we're excited about. I think consumers will be excited about with the first foldable phone and Siri AI as potential catalysts to help drive demand into the back half of the year.
Okay, Will, thank you so much for joining us. Appreciate your time. Will Power of Baird. Less than 4 minutes until your opening bell. We're going to speak with Amanda Agati of PNC Asset Management. That's after this break. This is Bloomberg.
Do you mind being called an ideological lunatic or a bunch of left-wing nut jobs?
You know, I've been called worse things than that.
You'd think she owned the place.
23andMe, I think, is so incredibly valuable. We're coming back.
It had that kind of detective story feel to it. You know, when you're hot on the trail of something, you know that it's very exciting.
What magazines were you reading as a kid?
I don't think I was reading magazines until I was in them.
You are on the cover of all of these.
Oh, and there's many, many more, but we just don't have time.
Why should people trust you?
I don't think anybody should trust any company or entity completely with any of this.
It's very uncomfortable. Artificial intelligence is this force that is far bigger than we are.
I want to build better businesses around these brands.
The shock will never wear off.
So you're a brother and sister running one of the most powerful companies in the world. When you argue, who wins?
No one. The way I could see AI being banned or blocked is if something really went wrong. And if something really went wrong, then maybe it deserves to be.
So is it paradise ahead or Gattaca?
Maybe somewhere in the middle.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Let's get your Friday trading day started. You're watching Bloomberg Open Interest. I'm Danny Berger. A rebound this morning after the tech wreck of this week. We are still headed for declines on the NASDAQ, even if we hold this. But we did end at the highest level in about 3 months. Actually, 1% we should be able to end with some gains. S&P also higher this morning, too. And we got through the bulk of the earnings season. So we've digested a lot, maybe smoother sailing. Maybe we'll finally get into the summer doldrums. Down at the New York Stock Exchange, Reformation ringing the opening bell. They listed yesterday and did their first day of trading up 0.5%. God, there's got to be a lot of pressure to dress really good for something like this. If you work for Reformation, which is literally a high-end clothing brand, they look pretty good, so I think it worked. Down at the NASDAQ, it is the Pat Tillman Foundation. They give support to vets and their spouses, and they're welcoming in the new class. So that's what's happening down at the NASDAQ. David, what are you watching this morning?
Yeah, love the sartorial commentary there. Again, watching these two major stocks here, Apple and Amazon. Of course, that's the contrast we kind of focused on over the course of the morning. Amazon reporting a fifth straight quarter of cloud sales growth with a 37% revenue jump for AWS. As we were just talking about a few minutes ago, completely different story for Apple. Its shares falling after component shortages weighed on the company's sales forecast. I think what's so fascinating here is the demand was there, as we were just talking about. People want to buy Macs, they want to buy iPhones, but Apple having a very difficult time getting chips. Kind of a similar story to what we heard from Qualcomm a little bit earlier this week. Danny?
So some big swings for them, a little bit less of a big swing for Big Oil, which also reported earnings. Chevron, they reported second quarter earnings. Oil prices did surge thanks to war-driven supply disruptions, so shares are up 1%. Exxon, though, even with that, they narrowly missed profit forecasts. They had an issue with scheduled refinery maintenance.
Putting a bow on big tech earnings, Amanda Agati, PNC Asset Management Group Chief Investment Officer, writing, you could say the Mag 7 band broke up. Google, Meta, and Apple get pummeled, while Amazon and Microsoft with big gains. These names are not trading like a herd or a pack any longer. And Amanda joins us now. Amanda, we're on the same wavelength. I was talking a bit about this yesterday, thinking about Michael Hartnett, who coined this term now many years ago, Magnificent Seven, over at Bank of America. Talk a bit more about this. I mean, we talk about hyperscalers broadly now. They are approaching this CapEx expansion in decidedly different ways. And how useful is it for us now to look at them as one coherent group?
Well, it's always great to be with you. Thanks so much for having me. The AI story continues to be top of mind, certainly front and center for investors. But I think what's been different this earnings season is just what I wrote, right? The band is breaking up. There may be a reunion tour, so let's not give up on them just yet. But I think it's been very interesting that they are not trading and behaving in this sort of pack formation, right? With this herd mentality. There's been a really significant distinction between winners and losers. Why is that? Because the business models are different. and the levers that each of them are pulling is very different. And I think in an environment where investors are getting pretty paranoid Android, that's the Radiohead reference for you. I think that's showing up here in terms of the results and certainly in terms of the return. So it's going to be okay, for sure. It's going to be okay. But in this moment where valuations are pretty elevated, the ones that are winning are the ones that have lots of levers to pull, are demonstrating acceleration in revenue growth, and still spending. CapEx is still a story, but they're kind of keeping it in check.
Loving this so far.
I say I've never felt more powerfully than today that we need more music on this show. Amanda, thank you for bringing it to us. Narratives are really powerful in this market, as you know very well. Having Mag 7 as this point of leadership for the market was something that really fueled the last leg of the bull market rally. What happens when that narrative starts to get complicated, when we don't know exactly who the new leadership or what the new leadership looks like? Is it just more volatility, more market churn?
Well, I think it's a great question, and I'm not particularly bothered by it, to be honest. I don't know if it's all the coffee I've had this morning, the songs or what, but I actually would welcome a shift in market leadership. We've been talking for the last few years about how we can't hang our hat on one name. It used to be NVIDIA, and then the Mag 7, now it's the Lag 7, right? Like the storyline here needs to be a maturation of this innovation cycle. It can't be about chips. It can't be about semiconductors. It needs to be about the use cases. And so I would welcome a shift in leadership, because I think that really means market breadth is becoming the more powerful story. We're figuring out how to use all of this technological innovation. I think that makes a huge difference in terms of the sustainability of the market rally.
I'm glad you brought us there, because there's been such focus. Again, it's the immediate thing that we're looking at right now, of course, the Magnificent Seven, these big tech companies. But I wonder if you could kind of situate the results that we got this week in the broader context of the earnings season we're in the middle of. How part and parcel is it of that, and sort of what have we seen beyond the hyperscalers and big tech, and what did this week's results tell you about those?
Well, what it tells me is there's a significant amount of resilience in both the earnings backdrop and also the broader economy that I think is underappreciated by investors. We're so fixated on this paranoia around the top 7 names, but when you look at the run rate on earnings growth and it's not over, right? We still have a ways to go, but we're at like 47% year-over-year growth for the S&P 500 in terms of earnings this quarter. That's insane. That's a technical term for you. And this is the 4th quarter in a row where we have set a high bar and are handily exceeding it. And so for me, it's reinforcement that the underlying fundamentals are really strong. And even at these valuation levels, right, it's not a cheap market, but the earnings power has been so strong. We've actually seen some multiple compression this year. I think it's just a really strong setup going into the fall, despite some volatility probably creeping in as a function of the midterms.
Amanda, I hear you talking about fundamentals, and what keeps coming to mind is a conversation I had a few months back with a hedge fund manager who said, you, Bloomberg TV, and all of your financial media are covering markets wrong. You cover them every day like there's any rhyme or reason to it, but the world is awash in leveraged hedge funds, and that's all that matters for this market. That sort of idea has come even more into the fore with this 24-year-old fund, situational awareness, reportedly having to unwind. Amanda, I wonder if we look back at this market and see the huge run up in memory names, which situational awareness did own, and then the sell-off in AI, and then the rebound again yesterday. I'm looking at Morgan Stanley writing a prime brokerage note basically saying that it was hedge funds that were basically the sole buyer of stocks yesterday. If this is just a market that's getting bullied around by leverage and hedge funds right now.
Well, there's no question that the hedge fund community has changed the dynamics a bit as it relates to the market. And so, in an environment like we're in, where there's a lot of concentration historically, there's a decent amount of volatility, you really have to get creative about what the future holds for all of this AI innovation, robotics, automation, et cetera. It's not at all surprising to me that there are organizations out there, firms that are taking big bets on one side or another of these trades. And some of it's going to work out and some of it's not going to work out. But volatility and sort of the uncertainty around this innovation cycle comes with the territory. But I think from a long-only perspective, there's just a really long runway here. And so if you can take a longer term view, but pick your spots carefully and use some of this volatility to your advantage, I think investors really will, win out in the long run here, staying the course.
All right, that makes me feel warm and cushy to hear you say that, Amanda. Thank you so much. So great to have you on this morning. Enjoy your weekend. Amanda Gatti of PNC. Let's get a check on markets, and let me do the bad thing where I try to assign any reason to these moves beyond just hedge funds. We are up 0.5%. Again, I will point out Morgan Stanley saying that hedge funds were huge buyers yesterday, whereas retail investors actually sold a large amount, one of the biggest single-day selling on Robinhood's platform among retail investors. Just to give you a flavor of where we stand on this market. Amazon, after their earnings are higher by 13%, you can see a lot of the chip makers doing well today, carrying on from that South Korean session where we saw an 18% rally in just one day. That's not a weekly figure. Even so, down 2% for the week. On the downside, Apple, in terms of points being subtracted, is the biggest loser this morning, subtracting 54 points away from the S&P 500. Exxon and Linde also had earnings themselves, and that's also falling after disappointments there. Looking at the individual sectors and how they are performing today, consumer discretionary, that is doing well this morning, along with communication services as Meta rebounds. Materials, consumer staples, healthcare rounding out the bottom. So some of the safety sectors not doing well. Infotech only gaining 0.1% because Amazon is rallying. Yes, the chip makers are rallying, but having Apple not playing along is hurting that overall sector, David.
Appreciate it, Danny. Contrast in rhetoric and results, contrast in how they're playing out in the stock market today as well. Amazon, Microsoft, Alphabet doubled down on AI spending. More on this week's big tech results coming up next here on Bloomberg Open Interest.
Historically, bubbles were characterized by a notion of if you build it, they will come. In the late 90s, when we were building out data networking equipment, people were putting huge amounts of fiber in the ground on the assumption that it would come. And economists like to go back for reasons that are unclear to me to the railroads. They were also, if you build it, they will come. What is unusual about AI right now is the builders are so far behind the demand, it's absurd. We have a backlog of more than $25 billion of demand. That there are none of us, not AMD, not NVIDIA, that can keep up with the demand that your employees are driving. That's, in a lot of ways, the opposite of a bubble. We are chasing. Our customers and their customers are moving at the speed of software, and we're moving at the speed of real estate, data centers. Right. And so we are behind.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers, and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech.
Every weekday, only on Bloomberg Television.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Burr.
I'm Lisa Mateo. And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this yield forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys,
buckle up.
The rebound continues with the Nasdaq trading at its highest level, or at least had its best day yesterday in about 3 months. The S&P only up about 0.25%. Let's see what the sell side has to say this morning with your top calls for some of the analyst action. First up, Wall Street reacts to a disappointing outlook from Roblox. BMO downgrades the video game company, cuts its price target over 50%. They cited monetization challenges and weaker than expected guidance. Shares getting punished this morning, down 26%. Next up, Wall Street impressed with Rivian's upcoming mid-sized electric SUV. Although that's not reflected in shares this morning. Morgan Stanley says the R2 could attract a lot of buyers, but the company still needs to improve its production and lower costs. Baird sees encouraging early demand for the R2 vehicle. And finally, Wall Street focusing in on Apple's weaker outlook. Citi says services miss expectations. Evercore ISI points to strong iPhone and Mac sales, but slower growth in services. TD Cowen says higher chip costs and supply issues are the biggest risk right now. Shares down 9%, David.
All right, more on big tech now. Amazon surging after boosting AI spending, joining Microsoft and Alphabet in signaling that demand for AI infrastructure remains strong. Bloomberg tech editor Sarah Fryer joins us now on set here in New York. Sarah, I want to get to earnings in just a sec, but let's go to another story first involving AI, the Anthropic sandbox, where there's been jumping out of the sandbox into the sandbox. I don't know what the metaphorical term is here, but we're seeing sort of something similar to what we saw with OpenAI just a few weeks ago. That is, they had these models, they were testing them, and you correct me if I'm wrong, they've kind of come to life, and the tests have gone differently than the company expected.
They were not properly contained in their digital box by the humans. It's interesting to me here that Anthropic is really blaming it on the humans, saying that their error in monitoring and the design of that sandbox is what may have caused this. That said, it does raise the question of whether this is the tip of the iceberg, whether, if this is happening with OpenAI and Anthropic, if it's happening with the other model companies too, how the government will react, and also, how do they not notice, right? Until they did this investigation, they were not aware that this had happened. And so that raises a lot of questions. If you're running a business right now, if you're experimenting with models, you better be checking that they're doing what you ask them to do and nothing beyond.
The skeptic in me can't help but look at this and have two reactions. One, they want to prove, it's not just OpenAI that has these really good models that have a life of their own. We have them too. But the second one I thought of, Sarah, was this letter that had been circulating around from Jensen Huang saying, we want open source here in the U.S. And Anthropic pushes back and says, government, you should really step in to be curbing the pace of AI advancements. Do you think there's a little bit of PR government relations happening here too, with them releasing to the world that this happened, kind of saying, government, if this is happening to us, we're honest with you. We can't say what the same would be for Chinese open source models.
There's a little bit of that, but remember, Anthropic's line for most of its history has been AI models are dangerous. You really need somebody who's responsible, who's going to look at the risk here and calculate properly how to build guardrails around it. Like that is kind of their thing, and it's a double-edged sword. It makes everyone feel like these models are above and beyond human capability already, and that we're just going to be like powerless to them in the future. And so we really have to think about it now, and Anthropic is the way to do it. It also ends up with situations like what we saw earlier this year between the government and the Mythos models, blocking it, saying you can't do that. So here they're saying it was the human error. To me, that signals that they want to indicate that their model, once it saw the open internet, the latest version said, "Oh no, I'm not going there. I'm not. Yes. I know I'm not supposed to do that." So I think they're trying to show the responsibility a little bit, even in the response to this. But of course, the incident raises all of these questions about how didn't people know? If Anthropic hadn't investigated this, would we even know about it? And who are those firms that were breached?
Two instances, not a trend make, but we got the same kind of introspective blog post from Anthropic that we got from OpenAI. And I'm curious, what happens beyond that? Is this leading to more government interest, maybe intervention? Does it lead them to take it more seriously, do you think?
I mean, we have Sam Altman in D.C. this week. Right. I'm sure that there are many discussions happening about this. We have, IPOs on the line for these companies. They have to show this. As we have open source models from China, it's not clear that these, at least with these companies, we know that this is happening. This is like a show of faith. Like we're disclosing this proactively because we are I think that's what this is about, really, is they're trying to get ahead of the government requiring that they investigate everything, by being proactive. We saw this a lot, actually, with like the social media companies, and we have transparency reports. We are doing internal investigations to take down coordinated misinformation. We don't need the government to tell us to do that, right? So it is a strategy in that sense, but I don't think that Washington's gonna just say, okay, well, that satisfies us. I mean, we'll have to see.
I guess with social media, though, I mean, there are some businesses that built themselves around social media, but there are a lot more businesses now that are adopting these AI models and have changed their business plans and their structure and their costs and their employees around it.
It's a lot more immersed in our economy.
Right. So isn't the risk that the government steps in and something gets shut off just much worse this time around because of the impact it could have on individual companies?
Yeah, and I think the scariest thing maybe isn't like cutting off these guys, because these guys do have political power that they've built up. But if the government says, you can't use open source anymore because we won't get that transparency about what's happening in terms of cybersecurity, well, the majority of businesses by token use are using those open source Chinese models. And so that would really harm a lot of businesses. At the same time, with these instances, you wonder if it's necessary. So.
Sarah, good to see you. Sarah Fryer here with us in New York, joining us on set. And coming up here, we're going to talk a bit more about South Korea, how its leveraged ETFs in sight as that country looks to curb volatility. That's coming up next on Bloomberg Open Interest.
Bringing you the latest geopolitical news whenever and wherever it happens. I'm David Gura on the Salar de Uyuni in Bolivia, and this is Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Tyler Kendall in Geneva, Switzerland, and this is Bloomberg.
"20 minutes into the last trading day of the week, we continue to rebound after the Nasdaq posted its best day in about 3 months. It's up 0.5%, supported by some of the earnings. I'll show you that in a second. Small caps having a more difficult day. That might be due to the fact that yields are moving higher today. Again, now up by 5 basis points. Really, since the Fed decision, we have seen some big swings in this bond market. No relief for the 30-year as it continues to trade at its highest, the yield, since 2007. Brent crude adds to that pressure, up at $90 a barrel. We had big oil earnings, Chevron, Exxon. Chevron able to capitalize off the high oil prices. Exxon is not, hence why you get that difference. Amazon, huge AWS results, their best since 2021, the revenue growth that they've seen. Apple, supply chain issues weigh on them after they report earnings, down 8.5%. NVIDIA up 1.5%. SK Hynix, this is child's play. The fact that it is up 2.1%. In the South Korean session, it was up by 26%. That was its best day ever. South Korean stocks in general, Kospi gaining 18%, huge moves. And that's part of the reason why South Korea has stepped in after a sharp sell-off. It was led by those AI chip makers, SK Hynix, Samsung Electronics. It rattled the country's stock market. The government now proposing new measures, including curbing retail access to leverage ETFs. Bloomberg Intelligence analyst James Seffert joins us to discuss. James, what are South Korean officials debating at this moment? What might they do to the country and ability to access ETFs?
Yeah, I mean, I think they're debating everything under the sun, trying to see whatever is within their purview to actually limit these things. One thing we know is they increased the size of your account limit, so you need to have a certain amount of money in your account to trade these things. That goes into effect, I think, this month, today, but potentially even. Another thing they're doing is they're going to limit the amount, like the portion of your portfolio that can be in these levered ETFs. They're looking to cap it at 20%. They're looking to require certain levels of education and showing that you understand these things before you can actually trade them. They want to increase the fees to trade these things. I mean, it seems like they're going to try everything they can to kind of put the lid on this leverage gambling fervor that they're facing.
James, kind of whipsawed here because there was such enthusiasm for these products early on. I'm curious, as we talk about SK Hynix's ADR here in New York, before that, I mean, this was the means by which U.S. investors, others could kind of get a piece of these South Korean companies. How did that shift? How did the terrain shift when we saw that ADR debut here in New York?
Yeah, I mean, I don't know if I'd say the terrain shift. I mean, obviously, it hasn't been a great thing since that ADR went live. But I would say that, like, when you look at these levered ETFs, for the most part, people were using ETFs in the U.S. to get exposure to these products. There's a few products like DRAM and a few other ETFs that you could get exposure, South Korea ETFs in general, because when you look at what these things were doing, SK Hynix and Samsung, initially they were 40-ish% of the underlying index. So it's not, people like to talk about the Mag 7 or whatever mangoes or whatever term you want to come up with the large stocks in the U.S. and say it's over-concentrated. In South Korea, 2 stocks at one point in June were made up 60% of the index. I mean, we've never even come close to anything like that here in the U.S. So you end up with these leveraged products that kind of go haywire. The traders start using them, retail investors get heavily involved, and things go crazy. And the ADR listing here in the U.S. just kind of, poured gasoline on that fire in some ways, you could say.
It doesn't help when there are stories in South Korea of retirees dipping into their pensions and putting them into leverage ETFs. And James, I wonder if for that reason, or maybe just a completely different market, a more liquid market, why we don't have the same conversations in the U.S., or maybe we do, about leverage ETFs and their impact on the market and what it means to retail investors. Have various regulatory forces also been looking at the huge amount of ETFs that have listed here that are leverage bets on single names?
Yeah, so the SEC has put out requests for comment on things that they're calling novel ETFs. I would say single stock ETFs fall into that. There's a lot of pundit worry about these things impacting the market. I have written notes that say there are instances of some of these single stock ETFs impacting the underlying, but usually in small and mid cap names. But nothing, it pales in comparison to what happened in South Korea. I mean, in South Korea in June, these single stock levered ETFs were the most traded ETFs in the entire market. That just doesn't happen here. Like, we're talking about tens of billions of dollars here and trading, hundreds of billions of dollars of trading here in the U.S. in these leverage ETF names. It still is not even coming close to touching, the money that we see trading in things like the S&P 500 or the NASDAQ 100 ETFs. So the size and scale of what happened in South Korea and the fervor with which it grew is nothing compared to what we're seeing here in the U.S.
James, insightful as always. Thanks for joining us, James Seffert. And of course, tune into ETF IQ on Mondays, 12 p.m. New York time. Coming up in your hour 2 of Open Interest, Paisley Nardini of PNC Asset Management. Plus, we'll bring you some of my interview with Jersey Mike's CEO, Charlie Morrison, after the company's trading debut. This is Bloomberg.
Today, Wayfair sees immense potential in brick-and-mortar stores.
When we got into physical retail, our view was that, even if the market continued to grow for e-commerce, probably a large chunk of the market in the space would stay offline.
Kate Gulliver showed me around Wayfair's new 150,000 square foot Atlanta flagship store.
When customers who have seen us online come into the store, they're generally a bit surprised by actually the breadth of what we offer. Often if you're going online, maybe you're looking for something particular. But when you come into the store, you walk in, you see the market square, you see all these pillows, you see the decorative accents. So what we're seeing actually is that in store, we do really well in some categories that online are, less a percentage of the total.
How does technology help in kind of making it seamless online to store?
I think
and vice versa.
The biggest thing is for the customer on the front end, that she can be in the store, that she can actually shop here, go back home, complete that purchase. And if you look at these sort of price tags and everything, they're all these digital tags. That's because they're the exact same prices they are online. So you're not going to be surprised that you saw something in the store and then you decided to purchase it online, that it's somehow different and that the offering is different. It's actually very consistent, but when she's here, she can have her app open and everything that she's doing here can be very similar to what she's doing at home. And I think that consistency is quite important.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bringing you up to the minute geopolitical news whenever and wherever it happens. I'm Anne-Marie Hodern in Beijing, China, and this is Bloomberg.
From ABC News, I'm Sherry Preston. Stocks surged this morning at the open. The S&P was up 0.5% right off the bell. The Dow adding about 41 points this hour. NASDAQ showing gains after Amazon reported a much stronger profit in the last quarter than expected. Also collecting some big profits in the second quarter. Big oil.
The U.S.-Iran conflict has reduced tanker traffic through the Strait of Hormuz to a trickle. In response, the major oil companies have raised the price of their refined products, pushing gasoline past the $4 mark. For U.S. and European oil companies, the strategy has worked. Most reported massive increases in second quarter profit as the war drags on.
ABC's Jim Ryan. Exxon profits up 105%. Chevron's profits up more than 300%. President Trump holds a cabinet meeting at Camp David today, and there in the Attorney General's seat will be Acting Attorney General Todd Blanche, whose confirmation is still being held up by two Republican senators, John Cornyn and Tom Tillis.
The senators are refusing to back Blanche until they get written proof that a $1.8 billion fund, which would have paid taxpayer dollars to Trump's political allies, including January 6th rioters, is officially dead, something Blanche already told Congress 2 weeks ago. But that wasn't enough for Cornyn, who claims the White House is standing in his way.
ABC's Jay O'Brien. Senator Tillis says one of Donald Trump's advisors want to revive the fund, which would also provide IRS immunity for the president and his family. A heat dome across the West, putting about 70 million people under warnings. As for the Pacific Northwest, wildfires are the main concern.
Oregon may be started on what could be their worst fire season in history. That's how hot and dry it's been here. What makes this worse? Wind gusts anywhere from 40 to 75 miles per hour.
ABC meteorologist Sam Champion. State of New York suing Kalshi, alleging its prediction market is nothing more than illegal, unlicensed gambling. You're listening to ABC News. Chaos overseas as thousands of migrants surge into a Spanish enclave from Morocco.
Thousands of people swimming around border fences or using boats. A number of them we know have drowned. Spain has deployed its military to try and restore order here.
At least 3 people were killed. It's believed the rush began with a recent Supreme Court ruling, says ABC's James Longman, that those who reach the area by sea cannot immediately be returned without due process. It's unclear, however, if any of those who came in will be able to claim asylum. New details into the death of Nolan Wells, who was found dead after a July 4th boat trip with friends in Mississippi.
Officials familiar with the investigation say the medical examiner has now completed the official autopsy, but it's not been made public. The report will be sent to a grand jury for review. The family's attorney says his team is analyzing audio tapes and ocean data from the day Wells disappeared to try to determine how he died.
ABC's Sophie Flay. People aren't reaching for wine so much these days, and grape growers are taking drastic steps because of it.
California vineyard owners say they've been forced to rip out their grape crops or burn them because of slumping wine sales. They say they've removed thousands of acres, hoping to rebalance the market's oversupply. They blame the slump mostly on a shift in drinking habits. Studies show demand for wine has dropped significantly, especially among younger consumers.
That's ABC's Hannah Battah. I'm Sherry Preston, ABC News.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, Originals and the Bloomberg Business app.
Good Friday morning from the Bloomberg Interactive Broker Studio in New York City. To our worldwide audience, we're streaming live on YouTube and streaming live at Bloomberg.com as well. It's Scarlett Fu, Paul Sweeney. This is the Bloomberg Intelligence program. We got red and green on the screen here. Coming up, we're going to check in with Joanne Su. She is the University of Michigan Surveys of Consumers Director. Got some UMich data out today. Came in a little bit better than expected. We'll break it down with Joanne. Rob Barnett, Bloomberg Intelligence Senior Energy and Commodities Analyst here. We got oil moving higher yet again, up a couple of percent here. We'll break it down with Rob. Joy Yang, Head of Index Product Management and Marketing at Market Vectors Indexes. Discuss her outlook for the markets. Gene Munster, Managing Partner and Deepwater Asset Management, joins to discuss Apple earnings and anything on the tech front. He is a go-to voice. Brandon Williams, Bloomberg's Business on Sport, he's going to join us here to talk to us about what's going on in the world of global soccer. UEFA, FIFA, all this kinds of
Everyone's
people
mad at each other.
Yeah, everybody's arguing. It's just there's like 100 countries you got to keep happy. I don't know what's going on, but Randall will follow it. And a programming note: Bloomberg Radio is introducing a new feature exclusively for Bloomberg.com subscribers and terminal clients. You can help shape our conversations by submitting questions for our analysts and experts to answer live on air. Subscribers can go to Bloomberg.com/askradio to send in questions, and you may just hear them asked on air. That's Bloomberg.com/askradio. There you go. Let's break it all down here. John Tucker and a Bloomberg Business Flash.
All right, guys. Happy Friday. This Bloomberg Business Flash brought to you by IBKR, trade election climate and economic indicators with IBKR prediction markets right alongside your stocks and options. Earn interest in your position. Receive $1 per contract if you're right. Learn more at IBKR.com/predictions. Well, you'd be forgiven if you're a little dizzy at the end of this trading week and month after some intense swings. Beaten down chip makers getting a bit of a bid right now, but even off the best levels of the session, even though the session isn't that old, the stocks right now up 0.4%. Best performing stock in the S&P 500 right now, Amazon up 14%. One of the worst performing stocks in the S&P 500, Apple down 9%. Avalon's going to take a deeper dive into these in just a moment. Roblox reporting second quarter daily active users missing analyst expectations. So this ongoing impact of the new child safety measures, that's having an impact. The shares right now, 29, well, let's call it 30% lower. Overall, everything has just turned negative. S&P 500, there goes my script out the window, down 22 points, down 0.3%, 74.17. The Dow Jones Industrial Average down 134 points, The Nasdaq 100 down 48 points. That's down 0.2%. Dan Greenhouse at Solus Alternative Asset Management, he says he's encouraged by the economic backdrop out there.
I'm trying to find some corporate commentary that says things are not great, and the best you can find is that a couple of companies here or there say things are flat. That's pretty good to me.
And after the Fed meeting Wednesday, 10-year yield right now almost 6 basis points higher, 472. The long bond up 4 basis points. That is at 5.26%. The more policy reactive 2-year, that is up 4 basis points at 4.28. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Scarlett and Paul, what did you say the water temperature was?
72 degrees, Jersey Shore ocean water temp. Perfect.
Oh, yeah. I'll be
and
digging
John,
my toes in the
yesterday,
sand.
It was the cleanest I've ever seen the Jersey Shore water in my lifetime. Chest deep, almost, shoulder deep. Absolutely clear sea at the bottom. Unbelievably.
You can see the bottom. That's our metric.
That's
for,
our metric.
And the air quality is decent now, too. Remember, 2 weeks ago, we couldn't go outside without masks.
It's all good.
Now
Come
it's
down
better.
there, sure. It's all good. We'll have some fun down there this weekend. All right, very good, John. Appreciate that. Scarlet Food, Paul Sweeney live here in our Bloomberg Interactive Brokers studio, streaming live on YouTube as well. Boy, we started the morning with stocks higher. Now they've kind of rolled over. I don't know what's going on out there. Let's check in see what some of the stocks are on the move today. We can do that with Avalon Purnell, color-coordinated Avalon Purnell, equities reporter for Bloomberg News. Avalon, what do you got for us?
We have to start off with Apple. That's ticker AAPL, currently dropping about 9.2% most intraday since last April.
Crazy.
And while Apple did report third quarter results that largely surpassed expectations, bears are largely focused on the misses, mainly Apple's services and also China-based revenue, which fell short of expectations. It also forecast revenue growth that was a little bit weaker than expected. Part of this is all coming from softer mobile gaming trends and also meaningful pressure from the memory crunch. If you remember, just last month, supply chain shortages and also really fast rising memory costs forced Apple to raise prices on MacBooks and iPads. Vital Knowledge writing earlier that the results are underwhelming given the weakness in those segments, especially since services account for so much of Apple's premium PE.
But Apple has a way of turning those shortages into a good thing because people lining up to buy this stuff is always like signaling to everyone else, must have, must have.
I mean, if you're a hedge fund manager and this is your core position, you're buying stock today. And that's on a separate P&L. That, like where I worked, the portfolio manager had the P&L for the main position. The trader had a separate P&L to trade around it. When it got a little cheap, you buy a little bit more. Got a little bit above where you guys thought it should be near term, you sell it, and you take a big cut of that.
So you keep adjusting that position. All right, next up, Avalon.
Amazon, another Mag 7, that's ticker AMZN, currently soaring about 14% most intraday since 2022. And that's after the company reported its 5th straight quarter of cloud computing revenue acceleration. The second quarter results are definitely easing some investors' concerns about how much Amazon is spending to meet that increasing demand for AI. Morgan Stanley writing that AWS delivered accelerating growth, surging profitability, and a better backlog to give the market even more confidence moving forward in the return on investment cost ahead.
All right, one more.
Last one is Replimune, that's ticker REPL, have to bring in a biotech. It is currently surging 91% most intraday since October, and that's after an advisory panel at the FDA voted to support the drug last night. The positive outcome already spurring upgrades at Cantor and also Piper Sandler, which note that the positive vote materially increases the likelihood that the FDA may actually reverse its previous rejection of their skin cancer drug. It really has been a roller coaster ride for the stock this week, though. Earlier, it sank more than 30% after the FDA released briefing documents that showed an uphill battle for the drug. And now after this, the FDA's decision, which could come as soon as later today, some analysts say, could actually end up being positive.
Okay, well, watch for it. Thank you so much, Avalon Purnell, with our movers for today. She is our Bloomberg News equities reporter. And for more conversations like this, subscribe to our Stock Movers reports, 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. We got some economic data at the top of the hour, and it shows that the move lower in oil prices, for the most part in July, is helping to
boost consumer sentiment. In fact, consumer sentiment now at a 5-month high in July, according to the University of Michigan. So Joanne Shu, she is U of M's Surveys of Consumers Director, joins us now from Ann Arbor. Joanne, a 5-month high for consumer sentiment sounds positive, but then when I chart it out, when I look at it on a chart, it looks like we're kind of bumping along the bottom. So just give us some perspective on this.
Absolutely. So we are definitely better than they were in the previous months, particularly with the initial shock of the Iran conflict. And with the recent decline in gas prices that we're seeing from part of the last month, that's definitely something that consumers noticed, they internalized, and it made them feel a little bit better about what was happening on their pocketbooks. But they remain just really frustrated by the persistence of high prices. And yeah, we are really treading water at this point, not as bad as a few months ago, but still not doing great either.
What's the, do we know what the energy swings mean for the consumer here? We know they're important. We know it's a big part of people's budgets, particularly, particularly on the lower end of the economic scale. That's kind of the stuff that you see immediately. How does that impact the sentiment in general?
In general, when we have these fluctuations in gas prices, particularly when gas prices are high, it does affect pretty much all consumers, but it disproportionately affects those with lower incomes and lower wealth. And so what we are seeing is just a surge in the share of consumers who are spontaneously mentioning gas prices during interviews. So this is something that's very much top of mind because most Americans, they can't really avoid gas prices, and it's really affecting the rest of their budgets as well.
Within the report, AI has become what you guys call a salient factor for consumers. What did you learn from consumers about AI?
So over the past year and a half, we've had a gradual increase in the share of consumers mentioning AI during interviews. But that gradual increase actually hides the fact that it's increased tenfold from the beginning of 2025 to now. It's really a mix of views. We have some people who are mentioning the positive effects on stock markets, on productivity, on efficiency, but we also have a lot of negative mentions as well in terms of potential negative effects on labor markets, job loss, and potential negative externalities coming from data centers, for example, possibly increasing electricity prices. So on balance, the mentions are broadly negative, but again, it's about 10% of consumers right now compared to the 30% of consumers who are talking about gas prices.
The outlook for inflation on a 1-year basis, 4.2%, on a 5 to 10-year basis, 3.3%. That's probably higher. That's a lot higher than the Fed would like to see it. What's the inflation concerns out there?
Consumers are quite concerned that what's going on right now with the shipping constraints in Hormuz and the elevated energy prices, that could spill over to the rest of the economy. Their inflation expectations are not as bad as they were in March from the initial shock of the Iran conflict, and they've come down a little bit since then, but 4.2%, we don't really want to see that. 3.3% is still higher than what we were seeing in 2024. And so, consumers really are expecting higher inflation for the foreseeable future.
And before we let you go, Joanne, you also look at sentiment by political party, and there's a huge jump among Democrats from June to July. Do we chalk that up to gas prices?
Well, part of that is that Democrat sentiment was pretty low to begin with. The thing to note is that all three political groups, Democrats, Independents, and even Republicans, everyone saw an improvement in July. So, we're really seeing quite a bit of consensus, and the same increases we saw across all groups by age, education, income, and wealth. So overall, people feeling better than June, but considerably worse than a year ago.
All right, Joanne, thank you so much. Appreciate that. Joanne Shu, Surveys of Consumers Director at the University of Michigan. Here's a red headline crossing the Bloomberg terminal that is interesting. Former New York Fed President Dudley says markets show loss of Fed credibility. That's kind of harsh. When one of your own kind of says the Fed kind of lost some credibility with their actions this week.
Given what Kevin Warsh said and did on Wednesday when he held his second news conference as the Fed chair, he talked a lot about a family fight, the disagreements and the debating within the Fed. But in the end, it feels like he confused the bond market because they weren't quite sure, why the Fed didn't raise rates if he's so hell-bent on containing inflation.
Yeah. The other way, I've heard some folks say, hey, he told us he was going to do this. He told us he was going to pull back dramatically on guidance and, that's kind of what he's doing. But you've got a whole generation of strategists and economists who have been used to the Fed giving them some pretty
spoon feeding everything.
Yep. And there's a new sheriff in town. Maybe that's the way to look at it. We'll have more coming up. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with his Bloomberg Business Flash. So the initial rally on Wall Street that we saw earlier this morning, that's faded fast. Major averages have turned lower. You have, 9 of the 11 major industry groups in the S&P 500 down right now. It's being led down by materials and information technology. Consumer discretionary, the best performing industry group, that's home to Amazon. Amazon.com, best performing stock in the S&P 500, jumping close to 14% after, of course, they reported a fifth quarter of cloud sales growth. And then you have Apple, it's one of the worst performing individual stocks in the S&P 500 right now, tumbling 9%. Component shortages weighing on the sales forecast. And the index of semiconductor stocks, right now, the SOX, it's up 1%. It's been bouncing in between gains and losses this morning. pretty volatile there. Right now, the S&P 500 down 15 points, a decline of 0.2%. The Dow Jones Industrial Average down 116 points. That is down 0.2%. The NASDAQ 100 pretty much flat. It's up only 4 points right now. And as far as bond yields, 30-year, the long bond up 4 basis points, 5.25%. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Scarlett and Paul.
All right, JT, thank you so much. We appreciate that. Scarlett Fu and Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well here. All right, we got oil up again here. We got WTI crude oil at $85. My question is, why isn't it even higher, like a lot higher? Because there is no crude getting through the Strait of Hormuz. I'm not sure that thing's ever going to be opened up again like it was before. So let's check in with an expert here. Rob Barnett, the best hair on Global Wall Street. He's also a senior energy and commodities analyst at Bloomberg Intelligence. Rob, why isn't oil higher? Because, boy, I just don't see, again, any oil getting through the Strait of Hormuz, maybe ever again. I don't know. The Red Sea, I don't know about that either. What's your take here?
Well, so the really bullish predictions have turned out to be wrong, and I think the market has proven to be much more resilient than folks anticipated at the start of the conflict. And in many ways, I would characterize this as a story about how the economy is much less dependent on oil today than it was during the big shocks in the 70s, right? So oil contribution to GDP tends to get lower and lower every year. And so what you're seeing is that perhaps the world can adjust and live with less oil. It seems to be that's the narrative. But, when I look at the price trajectory over the last month, we started at 70, we hit over 100. Now we're closing out the month at 90 for Brent. And really, it all comes down to geopolitics. You can kick out your supply demand models. You can everything that, you might think about in a economics 101 context. None of it matters. It just matters, are we at war? Are we not at war? Is the Strait open? Is it not open? Does the Red Sea matter? These are the questions that are really driving the market.
So things like OPEC, OPEC plus, different countries' strategic oil reserves, those don't matter at all?
I think, look, in equilibrium, all of those things matter, right? So if you have a coherent view of the oil market, you certainly are thinking about what's going on with inventories. The Strategic Petroleum Reserve in the U.S. is at lowest point in decades right now. Normally, that would be a very bullish indicator for prices, right? And so, to Paul's point, why haven't prices gone higher? I mean, I think there's the market is reconciling a couple of things. One is that the physical market's very tight today. We don't have enough oil to go around. But there seems to be this sense, well, if everything gets resolved in some way and we get normalization in the Middle East generally, then we end up just flipping to an oversupplied situation in, say, 2027. And so you've got very tight physical market. Everything is sort of screaming red alarm fire right now at the current moment. But if we get a peace deal, if we get normalization, then we're going to be swimming in oil in 12 months. And so I guess $90 is the reflection of those two very different kinds of signals.
If I'm Lloyd's of London or some insurer that's got to insure these big boats that get the energy in and out, there's no way I'm doing that. I'm not going to insure anything. I don't care what Iran says. Is that a downside scenario? Is that a realistic scenario? I'm kind of asking, is the Strait ever going to be open again?
It's a great question. And certainly we've been thinking about that, right? I mean, one of the perhaps enduring outcomes of this conflict, no matter whether we get a peace deal next week after, years into the future, right? There's going to be lingering questions about insurance. already any operator that's going to take a vessel into that region is going to be charging much higher rates for operating there. I think what you might see emerge is that some of the countries in the region might have to offer some kind of sovereign backstop on shipping through the region. So you raised the question around Lloyd's, but what if Saudi Arabia, UAE, these countries have deep pockets? Maybe they have to back the shipping in ways that they hadn't had to do in the past.
Rob, really appreciate your perspective here. Rob Barnett, he is our senior energy and commodities analyst on oil. Next hour, we're going to be talking to Vincent Piazza about ExxonMobil and Chevron's latest results. Yep, because they came out with their numbers. All right, let's move on to the markets overall, because it was a collision of macro and micro factors this week. We had the Fed, we had specific earnings from big tech companies. So we want to welcome right now Joy Yang. She is head of index product management over at Market Vector Indexes, and she joins us right now in our Bloomberg Interactive Brokers studio. Joy, great to see you.
Thank you, Scarlett.
So we have this collision between macro and micro, and investors are left to deal with a lot of different factors, grapple with a lot, and we're seeing a bit of volatility as we close out the end of July. What's going to be the theme for the rest of the year? I mean, has macro overtaken micro because there's just so much confusion?
I know what we've seen is these two headlines dominate, media attention, investor attention, which is AI and geopolitical risk. And largely, markets tend to ignore macro shocks because they don't seem to get in the way of the market trending up. But this week, we're seeing AI, big tech earnings, Fed announcements all collide into one, and that's created this volatility and this great unwind and leverage plays we've had in this optimism about AI, which now cannot ignore, these headlines just keep coming back, whether it's the Iran war, tariffs, or inflation. So as you said, Paul, when is this strait going to open up? And I think we can't ignore that. So investors have to refocus back on costs, not just how big AI is, but how much is AI going to spend on costs. So we've seen this week the differentiation between how investors are looking at Amazon versus Meta, or Google versus the players that are more disciplined around their spending and costs.
So how are you guys? Again, we did have a bunch of the big tech companies report, and Amazon traded up, but Meta traded down, and Google traded up. Kind of all over the place. Or Apple's trading down a little bit here today. What did you learn? What did you take away from that may continue to inform your AI call here?
I think it's important to think about costs, not just this financing costs that are going to become higher because interest rates, inflation is still out there, but also just this kind of revenue circular dependency we have between hyperscalers and the whole value chain. What happens when they stop growing, when they stop their CapEx flows? How does that impact semiconductors, data centers? And then we have to think about hidden costs. We're just now learning about the SPVs, the private credit that's coming in, off balance sheets, and people are focusing on that. But also, with this unleveraging around the world, I think it's good to kind of have this cleansing, because I think we're having this reset. People are repricing their outlook on risk. People are rethinking how to look at costs, versus just focusing on revenue.
For the hyperscalers themselves, though, the costs will keep adding up. I mean, no one is saying there's going to be a slowdown in how much they spend, and they're going to have to borrow a lot of that money. And we see that in the U.S. credit markets and increasingly in overseas credit markets. At what point does it become too much, where the borrowing costs become, I don't want to say prohibitive, but something that causes them to rethink their strategy? Would it?
I think, they have to rethink their strategy, and investors have to, because now they have this, risk exposure both on the equity side as well as on the bond side. So, their total portfolio is going to be highly correlated to these macro shocks. And if that continues, then it will have an impact on the cost side, on the debt side, and certainly on the financing and maintenance of AI infrastructure.
Okay, so this week was really dominated by the big tech names, the AI story. How about folks that might be looking for opportunities, maybe value outside of the AI story. How do you guys think about that?
I think, it went quietly unnoticed, but, we had strong earnings from, whether it's Coca-Cola or Starbucks, so these are the, boring consumer staples or consumer discretionaries. And I think people have to focus outside of the opportunities around large tech, and consumer staples have been strong performers year to date. We've seen strong performance in small caps, so equal weighted S&P has outperformed the market cap weighted S&P. We've also seen cheap AI relative plays outside of the US, and I think with the return of DeepSeek, of Moonshot, of CXMT, investors are taking notice that there are cheaper opportunities out there. And with China funding their own AI infrastructure, we look at our China semiconductor index, it will start to diverge from US semiconductor index.
Speaking of Asia, I think about what's happened in Korea, and that market is just bananas. All over the place, right? Up 16% overnight. Earlier this week, it was down 10%. We know South Korea is a market where retail investors play a big role. That's increasingly the case in the U.S. Is South Korea kind of a picture of what the U.S. market could become down the road?
I think definitely the volatility and how much it's attracted leverage, single stock ETFs has amplified that volatility. But you have to think year to date, that market, Korean market is still up 50%. These SK Hynix, these semiconductor indexes are still up over 100%, even after they fell, 30, 40% over the last few weeks. So I think it's a wild ride, but this is the volatility of the space that people are playing in.
All right, Joy, thanks so much. Appreciate it. Joy Yang, Head of Index Product Management at Market Vector Indexes, joining us live here in our Bloomberg Interactive Broker Studio. Kind of red and green on the screen here, no direction. We started out strong this morning. We sold them off. And now we've got kind of no real movement in the S&P, the Dow, and the NASDAQ.
Although small caps, which had been outperforming the big caps, is laggard today, with the Russell 2000 off by about 1%, while the S&P is just marginally lower.
Yep, I'm keeping my eye on the bond market. We've got the 10-year Treasury up 5 basis points here, so we're 472 on the 10-year. Keep an eye on that one. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. You know what really stood out to me? I just checked the volumes. Very high volume trading day today.
On a Friday?
On a Friday in July. The end of July. Major averages, they were higher earlier. They turned mixed, a little changed at this point. The S&P 500, you had, well, let me check exactly, 177 stocks higher, 324 are lower right now. And of course, Amazon remains the best performing stock in the index with its fourth biggest weighting in the index, keeping things afloat with a 15% pop after the earnings, where we learned they enjoyed a fifth quarter of cloud sales growth. The Mag 7 index up right now. The Bloomberg Mag 7 index up 1.5%. And if you didn't get enough of Dan Ives at Yorkville Ives, he sees the AI investments by hyperscalers definitely paying off.
As long as you're showing these numbers, the CapEx, investors are fine and willing and understand why they're spending. And I think that's where the narrative from this earnings season, what we've seen across the hyperscalers, worrying about monetization across tech, but now you're starting to see it.
The S&P 500 dead flat, 74.38 right now. Dow Jones Industrial Average up 3 points. NASDAQ 100, 41 points lower. That's up just about 0.2%. Back to the yield space with a long bond up 4 basis points, 5.25% on the 30-year. Polls of American voters consistently have showed housing costs among their top priorities. And here's one, kind of a sleeper issue. I don't know, maybe not, but home insurance costs, making already expensive housing unreachable for some, and Americans starting to notice. So 58% of voters say rising home insurance costs are making them more likely to turn out for the midterm elections. This is a poll by the comparison site Insurify. Home insurance premiums have risen 46% since 2021.
So what's the thinking here, that you want policymakers to pressure insurers to reduce the cost of your insurance?
I don't know. I mean, I was dropped by, who's the big one?
Allstate, State Farm?
Allstate. And because I'm like, you know, within a mile of the water.
Yes.
So
they're all worried about flooding.
And boy, they gave me every excuse. You don't have shutters. You don't. I'm like, you know, whatever.
Well, when I owned a home in Carmel, California, I got dropped 3 times. So fine, because of the fires. Finally, I was going with Lloyd's of London, the same people that insure like these tankers going through the Strait of Hormuz. It was like, you got to be kidding me. But it's a scam.
Oh, wow. Well, now I'm secure because I have Joe's Insurance of New Jersey.
Yeah. All good.
All right, good stuff. John Tucker with our Bloomberg Business Flash this morning and other stuff. It's always the other stuff that takes up most of our energy and time, which I appreciate. Going back to the markets, the Dow not doing anything, the S&P not doing anything. But within the Dow, the best performer is Amazon, up almost 15%. The worst performer is Apple, down about 9.3%, following yesterday's quarterly results and the outlook. Gene Munster is the authority on Apple. He is managing partner at Deepwater Asset Management. And of course, years before that, he was a sell-side analyst on Apple, one of the most well-known. Gene, good to speak with you. Partially, I'm guessing that Apple's decline today, outsized decline, has a lot to do with the fact that it was an outperformer in the lead up to these results. What did we really learn from Apple that can be attributed to decisions it made versus things that are beyond its control, like really high memory chip prices?
Well, this is less about the high memory prices and more just some numbers about where the guidance is going. So, Scott, just to take a step back, they guided to 12, or the street was at 12% revenue growth through September. They guided to 9 to 11. Now, when you find this subtraction key with a company, a stock that's been up 22% over the past month versus the NASDAQ up 1%, when analysts go to that subtraction key, that is negative for the stock. There's just no explanation that can get investors comfortable. And I think that's kind of where the conversation ended. But I want to go through that a little bit and answer your question about like what's the substance of what's going on? Is this about memory costs? The answer is a little bit about memory costs. Maybe if you think about the 10% decline, probably 1 or 2% is about just higher memory costs. It's going to have a 50 bips negative impact on their margins in the September quarter. The bigger picture is on revenue. And effectively what happened, this is a pretty unique dynamic, but it makes a ton of sense, is that the iPhone has been on fire. It was up 22% in the June quarter. If you look at over the past year, it's been up 22%. That compares to over the past 5 years, it's up 3% on average. So we've got this huge surge in iPhone demand, and separately the Mac up almost 30%. Typically it's up a few percent. And what that means is that they have essentially been pulling through inventory. Remember how tight inventory is? In part because of these pricing deals that they have to try to keep costs low. They're limited to the amount of capacity that they've had. So they pulled inventory essentially from September into the June quarter. And that means they just simply don't have as much. And the way that I'm going to back test this, and it'd be pretty easy for your listeners to do this, is just look at what the lead times on the products are. Right now, they're running a few weeks. Now, that typically would be same day on many of their products. And that's an indication that they are, in fact, constrained. And so effectively what happened is they stole demand from the September quarter and pulled it into the June quarter. There's still a ton of demand out there, stole supply, and pulled it into the June quarter. There's still ample demand. And I think at the end of the day, just to put it in the most basic terms, Street was at 12% revenue growth for September. If they would have kind of had currency constant and supply constant, I bet they would have guided to better than 15% growth for the September quarter.
So, Gene, you were busy this week, as a lot of tech investors were, with all the earnings, but I got to ask you about this story. Wall Street Journal story about Tesla spinning out its China business to maybe pave the way for a SpaceX merger. Does that seem reasonable to you?
Yeah, I would say it's reasonable. And it is going to increase the probability that I have put on this happening in the next few years from 90 to probably 92%. Okay. About a week ago, I had it at 80%. And then the Tesla earnings call, they let a question in about the two companies coming together, which surprised me. Elon started to answer the question, and then legal took over and said, really, we can't say much. And then Elon grabbed the mic back and started to kind of pontificate about the benefits of these two companies being together. That took me from 80 to 90. Now I'm at 92. And the answer is, it just makes a ton of sense. Like, this China piece, I think, is grossly underappreciated about the tensions from the technology companies geopolitically, as I've been meeting with many companies that have ties, and these leading private companies that have ties to China. It's pretty clear that they want as much separation as possible. And so my view is that we're probably a couple years away. Elon's has always structured the China business to be easily separated from the U.S. business for a lot of reasons, and one of them is his master plan. It's very simple. He's going to just keep rolling up his businesses into a master company. And so to answer your question, Paul, is I think that this it makes a ton of sense. And even though they're saying it's not going on, I think it very much is in the cards.
It sounds like it'd be good for Elon Musk from the way he operates and runs his company. Would it be good for investors?
Now, that's the key question. And I think the answer is the simple answer is yes, from two levels. On an operational piece, which is most important, is that when you bring things together, you reduce redundancies. And there's this long-standing view within tech companies that are highly innovative that smaller teams are more effective. And so when you have smaller, tighter teams, and effectively you can do that, I think that's one piece of bringing all these together. I think their visions are very similar, obviously around being AI first, space AI with SpaceX, physical AI, terrestrial with Tesla. All of that makes sense. The other reason why I think investors would be rewarded is that the dynamic around Tesla and SpaceX, to a lesser extent right now, is really about investor confidence around the long term, retail investor confidence. And I think that unwavering confidence would only increase if they brought some of these together. And that has really explained how Tesla can still be a $1.2 trillion company despite having many of its targets pushed back for years. And so I think you put these two together, it would undoubtedly be the biggest company. I think you put them together, I think the path to a $10 trillion company is well laid at that point.
Oh, there you go. Geez, that's kind of what a lot of the folks are thinking about. Gene Munster, thanks so much for joining us. As always, appreciate getting some of your time. Gene Munster, managing partner, Deepwater Asset Management. He's based out there in Minneapolis out there. So good stuff there. S&P up 11, Dow up 25, NASDAQ up 110. That's 0.4%. So kind of bouncing all around here this morning. So we'll keep an eye on that. Coming up, Randall Williams, Bloomberg Business and Sports reporter. What's going on with FIFA and UEFA? Am I even
So
pronouncing
much.
them right?
So
I mean,
much.
so much going on. We'll have that coming up.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
Scarlett Fu, Paul Sweeney, live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Let's get right to it. FIFA has plans to privatize some of its commercial business. I think I've got that right. Okay, that's the global FIFA. UEFA, they're the European dudes. They're not happy with it. And look at this. Just across the tape, I think this is AP. Senior FIFA official resigns over Infantino's World Cup sell-off plan. Second says it deceived staff. Wow. Randall Williams joins us here, U.S. Sports. This is a big story, Randall. This is global soccer. We just finished with the World Cup. People have a great appreciation for football maybe now than they had before the World Cup. What's going on here?
Listen, FIFA's trying to make as much money as they possibly can. And, you know, for me personally, I thought the World Cup was going to come to a close. I would be able to take a deep breath. But obviously, we're witnessing a global fight right now. We have FIFA, who is over the World Cup, which is the biggest, largest tournament and the most famous tournament. It's the one the players love the most. It's the one that the teams participating, they have a deep desire to win it. But now they're saying, you know, we can raise up to $4.2 billion from Joshua Kushner, Strive Capital. And, of course, he is the son-in-law of President Trump, who, you know, FIFA catered to.
Brother of the son-in-law.
Brother of the son-in-law. Thank you for correcting that. Who, you know, FIFA catered to President Trump all while he was here. And you have UEFA, who's over many of the countries who were participants, France, England, Spain. So many who are just like, hold on, enough is enough.
Enough is enough. So UEFA is now talking about boycotting the World Cup. That's not for another 4 years. So is this kind of an empty threat? Because there's a lot of time between now and the next World Cup.
I don't think it's an empty threat. I think that they're very, very serious about this because CONCACAF, who is over in North America, Central America, and the Caribbean, is also in it. We have yet to see what South America has to say as well. And so if everyone raises their hand and says, we're done with this, then now, of course, these are membership organizations. These aren't the members themselves. But, of course, to be a part of UEFA, you have to be a member, and I think FIFA as well. So if England, France, Mexico, the U.S., all of these organizations are saying no, who is going to be participating in this World Cup? And it's not just the 2031, it's next year's Women's World Cup that, of course, is top of mind as well.
One of the surprising aspects to me is JP Morgan is advising FIFA here. I'm surprised JP Morgan would get within a million miles of this.
Well,
it's not a lot of money, and the potential political fallout is ugly. Yep.
It's true. That's true. However, JP Morgan tried to do the Super League years ago that fell apart as well. Context. And then outside of that, the upside is tremendous. You know, FIFA's talking about expanding the World Cup to 64 teams. I believe there was a report from the Times of London that just dropped a couple hours or maybe minutes ago that said that they're trying to do this by August. And the vote for this $4.2 billion would be in September. So who stands to profit between now and then? If you expand it before this investment goes in, of course, the investors immediately make a ton of money.
Your colleague, Giles Turner in London, wrote a really interesting newsletter where he said FIFA's mistake was to value its spinoff at $20 billion. What it should have done is value it at 5 times that amount and make it so that the members, each country, would get even more of a payout so that it'd be uneconomical for them to say no.
We were talking about this before, we went live. And if you are France, if you are England, if you are Spain, if you're Portugal, if you're Croatia, $20 million is nice, but a good portion of these soccer federations can make that money in their sleep. And $100 million goes a long way. You can, might be able to build a training facility. You might be able to hire coaches that can better develop talent, all of those things. Whereas 20 million, I'm not so sure.
It's harder to say soccer's not for sale if you get 100 million.
Exactly. And of course, you have to remember that some of the issues that exist in global football outside of Europe are often the money distribution. So after you send this check, who's going to be distributing the money? Is that person going to be like, oh, we got $20 million. I'm going to take 5 of it. Oh, no one's looking. I'm going to take another 2.5. And now, you have 12.5 left to distribute amongst the players, amongst other officials and everyone else like that. There's no governance over that. It would just be a blank check to these federations, and then they would have to deal with it. So it's on life support, I would say.
Is UEFA and the other critics of the FIFA's plan, are they critical of the fact that they're selling a piece of FIFA in general, or is it to whom they are selling?
I think it's both.
Okay.
I think it's both. Number one is that if you were going to sell a part of this, then you would want to consult them to begin with. You would want to consult UEFA. You would want to consult CONCACAF. Say, hey, we're thinking about doing this. Then you could say you could get some preliminary thoughts on it. Everyone was shocked, a week ago or earlier this week when they dropped this and said, you know what, we're going to be raising this money.
But your reporting has shown that these discussions have been going on for a while. It's not like it was last week.
Exactly. So now that makes you think. You go back all the way to December of last year, President Trump gets a peace prize. And then we have, these different wars that go on. But also, how long has FIFA been considering this, knowing that this was going to be the most successful World Cup of all time? And why did FIFA not have conversations with other private equity firms, such as CVC, such as a Sixth Street? There's a bunch of them who might be interested in doing this, but those conversations probably did not happen.
It's called running a process. Why did they not run a process? And the process is, here's a pitch book. We're going to send it out to 200.
You cover yourself, right?
Yeah, and do it. And then you create competition. You drive up the value and all that kind of stuff.
And you brought up JP Morgan really quickly. What about the other banks?
Yeah.
Why? And not saying there's anything wrong with JP Morgan, but I imagine that there are other banks who might want to be in this, and they're not.
Interesting.
So many questions and so much anger.
Exactly. Randall, thank you so much for joining us. Randall Williams, he covers the business of sports for Bloomberg News. And again, not a quiet time after the World Cup with this news story breaking. In the world of global soccer, this is big. This goes to the existential kind of aspect of who's running things out there. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM channel 121 is presented by Golden Crest Metals. Stay tuned for the latest market news and industry research. The next hour of Bloomberg Intelligence starts right now.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
Concern about rising prices spooking investors.
What does renewables investment look like in the U.S.?
More tariff talk coming out of this administration.
Breaking market headlines and corporate news from across the globe.
The president wants lower interest rates. He wants a rate cut cycle.
How do you broaden out the AI play?
Are people just looking for something to worry about when it comes to China?
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, Originals, and the Bloomberg Business app.
Good Friday morning, TGIF from the Bloomberg Interactive Brokers Studio in Midtown Manhattan. This is Bloomberg Intelligence with Paul Sweeney, Scarlett Fu, and John Tucker. All right, we have a lot to react to, certainly earnings, as well as oil prices. It's the end of the week, end of the month as well, so a lot to discuss when it comes to markets too. Coming up in this hour, we've got Vince Piazza. He's our senior equity research analyst talking to us about Chevron and Exxon's latest results. They did report today, and of course, Exxon and Chevron seen benefiting from the movement in oil prices over the last couple of months. We also have Tom Keene making a return to the studio.
Wow.
I know. He's coming back with his man bag. He's going to talk to us about what we're going to look forward to, what we're going to talk about in Bloomberg Money today, airing at 12 p.m. New York time on Bloomberg Television. Cool. Eric Kazatsky is our go-to guy for Munis. It is Munis in Focus. He's going to talk to us about the latest developments there. He is, of course, with Mackay Municipal Managers. And Frances Newton. She is our economic strategist and CIO of Tuttle Wealth Partners, in town to talk about, just to take stock of everything that we learned this week when it comes to the macro drivers in the market and the micro as well. Earnings, the Fed, geopolitics, all of that. Of course, we want to remind everyone that for our listeners, if you want to participate and engage with us, Bloomberg Radio is introducing a new feature exclusively for Bloomberg.com subscribers and terminal clients. Help shape our conversations by submitting your questions for our analysts and experts to answer live on air. Subscribers can go to bloomberg.com/askradio to send in questions, and you might just hear them asked on air. That is bloomberg.com/askradio. All right, let's head over to John Tucker for Bloomberg Business Flash.
All right, let's start with this, Scarlett. Earnings season past the halfway mark, so time for your earnings report card. 86% of the 291 S&P 500 companies that have reported have beaten estimates. So this tracks the highest pace in 5 years, according to Bloomberg Intelligence. And I sound like a broken record with these, but the best performing stock in the S&P 500, Amazon, one of the worst, Apple. Amazon revenue jumping 37% at the Amazon Web Services. And what that generates about a fifth of the company's revenue, most of the operating profit there. So Amazon is up 14.7%. Different story for Apple, tumbling by the most in 16 months. They had shortages, component shortages weighing on the sales forecast. Meantime, Victoria Fernandez at Crossmark Global says investors facing lots of questions.
Do we buy chips? Do we not? Do we buy memory? Do we not? With the volatility that we're seeing in these markets, I think that's going to be the biggest conversation people are having. And really and truly, we need to be tactical. It's what we're doing for our investors. There is so much going on underneath the surface right now.
Big volume day also. S&P 500 up 6 points right now, 74.43 on the index. The Dow up 56 points. The NASDAQ 100 54 points higher. That's up about 0.2%. 30-year yield continues higher, up 5 basis points right now at 5.26%. This one's kind of scary. Halloween getting an early start this year. Hershey's hoping this means a sweeter season ahead. Sorry. The candy giant says the rise of, now this is what they're calling it, Summerween. Please.
What?
So this gives the holiday a longer runway. Hershey says 67% of parents have already purchased Halloween candy. More than half are in Halloween mode well before, no kidding. The number one Halloween candy, by the way, what is it? Want to guess?
Reese's Pieces?
Reese's
peanut butter cups.
Yeah.
Which they've diluted by not using real peanut butter and real chocolate.
What?
Yeah, there was a story about this in Bloomberg Business Week. Yes, because all of this costs money, and they need to reduce costs.
I like to freeze mine.
Yes.
Oh, really? I have
Yes.
not tried that.
Oh, no. At least refrigerate them. You don't want to eat them when they're like all mushy.
Yeah, that's true.
During-
Are there some upstairs? Sometimes
during-
there's some upstairs.
Okay. Happy Summerween. We check the markets for you all day long. Right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Scarlett and Paul.
All right, John Tucker, thank you so much. We appreciate that. As John was just reporting, we got some green on the screen here. It's Scarlett Fu, Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Let's take a look at some of the stocks on the move today. We can do that with Tatiana Darrier, strategist for Markets Live. Join us here in our studio. Tatiana, what are you looking at today?
Well, we'll start with Apple, as it was a big earnings week, as John mentioned. Shares under pressure. They're 9% lower after earnings, and guidance was a little bit shy of earnings of analyst estimates. So earnings for the third fiscal quarter were okay. However, looking ahead, the company said revenue will rise 9 to 11%, which is lower than the estimated growth of more than 12% that analysts were expected. However, this is not a demand issue, but rather it's a supply issue, as they cannot get a handle on enough computer processors and enough memory chips, as we've heard all along, and this is leading them to times for their products, hence to this lower outlook. But the good news is that this company is a cash cow. $32 billion and free cash flow there. That's more than Microsoft, Meta, Alphabet, and Amazon combined, with the disclaimer that the latest two have posted negative cash flows. But that discipline not rewarded today by investors.
Certainly not. Worst performer in the Dow Industrials. What's next?
Well, Amazon is doing quite the opposite here, surging 15% after its report, after it posted accelerating cloud revenue for the fifth straight quarter here, helping ease some of those concerns that AI bets are not paying off. Revenue jumped nearly 40% to over $40 billion at AWS. This segment now generates a fifth of its revenue, and it's the leading source of operating profit. That marks the fastest pace of growth since the fourth quarter of 2021. So investors really rewarding the company for its growth, even as it has boosted its capex to $220 billion from a previous estimates of $200 billion. And despite negative free cash flows, we are seeing Amazon truly rewarded here today, and that may be because it has been lagging this year.
NVO, what is that ticker for?
That is Novo Nordisk, as ADR's shares are down by 9% here after one of its experimental drugs failed to reduce the risk of heart disease and strokes in a large study. It did target the protein that it wanted to in the body. However, it didn't post that significant result when it came to cardiovascular problems. And this is really a blow to the company as it tries to diversify away from those obesity drugs, as that market got really, really competitive. And if you look at the stock, it has been lagging this year, but if you really zoom out, you'll see that the company really needs a new source of growth because shares have been lagging badly since that peak in 2024.
It's remarkable, given this company had the first mover advantage.
I know, that's a good point. Usually you can keep that for a while. Tatiana, thank you so much. Appreciate that. Tatiana Darrier giving us the big report here from Working Conversations like this. You can subscribe to our Stock Movers Report. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. Earnings coming out of the energy patch here. ExxonMobil, Chevron, some of the big boys reported here. Let's get in touch with an expert on this stuff. Vincent Piazza, he's the senior research analyst. He covers all the oil and gas companies for Bloomberg Intelligence. No idea where he is. It could be Philly, Princeton, Wilmington. You never know where this guy is. Vince, what's going on in your world of big oil?
And good morning from Wilmington, Delaware. But it's always sunny in Philadelphia, remember
there
that.
You go.
Yeah, so look, if you think about coming into the quarter, Exxon and Chevron, significant optimism coming into the quarter, just considering where we are on WTI and Brent. But, Chevron posted a much, much cleaner quarter operationally. Significant free cash flow, buybacks and dividends were up. The debt side, Chevron bought back roughly $8 billion of debt. So Look, strong quarter operationally for Chevron, a little more optimism coming into the quarter for Exxon. It's down roughly 2%, little softer on the downstream side. But Paul, combined $32 billion of free cash flow in the quarter for both companies. You're getting that back in dividends. You're getting that back in buybacks as well. But for Exxon, Paul, a little bit more of an impact from Hormuz in 3Q. Some thorny issues